very good morning. You're watching India Market Open, and we need a mood lifter in the markets right now. After the kind of down day that we had yesterday, there is consolidation, and then there is what we saw in the closing session yesterday. So a bit of a pain point there.
I think there are a lot of interesting trends that are coming out from the debt markets globally. Japan is seeing some interesting moves. Yields are moving higher. US as well. Today there's going to be an auction of 20-year bonds to see where the foreign institutions are buying. And that, I think, will be a trigger to understand whether the flows are going back into the US or staying out.
So what about 10,000 crores in FII outflow yesterday? They've sold after a while. And some of the reasons could be, and what to watch out for, which might be a bit of a dampener for Indian markets, is exactly what Alex said. The 30-year back again very close to the 5% mark. Now, if you're seeing treasury yields go up, they become an alternative investment destination, very simply put, for global investors, and then you see them pulling out of equity, emerging markets, especially like India. The other one, which might be a bit of concern, not quite yet, but maybe, is just that rise in COVID-19 cases again, Alex. And I found that a little, worrying, because yes, cases in Singapore, Hong Kong being reported, this new variant on the block, this JN.1, it's a Omicron descendant in parts of Asia. I think 250 odd cases, 257 odd cases in India, mostly mild, no hospitalizations required, but 2 deaths have been reported. Yeah,
and I think it's important to think about the safeguards that we put in place, and I think a lot of people have forgotten about that. Just basic, wash your hands, all of those things. Keep a safe distance if you have some of those symptoms. Yeah. Basic things. Yeah, basic things might need to come back. So this is something we'll watch and wait for. It's not something which will likely panic the markets, but it's something that we need to watch out for. Let's pull up the implied open before we move ahead. Remember, it was a down day yesterday, so you might see a bit of a pullback, but the implied open can be very deceptive. Yesterday, we were supposed to open with a 100 points gap up, and what followed through the day was quite different. So global cues right now become quite important, and no major signs coming in. So US markets have given up pretty much all gains overnight. All 3 indices ended in the red, mildly so. No massive drawdowns. The Dow Jones was about 100 points odd down. All eyes are now going to be on Trump's attempts to pass his budget bill. He's calling it the beautiful bill. So we'll wait and see what that tussle looks like in Washington. That becomes important from a US markets perspective. Bond yields continue to move higher, the 30-year at 4.97%, so too close for comfort to the 5% mark. The 10-year at 4.48%. Higher bond yields, not great news for emerging markets, including India. Crude prices have rebounded on Ukraine-Russia ceasefire hopes, US-Iran talks as well. Brent is above the $66 mark. Asian markets have opened in the green. Japan's export data, though, is lower than expected. So that's why you're seeing a bit of a downtick on the Nikkei. Export growth has slowed to 2% as US tariff has shown impact. So that is one of the things that is showing a bit of pain as far as US markets are concerned. But for an exclusive conversation now, a strong vote of confidence for India has come in from Moody's as they've underlined the country's economic resilience, saying it's driven by robust domestic growth and a vast internal market. Despite global uncertainties and US trade tensions, India's low reliance on exports and a thriving service sector act as an effective buffer against external shocks, says this Moody report. It also highlights significant government investments in power, transport and digital infrastructure, poised to sustain GDP growth over the next 5 to 7 years. To talk on this, I'm joined now by Nikki Dang, SVP at Moody's Ratings, for this exclusive conversation. Nikki, thank you so much for speaking with us. Very good morning to you from where we're sitting. Take us through what the key view is coming in on India in relative terms.
Yeah, thank you for having me today. Yes, indeed, as I highlighted, the report highlights India's unique position among this global trade turmoil because of the few factors you mentioned. That is, smaller exposure to the U.S. Goods exports, and plus the strong domestic growth drivers, including large domestic market and very robust domestic assumptions and recovered domestic consumptions. And just to put things in perspective, India's goods exports to the U.S. only accounts for less than 3% of GDP. That that really compares to, the high single digits or even over 20% of some of the emerging peers India's got there. So it's much smaller exposure here. And another thing adjacent to export, that is, India has a growing share of service exports, and it's growing to almost accounts for half of, the total exports of the country. And just keep in mind, service exports is not really subject to this current tariff play. And one last thing I want to mention is the large domestic market and domestic consumption. It's the nature of India's growth drivers, and this is further bolstered by the government supports fiscal policies such as the personal tax cut announced in the budget.
Nikki, so to put all of that into a number that everybody looks at, what is your assumption of economic growth for India in the context of concerns, worries about global growth, even though you have a few pockets of strength here and there?
Well, yes, indeed. After the observation of the turmoil coming through the market, after the so-called Liberation Day with high reciprocal tariff announced by the U.S. administration, in our early May release of our new forecast, we did cut across the G20 growth forecast collectively to 1.9% from 2.5%. For the emerging market in particular, it's down to 3.6% for this year from 4%. India, on the other hand, it did suffer a smaller cut. Our view now is for the calendar year 2025, our forecast is now down to 6.3%. And compared to our 6.7%, the number released in February of this year. And just keep that in mind, India remains the fastest growing economy among the G20. So there is definitely the downside play by what's going on in the rest of the world with the trade disruptions whatsoever, and also the balancing it off with the strong momentum domestic growth drivers is putting in, and together with a favorable credit conditions domestically.
Nikki, I'm wondering, in terms of GDP outlook for India, one key factor which is yet to play out is whatever the bilateral trade agreement is between India and the United States. How do you see that impacting? One thing is for sure from all, from everything we're hearing so far, we're going to definitely end up at a lower rate than 27, where we are right now. Do you think that would be a clear enough indicator to boost GDP outlook for this year, or we're not really seeing any impact one way or the other of the current tariffs?
I think that's definitely upside for India's growth, and especially for planting India's economy more into the global supply chain, right? So we saw early May, India and UK secured the free trade agreement, and the trade deal really suggests the trade liberalization is becoming a pillar to the broader policy response to the U.S. Tariff shocks in here. And this is in contrast to India's historical moves where more protectionist the trade policy is in place. And with the continued negotiation with EU and the US, latest news has Commerce Minister just finished the 4-day of a trip visit to the White House, and with a now 3-phase timeline, with an initial pact signed with the US expected before July, and the comprehensive agreement concluded by the next year. So this is all going in favor of plugging India more so in the global supply chain. And this is a kind of in conjunction with government's manufacturing push, which has stalled, in recent years, where you see manufacturing contribution to GDP kind of is half of where the government would like to see, like 25%, but we're staying at 13%. At the same time, employment for industrial employment only accounts for a quarter of the total employment, compared to high 40% for agriculture. So I think this is definitely in India's favor.
Nikki, I do realize that you don't specifically comment on sovereign rating. So I'm not asking a pointed question. I'm asking directionally, right? So given what we've spoken about India, and also the fact that there is an element of fiscal prudence from the perspective of the government and the way that it has approached its budget, the way that it's spending, corporate balance sheets have improved. Directionally, do you think that all factors are moving in the right direction for a better rating for India?
Well, there are, I take everything you just said, the positive momentums on economic strength, right, for India. But, in terms of again, this is not my subject, I'm not a subject matter expert for sovereign rating. But one thing we do focus on, in addition to the economic strength, is really the physical strengths, right? So we did see physical consolidation gradually coming in for the government. But I mean, the pace has slowed down in the recent, I think, the fiscal year, as reflected in the budget. And I think in order to compare with the peers, right, similar rated peers within the global portfolio that we have for sovereigns, I think the physical metrics are not boding too well or positioning India too well for next rating level.
Okay, Nikki, thanks so much. And for answering that last question in particular, I think a lot of people here in India are looking at this very closely. But the outlook that you pointed out to will also bring a smile to a lot of faces today. Thanks so much.
Thanks very much.
All right, let's talk about what occurred in trade yesterday. And in fact, it was an interesting day of trade because and Tamanna pointed this out at the start, foreign institution investors turning net seller and selling the most in a single day since the 28th of February. 10,000 crore rupees, more than that, on a net basis was sold by foreign institutional investors. Of course, domestic institutions buying over 6,000 crore rupees worth of equity on a net basis. Indian equities dropped on account of that heavy selling, and there were a few very large names, the likes of HDFC Bank, Reliance Industries, seeing very significant delivery volumes as well. So that played a part. We'll come to that in just a bit. They've booked profit, seemingly, foreign institutions, after that red-hot run that you saw last week. And we were anticipating a bit of a cool-off that seems to have taken place. The key indices ended near the low point of the day. That's certainly something to bear in mind at the start today. But take a look at this, right? They've closed just about less than 0.1% for the Nifty 50 off the low point of the day, mid-cap index around that much, and the small cap index recovering about 0.2% or so from the low point of the day. And you see those graphs illustrate that point quite well. 43 of the Nifty 50 stocks have lost ground in trade yesterday, and it's a pretty dramatic shift from where we opened up, where it was even Stevens from what I remember. Auto stocks, Hero MotoCorp, Bajaj Auto, Maruti Suzuki, Eicher were the worst performers in trade. And again, we spoke about this during trade setup when we said that perhaps that run-up in auto stocks might be looking a little bit shaky at this point, and that is what panned out yesterday. Eternal was the worst performer in the Nifty 50, down about 4.1%. The Nifty 50, however, remains above key moving averages. 200-day moving average is just around the 24,000 mark, so still 600 plus points to go to hit that mark. The benchmark, by the way, has lost about 410 points from the May 15th high, which was the most recent high for the benchmark. All sectoral indices ended in the red yesterday. Sectors that saw a sharp run-up in the recent past have cooled the most. Defense index, for example, was the worst performer, ended lower by about 2.4%. The auto index lost about 2.2% or so, showed signs of fatigue. IT was the best performer relatively speaking, but it still lost about 0.5%. And we were talking about tic-tac-toe. I wonder whether there will be some strength visible in trade today. The market breadth turned very sharply negative after a decent start, and 3 stocks declined for every stock that gained at the end of the session. Tamanna.
What really strikes me is that, yes, there was a consolidation phase, but the strength with which the market gave up gains yesterday is pointing to maybe a little more trouble than just a consolidation on the way to 25,000. So that's what you have to watch out for, because the Nifty was in red for the 3rd consecutive session, dropped more than 1% in trade today. That's the final index. But if you see through the day, the intraday moves, you've had close to a 200 to 300 point move on the Nifty itself. However, the overall trend does remain in favor of the bulls. What's the pain point? Spike in US Treasury. COVID cases could be challenges for equity going forward, especially if the 30-year in the US is closing in on the 5% mark. Now, unless and until the index decisively breaks below 24,500, it may continue to trade in a range. 24,500 acting as an immediate support. Index may attempt to rebound towards the 25,000 zone. A fall below 24,500 could drive the index down towards the next key support at 24,380. For the bank Nifty, resistance could be at 55,374, support at 54,809. The other thing to watch, of course, are results today, and there's a whole host of them. You'll keep seeing them on your screen. I'm just pointing out the ones that I'm really keen to see what comes out of. Colgate-Palmolive, for one, the last of the major FMCG players. Want to see what they're saying. Interglobe Aviation, so much happening this quarter for that entire space. I'm sure the management will answer questions on Turkey, which is why Interglobe Aviation is something that we need to see. IndusInd Bank, now one reckons, of course, you might see the results come in post-market hours, could be even later in the evening, but we'll be on top of that story, have no doubts on that, because IndusInd Bank is has had so many, so much news coming out of the Pandora's box that this is the point at which investors may get some answers. Protean eGov is the other one. We'll wait to see what the management says after they've lost PAN 2.0 and expect a big knockdown in their revenues, what happens to them. So those are some of the results I'm watching out for. Just want to also point out this interesting note from Morgan Stanley and what Rhythm Desai is saying. He has talked about a drawdown in Indian stocks from September 2024 high and says it's an opportunity to buy India's long-term story. I thought that was very interesting. That said, India's low beta means it will underperform a global bull market. He's raised EPS estimates by just 1% to reflect their GDP growth forecast upgrade. New Sensex June 2026 target of 89,000 has been set by them. That's an 8% upside. That's versus the 82,000 target for December 2025. Fundamentals remain strong macro stability with improving terms of trade, declining primary deficit and low inflation volatility. They also see mid to high teens earnings growth annually over the next 3 to 5 years, a reliable source of domestic risk capital. Some of the positives is a dovish RBI and oil prices in range. Persistent retail buying underpins structural nature of the market. Foreign portfolios positioning is weakest since we have had the data in 2000. There are signs that their view on India is shifting. They prefer domestic cyclicals more than defensives and external facing sectors. They're overweight financials, consumer discretionary and industrials, underweight energy, materials, utilities and healthcare. This is likely to be a stock picker's market in contrast to one driven by top-down or macro factors since the COVID pandemic. Could not agree more. All right, let's get the F&O view in with what's cooking and what the setup is like. Puneet joining us for more.
Well, thank you for that. We are seeing, yesterday a very big breakdown, at least in terms of the percentage points, which we've seen 24,680, 24,500 remains one of the key support levels to watch out for. We've also seen yesterday that, the Nifty futures also fell 0.8%, a premium of 99 points to the spot market as well. On the Nifty bank side, we mentioned yesterday that 55,500 is one of the levels, as well as 55,000 a long-term support. We are very close to that level as well right now at 55,100. So watch out for this one in trade today as well. When you look at, some of the other key aspects, and we've seen, FIIs being largely, short on the market across, indexes, both in the Nifty futures as well as the Nifty bank futures. We've also seen that the longs have been unwinding for the FIIs in the market as well. Currently, the long-short ratio, if you can move on to the next graphic, is currently at 37 is to 63%, essentially indicating that FIIs are long on 37% of the contracts. It's also important to note that FIIs also have derivatives as a hedging tool. So they do mention, have some shorts for the longs that they have in their stocks portfolio as well. We've also seen, the net OI PCR stand largely at 0.93%, which is a neutral sign. Essentially, the puts are largely equal to the calls in the market today. When you look at the key aspect in terms of the open interest distribution for both calls as well as puts, we've seen an increased interest maintained at 25,500 over the last week or so for the calls. But in terms of both calls and puts, at one level has been seen at 25,000, while the increasing call interest has been maintained and built at 25,100 levels as well. In terms of stocks, both on the open interest distribution gainers as well as losers side, we've seen some short build-up, seen stocks like Zydus Life. Yesterday, the results also came for the company, as well as something like a Cummins, which is expected to report results. Ashok Leyland is an interesting one because the company is going to be meeting on May 23rd for bonus issue, the first in the last 14 years. So seeing some long build-up there as well. In terms of the open interest losers side, finally, to highlight, we've seen long unwindings across stocks today. We've seen Exide, PI Industries, ABFRL as some of the key ones where you've seen some long unwindings. But overall, 24,500 remains one of the key levels to watch out for in trade today. And we've also seen yesterday in trade a very high delivery buying as well. Alex, you mentioned about Eternal. We've seen a decent number of delivery-based buying of almost 51% in trade today, in trade yesterday. And stocks like Bharti Airtel, HAL, and Cochin Shipyard were some of the other ones. So we are seeing delivery being taken at essentially a delivery-based selling. But watch out for those two key levels, both on the Nifty and the Bank Nifty, going forward in trade today.
Okay. All right. Thank you for that, Puneet. Let's take a look at some of the stocks on our list. I'm starting off with Dixon Tech. On my list of three first, thumbs up on the back of their numbers. Revenue was up 121% to 10,293 crores versus 4,658 crores. Bloomberg estimates were actually a tad higher. EBITDA up 143% to 443 crores versus 182 crores. This is a beat on estimates. Margins have expanded, and I think this is the important bit because yes, there are exceptional items, but the margin expansion is solid from 3.9% to 4.3%. Net profit is up 322% to 401 crores versus 95 crores. This is nearly double of Bloomberg estimates. So there is an exceptional gain of 250 crores in Q4. Mobile and other EMS divisions, though, have grown rapidly, 194% to 9,102 crores from 3,091 crores. To put into perspective, whenever you're hearing of more and more smartphones and electronics made in India, well, Dixon is one of those companies that is taking that forward. We're looking forward to speaking with Saurabh Gupta ahead on the show as well. So that's the thumbs up from me. United Spirits is the other one, also a good set of numbers. Earnings have beaten estimates, margin-led beat, which is what's important. A good volume growth in prestige and above category has been seen. Strong cost control measures have led to gross EBITDA margins expanding as well. Here are the core numbers. Revenues up 2.4% to 2,946 crores. EBITDA is up nearly 40% to 505 crores. Margins have gone from 13.6% to 17.1%, which is why I think this is going to be an interesting stock to watch today. Healthy margin expansion. Net profit is up 17.4% to 451 crores versus 384 crores. And PAT has been boosted, up 57% uptick in other income, so that is there. There was an exceptional loss of 31 crores in Q4 of FY24, so it's a base effect factor on both ends of it, which has helped the numbers look good. So what's worked for them? Overall volumes have grown 7% year on year, growth driven by the resumption of business in Andhra Pradesh. That's one policy measure which has helped. NP expenses have decreased 2.8% year on year and 16% in the quarter. Interest costs were also down, and the other income factor has also boosted the PAT. So good set of numbers for United Spirits. Just quick view on JP Morgan. They've maintained a neutral with a target price of 1,415, saying they expect upward revisions to earning estimates on account of better than expected margin delivery. Goldman Sachs has maintained a buy, target price of 1,710. I've said acceleration in volume and revenue growth in a tough consumption environment. Very quickly, my third stock, Aster DM Healthcare. Again, good set of numbers. Revenue up 2.7% at 1,000 crores. EBITDA up 21% at 192 crores versus 159 crores. Margins have gone up. So companies with good margin expansion is always good to watch, from 16.4% to 19.2%. Net profit at 79 crores versus a loss of 24 crores. So always something that the street would like to watch. Those are my first three stocks, and all three are thumbs up, Alex.
Yeah, I have one thumbs down. I'll come to that last. Let me talk about the the decent numbers first. And Fortis, okay, again, I will point out that there was a little bit of a debate on Fortis Healthcare. I've chosen to give it a thumbs up. I'll tell you why. The revenue growth has come in about 12% or thereabouts at 2,007 crore rupees. This is more or less in line with expectations. The EBITDA has increased about 14.3% and come in at 435 crore rupees. And this is again within the bounds of the expectations. The margins have expanded from 21.3 to 21.7%, and this is higher than expected. The PAT number is a miss. And that's because there are a few exceptional items in this PAT number. 184 crore rupees is where the PAT number stands in the P&L. But take a look at this. There's an exceptional loss of 54 crore rupees or thereabouts on account of an impairment of an investment. And there's also an exceptional gain of 23.5 crore on account of the sale of the Richmond Road, Bengaluru facility. Adjusted for those exceptional items, the PAT has actually increased 21% on a year-on-year basis in the fourth quarter. What are the few key metrics that you should watch out for? The occupancy levels have gone up, which is always good for a hospitals company. 69% is what it stood at, compared with 66% a year ago. The average revenue per occupied bed, it's abbreviated to RPOB, so if you see that anywhere on the screen, then you know what it is, rose 8.4% to 2.51 crore rupees in the fourth quarter, and that is also seen as a positive. Now, the operating EBITDA of the diagnostic business, which is what I found quite interesting, rose 32.5%, and the adjusted EBITDA margin stood at 23.4%, compared with 16.3%, which is a very sizable increase or an expansion in the margins. So bear in mind, of course, that the diagnostic business only saw a 3.5% increase in the revenue that it generated, but the profitability has improved quite dramatically. The hospital business EBITDA margin, however, has declined marginally to 21.9%. All told, I think bases the margin performance, it's a good number, and therefore watch out for Fortis on the upside. Torrent Pharma, thumbs up. Because it's a solid set of numbers once again for this company. Revenue increase of 8% or thereabouts. The EBITDA is up about 9% or so. Margins have been more or less steady. Very small expansion, stood at 32.6% compared with 32.2%. The PAT number as a result of which is up 11%. There is an exceptional loss of 24 crore rupees in that bottom line, so account for that as well. What are the factors that you should watch? There is a plan to raise funds. The board has approved 5,000 crore rupees of fundraise via QIP. There are a few brokerage notes that have come through. Jefferies on Torrent Pharma has maintained a buy, but it's cut its target price to 3,740 from 3,970. It says that it remains a steady ship. The India business is set to continue its outperformance, and Brazil growth is set to improve. The US challenges are set to persist in the near term. Citi, on the other hand, has maintained its buy with its same target price of 4,000 rupees. It says that the healthy underlying trends in the branded markets is something to watch. The margins have surprised positively, and they also believe that the margin expansion trend will continue on the back of the operating leverage in the branded segment. So that's on the second stock, which is Torrent Pharma. The last stock is a thumbs down, and this is from the tires pack. And we've seen a few tire companies report numbers, not the best numbers in the fourth quarter. So it was expected to be a weak quarter for JK Tyre and Industries, and that has panned out. The revenues increased only about 2% or thereabouts, and the EBITDA has actually shrunk by 21%. The margins have contracted to 9.8%. from 12.7%. That's on account of pressure from cost of materials, which is at 64.4% of the total versus 59% earlier. The margins have been impacted on account of those higher commodity prices, and the natural rubber prices have increased on a year-on-year basis. Of course, on a sequential basis, there is a sign of moderation, but on a year-on-year basis, they're still much higher. The revenue mix is interesting. There was a higher OEM share in this quarter. The replacement demand stood at 58% and accounted for most of the volumes. The OEM segment has risen to 29% from a contribution of 22% earlier, and the exports have fallen by that mark by about a certain amount, by till 13% from 18% earlier. All right, so watch out for JK Tyre in trade. By the way, you have had a lot of the tyre stocks react positively in the recent past. CIAT, for example, has moved higher very dramatically. JK Tyre is up only about 10% or so over the last 1 month. So watch out for that in trade. But really, the focus today and tomorrow, of course, is going to be on IndusInd Bank. And that's because the lender is set to announce its FY25 results we will likely see that post-market today. And the question is how much the loss is going to come up to. In fact, let my colleagues Vishwanath Nair and Harsh Saita take you through this. Vishy, you've broken multiple stories over the course of the last couple of months on this IndusInd saga. The question is, what is the implication for the earnings?
Right. So, Alex, let me take you through a bit of a history lesson. All of this started on the 10th of March. Essentially, that is when IndusInd Bank came out with a disclosure saying that there are discrepancies in the derivatives trading portfolio. And then they said that this is likely to result in a financial hit of about 2.35% of the net worth, which at that time would have been calculated to about 1,900 to 2,000 odd crore. This was then, of course, the bank also held an analyst call where it said that they had appointed an external agency to verify whatever they had found internally. At that point in time, we didn't know who this external agency was. Later, it was revealed that it was PwC. Once that is done, then on the 15th of March, the RBI comes out with a statement, because imagine these 5 days, a lot of depositor concerns had risen. Will the bank still be standing there? Are my deposits safe or not? The RBI came out with a statement saying that, listen, depositors don't need to worry. This is an internal problem at the bank, which is being dealt with at this point in time, but depositors can stay put. Then on the 20th of March, the board of IndusInd Bank came out and said that they're going to constitute a fresh inquiry into the issues. They appointed an external agency. This time it was Grant Thornton, which was going to look at what exactly happened, the root cause of it all, and will see who are responsible so that the board could take appropriate action. A month later, on the 22nd of April, the bank discloses that it has found additional issues, and this time it was a microfinance department of the bank. They said that an internal audit department is conducting its own investigation, and that EY is supporting that internal audit team into this investigation. Then about 5 days later, on the 27th of April, the board said that the Grant Thornton investigation had concluded and that they had found that the financial hit on the bank was about 1,960 crore, which is in line with what the bank had guided at the onset of this entire problem. This agency had also found the people who were responsible for these accounting discrepancies, and the board was taking appropriate action. A day later, the deputy CEO of the bank, Arun Khurana, announces his immediate resignation. He says, considering all of these developments that have happened in the derivatives portfolio, I was the chief of the Treasury Department, so I resign. Then a day after that, Sumas Katpalia, the CEO of the bank, steps down. He says that for whatever multiple omissions and commissions that happened during my watch, I will take responsibility and then resign. At that point in time, a lot of people thought that this was the end of this entire saga. But on the 30th, the day after that, of course, the board appointed 2 executives to run the bank. But yeah, on the 9th of May, that is when more issues started coming out. The bank's board said that it is investigating insider trader allegations. This is on the basis of what Grant Thornton found. They announced this after a news report came out that there were insider trading issues. So it's not like the bank was forthcoming with this information. It's only because a news report was out. Again, same thing happened on the 15th of May, where the bank said that it had found 2 more issues apart from the derivatives trading. One was microfinance, where the bank found about 674 crore worth of incorrect interest income spread over 3 quarters. And then again, in the other assets department, where they found 595 crore worth of unsubstantiated balances in these accounts. The bank at that point in time said that in January, both these gaps had actually been closed, as if that is supposed to calm nerves. But this is exactly what has happened at IndusInd Bank. A lot of information being held back till it inadvertently comes out in some news report, and then the bank is forced to clarify, forced to announce what exactly happens. So this quarterly result that is going to be announced later today is a culmination of all of these different issues. But we have Harshita here, who is going to come in and talk about what exactly is going to come out during the quarterly results.
Yeah, what's expected, Vishy? And it's going to be a tough quarter. Focus more on the commentary than on the absolute numbers to try and assess and judge. And I believe that's what the analyst community will look to do as to whether this is indeed the worst and whether the worst is actually behind IndusInd Bank or not. Let's look at numbers, though, before we talk about how the commentary will likely stack up. Net interest income 6% down. Now you are seeing the book to be under pressure, both from microfinance perspective, but also from a growth perspective. Growth hasn't come through over the last year or so. Look at operating profit, likely down 15 odd %. You're looking at provisions which will spike sharply at 3371 crore. And therefore net loss will likely widen to 318 crore. This is of course as per the average analyst at Bloomberg, and therefore just want to put that out there from a caution perspective. It's going to be tough to exactly try and understand where those numbers will add up. We'll have to wait and watch. Advances up 8%. The guidance was 18 to 23 at the start of the last financial year, so keep that in mind. Deposits are expected to be flat on a sequential basis at 4.1 lakh crore. Now, in terms of what to expect, growth will unlikely come through, just a 1% advances growth expected. Margins are expected to hold. Again, a very key number, if margins do weaken substantially, will be a key negative, and outlook on margins will be important from a analyst perspective as well. Derivative losses obviously have been understated. Those will get booked this time around, and any further impact on profitability. So the impact of this is going to be 1600 crore. The impact of and this is again post-tax impact is 1600 odd crore. When you're looking at the pre-tax impact on the microfinance portfolio on accrual of interest, that is going to be around 600 odd crore. This is the pre-tax impact. So likely all these numbers factor in all of these negatives. The microfinance portfolio will continue to be under pressure. That's the likelihood. Are we seeing light at the end of the tunnel is going to be important. And whether there are any negative surprises and leadership change guidances which come out will be the other key things to watch out for.
Definitely. Thank you for that, Harsh. Gurmeet Chadda, Managing Partner and CIO, Complete Circle, joining us on the phone line for more on this. So, Gurmeet, IndusInd Bank, now what is the perspective with which the numbers need to be seen? Because important cues required for investors as well. The broader sense is that not all of the dirt is out yet.
Good morning. There's a saying in banks and financials that there's never one cockroach in the kitchen. And, probably there was an assurance from the management that, derivative losses, though, it was very surprising coming from a large institution like this, the way they were doing accountings on derivative is what it is, and they have been conservative in terms of proactively recognizing it. And then came another stress on 595 crores as far as other assets is concerned. And I think the bigger issue which Street would face is, one obviously is hoping that there are no more negative surprises. Is that had there been a smooth transition of the CEO, that would have actually calmed the nerves. But the fact that the CEO had to resign and more leadership team followed would also lead to more attrition. It can happen in the mid-management as well. And the market will also be worried in case RBI decides to have a nominee on the board or a PSU banker, like what they did with, let's say, RBL or Bandhan, etc. So I think the bigger issue now would be transition and who takes over and how regulation happens, which also means slowing down on growth and other aspects as far as those are concerned. So I think to me it's a wait and watch, because it's a risky business, and when things go wrong, they really go south.
Gurmeet, all very pertinent points that you're making. Ultimately, I think more so than any other business, the banking space, it's about trust, right? Because you have a very large deposit franchise which you use as raw material to lend and make money. We've not seen a very material erosion in that deposit franchise based on the quarterly data that we have. But then what if that occurs? So is that a big concern in your opinion? And would you say that likely we're going to see very slow growth from IndusInd irrespective of how this gets resolved?
So as far as, there hasn't been so far a big stress as far as the run on the deposits is concerned. And I think the bank as well as RBI has been proactive there. So it's not as bad as what we've seen in, let's say, other episodes without taking names. But I agree with you. And one portfolio where they are struggling is microfinance. Then there have been state-specific issues like the Karnataka ordinance, which actually prohibited use of coercive powers and made it punishable. Although there is some interpretation that is for unregulated lenders, but it does create an impact. So the MFI portfolio could see more stress. Also, the bank would be a little more conservative in recognizing any more stress if it finds any, because what you want is something coming out every quarter, every month, which means that you got to slow down a little bit, just to stabilize things, focus on liquidity. And I think the bigger event to me is the succession planning. I think if the one street needs to understand if RBI is going to tightly regulate it in terms of a nominee on the board or a PSU banker as an MD CEO. We need to see that, and once that happens, probably the market would try and make more sense of it. Hopefully, the numbers are better. This doesn't lead to more erosion as far as the net worth is concerned, and let's hope for the overall stability. There are no more skeletons.
All right, thank you so much, Gurmeet. We'll come back and have this conversation when we actually have the numbers out. What we're learning is that IndusInd is not doing a press conference after its earnings. They're just going to do an analyst call and leave it at that, which is unfortunate. This is a good time to have some transparency and take questions as you must. This is
but the question is, who is going to address that call? Because you've had top-level exits, so I guess that is also a question mark, right?
Yeah, but the current team is still there.
Yeah.
I mean, the MD CEO is still very much there for now.
Yeah.
Anyway, his term has been curtailed.
Yeah.
For today, he's the one who answers the questions.
Yeah.
And we're happy to ask those questions if we get an opportunity. We'll take a very short break. On the other side, we're coming back with what your top stocks for the day should be. There's so many stocks to cover. What should be on your watch list? All of that when we return.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Welcome back. You're watching India Market Open, and the indication is for a marginal uptick, but you saw how this played out yesterday. There was an expectation that we would start off in the green, and there was a little bit of pressure at the start, and of course that built up over the course of the session in the form of selling. We're joined this morning by Amardev Singh of Angel One, as well as Mayuresh Joshi of MarketSmith India. Gentlemen, thanks so much for taking the time as always, and good morning to you. Amar, I'll come to you first on the levels that you would watch from this point, and of course a lot of people talking about stock-specific action, but let's start with a broader view. We saw a few levels being broken yesterday, but we're still well above all of those key moving averages. What would you be looking out for in trade today?
I would say that the trend definitely remains positive from a short-term, intermediate-term perspective. And long-term, yes, we are seeing some sort of consolidation there. But what is happening is that if I compare Nifty with Bank Nifty has been on the weaker side, and that's really that's impacting the up move of Nifty. So if I look at Nifty, the first level of crucial support I see somewhere around 24,500, 600 zone. That's a very important support zone from a short-term perspective. Whereas on the upside, it definitely seems to be capped around the 25,000 levels. There's no doubt. So what's likely to happen and what's happening is that at higher levels, shorts are being created, and also those who are long, they're looking at booking profits. Technically speaking, we definitely see some loss of momentum on the Nifty and the Bank Nifty, but the loss of momentum in Bank Nifty is significantly higher as compared to Nifty. So if I look at Bank Nifty clearly shows that there's a double top formation there. And till the time we don't take out the 55,000, 55,200, 300 zone consistently, we could see some upside capping there. Whereas on the downside, support is very strong for Bank Nifty around the 54,300, 400 zone. So my still recommendation is that if there's an opportunity or a correction, that's a buying opportunity. Till the time we don't see close below 54,300, 400 on that.
Okay, Amar, hi, good morning. Tamanna here. What are your top picks this morning?
So I would say that there's one stock I would like to talk about that's from the steel industry, and that's SAIL. So we've seen SAIL consolidate, and we've seen the metal stocks also rally. And SAIL is very strong structurally on the short term, on the intermediate term basis, and long term we've seen the stock move out from the oversold territory. So this is one stock one can look at from a buying perspective at the current levels or towards 120 with a target of 139 on the upside and a stop loss of 109.
So just one pick this morning?
Yeah, so there was this other pick I had, but that was IndusInd, so I had missed that it's coming out with its report today, so I skipped it. Yeah.
Okay, yeah, no, fair enough. Till we don't really have a say on it or clarity on it with so much volatility, maybe best avoid. Mayuresh Joshi also joining in this morning. Mayuresh, very good morning to you and good to see you. I'm just wondering whether you would look at opportunities here on banks right now. And the reason I say this is because banks have been sitting quiet on the sidelines. If you want to use this lull to shore up positions, would banks be the right place to start?
Morning, Tamanna. Morning, Amar. So I think two things, Tamanna. I think banks have given decent set of numbers as far as Q4 is concerned, both from the private as well as the public space. So a whole host of parameters and the indications thereof in terms of advances growth, expectations of what deterioration you probably saw in CASA is probably bottoming out. And therefore, I think the liability side of the business expected to strengthen for a large part of these banking names. And therefore, I think the asset quality pressures, which have remained largely stable, the underwriting which most banks are probably doing at this juncture, you've heard the two biggest names probably being a little cautious in the previous quarter, tantamounts to expectations that as consumption picks up because of tax cuts, as consumption picks up because of better monsoons, as far as rural, as far as the rural side is concerned, which probably means that the MSME part of the market should also show signs of bottoming out and strengthening. And expectations of a rate cut in the second half. I think all these factors might probably lead us to believe that the system, or the banking system in general, should probably do well. Again, I think the liquidity support provided by the RBI gives ample support to the overall system. Having said that, my own sense in terms of numbers actually expected to improve as we head into the second half, and the festive season for a combination of these factors should actually play out. So we continue holding leadership stocks like ICICI Bank, Axis Bank in our global portfolios. A stock like Karur Vysya Bank is something that we continue holding from the mid-cap space. So yeah, to answer your question, we remain optimistic on this sector.
Okay, all right. So, but Mayuresh, you've said, okay, I do want to take a point on the banking stocks, because Amar, yesterday we've seen selling and we've seen delivery-based selling in a few big frontline companies, right? You're talking about HDFC Bank, you're talking about Reliance Industries, Eternal saw quite a bit of delivery-based selling. So what does that tell you in terms of the tone and tenor, particularly if we're talking about the large cap stocks?
So this question is for me.
Yes, Amar.
Yeah. So see what's clearly visible is that in the large cap, which you talked about, HDFC Bank, for example. See, HDFC Bank is extremely strong on the long-term charts as well as the intermediate-term trend. No doubt about it. Short-term, because if you look at HDFC Bank, it has since March it rallied from almost 1700 levels to 2000 levels, which is quite good for such a market cap company. But currently, it's definitely showing some signs of consolidation, maybe waiting for fresh triggers or maybe waiting for some sort of cues going forward. So it is more of consolidation in HDFC Bank between 1800 and 2000. If I look at ICICI Bank for that matter, the other major banks. So ICICI Bank is also having a similar pattern, but the good part is that both of these are very strong structurally on the long term, on the intermediate term trend. So definitely these are buys on any correction. There's no doubt.
Okay. All right. Stay with us. Another stock which is in focus is Siemens India after the company held an earnings con call. Anushi, the numbers weren't the best. What are the big takeaways from the call?
You know, we did see a muted set of numbers for Siemens India this quarter. So, you know, the biggest takeaway was the digital industries business. Now that was impacted by inventory normalization on lower demand is something that was seen across the trends. Now, this was also on the basis of private sector spending, which has remained on the muted side. So a cautious approach is what we are looking for this segment going forward as well. However, it's the mobility segment which is expected to offset some of that weakness seen in the digital industries with a strong order book pipeline over here, especially for its rolling stock business, which is there. So that is a positive, but coming back to what we are seeing is also low voltage motors growth, which were affected due to weaker set of demand over here. Private sector has remained weak with mixed trends seen across industries, especially in industries like steel. However, the company does see emerging areas like electronics, semiconductors, batteries, and key centers. Now, coming to the second quarter key takeaways, we did see that revenue had remained flat due to the normalization of demand in digital industries. EBITDA margins had declined on higher employee costs and other expenses, and net profit was impacted by higher extraordinary expenses due to the demerger of Siemens Energy that we had seen. This had an impact of around 63 quarter in this quarter that we had looked at. Order book, however, remained on the positive side as compared to something like ABB or other players which are there. New orders saw a growth of 44% this quarter, while order backlog was up over 7%. So these are the key takeaways that we are seeing for Siemens India. Of course, commentary in focus in terms of where the private sector spending is headed.
Okay, all right. So that's the view on Siemens. We're talking about the space, Mayuresh, and you've seen quite a few earnings come through. What did you make of it in the space that Siemens operates in? What did you make, first of all, of the earnings? And were you more positive than negative?
So, morning, Alex. No, I
Morning.
think two things. One, I think in terms of the entire space itself, the expectations that are largely getting built in is with government capex kicking off very, very strongly and expected to continue over the next few quarters across the space, whether it's heavy engineering, whether it's high-level critical fabrication, whether it's metro work, whether it's the road sector that you are talking about. Generally, I think the allocation that has happened towards industry stroke infrastructure is quite significant. And I expect a decent number of, a decent order size to probably come through across companies in this industry as well. Having said that, I think the typical nuances that these industries had to go through in the previous few quarters was sluggishness in terms of order delivery. Execution was a little bit weak, and obviously working capital cycle had got a little bit elongated. Now, a large part of market expectations is with a combination of consumption expected to go higher, government capex expected to go higher, SME, MSME market expected to bounce back, and liquidity expected to remain strong. Private capex at some point of time should start coming back. And therefore, the orders from the private sector, which have clearly been lagging to a large extent, should start coming back to these industries as well. And as that happens, I think there might be some element of upheaval in terms of numbers that can get reported for the second half and from an FY27 perspective. Having said that, I think within the sector itself, I think L&T, in my opinion, gave a very decent set of numbers across the sectors and the areas that they probably operate out of. Even for Siemens, I think the kind of areas that they operate out of, mobility has remained strong. The expectations in terms of new businesses, specifically data centers, semiconductors, new age businesses, are expected to pick up steam with all the rationale that I probably gave in the second half. And therefore, I think we remain optimistic on the sector as a whole. But within numbers that got reported from a Q4 perspective, I think L&T probably stands out.
L&T stands out basis numbers. We'll circle back on a couple more names, but let's talk about earnings since we're on the subject. And Harsh joining in to round off the list. We've already spoken about several stocks, Harsh, but a few more stand out in terms of decent performers in Q4.
Well, absolutely, Alex. Good morning. You're looking at Gabriel India first off. Again, strong set. You're looking at revenue, which is up 17% on a YOY basis. EBITDA up 35+% on a YOY basis. Margins coming in at 10%. Strong margin number there. And net profit is up 31.5% on a YOY basis. So strong numbers coming in from Gabriel India. The other one is EIH. Now, third largest hotel chain now in India. Revenue up around 12% on a YOY basis on a high base, mind you. EBITDA up 15%, so margins continue to get better. Of course, December is a seasonally strong quarter, but March, despite that, the margin shrink has been very, very low on a sequential basis, just kind of showing the kind of resilience that the margins have done in Q4. Even versus Q4 of last year, margins have improved by 1.5% absolute. You're looking at net profit, which is up nearly 14% on a YOY basis as well on that high base. Last off is Johnson Controls. In terms of growth, again, very strong top line number, 21% growth on a YOY basis. You're seeing EBITDA, which is up around 12.5%. Reason why we picked this is because sequentially the margins have improved, understandably so, but nonetheless, on a YOY basis, the margin number has come in slightly lower, but nonetheless, it's a strong overall number, top line as well as PAT. PAT was up 15% YOY.
Okay, so some more results that we need to cover this morning and stocks that could be buzzing. We'll take a very short break. We're right back with the pre-open. Just want to pull up the implied before I get into that break. We're looking at a quiet start and a bit of a wait and watch. Just about 12 points in the green is what is indicating. It's a stock picker's market, says Morgan Stanley. We're coming right back and telling you which stocks you should pick.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
back. You're watching India Market Open. So a lot of specific stocks that we're covering this morning, and one of them is Ogro Capital, set to raise over 1,300 crore rupees through CCDs and rights issues. Let's go across to Harsh for more for those details. This announcement made yesterday, but Harsh, while they're calling it a fundraise, it's also a massive equity dilution, isn't it?
Absolutely. In fact, more of an equity dilution than a fundraise. So when you're looking at the current market capitalization of the company, it's around 1,780 crore. And therefore, this raise of nearly 1,300 crore is extremely large in absolute terms. 915 crore is the CCD issue, which is going to be converted to equity at 185 rupees a piece. And therefore, that also looking quite chunky because the current market price very close to that number. You're seeing that if the full dilution were to happen, excluding the rights, there's going to be a dilution of 34% for existing shareholders. Who are going to be coming in? Well, it's the existing institutions which are participating in the CCD preferential issue. The likes of a Samena is one of them. You have the Danish government also participating, and therefore some of those larger names coming in, which is likely a positive to a certain extent, but they are diluting existing shareholders to a large extent. And for that, they've also done a 400 crore rights issue, it seems. The 400 crore rights issue kind of aids that dilution a little bit and gives existing shareholders the right to participate at the current market price. That's what it is. What the company is projecting is that it's improving the capital adequacy of a fast growing business from 19.5%, 29.5%. But what we also need to keep in mind is they've done a fundraise just last year where they've raised 1,200 odd crore last year as well through a preferential issue of CCDs and warrants, which are yet to convert. So we need to wait and watch as to when those convert, because that issue happened at 265 rupees a piece. Interesting developments. Of course, we'll speak with management to understand this better. But of course, this one will definitely be in focus today.
Yeah, it'll be focused, and I think I would reckon it's a bit of a negative if you're, raising funds, but at the same time diluting equity to this extent. Mayuresh, any thoughts on that? Have you looked at the developments around Ogro Cap?
Oh, no, sorry. I think I don't have.
Okay. No issues there. All right, let's talk a bit about some stocks which have really worked and some results which have really come in well, and Dixon is one of them. Now the story with Dixon, Mayuresh, and I'm coming back to you on this, is interesting because yes, the numbers are fabulous. There is a one-time, but then the question is how much and how far?
Absolutely. I think valuations have gone out of bounds for Dixon. But again, I think if you probably have a comparison check done, you look at Amber's numbers and the commentary that Amber probably gave out over the next 2 to 3 years. Obviously, they're expecting margins to improve quite significantly and hit that double-digit mark. And I think both these players, what they're trying to probably achieve is rather than concentrating on the OEM, which is still a large part of their business segment, I think they're trying to do more in terms of the ODM part, which is the original design manufacturing. For a whole host of companies, whether it's the telecom sector, whether it's the television sector, or the refrigerators to a certain extent. I think that will evolve as time passes. But ODM has better margins, and because margins are relatively better, the overall numbers, at least from an operating perspective, show that uptick, which the street now probably wants to see in terms of justifying the elevated valuations that the stock probably trades at. And therefore, how this transition probably happens in terms of ODM, how do they add more value adds in terms of their product mix is something that the street would like to see. But there are huge opportunities. There are no two ways about it. I think the entire market, Tamanna, is expected to grow twofold over the next 5 to 7 years. And therefore, organized players like Dixon should benefit. Albeit the only reason is the only risk concern is elevated valuations and whether they might not satisfy the earnings momentum quarter after quarter. But if they're able to do that, I think it might just sustain.
Okay, so Chandan Taparia, Head Technical and Derivatives Research, joining us this morning. Chandan, very good morning to you. Just to round off that other point though, before I come to you on that one, Mayuresh, very, very quickly, if you were to talk about valuation picture and relative comfort, because we've seen a few EMS players come out with numbers and you've seen a few margin surprises on the upside, which would you pick?
Alex, but I think Avalon is something that has a better mix in my opinion.
Okay. Chandan, very good morning to you. The question I'm asking you this morning is based on yesterday's move. In the recent past, it seems that the cool-off is something that is panning out. We were anticipating this based on the run last week. The question is, would you still be buy on dips?
Good morning, Alex.
Good morning.
Thanks for having me. So looking at the market setup, the major trend is intact to positive. However, market has seen a profit booking decline from higher levels, but we need to keep in mind that already we have seen a decent run up of more than 3,200 points in last 27 trading session. Market is finding some supply near 25,000 marks, but at the same time, multiple supports are intact at lower zone. We have noticed that base of the market is shifting higher. It formed the earlier base at 24,000, 23,850, then 24,444. So I believe that 24,444 could act as a key level. Till it holds about the same, I believe some buy on decline stance could be continue. But the way data has changed, upside could be kept as of now because put call ratio fell to 0.69. India VIX is hovering near 18 marks. FIs have sold to the tune of around 10,000 crore yesterday, and FIs long short ratio declined from 50% to 36% in last 3-4 days. So I think scenario has slightly changed because of that upside could be kept, but trend is positive. So because of that, buy on decline could continue. So I believe that last 3 days, which were making lower highs, could provide some stability. And with support of 24,444, I'll go and attempt for buy on decline stance for a kept upside target towards 25,000 to 25,100 zone.
What is the time range you're seeing for 25,200, Chandan? Has that also been pushed back because of all of the factors you mentioned?
Yeah, so that's why I'm looking at the kept upside. However, the good part is that SIP flow is working well. In fact, in the last month, the SIP flow was more than 26,000 crore monthly. Days are continuously buying. The good part is we have not seen a corrective move in the global markets. However, the trigger will be the rate cut from upcoming RBI policy, and I think that will continue to keep the momentum intact at decline. So multiple concerns are there. That's why we are keeping the kept upside. But multiple supports and trend is quite positive. And we have noticed that any small or meaningful decline is being bought. That's why I'm keeping this stance for buy on decline, but with kept upside. And one has to be very focused as sector or stock specific churning would be there in the market.
We need time to be nimble. What are the stock specifics that you're looking at this morning, Chandan, your top picks?
Yeah, so I'll mix with buy and sell idea given the market scenario. So first trade is buy on ONGC. We have noticed that stock is comparatively holding well. It is a margin of safety with lower beta. We have seen the 250 call started to witness unwinding. Already from last 7 to 8 days, it has been making high rise, high lows, or has seen a recovery from 228 to 252 marks. It gave the close near 249 and a small follow-up could lead the stock on higher side. So with support of 243, we are looking ONGC to head towards 261 marks. One sell idea, that is sell on Muthoot Finance. Structure is weak. It has given the lowest daily close in last 22 trading session. It formed a multiple rounding formations, trading below key moving averages with build-up of short position. So one can sell with a stop loss of 2,075, and this counter can drip down towards 1950 marks.
Okay, a lot of early movers, and before we get to our big brokerage call of the morning, look at Aster DM, 3.5% up, good numbers. Acme Solar, numbers came out yesterday, were fairly decent, that's moving. Siemens after its call seems to have perked up a bit. Whirlpool also seeing some action this morning, but all eyes on what's happening with Dixon. Good set of numbers. What are brokerages saying? The big brokerage call on Dixon from Jefferies.
Well, yes, it's in fact an underperform. Very strong numbers, of course, but Jeffrey is saying that valuation comfort not there. Let me first talk about the positive, some of the positive takeaways that Jeffries has highlighted. One is mobile plus EMS is what is driving growth for Dixon. The in-house mobile production is set to rise to 4 to 4.5 crore units in FY26 and 6.5 crore units in FY27. That's kind of underlining the kind of growth potential that Dixon has. Mobile PLI expiry in FY27 though could be a risk is what they're saying, which could allow rising competition to come in. They've therefore also expecting FY26 and 27 capex to be quite on the higher side. Let me talk about the risks now. Dixon has rallied 80% in the last 1 year is what they're saying. It currently trades at 97 times price to earnings, which is a substantial premium to historical averages. The risk reward therefore looks stretched according to Jefferies. 85% of the revenue is from low margin product. The order book is susceptible given low entry barriers. They're also saying higher capex will likely soften the ROCE numbers going forward. Emerging competition can easily come in is what they are saying. Normalization of a high PE once growth starts to taper. Right now growth is quite elevated, and once growth starts to taper, there is that risk. Their target price to earnings multiple is 58 times, which is a 10% premium to the average. Target price being 13,300, which is a 20% downside to current market price.
13,000 is the target for Jefferies. All right, watch out for that. We were seeing quite a bit of activity in Dixon. Let's see if it bucks up at the start of trade today. But Chandan, I want to come to you on a sector that has, as we've been calling it this week, been playing tic-tac-toe. One day it's up, one day it's down. IT as a pack, traditionally you have looked at it as a defensive play, but of course a lot has changed since then. Would you look at trading any of these stocks?
So yes, I think you mentioned it rightly. Some sort of volatile swings are there in a broader range. One day up, second day down. However, it witnessed some profit booking after the news that the US market downgraded. But again, I believe support-based buying could intact. However, USD INR scenario or dollar index scenario could keep this sector floating on the higher base. But again, if one stock I have to consider, I'll focus on Dixon because the major trend of the counter is positive. However, on the last trading session, it failed to give a key breakout above 17,000 marks. But again, supports are intact. I believe if it manages to hold 16,400 marks, then recovery could be seen to a 17,000 zone. So I believe Dixon could be one preferred idea, but needs to hold key support of 16,400 in morning tick. Apart from that, I believe other counter will be consolidative. I can focus on one counter that says persistent system. Trend is consolidating. Multiple supports are visible at 5550 marks. So with support of 5550, we are expecting a persistent system to head towards 5900 levels.
Okay, some early movers and some which are seeing quite a hit. KPR Mills among them, as the pre-open session has ended, will be down because of the block deal. Promoters are selling their stake in KPR Mills. Block deal amounts to roughly 1,000 crores, 1,200 crores actually, 1195. The total promoter holding is 70.68%. So they're selling their stake and their current holdings. KP Ramaswamy has 20.34%. What you're seeing is their current holdings. KP Day, Sigamani has about 20%, 20.34 to be exact, and P Natraj has 20.34. The floor price is set at 1,107 per share. Floor price is at 10% discount to the last current market price. The offer size there on your screens as well and amounts to 3.2% of existing outstanding shares. So a lot of promoter sales recently also, coming to mind, and you're seeing that trend. Mayuresh, I don't know if this is something you've noticed or have any commentary on. The trend of promoter stake sales also increasing at a time when froth seems to be building up.
Yeah, I think that seems to be the case. And obviously, I think why is the stake sale happening? I think individually, company-wise, I think needs to be seen. Whether the promoter is going to infuse that back into the company, is it used for growth, as growth capital for the company, is going to be extremely critical. But again, I think within the textile space, I think there are very few integrated players. KPR Mills probably stands among that, along with Vardhman Textiles. And with the agreements that are probably happening with the UK as we speak, the opportunities that probably exist in terms of China plus one. And I think there is a sheer expectations in terms of Indian textiles because of their integrated operations, that as things improve, both on the global front as well as domestically, I think integrated players might actually have a decent show. So yeah, I think leaving aside the promoter stake sale for the purpose that it is intended for, I think textile as a space and few select integrated players, in my opinion, are in a sweet spot.
Okay, so KPR would be a key pick in the textile space for you, Mayuresh?
I think three players, Tamanna, that we'll keep a watch on: KPR, Vardhaman Textiles, and Indocount. And why Indocount? Because Indocount is establishing a plant in the US with all the tariff news around it. I think establishing a plant and the acquisitions that Indocount has probably done in the US market over the past few years, I think that will be incrementally positive as we head into the next few months.
Okay, so we've seen, we're just about a minute or so away, Chandan, at this point, and you pointed out a few stocks that you like at this juncture, but anything that you've spotted in the first few ticks that has caught your attention?
So again, I'll focus on one counter, that is BL from the defense. After the consolidative or corrective move of last 2 days, I believe this counter is all set to start the next leg of rally. Major trend of counter is quite positive. In fact, in this month, the stock is rallied well by more than 16-17% and quoting at its lifetime high territory. So BL could be in focus with support of 358. It has potential to rally towards 380, 385 marks. So I think one can focus on BL from the defense system.
Okay, keep an eye on TCS, news coming in of a follow-on order from BSNL, and that could be something that you need to watch out for. One day up, one day down, but on the charts, TCS, do you like it, Chandan, very quickly?
So TCS, yes, I'll look for some positive to range bound bias, not much aggressive, but likely to be in range between 3440 to 3600 zone.
Okay, that's the news. They've gotten an order worth 2,900 crores from BSNL for 4G mobile networks. Good news for TCS as the first ticks come in, but let's take a look at how the markets are opening this Wednesday morning. This is not half bad because remember, quite a bit of hit yesterday. If you look at it, just 1% down, but intraday you had about a 300-point roll up and down for the Nifty. So you're seeing it about 60 points up. 24,750 is the mark to watch out for in early trade. IT, all right, pretty stable. So is Bank Nifty actually. Not half bad, no clear winners there, but the overall mood is positive. Broader indices cooling off. They have been holding on really while the Nifty hasn't quite. Small cap and mid cap both down in the red, about 0.25% down, nothing massively disturbing over there. Let's look at the Nifty heat map and pull it up for what's happening on that end. Pharma, a defensive play there, making a bit of a comeback. Dr. Reddy, Sun Pharma, both of them doing fairly well. We're seeing a smattering of auto as well. After the drawdown we saw, Nifty Auto was one of the biggest losing indices in yesterday's trade. So Maruti Eicher up there. Hindalco, we'll hear from the management today. Numbers is in focus as far as Hindalco is concerned. HDFC Bank making a comeback to the top line after quite some time, but nothing massive. Your top gainer on the Nifty is just about 1.5% up. So more green on the screen than red. So that's one good thing. I just want to pull up the TCS intraday if we can for a second and look at that before we get to some of the losers over here. So yeah, TCS is going to be in focus because of that follow-on order from BSNL. So we'll wait and see, about 0.5% up. Just 1 second quickly to the heat map. I'll come to the losers before I hand off to Alex for what's happening in the broader markets. Eternal had a very important shareholder meet yesterday, the board meet, and while it was expected that they would cap foreign ownership, that has now come into play. What that means is that they lose a lot of passive flows in their positioning on the MSCI index, which is why you're going to see some pressure coming in on Eternal for those reasons for the next few days. IndusInd, a big focus for us here at NDTV Profit. We've been on top of the story from day one. That stock about 1% down ahead of its numbers. We will wait and see and get some clarity on how deep the rot is as far as the IndusInd balance sheet is concerned. Trent also not doing too well this morning, but nothing massively down or up. Sun Pharma continues to be the stock that shines on the Nifty.
No doubt. And I think that investors would take this based on what's happened over the last couple of days. You do want a little bit of calm, a little bit of solidity, so to speak. We've given up a little bit of ground since those opening ticks, and we'll see where we end the first half hour of trade or so at. But let's very quickly pull up the sectoral indices, and I would hazard a guess to say that it's more or less going to reflect what you're seeing on the screen right now. Pharma up and about 0.7% higher as the top gainer. Realty is making a bit of a comeback. Remember, it's been under pressure in the recent past, having lost ground, but it's up about 0.6%. The healthcare index is up about 0.6% as well. Nifty Bank not doing too badly, up about 0.2% or so. What's losing ground? Let's look at the bottom of the screen. Consumer durables down about 0.4% or thereabouts, and oil and gas. Remember, a few important companies going to be in focus on account of earnings. ONGC, one of them, are going to be reporting numbers later today. But let's take a look at some of the stocks that you should watch out for from the broader markets, and we've been speaking about this over the course of the last half an hour to 45 minutes or so. Dixon is something that started reacting on the back of earnings. Let's see where it is right now. It is, in fact, turning the other way. It's down about 5% or so, despite a decent set of numbers. And of course, I think the focus is going to be on that exceptional item that has propped up its profit in the quarter gone by. And also, perhaps to a certain extent, the question mark about valuations and where they stand right now. Does it really justify the kind of growth that this company promises? Gabriel, on the other hand, reacting to a 31% increase in the profit number for the fourth quarter, doing quite well for itself, up about 3% or so. Let's pull up something like an Astra Micro. It's been in focus because of a possible acquisition by RK Damani, set to participate in the preferential issue for this stock, and it's losing about 4% in trade today. Watch out for that in trade over the course of the session. Another earnings reaction, and this is EIH. We've seen a few hospitality plays come through, and these rest are also on the back of earnings, but EIH losing about 1% or so in trade on the back of earnings. It wasn't too bad a set of numbers. In fact, the margins have held above 40% and they were largely steady, so maybe more of a valuation reaction than anything else. Johnson Control Hitachi, it's the best quarterly profit in as many as 10 quarters. It's up and about 1% or so higher. United Spirits down about 2% despite a pretty steady quarter. And in fact, it's had a 57% increase in the PAT number. So nothing really egregious about those earnings. The stock is just about 1.5% lower at the start today. Something like an Aster DM Healthcare, there's a margin expansion that has taken place and PAT growth, but the stock is down about 3% or thereabouts, also reflecting the mood, so to speak. Quite a bit of caution pervading the street right now. Fortis as well. There were a few exceptional items in the bottom line, but the margin picture has actually improved, and the diagnostic business looking better than it did last year as well on the margin front, and that is perhaps why the stock is just about 1/3% lower. Torrent Pharma reacting to a solid set of numbers, a few brokerages coming out and saying that it was a good set of numbers. A beat on margins as well, which is something we've been saying about quite a few companies this earnings season. Let's pull up something like a Whirlpool of India. Margins better than expected. Is it reacting? Indeed it is. 3.5% higher at this point, and something to watch out for in trade today. Very quickly, rounding off the list, Ircon has gotten an order worth 250 crore rupees. It is up and about 2% or thereabouts. JK Tyre perhaps reacting negatively to the earnings. A few more stocks. So JK Tyre, poor set of numbers, was expected 2.5% lower. Finiotex Chemicals really taking it on the chin. EBITDA falling as much as 44%, down about 8%. The worst performer, so to speak, so far on the share price reaction front, and Gland Pharma down about 1% or so. Just finally, KPR Mills, you have a large trade that is seen in this stock. The promoters selling stake, 6% downtick. Of course, this has to do with the promoters' sale and the price at which that deal has taken place, so a reaction there. But quite a few expected reactions, Tamanna, a few which are moving the other way.
Unexpected for me is Dixon down 5.5%, nearly 6% now, with what is a solid set of numbers. Yes, there was exceptional gains as one item, but that kind of a response I do find a little surprising. 6% down now. Chandan, is this an opportunity to buy Dixon, or you'd wait for it to cool off further?
I think I'll wait because the setup has changed. It was supposed to hold the key levels, but it has negated the same and drifted below key line. So I believe let it correct. Next support will be around 15,000. So let it find some support near, then only we can think about again bargain buying. Otherwise, as of now, avoid.
Not bargain buying yet, maybe moving into the other sense of it. When you looked at the numbers, did anything stand out for you, Mayuresh, which would be a red flag?
So again, I think as was pointed out, I think the mobile PLI, I think that is expected to expire. But I think that will get renewed. There is no two ways about it that we need to boost local manufacturing. And you already heard plans of Apple probably shifting here to India as well in a significant fashion. And therefore, as I said, I think the critical part of business operations will be how the transition happens to ODM. Otherwise, I think there is no justification for elevated valuations. How that happens, in what proportion does that take place over the next few quarters is going to be extremely critical.
Look at some of the movers today. Jubilant Pharmova looking interesting. GSK Pharma, Aegis Life. It's definitely a day for Pharma. I want to pull up Sun Pharma as well. Top gainer on the Nifty when we started trade this morning and still holding on pretty decently. Chandan, is this defensive play something that you find interesting? Anything in the pharma space that you would look at?
So yes, I think selective pharma counters can witness some buying interest being the defensive bet. I'll focus on the Glenmark as the stock has bottomed out after the consolidative move of last 27 trading session. We have noticed that 1460, 1470 is acting as a hurdle, and today it formed a strong bullish candle, some sort of bullish belt hold, so which indicate an early sign of the fresh breakout. So I can focus on the Glenmark. One can buy with support of 1430. It can head towards 1530 marks. Apart from Glenmark, I believe Sun Pharma could be on radar. It has bottomed out after the corrective move last 2 weeks. Multiple supports are near 1700 levels. It can head towards 1770. So Glenmark will be preferred pick. Sun Pharma can also see some defensive buying in this market.
Mayuresh, we've seen quite a bit of the earnings print so far. And what I've been noticing is that in quite a few pockets, and not just in one industry, but a few industries, you're seeing margin surprises. This is perhaps to a certain extent raw materials proving to be beneficial, or the cost easing in certain pockets in manufacturing space as well. But what have you noticed? Is it a trend? Does that continue into the first quarter, or is this a flash in the pan?
Well, Alex, I think we'll have to be a little bit more selective, and I think it's going to be a combination of how top line growth is expected to play out with margin improvement. And therefore, I think sectors which qualify on these parameters, in my opinion, might actually do well. And again, let's assume that the compound effect that comes through in terms of consumption going higher, expectations in terms of better monsoons, might also mean that the rural side, which has been under distress, showing signs of revival, should start coming up as well. And therefore, two sectors specifically, I think, both from an urban as well as a rural perspective, probably might actually stand out. One is alcohol beverages, where numbers have been very, very decent. I think it's a combination both in terms of volume growth, price increases that have happened, states expected to take price hikes. From an input cost perspective that you probably pointed out, ENA, molasses, glass prices expected to stay stable and expected to stay lower. And that will be operating leverage that probably gets played out. The second sector, obviously from a rural perspective, which we have been liking for a periodicity of time, is agrochemicals. And our own sense is that farm gate prices are holding up very, very strongly. The input cost question that you ask, specifically for agrochemicals, fertilizers, phosphoric acid, ammonia, and potash, are down and are expected to remain very, very stable as we speak. And therefore, a combination in terms of volumes with better farm gate prices, expectations of better monsoons expected to prop up, and expectations of volumes expected to continue might actually mean operating leverage play out as well. So I think these two spaces specifically is where top down to bottom, I think the growth might actually sustain, which probably means that the market might actually reward them if they continue with better.
And even the fact that crude oil prices are more benign than they were even a year back. They've hovering around $65 to the barrel for Brent. And of course, the lead times are there. You don't expect it to pan out immediately, but I think it's been benign for some time, Mayuresh. So I'm going to be curious about some of those crude sensitives as well. Chandan, we're looking at Dixon 8% down. At what point does it become interesting to you, or do you say wait till the dust settles, let the session go by and see where it settles?
I think one should not be hurry. However, 15,000 could act as a key level because earlier it drifted to 15,000 at the beginning of May and then headed to a 17,000. So I believe 15,000 could provide as a support, but the way selling pressure is clearly visible with sustained cold writing and built up of short position. Suggestion is wait and watch because the open interest added by around 9 to 10% and price is continuously falling down. So let it stable near 15,000 or better to be on wait on watch mode before this does settle, because I don't think there's any benefit of catching the falling knife as of now.
Okay. Chandan, thanks so much for that view. A pleasure having you, and Mayuresh as well. Apologies, I'm stumbling over your name. Thanks so much for joining us today. Pleasure speaking with you.
Thanks.
All right, time for a very quick break. On the other side, we'll be joined by Prasanna Kumar Motupalli of NLC India to talk about their March quarter earnings and more, and the outlook going forward, of course. Do stay tuned for that.
गोल्ड क्लास ऑप्टिमिस्टिक रिफ्लेक्टिव ग्लास लगाओ, धूप की गर्मी को दूर भगाओ और बिजली का बिल भी बचाओ।
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock.
Welcome back. You're watching India Market Open. It's looking like a bit of a tough morning for the markets. Patchy there as well, but corporate focus at this point. And we're talking about NLC. Revenue has seen a modest increase for the company in this quarter, increase of 8%, but net profits have seen a 4x jump on the back of other income operationally. As well as it was a strong quarter. We will speak to the management, the CMD, in just a minute, but first let me get in Mahima to give us the rundown of what the quarter looked like.
Right, so in terms of net profit, as you rightly mentioned, I was aided largely by other income. The margins also improved on the back of lower other expenses. Now, it's been a strong growth in terms of this quarter, and this is due to operation of Ghatampur Unit 1 being fully operational. In terms of the overall numbers, revenues up 8%, EBITDA up 43%, margins stood at 22.5 versus that of 17%, and net profits stood at 482 crores versus that of 114 crore in Q4 FY24. In terms of the overall operational performance, they achieved all-time highest ever coal production at 172 lakh ton with 36% growth, achieved lignite production of around 240 lakh ton with a 1.6 odd growth. The total coal e-auction volume in FY25 was around 7.3 million tons, and they also achieved gross power generation which was 3% higher than that of last year. In terms of balance sheet performance, that overall net debt increased by around 2% on YOY basis, and the overall net to debt equity remains at 1 time. Net debt to EBITDA is at 4.6 times. Lastly, ROE improved on account of higher regulatory income to around 14.9% in FY25. So this is the overview of how Q4 as well as FY25 has shaped up for NLC India.
Okay, let's ask the management about the quarter gone by. Mr. Prasanna Kumar Motupalli is with us, the CMD of NLC India. Mr. Prasanna, thank you so much for your time with us this morning. Take us through the Q4 numbers and the exceptional items which has actually aided the balance sheet this time.
Madam, this year 24-25 is a golden year in the history of NLC India Limited, with all-round improvement in the performance in all the areas as well as some positive regulatory orders.
Because of the reason we achieved almost all-time highest ever PAT, PBT, and as well as EBITDA. This is mainly because of the increase in the coal production substantially, almost 36%, and achieving all-time highest ever lignite and coal production.
Has aided this all-time highest ever coal production? Is this operational performance which will sustain into this financial year, sir?
Certainly, madam. It will further improve in this current financial year. Last financial year, we targeted 16 million metric ton, but produced 17.2 million metric ton of coal. And this financial year, we are targeting 20 million metric ton. So the operational performance, particularly with reference to the coal production and lignite production, will certainly improve in the current financial year.
So that's quite a bump up there. There's similar targets for lignite as well?
Yes, madam. We achieved the target for lignite also. And the next financial year, we increased our target to 25 million metric ton. So we are hopeful that we will be doing more than that.
Okay. There are factors that have led to an improvement in the margin picture as well, Mr. Prasanna. Margins in the quarter gone by standing at 22.5% compared with 17% year on year. What has led to that expansion? And is that the level that you would anticipate broadly for FY26 as well?
Yes, we are expecting the same level in the financial year 26 because there are more favorable conditions in the financial 26 compared to 25.
Sir, can you lay out just for the benefit of your investors, what are those beneficial factors that are leading to this margin expansion?
See, the first point is the coal production, which we are going to increase from the current last year target of 16 million metric ton. We are going to achieve more than 20 million metric ton in the current financial year. In terms of power production, our Ghatampur unit number 1 already commercialized in the month of December, and that unit is doing excellent, and it is generated more than 1 billion units in first 3.5 months of operation itself. And Ghatampur unit number 2 and 3 also we are going to declare the COD in the current financial year. This will add to our thermal generation capacity also. Also, our the renewable projects that are in pipeline, 300 megawatt in the state of Rajasthan, and 100 megawatt in Gujarat, they will be operational, so that will add to our margins.
So we've spoken about your coal and lignite production, and you've also mentioned about the addition of capacity in the power generation space. I'm just trying to understand, 27,865 was the production power generation, gross power generation in the quarter gone by. What is the outlook for FY26?
FY26, our target is 35 million units. So we are hopeful that with this capacity addition, we'll be able to achieve that.
You know, just I want to come back to a couple of things on your margin expansion, and you answered Alex's question as well, but I'm just trying to understand how much of that margin expansion, Mr. Prasanna Kumar, is cost saving, which is one time. Is this the margin range that you see sustaining for your company?
Madam, as I told, the margin expansion is mainly on account of the improved coal production and power generation. So, and the capacity addition that is going to happen consistently in the current financial year also and the next financial year also. So, the margin levels will be same as it is improvement in coal production, power generation, as well as the capacity addition.
And the other income portion, what was that comprising of? Can you give us some details there?
In other income, we got some favorable regulatory orders. That is the first one. Then higher dividends we received from our joint venture companies, and the increased in interest income. And we received some mine closure reimbursement from the Ministry of Coal. So all these things added to the other income.
So these, of course, will not be carrying on. This is again.
It is a regular, like mine reimbursement. Every year we will get it because it is a progressive type of activity.
To what extent? Can you just give us a number there? So we
around 129 crores we received in the last financial year.
Okay.
And we are expecting same in the current financial year and subsequently also.
Okay, understood. Thank you so much, sir, for speaking with us. That's the management of NLC, talking about the quarter gone by. Decent set of numbers there for the coal company. Now, focus remaining on earning. Max Healthcare is the next company we're looking at. Revenue has risen to 29%. Net profit has risen 21%. There was some treasury income as well. Varsha, breaking it down for us.
For that, so overall decent set of numbers. The revenue growth that you're seeing is driven by occupied bed days, the increase in occupied bed days, and the share of revenue from new units, which is the highlighting factor, was at 15% versus 2% last year, and the bed occupancy was at 75% versus 74% last year. Now, if you see ARPOB, that is average revenue per occupied bed, stands at around 77,100 rupees as compared to 76,800 last year, and excluding Max Dwarka, which is their 303-bed Greenfield hospital, the EBITDA margin stands at around 28%. Now, the highlighting factor over here is capacity. They are aggressively expanding their capacity, and which is brownfield in nature, which will actually aid their profits. They have entered into long-term service agreement for setting up 200 beds hospital in Delhi, and they're going to commence operation at 3 new brownfield towers in Saket, Nanavati and Mohali hospital, and they're going to add 1,500 bed to capacity in FY26.
Okay. All right. So that's the view on Max Health. It's actually an interesting set of numbers, and especially in the context of the other healthcare provider also that we've seen. We saw Fortis results come through. But for Max Health, just to reiterate a few of those numbers, the revenue has been driven by an increase in the number of occupied bed days, and that bed occupancy has gone up to 75%. We spoke to Abhay Soy, who is the chairman and managing director of Max Healthcare. Here's what he had to say.
Now, if you have to look at the kind of growth that has come in so far, are you expecting a similar kind of trend to continue in the coming quarters? And what has led to this kind of a top-line growth?
So we've had a 30% increase in occupied bed days.
Okay.
That means 30% growth. If I look at my occupancy was 75% last year, 76% last year, and that number X the new hospital in Dwarka that we put up, that's Greenfield, which you may recall, we put up in July, which broke even in December, and obviously it's at the ramp up stage. If I look at it X that, then even the profitability is margins are 28.5%. If I exclude the 2 acquisitions, if I include all hospitals but exclude the 2 acquisitions that we did in October, November last year, which is really the Max Noida as well as Max Chitta, which were former JP hospitals, then the occupancy is 78%. And this is, I think, perhaps the highest it's been at the group level.
Okay. So taking the occupancy into consideration, the occupied bed days are also up approximately 30% on a year-on-year basis. What's the trend that you're expecting going ahead? Because the new units, their contribution to revenues has gone up significantly this time around in mid-double digits compared to a 2% that we saw in the fourth quarter of FY24. So what is this actually indicating from a trend perspective?
I mean, because we essentially acquired the first 2 units in March last year, so beginning of March last year, so you would have only got about 20 days of their revenues last year. Then we did a greenfield in July, and then we acquired 2 more units in October, November of the previous calendar year. So, I mean, you would have got, perhaps the entire import of it in the current year. So that's one thing. Which has led to a higher growth, obviously emanating from the newer units, because they were operational through most of the year rather than just 20 days of the previous year. Going forward, having said this, we're expecting perhaps the strongest, very, very strong sort of capacity expansion happening in the current year. Strongest, if I may say so, because it's almost going to be 30% capacity growth in not only the financial year, but in the calendar year, of which in the next 90 days, we'll be adding close to 1,000 beds. on a capacity of about 4,000 beds that we have at present. So, there's a significant capacity expansion. These are all the ones which are being added in the next 3 months are entirely brownfields. That's 268 beds in our Mumbai hospital at Nanavati, about 200 beds in Mohali, in our Punjab hospital, as well as 400 plus beds at Max Saket. So that's the extensive increase that we're expecting, and then followed by December, January, when we should be coming up with another 550 beds in Max Gurgaon.
Okay. Abhay, so taking this capacity expansion into consideration, what's the incremental revenue that you will see that could flow in terms of FY 26, 27 and 28 in terms of growth? And two, how are you meeting the CAPEX?
I think, up till, like I mentioned, last year we added about 30% capacity. This year, through our expansion plans, we're adding another 30% capacity. We were 3,500 beds last year. We have 5,000 beds at present. And by the end of next year, we'll be 6,500 beds. By 2028, we'll be close to 9,000 beds. So that's a significant ramp up, in capacity. It's almost entirely funded through internal accruals. We were net debt positive. That means we had, net of our cash, we had positive cash till October, November. Right now, we have about 1,500 crores of overall debt, net debt on our books going forward. And that was used for the acquisition of the JP Hospital. So unless we do any further acquisitions, which I'm sure we will, we will be funding it entirely through internal accruals. As far as EBITDA and profitability projections are concerned, we've sort of always stayed away from giving forward-looking statements. So I'm not going to give you any forward-looking statements on where we're going to arrive in terms of numbers. But having said that, like I said, the key driver of those numbers is going to be capacity expansion as well as surgical mix, because historically oncology has been a major sort of driver for us. The newer hospitals, obviously, we are ramping up. In fact, we are going to be putting up radiation bunkers in the current year. They're going to commission in the next 4 to 5 months in Lucknow as well as Dwarka. As well as whatever capacity additions we are doing, both of those should augment well for both ARPOB as well as occupancy growth going forward.
Okay. And you mentioned about CAPEX as well. So how much are you looking to spend in terms of FY 26, 27 and 28 if you have to look at the next 3 years?
Well, close to 5,000 crores.
Okay. And any plans on an inorganic growth front taking into consideration as a part of the CAPEX plan? And what will be the breakup?
So inorganic growth, it's always sort of hard to pin down how much we will spend, simply because, depending which target kind of comes to fruition. But having said that, we are quite comfortable going up to 2.5 times debt to EBITDA. At present, our debt to EBITDA is about 0.6 times or 0.65 times. So that gives us with adequate elbow room to be able to raise funds if we wish, conclude any acquisitions. We did 3 last year. I'm fairly confident that may just be doing some this year as well.
Okay. And apart from that, if you have to look at the performance specifically with regards to Dwarka, Lucknow and Nagpur, how has the occupancy been at these 3? And what's the progress on the bed additions as well?
So, immense occupancy. I think all are in late 70%, close to 80% occupancy in all 3. Dwarka, has been a case study. In fact, it's perhaps the fastest break even in any greenfield hospital. It broke even within 6 months. And, it's almost up to full capacity, in 9 months. So that's worked out very well. As far as Lucknow and Nagpur are concerned, we've had 100% growth in EBITDA since the time we acquired. Do keep in mind that was the first year of acquisition, first year post-acquisition, and really being able to double the EBITDA with more than adequate elbow room to go further. In fact, in Nagpur, we've sort of run out of capacity. We are now intending to add another 150 beds. That means taking up the capacity by another 80% in Nagpur. Because it's brownfield, it's very high ROCE. We will be able to sort of exceed our EBITDA numbers significantly with this, as well as Lucknow gives us 27 acres of land, and we already have close to 500 beds over there. We're ramping our capacity further as we're going along. So brownfields pay rich dividends because the fixed cost is already incurred. So again, like I said, they both have worked out extremely well and continue to do so.
Okay. And what is the RPOP trend indicating right now? Are you seeing an upward journey, or are you seeing any amount of pressure, taking into consideration, hospital as a business is absolutely capex intensive, and right now the kind of capex other companies are also looking at, it is expanding pretty sharply. So how are you seeing the RPOP trend?
So ARPOB continues to grow at 7.5% for existing hospitals, and we've seen that in the current year as well. It's no different from what we've seen in the past. This is of course aided by a huge ramp up in international business. It's grown for us by 29% year on year this quarter. So that continues to keep extending. Robotics again has been growing, oncology, some of the other key sort of star specialties have been growing. But look, I think really India is very, very underserved as a market, as far as healthcare infrastructure is concerned. We have a baby boomer population, which every year becomes a year older, a little more sicker. Per capita income is ramping up. So, affordability index is going up. More and more people are sort of getting insured as well as the fact that people's awareness and desire for quality healthcare is increasing only. I mean, if you go around the room today and you ask 20 people, I think all of them would be going to private hospitals, to corporate hospitals at present. So I think, the numbers for this are exceeding, and I think they will exceed any capacity for all of us collectively or individually to set up in the country. I mean, we are significantly underserved. I mean, the total capacity of all the corporate players put together would be less than 100,000. I was reading a recent report that you require close to about 2 lakh beds. So I don't see us catching this curve anytime soon, even if we all collectively were to apply our balance sheets and put up capacities.
Right.
तू ही तो है जिसकी सच्चाई वाली क्लैरिटी की वजह से मैं आज यहाँ हूँ।
गोल्ड प्लस सिल्वॉक्सी मिरर्स, ऐसी क्लैरिटी कि आपको सिर्फ सच नजर आए, चाहे कितने भी साल बीत जाएं।
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
All right, stock of the morning, and one that everyone has a lot of curiosity about, is Dixon Tech, under pressure post numbers which optically look really good. You've seen phenomenal growth on all ends. Yes, there is a one-time element as well. But why the 6.5% downtick? We're going to be speaking with Saurabh Gupta, the CFO of Dixon, in just a minute. But before that, getting in Puneet to set it all up for us. Puneet, take us through the numbers and any sense on why there's concern at all. Is this just valuations and profit booking that we're seeing this morning?
Well, definitely, it's a very good set of numbers. As I said, revenue has doubled in this particular quarter, and the profits as well, growing in this particular quarter, almost doubling again, 95%. Now, the one-time expenses, of course, because the company owns a 6.5% stake in Aditya Infotech, because they sold their security business. So that was there in the last quarter. There again, it's a fair value expense, but even if you exclude that, really strong growth in terms of profitability, up 95%. Now, the stock might be under pressure because only of a couple of reasons that I can really think about. One could be some valuations because it's priced to perfection at this point of time, 120x in terms of price to earnings for FY26. And the other aspect is the PLI part. Now, for the FY26, the company, of course, is eligible for mobile PLI, but that is the last year for PLI benefit, and that's roughly 0.6% to the margins for the company. The company has mentioned this will be replaced essentially with their components foray, and that will help margins. But that is the first question I would have with the management of what are the 3 to 4 components. They've largely mentioned to us in our previous conversation that display as well as camera modules is the plan in the near term. But they've also looked at a couple of other things. That's one. And the other thing is the PLI component scheme, 22,000 crore youth scheme, which will benefit margins. So those will be the couple of questions to watch out for in this conversation.
In fact, let's take that straight to Saurabh Gupta, CFO of Dixon Technology. Saurabh, always a pleasure to speak with you here on NDTV Profit. Spectacular quarter. I think the fly in the ointment is concern about what happens after the mobile business PLI is set to end. So let's just address that straight up and upfront. Do you expect an extension? I think you're on mute, Saurabh.
Good morning. Good morning. So I'm saying that I'm not sure about what's there in government's mind, whether it will get extended or not. But as a company, see, we were never sitting on the laurels of PLI, and we were always investing a lot. So we have created a large infrastructure. We have a very strong balance sheet. We are generating that operating leverage. We are investing in systems. We have been able to get mostly all the customers on the Android ecosystem. We are now really investing in backward integration. So clearly the focus of the company is to driving more and more operational efficiencies and also do more automation and also get into this large play of backward integration. So clearly we feel that assuming that PLI doesn't get extended after a year, we feel confident that not only will be able to mitigate those margin impact that will happen on account of the PLI, but we will be able to in fact improve our margins on account of all the factors which I just mentioned.
So let's just quantify it, and you saw some, you heard some figures that my colleague Puneet put out. What exactly would be the margin contribution of the PLI incentives right now, or what would be the extent of hit if it were not to be extended, because the deadline does end in FY26?
Yeah, so the margin contribution of PLI is around broadly 0.6% of our mobile revenues, which we feel confident that if starting next financial year only, not only that will be getting easily compensated, but we feel that there can be a margin expansion. So even if taking into account the PLI going away in 31st March 26, we feel that there will be a margin expansion which will happen in 27 and in the future years.
I just want to talk a little bit more about that part, sort of before we get into some of the segments here. Hi, Alex here. Good morning to you.
Hi, Alex. Good morning.
I'm just asking about the margin picture, because 4.3% versus 3.9% year-on-year performance is an expansion there as well. And I just want to understand how much of this is related to the backward integration efforts that you've undertaken. What is the reason for that expansion? And when you say that there is likely to be a further expansion from this point, we've seen some of your peers in the EMS space achieve that. I'm just wondering to what extent you are expecting an improvement in the margin picture.
Yeah, so first of all, Q4, I think so there are a lot of levers for margin expansion, which is basically a ramp up and stabilization of our refrigerator business, which is doing very well, which is an ODM business, and it generates 9.5-10% margins for us. Then there was significant uptake in a telecom business, in a variable hearables business, which are again have decent margins and better margins than our mobile business. And also the mobile business also, as of now, the no backward integration has started getting reflected in these numbers because it will take time, as a display plant will be only operational by end of this calendar year, and it should get into mass production only from Q1 of next financial year. And the other components of camera modules, lithium-ion batteries, and as well as the enclosures will only come in from next financial year. So clearly the backward integration numbers are not coming to this category. So when I said margin expansion, I'm not talking about a margin expansion from 4.3% levels, but clearly from a full year levels of 3.9%, there is definitely a scope of margin expansion in next year, and a large part in this year, and a large part will happen in 27-28 when our backward integration or the component strategy starts playing out.
So, you know, a lot more detailing on that, which we want to get into, especially on how you see that coming together. But Saurabh and viewers, please just give us a few seconds. We need to take a very short break and come right back. Sure. So stay with us. We're back with that conversation with Dixon.
That's huge. That is a biggie. It's on the
Gold Plus Clear Glass. Far ho ya near, sab kuch dikhe clear.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock.
All right, we're back in conversation with Saurabh Gupta, CFO of Dixon Technologies. Saurabh, if you can hear me, you know, you were talking about the display unit coming online by Q1. Can you give us a sense of what kind of you know, input it will have on revenues and margins? All right, I'm told we've lost that feed with Saurabh Gupta. We'll try and get him back. But interesting take on Dixon. I think, you know, the highlight of what he has said that yes, we have been aided by PLI, but to think that without that PLI buffer, nothing much is going to happen is maybe something that the street is not seeing very clearly.
You know, and the other aspect is what he's spoken about in terms of backward integration and margins improvement. He did clarify that he's not talking about an improvement from 4.3% level, and I think that that's an important.
But from 3.9.
Yeah, so I think that's an important point that he made. The mobile and EMS division, the kind of growth that it's seen, 200% practically, and the kind of shift that you've seen in the contribution of revenues, even if there is an improvement in contribution from other certain better margin sub-segments, we're likely to see the dominance of this mobile and EMS division play out. As a result of which that margin picture, though it improves over the course of the next few quarters on a year-on-year basis, and if you're talking about the full year, 3.9%, the interpretation seems to be, and hopefully we can get Mr. Gupta to come and talk about that, the interpretation seems to be that from a 4.3% level, don't expect a very substantial improvement in the margins going forward. What are the other aspects to focus on here? Of course, there is a fair value gain on account of the investments in Aditya Vision, and that was 250 crore rupees. The net profit standing at 401 crore rupees, and that's significantly ahead of the expectations of 217 crore rupees or so. And what you're seeing on your screen is the breakup of the revenues. So take a look at that. The mobile and EMS segment growing as much as nearly 3 times to 9,100 odd crore rupees, and there are certain businesses that are going to see improvement in output and certain things coming on stream over the course of the next coming quarters that should have a bearing on the overall mix. But take a look at the total revenue performance as well. The increase is 2.3x in the fourth quarter compared with the year ago period. Of course, the question mark really, Tamanna, is about the valuations and whether it captures it right now.
Yep. Okay, so more on that. But meanwhile, look at what's happening in the markets. The Nifty nearly 0.5% up near the day's high. Sharp recovery over there and robust recovery. Just pull up the Nifty contributors. Let's see what's aiding this kind of a boost over here as you know, as we speak. And you're seeing BEL, yesterday con call was good. The first kind of a response to the numbers wasn't great, and that's because, of course, BEL had already run up with a lot of the defense pack. But you are seeing that now reversing in a sense. Bharat Electronic top gainer on the Nifty. Sun Pharma, DRL, Cipla, Torrent Pharma, it's all about pharmaceuticals today as well. On the markets. Meanwhile, HDFC Bank is doing pretty well. and that's adding on. All right, I'm told we have Saurabh Gupta back, and we're of course waiting to speak to Upasana Thakur next, but I just want to quickly wrap this up because we left that conversation midway. Saurabh, thank you. I know we had a bit of technical disturbances, so thank you for coming back on the phone line so we can wrap up that conversation for our viewers as well. I want to know a bit more about the display fabrication which comes online, I think in FY26. What does that do for your top line?
So more than the top line, it adds our margins, and it helps us build a large moat and strength in the business, because all of this display or the corporate strategy will be captive for our customers in the Android ecosystem or in the IT hardware categories. So more so in because drivers.
Okay, we'll leave it at that, Saurabh. Thank you. Thank you so much for speaking with us today, Dixon Tech there, talking on the numbers that we're seeing. But focus now on MobiKwik. Upasana Thakur, Executive Director, Chairperson and CFO of One MobiKwik Systems, joining in today. Their revenues, remember, spiked to 1,192 crores for the quarter. Upasana, how would you describe Q4?
I think I would describe Q4 as a good quarter. I think overall for this quarter, we have shown amazing growth in our payments business again. And for the full year, we have delivered a record high of 1 lakh crore plus in terms of payments GMV. So that's the first one for us. So full year is a record in terms of payments GMV. I think it's about a 200% growth. And the fourth quarter is also higher than all the previous quarters. So the payments business, which is the mainstay foundation of the company for the last 15 years, has continued to deliver. And that too with an amazing contribution margin of 20%, which is, I believe, one of the highest in the payments business. On the credit distribution side, there is still a little bit of pain in line with the macro environment, and that is playing out in the financials. And because we've not been able to demonstrate growth in that sector, so the overall contribution margin of the company has suffered a little bit, and that has put us into a red a little bit for this quarter as well as for the financial year. But we are confident that in the near future, there will be an inflection, and as the financial services business will see an uptick, we should be able to go back into green.
To that part, I don't know if it's a little bit of red, Upasana. It's a fair bit. You're 121.5 crores in losses for the financial year. What is the pressure on profitability coming from, and what is the path to profitability?
So the reason I said little bit, Tamanna, is because it's minus 6.7% EBITDA margin as a percentage of the overall revenue of the company. And yes, it is, something that we are not happy about. If you see historically, in the last 8 quarters, the first 6 quarters we've been profitable. And the last 2 quarters, our EBITDA is red, Q3 as well as Q4. And that is what I was trying to clarify, that our payments business runs at about 20% contribution margin. Our distribution of financial services business runs at about 40% contribution margin. And that's where you will see that there is a dip, because payments has continued to outperform, both at quarterly and annual basis. And due to that, we have been able to demonstrate revenue growth also. And now what has happened is that we've also continued to invest a little bit in growth, because we are still a high growth business. Overall, the fintech TAM is large. So with lower contribution margin and slightly higher fixed cost has resulted in the profitability going down. But that is what I'm trying to say, that historically we have demonstrated as soon as CM is above 30%, we should be able to be profitable again, and that doesn't seem too far away.
Okay, fair enough. And also your registered users have gone up in the last financial year. So has your customer acquisition cost. What are your thoughts there? Do you see these going further? Do you see your CACs, your customer acquisition costs, going up further?
So see, we have acquired 20 million new customers this year, and the total user base now stands at 176. Typically, our customer acquisition cost, has continued to be in the range of 30-35 rupees. And a little bit of fluctuation keeps happening because many of the ad networks are global, and so the USD to INR also impacts that. But yes, we do believe that acquiring customers is important for our growth, acquiring merchants is important for our growth, which is also part of the use of proceeds that we had highlighted in our recently concluded IPO. And so we will continue investing for user growth and merchant growth. And on top of that, we will be pushing innovative products. Like this year, we are now trying to push 2 innovative products to help us scale UPI growth. The first product is called Pocket UPI, which is a smarter way to pay for your daily life UPI payments. And the second product is called First Card, which is a RuPay credit card, which you can use for your daily life UPI payments. This is a credit card for every Indian, even an Indian who doesn't have a CIBIL score or a bureau score. So we are trying to play on innovation, on our strength of a customer base, how we understand the customers and their needs. And of course, our inherent business model is acquire users and merchants via payments, make the bread and butter revenue there, but then cross-sell financial products to them. So there we have expanded our portfolio of credit products as well as investment products this year. So we do expect to see growth from these avenues. We are also investing in AI, which will help us optimize operations, optimize collections, and also code faster. So faster go to market with new products. And all of this will also bring efficiency on the fixed cost side in this year.
So Upasana, interesting that you mentioned about, credit cards to users who do not have a CIBIL score as well. What's the risk of lending through default loss guarantee on this? Because that will, to an extent, have an impact on the balance sheet. How are you navigating that aspect?
So the card is actually a secured credit card. So the way to, it's a drive for financial inclusion. So many customers today who don't get a credit card, this is a way for them to get included. And let's say somebody's monthly UPI spend is 5,000 rupees, 10,000 rupees. So they would have to park an FD for that with the partner bank that we have, and on the back of that FD they would get a credit card which they can use for spending anywhere on the UPI network, and they would also get reward points on top of that. So it's a secured card, so there will not be any losses emanating from this product. In terms of our credit distribution business, of course we have 2-3 types of products there. We have unsecured products where there is a personal loan where we do take 5% loss guarantee, and that shows up in our financials. Then we have secured product like the credit card I just spoke about. And then we also do risk-free distribution, which is distribution of personal loan, credit card, where we only earn a lead gen commission upfront. And we have, no risk in the portfolio of that product.
All right, Upasana. Thank you so much for speaking to us. And this is going to be interesting because customer acquisition cost is what, you are going to invest in from here on. Profitability is going to be key as well now, whether it's FY26 or 27 is what the street needs to watch out for. But moving on, N. Jaykumar, MD and Group CEO at Prime Securities, joins us as well to discuss what's in store from here on. Jaykumar, good morning and welcome to NDTV Profit. This is Hiral on this side. With the kind of uptick that you're seeing in terms of markets, and you had FIs which actually came out and had a big sell number in terms of yesterday's session. What is the feeler that you're getting from here on? Is it going to be a DII-driven market? And if the FIs are exiting and booking profits, what would this mean?
I think a one-day sale figure can hardly be classified as a trend. And I personally don't think that a single-day sale figure is enough to conclude that the FIs are selling and booking profits. I think there have been sellers in the past, but over the last couple of weeks, I think there's been a decided shift with the dollar index coming off and the money moving out from the US markets. I definitely see an increasing trend of money coming through. There could be odd days when the FIs are sellers, much the same way the DIs could be sellers on a few days. But I think the trend that every dip will be bought into is something that I buy as of now.
I agree with that point, Tamanna here, and great to speak with you again. I'm just wondering if bond yields inching upwards is something which can be a bit of a pain point from an emerging markets perspective at all. And in terms of global turmoil and turbulence on the trade war front, do you think that ship has now sailed, or could this as a factor come back and bite us?
With Trump, nothing has ever sailed. I think these things have a habit of popping up. And especially when you have a social media-driven policy formation process, where everything is announced on Twitter and then we wait for clarifications later. Or for that matter, everything is done through executive orders with hardly any referral to Congress. I think it's a new world and it's a new way of doing things. But the way I see this is that at least as far as the trust factor in the US markets or the US government, more importantly, is concerned, that's certainly something that is a big overhang. I think people have started losing faith, and money flows have in a sense presaged that and preambled that. And the money coming out of the US markets, coming out of the bonds, equity markets are holding up despite the fact that there will be earnings downgrades as inflation catches up. We've not had a single full quarter with the tariffs in place. And the tariffs are inflationary at the very least. I mean, 30% China may be a sort of a cotton wool kind of deal. But the reality is that at 30%, it's still a lot of pain point and pressure on the average US consumer. I believe that the Indian trade deal will get done over the next few weeks. We aren't used to these knee-jerk kind of have a cup of coffee in Switzerland and do a deal kind of process, which China seems to have taken up more, I would say, almost as if needing a deal to be done. I think the US needed it probably even more. But now that China has been set, and I think there'll be a reasonably fair deal done, I believe, with India. Keeping that in mind, but also the backdrop being that Trump's whimsicalities are legendary now, we will have uncertainties going along the way. But the reality is that the US consumer is now going to be hit and slam dunk with a whole bunch of cost escalation, which is already happening. The likes of Walmart and Home Depot, etc., have already talked about it. My own sense is that that will be the pressure point that will make them, relent. The downgrade in the US bond, the treasuries, is a matter of severe concern for them, as $36 to $37 trillion of debt is the outstanding, and interest rates are moving up. The long bond, the 30-year has gone or inching close to 5%. The 10-year has gone past 4.5% and kind of straddles that area. And these are levels that have not been seen, especially in what is seen as a recessionary and almost stagnation kind of environment domestically. So the US consumer is hurt. The US manufacturer has never made money. In fact, people have been moving out of the country to set up manufacturing facilities. So I'm not even sure what the current administration is in the US is smoking. I mean, these are completely alien to conventional thinking, and certainly makes no sense whatsoever. But be that as it may, we are in this maverick-led world, if you will. Wow. And certainly as far as the US is concerned.
This is what I love. Jakes doesn't pull his punches. But the fact is that we have to live with the outcome of whatever the US administration is smoking, as you put it. And in that sense, if there is an economic hit to the United States, IT and the resurgence we saw in IT then goes on the back burner? How do domestic investors who've kept the faith steady in Indian equity right now unpack all of these possibilities?
IT is an issue not necessarily because of US policies. I think it's a bigger issue because of AI. And that impact is playing out every quarter. Number two, the ability of the Indian IT sector to adapt to more products and more AI-driven solutions is probably the need of the hour. And that's easier said than done, because these are all large service organizations. And most importantly, if you look at the domestic sector, India still being the oasis in terms of a growth in a global desert, if you will. My own assessment is that the Indian growth story continues. Liquidity has never been as plentiful as it is right now. The RBI and the other, should I say, regulatory authorities are doing what it takes to improve ease of doing business. SEBI's come out with a lot of steps which I think will allow for greater access to foreign capital. But more importantly, RBI is very, very pro-banks, and therefore banking and financial services will lead, to my mind, the next rally. But from an international sector perspective, I think the pharmaceutical sector, which is the lowest cost producer in the world, other than China, will be hugely in demand as the US consumer seeks out pockets of low-cost production. Even today, Apple has made it very clear that notwithstanding what Trump may like or otherwise, they would like to continue production with India. And I think that goes, unabated. So if individual companies are taking steps which reduce their costs, India cannot be a point on the map which they ignore. We could argue whether they'd be as important as China was 10 years, 15 years ago, but you cannot argue for the fact that the Indian manufacturing setup is here to stay. We'll need to keep tweaking to make sure that things happen. But having said that, the world itself has moved on. The dollar index collapse, the yields going up, clearly indicates which way money is moving and which way international thinking is, geared towards.
Right. Jakes, one question I have when you mentioned about BFSI that will lead the rally. You have an IndusInd Bank that is going to report numbers today. And with everything that's happening across, the disclosures that they've made in terms of the discrepancies in the derivatives trading portfolio, the RBI coming in, and the latest that's come in where an additional accounting issue where the bank has found almost 674 odd crores worth incorrect interest income. And you have the earnings. How would you actually describe the entire episode? Do you think this is going to be a cleansing act from here on and a good investment opportunity, or do you think this is something one should be avoiding?
I would not like to talk individual stocks, but in general, just a one-liner which may be trite in some senses, which is banking at the end of the day is in a sense, a trust business. And any bank which faces this kind of a sort of barrage of events, clearly the trust factor starts weakening. So for me, it's an avoid, especially when the banking sector is replete with small and big players, all of whom are focused and doing the right stuff, especially with the tailwinds of liquidity, etc. The BFSI is a large space. We don't necessarily need to, hunt out gems from, in some sense, near-term fallen angels.
Okay. Now, the hunting out gems is the interesting bit. Are there gems in the market right now? Because the companies that are doing well, and we're seeing it from the corporate numbers, companies are doing well that have reported good numbers, and the question comes in of valuations. That balance is getting more and more difficult to strike. What are you making of the kind of numbers that we've seen so far?
I think markets will pay up for growth. And as I said, there are multiple companies that have reported very good numbers. And in 7,000 or 8,000 listed stocks, I'll be the first to say that there are more gems than you and I can count. The idea is that what will you pay for growth? And as growth becomes a huge challenge in most parts of the world, I think there are several small and mid-cap players who are giving the growth at, arguably not the cheapest of valuations. But then as companies become bigger, valuation multiples start becoming a part and parcel of what people have to pay up. But in the BFSI space specifically, I do believe that there are a number of good candidates in the private sector space that I would be buying. But as I said, I don't want to talk specific stocks, but our interest in the space is very, very high.
That's all right. What about defense? What you're seeing, of course, there's the recency bias with defense, but there seems to be much more to it than just, okay, there was a conflict and then people brought into defense stocks. What we saw with Operation Sindoor was the coming of age of Indian or indigenous defense technology. Are you buying into that defense story right now?
I think, defense very quickly has sort of moved up and become, on the face of it, quite expensive at this point in time. But is there a play with defense being potentially an export theme, where a number of smaller countries come to us to actually source equipment? Because I think if this war taught us anything, it is that that indigenously made armaments actually did extremely well and helped us big time. So I think from that point of view, is there a space, and is it a longer term story than just being used in some conflict, and therefore the proof of concept being tested out to our satisfaction? So taking away the fact that there is jingoism associated with some of this, but the reality is that most of these companies are priced to perfection as of today. Can this be a longer term story with a lower return than what they promised several years ago? Probably that's the way it's playing out. So wait for any sharp dip where these stocks come off 10-15%, and then that could be an entry point, because a lot of the returns have got front loaded in defense stocks.
Right. So, Jakes, with all of this said and done, BFSI, that will lead the space. We've spoken about how pharma will do. Defense is what we've spoken about as well. From a market perspective, where are you looking at the new base from here on, taking into consideration the gyrations that we've already seen so far? What could be the new normal for Nifty 50?
Well, difficult to say a new normal over what period of time, but let's say if we took the next 6 months. Clearly, the double testing of 21,000, 22,000 has become a very, very solid base. Even through the war and everything else, we did see those levels holding out. And then when the dust settled and money started coming in from, especially from, overseas markets in, and we saw the foreigners actually buying through this difficult period as well. To my mind, 23,000 to 23,500 perhaps will become some kind of a pretty solid base. And quite suddenly, we are now close to 25,000. But I would dare say that if you want a really solid, sustainable sort of thing, I think 21,900, 22,000 is that level. Intermediate wise, I think maybe 23.5 would be the level. So we probably will, we should look at buying into this market on any dips, but avoid the sort of blowout days, the days when Nifty goes up 1%, 1.5%. Those are probably not days to buy, because a reversion to mean, while it may not happen, but reversion to 2-day and 5-day-old levels could happen, because so many, as I said, policy statements are coming out through social media and in a sort of a whimsical kind of manner. And those will remain opportunities for us to grab, especially, for instance, things like pharmaceuticals. Whenever they put out policies which actually makes no sense whatsoever, they talk about price cuts and so on and so forth. And markets tend to react maybe irrationally at times, or market men react irrationally. So those opportunities can be taken. And I would say that, watch out for sharp dips to buy into. Markets may not be that forthcoming, but if you have to look at two things to figure out if the trend has changed, I think it's the US yield and the dollar index. The dollar index tested 98, came back to about 101.5, 102. Now it's gone below 900 again. It's probably close to 99.5 and may retest 98. The dollar yield, the index, the market moves are clearly linked to weakness in the dollar and positively correlated to a dollar weakness. And the bigger problem from a US perspective are yields. And I'm hoping that some solution, because any country that has 37 trillion in debt and the long bonds trading at 5%, give or take, is in deep trouble. But that also happens to be the country that can print notes and be the standard currency. And that paradox somewhere along the line is getting sort of unwound as money moves into gold, money moves into the Swiss franc, the euro, and safe haven like that.
No, okay, you talked about pharma. Jakes, and I'm interested in that, because I think that turnaround has been seen, that understanding has sort of come in, that perhaps investors were quick to jump the gun, thinking that one day Trump will say most favored nation policy for pharma, our prices will mirror the cheapest in the world, and then everything will sort of blow apart. Do you think that there is a distinction to be made here between companies which are selling largely generics, CDMOs, and how do you sort of navigate as an investor the pharma space?
I think the real problem from a Trump perspective, of the US consumer perspective, is the pricing of some of the patented drugs and the sort of unholy alliance that exists between the middlemen, 2 or 3 large groups distributing the bulk of pharma in the US, especially generics. So typically, if a generics lands in the US on US shores at $1, it gets retailed at $5, where the patented equivalent could be between $10 and $15. Now, because the patented equivalent is $10 to $15, it could be maybe $10 or $12 in Europe, but 12 to 15 in the US. The middlemen actually make a huge spread between that by marking up the $1 to $5. And I think if that system were to be eliminated, the demand for generics would dramatically move up. And more importantly, the patented folks would actually bring down their prices. So prices have to come down with competition, not with diktat. Prices have to come down with more, getting lowest cost producers a chance to get their products across to consumers in the cheapest possible way, not by talking down prices. And that the exponent of free markets, the US, needs to probably understand, and I think they do, but a certain few who make policies, I don't think quite get it, that they believe they can bluster their way through by actually talking prices down, which is not going to happen.
That's not going to happen, and I think that agreement is something that is absolutely crucial.
And the last point here,
yes.
The last point, if you will, is that the US actually needs more, not less generics. And Indian pharma is more generics than anywhere else in the world. And I think that is therein lies the rub, that you need Indian pharma, and yet you're sort of peeved about the fact that Indian tariffs have been high, and you're mixing issues here. So this needs to be sector specific. This can't be a one tariff fits all kind of strategy, which is attempted to be put in place right now.
Absolutely, and the doctor of medicines is what India is called for the US as well, taking into consideration the kind of generic exports that happen from here on. But thank you, Jake, so much for joining us on the show and sharing the views. It's very interesting, Tamanna, from what he comes up and says that, one, this is the time to buy on dips in terms of markets. Lows should be used as a buying opportunity. Pharma, things could cool down, and taking the quantum of generics that are being exported from Indian markets to the US, they cannot do away with it. Right?
Yeah,
they need it.
My favorite is, I don't know what they're smoking. So,
exactly.
So don't take it too seriously, and then maybe have a contra play to when announcements
and BFSI
like this
continues.
come in. BFSI was the other big one. So all right, a lot to take away from Jake's and of course the entire show. But that's all the time we have on India Market Open. From Hiral, me and the team that put the show together, thank you so much for watching. Stay tuned. Ask Profit up next.
गोल्ड प्लस ऑप्टिमिस्टिक रिफ्लेक्टिव ग्लास लगाओ, धूप की गर्मी को दूर भगाओ और बिजली का बिल भी बचाओ।
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with.
Profit. I am Mahima Vajrajani and you are watching Ask Profit. Today's Ask Profit is going to be a tad bit curtailed. It will start from 11 o'clock, but before that we have two very interesting managements lined up for you on the show. We'll be talking to you, Hindalco's management as well as Yugo Capital's management. But before we move on to that, let's take a quick check on how the markets are doing. In terms of the Nifty 50, well, after a huge sell-off that we've seen from FIs as well as DIs yesterday, FIs in terms of almost 1,000 crores, the markets are now catching up. The Nifty 50 is trading almost 0.8% higher, 0.9% higher at the 24,900 odd levels, and it'll be interesting to watch out for as to now when next Nifty will be crossing that 25,000 mark. In terms of the Nifty Bank, doing well in trade today, up by about 0.7 odd %. The broader markets largely in line with how the benchmarks are doing, so moving in tandem with them. Mid cap 150 up by about 0.9%, small cap 250 up by about 0.6 odd %. Let's pull up the Nifty heat map and see what counters are buzzing in trade today. There you go. Counters like IndusInd under pressure ahead of its earnings, are down by about 1%. Shriram Finance and Kotak Mahindra are the two other counters in the red. Otherwise, all other Nifty counters. So 47 other Nifty counters in the green, led by BEL, 4% up. And this is the second day in a row post its earnings that it's buzzing. Bajaj Auto, again, yesterday it saw some profit booking, but today up 2% in trade. M&M, Cipla, Sun Pharma, Apollo Hospitals, Tata Consumer, Ultratech, all seeing gains of about 1 to 1.5 odd %. Let's also pull up the sectoral heat map and see what are sectors doing in trade today. And all sectors in green, led by the Nifty Defence. Nifty Defence up 2.35%. Nifty Pharma also up 1.78%. But Hindalco is in focus. Strong operational performance in terms of its Q4 numbers. Overall numbers did beat estimates, and PAT growth was on the back of lower tax outgo of Novelis. In terms of the EBITDA growth, as aluminium upstream business, EBITDA grew on lower input costs, saw significant reduction in debt as well, and expects to suspend USD 2.2 billion to 1.9 billion in FY26 for maintenance of capex. In terms of revenue, up 11%, EBITDA up 26%, margins up 180 basis points, and net profit up almost 41%. Novelis sales up 13%, adjusted EBITDA down 8%. EBITDA per ton also kind of down by around 9%. We spoke to company's managing director Satish Pai. Let's listen to what he had to say.
Clearly, on all fronts, numbers across parameters have actually beat street estimates. Is this kind of performance expected to continue in the coming quarters as well? Because I ask you this question is because this is a business absolutely related to the kind of cycles that we see on the commodity side.
So I always give, the performance of a company is based on how its operations run, how efficient their cost of production is, how good your product mix is. And in Hindalco, we are adding more and more value-added products. So all I can assure you is that on all of the things that we control, which is our operations, our cost of production, our value additions and quality of products, that is completely sustainable and actually will get better every quarter.
Right. Satish, when you mention about the increase in terms of value-added products that could be coming in terms of Hindalco, if you could help us understand in terms of strategy, what percentage of revenues will come in from value-added products and how margin accretive is that expected to be, and what are the kind of timelines you're working with?
So, when we did our analyst show in early April, we actually gave a very clear guidance that we are going to make our downstream EBITDA 4x. So roughly from around 1,000 crore, we are going to take it to 4,000 crores. Now, if you look at it this year, 160,000 ton roll plant is coming up and is commissioning in Odisha. An extrusion plant in Silvassa was commissioned last year and is going to ramp up. A copper inner groove tubes for air conditioners is commissioning in Baroda. An AC fin plant is commissioning in Taloja outside of Bombay. So we are adding nearly 200-250 KT of value-added products into our mix over the coming quarters. So I think this is where the additional benefits and the additional EBITDA is going to accrue to Hindalco over our upstream margins.
Okay. And along with this, in terms of where the copper business is concerned, we did see a marginal decline that did come in terms of the copper EBITDA. And this is despite the kind of higher shipments as well as revenues that we saw. From here on, what's the outlook looking like in terms of FY26?
Yeah, so as you rightfully said, TCRCs, which is the conversion and refining margins that are given to custom smelters like us, has come down quite a lot. So I think that this year we are guiding that the copper business will do about 600 crores a quarter. And what is helping us is that the copper value chain is very diverse. So sulfuric acid prices are good. And we are doing quite a lot of value additions on top of copper cathodes. So copper wires, copper tubes that I just mentioned, copper alloys for the railways. So we have a wide range of downstream products on copper that we are releasing to the market. And hence, even with low TCRCs, we are quite confident that we'll have a 600 crore per quarter EBITDA for the copper business.
Okay. And in regards to Novelis as well, the performance was pretty strong because the shipment volumes have seen a growth on a sequential basis, though remained flat on a year-on-year basis. However, which are the segments that are driving Novelis, and where are you seeing the pressure, which could probably be a risk?
So if you look at the tailwinds, what is the tailwinds of for Novelis today is the can demand is extremely strong. We are actually completely sold out. The second thing is the scrap spreads that had tightened in Q2, Q3 have started to ease off. And in fact, we are starting to see scrap spreads improve. So these are two important tailwinds for Novelis. If I look at the headwinds, the auto demand in Europe has been a bit weak, with the economy there being a bit weak, and also because of the tariffs situation with the US. And the other important headwind for us, which we are hoping will get resolved very quickly, is the Canada-US trade agreement, because we have a plant in Canada that supplies to the US, which is a sort of a headwind today because of the 25% tariffs, but which we are hoping will get sorted out when the US MCA 2.0 gets signed.
Okay. And any impact that you're seeing currently with regards to where the tariffs are concerned?
As I said, in the India business, we don't see any impact. The only thing I just mentioned was the US-Canada for Novelis.
Okay. And what will be the quantum? That's what I meant to ask.
So we have already been on record saying the quantum could be in the order of about 40 million.
Okay. Apart from that, overall, if you have to look at the coal mix for 25, even 26 you've mentioned will remain similar to 25, but things will only change post commissioning of Chakla as well as the Banda mines. What's the timeline for this, and how does this impact in terms of finances?
See, our opening of our coal mines is very important in the sense that it gives you, for the next 20-25 years, a steady cost of production. Because even though coal prices this last year have been very favorable, but we are still exposed to what could happen in the market when we go in for auctions, linkage, or spot. So I think the biggest thing for a smelter, if we have Chakla and Banda open up, and by the way, they are all going to open up in the sort of January, February, March of 26. It gives us a very steady cost of production for our aluminium business, which is, I think, is going to be very important for our long-term profitability going forward.
Okay. Apart from this, Satish, the foray in terms of where EV goes, 10,000 units is what you've already looked at. What's the kind of order book that you already have in place from here on? And what is the strategy with regards to this business?
See, we are involved in the EV chain now in quite a different few things. Let me run. So that 10,000 units that we announced, that plant capacity is 6,000 units a month. So that's for one customer. The second customer is already talking to us of setting up a line of equal capacity. We are just going to commission sometime by November of this year, aluminium foil that goes into the lithium-ion battery. And we are then very quickly going to put up a copper foil plant. So copper foil, aluminium foil for the lithium-ion battery, aluminium battery enclosures for electric vehicles. So our portfolio in supporting the EV chain in India is growing.
Okay. So let's, just to clarify on this front, Currently, from the capacity that you have is for one client. Additional capacity is what you're talking about. How long will it take for you to increase for the other clients? And two, what's the order book that you already have in place on?
So that's what I said. Our plant for the existing customer is 6,000 battery enclosures per month, the capacity. The next customer will be exactly of that same order because the units are quite modular. And that will take us about 8 to 12 months to set up.
Okay. And with the first customer that you're talking to as well, where you have an order book of around 10,000, capacity 6,000, any further orders that are in place, or that's where it is right now?
No, I think, we build a line for a customer. So that line is completely dedicated to them. So they will use that fully.
Okay, understood. Overall, if you have to talk about the capex as well from here on, what is the kind of spends that we should be looking at in this year and the year after, that's FY26 and 27, and what's the fundraise plan for the same?
So let me give you an overall view, which we gave to the analysts during our Capital Markets Day. So our plan is to spend 45,000 crores over the next 3 to 4 years to largely increase our upstream capacities, expansion in aluminium smelter, a new copper smelter, an alumina refinery, a copper recycling plant. So those capexes are going to be spent over the next 3 to 4 years. This year's capex guidance is around 7,500 to 8,000 crores. So it's about $1 billion. Next year will probably be even larger than that, but I'll give you the numbers when we meet during Q2 or Q3 calls. So in short, we are going to be on a big capex and a capacity expansion plan over the next 3 years because our balance sheet is very strong. We have a treasury of 16,000 crores and our net debt to EBITDA is negative in India.
Got it. And taking that into consideration, Satish, we've already seen a good amount of debt reduction that's come in this quarter as well, right? So what's that target net debt to EBITDA ratio that you're aiming for, taking into consideration the heavy capex plans that you already have in place?
So what we have committed to is that the India business will not breach 1 to 1.5 times net debt to EBITDA. I mean, today we are at negative, but when I look at over the next 3 to 4 years with our large capex plans, that is the sort of net debt to target that we have communicated to the street.
Okay. And very lastly, any trends and outlook that you're picking up with regards to where key raw materials go for FY26? What are you taking into consideration? That we did see a remarkable increase in the EBITDA per ton this time around, if I have to talk about aluminium upstream, right? So overall, aluminium upstream plus the other raw materials, what's the trend?
So it's a mixed bag right now. So what the coal prices seem to be under control. Pitch is also under control, but CP coke and caustic, we are starting to see a little bit of inflation. Furnace oil has come down because oil prices have come down. So net, if I have to summarize, Q1 cost of production will be flattish with Q4. So some things are going up slightly, some things are going down slightly. So we are not seeing any big inflation in input costs right now.
Well, that's the conversation on Hindalco. We'll switch focus though. The big conversation today is with regard to Ugrow Capital. Why is it big? Is because they've done a large fundraise. Now, for an 1,800 crore market cap company to do a 1,300 crore or announce a 1,300 crore fundraise is certainly extremely large. And for that, we have with us Mr. Sachindra Nath to understand as to what this is all about. And this is an exclusive chat with NDTV Profit. So thank you so much, Mr. Nath, for taking out time and coming in and speaking with us live from our studio. So I want to first start off, explain the dilution to us because it's a large dilution at sub one-time price to book. So explain the dilution itself, what was the thought process behind it, plus you've done some instruments in June of 2024. So when I'm combining those two, the dilution is very, very large.
Yeah, no. So thanks for giving the opportunity to explain. I think it's important for everyone to understand that why we have done it and what's the method. So look at this way. We were at around 6,000 crore of AUM in 23. We were at 9,000 crore in 24. In June of 24, we raised total capital commitment of 1,265 crore, of which around 250 crore was in form of equity, and we did 1,000 crore worth of warrants. That was done at a price of 265 rupees. And those warrants conversion is in the month of December. Every time when we reach near about 20% of capital adequacy, philosophically we raise new capital so that it continues to give comfort to the lenders, to the regulator, and we continue to do our growth because this company is growing, sequentially.
Sure.
So we reached around 19% capital adequacy end of March 24. When in December, if these warrants would have converted, then we would have reached back to 26-27% capital adequacy. What we thought that given that now traded price is much below the warrants, the possibility of warrant converting and not converting depends upon the share price. Now we are an operating company, and as an operating company, our capital cannot be dependent just on share price.
Sure.
So we thought that it would be very good that we go back to the investors which have invested in the warrants and give them the option to infuse the same amount of capital in the company now. They benefit from the price. We benefit of locking our capital today and continue on our growth journey. So that's the logic. So I don't think so you should look at this double dilution. You should look at this as a replacement dilution of against those 1,000 crore of warrants. We have now issued fresh capital of around 915 crore. We had to do a right issue because we wanted to be equitable and fair to every shareholder. So the incremental dilution, if the same warrants would have converted at 265, which now money is coming at 185, leads to around additional 4% dilution. So we have done a right issue at the same terms, so that every public shareholder also have the opportunity to invest in a growth company. And that's a little bit of additional capital. So my presumption is that this is the same dilution. At that time we were diluting 25%, this time we are diluting 30-odd%.
Point taken. So sir, you're giving benefit of the lower price to institutions. Of course, they had the option of subscribing to the warrants or not. How much of the warrant money did you receive upfront? And isn't it ideal that you ought to have raised equity back then, therefore, at 265?
Yes, ideally, yes, of course, why not? So look, in June of 24, when we raised that capital, you'll remember that was a point in time where multiple NBFCs were getting banned. Market sentiment around NBFCs was very hostile. And that's why we, raised what capital was required. So we raised 250 crore of equity. We raised 1,000 crore of warrant, of which 25%, which is 250 crore came, and 500 crore got added to our net worth. Investors were also, making a choice that in a very, turbulent time, they were taking the optionality of giving us the money, but they were protecting, their risk. And look at what has happened that, since then the market and NBFC market have come down, and our prices also come down. So they made that choice of taking that risk, and we raised capital through that structure. And that's okay. And from now, but if you look at our operating performance, we have delivered what we have promised. We have moved from 9,000 crore to 12,000 crore. We have moved our profitability. Our ROEs have improved. ROE has, because of the capital raise, has not gone up further. We have delivered high credit quality. So in fact, there's a lot of narrative. In the morning when I woke up, I was reading. People said, "Oh, like microfinance company, this company is raising so much of capital. There's big, problem or NPA is coming up." Think of this way. Two of our, largest institutional investors, Danish government, which is, sits on our board, is committing 150 crores. Samina, which is existing 7% shareholder, sits on our board, are putting 500 plus 150 crore of capital. Why in the world and two, global institutional investor would put more money into the company if they will not see the growth potential or they will see trouble in the company? Nobody does that, right? Because
is there a concern, sir, from some of these investors, because your stock has taken a bit of a beating? You used to trade at 1.3, 1.4, at peak even 1.5 times book, and I'm talking trailing 12 months. You're currently trading sub 1 time.
Yeah.
So is there a concern that any of these investors have expressed? Is there a due diligence which they've they've spoken to you about?
So no, so that's what I'm saying. If you look at of the total current capital which we are raising, almost 60% of that is coming from investors who are, on our board actually, right? So they see and look at this company on an every quarter basis. So obviously they are super confident, and that's why they are using their option to double up on their investments. Second, I think so it is the market price, in my presumption. Sometimes it's very hard for broader market to differentiate. So in a market scenario wherein SFBs, microfinance companies, there's so much of happening around that. I can keep saying that MSME financing, we keep saying this tagline, MSME अच्छा है, बिल्कुल अच्छा है, but for broader market to then pinpoint and say, no, this company is really different, sometimes it's very hard for me to control that narrative. Over a period of time, I think so we have to deliver what we have to deliver, and market would react to that. But financial institutions, whether they are bank or NBFCs, if they are independent, have to raise capital to make sure that capital for growth, for capital adequacy and lenders' comfort remain with us. And I think so we have ensured that. We are hopeful that this size of capital raise would improve our ratings, will reduce our cost of borrowing, and our operating performance would continue to improve. We have invested very, very heavily in our operating infrastructure. In last year itself, we have added roughly around 100 plus location. We are at 270 plus location. Our emerging market channel is growing. We are super confident that over the next 2 years, we will deliver a very high performing business, and we'll continue to grow MSME financing in India and make this as a leading MSME financing player in the country.
I take your point on that, sir. Sir, tell us, you've spoken a couple of times about how the dilution is just 4%.
Extra 4%.
Extra 4%. So you're saying versus last year's dilution, the dilution will just be 4%, but that's the base case. That is if the stock doesn't rebound.
Yeah.
If the stock does rebound, then dilution will be far more.
Yeah, of course, it will be. I hope so that you're right. I hope so stock rebound, and there are two parts of it. If it rebounds and the warrants are still alive and if they get exercised, that would be an additional capital to company at a higher price.
Sure.
Number two, I think so within our warrant holders, there are, Samina is 50%, right? Post this round of CCD, they will touch roughly around 21%. And as you know, institutional investors don't want to cross 25% because they will trigger open offer and so on and so forth.
Sure.
There is another investor which will cross touch 5%, and as an institution, they don't take more than 5%.
Okay.
And I can't commit on their behalf, but my presumption is that even if theoretically the price goes much beyond the warrant conversion price, some of these investors won't be able to convert. So there will be not additional dilution. And whatever is left, roughly around 200-300 odd crore, even if it comes, we are a very high growth company, right? We should be able to, take that benefit of that capital and deliver, optimal performance to that capital.
Point taken. Sir, you've gone from 19% capital adequacy to 29%. You're, of course, leaving scope for another 200 to 300 crore of possible equity to come in if at all things were to become more favorable in terms of the stock price move. So what happens to your capital adequacy then? And how long will this 29% capital adequacy last you? Because you're fast growing.
Yeah. No, so I think so. Look, there are last 3 years, we have focused on building the franchise for size, which we have now delivered. Every year, we have added roughly around 3,000 crore of AUM and around 1,500 crore of on-balance sheet asset. We have the capacity to go even beyond that. But right now, for this year, also we will grow at the same pace. So I think so we will add another 3,000 crore of total AUM, add another 1,500 crore of our balance sheet. But we have channels and capacity. So we will, I think so at the end of FY26, we should end up at around 24% of capital adequacy, which means we have another, 6 to 9 months of growth momentum which will come. And gradually our ROEs will start improving. So our need of capital, if you grow at 25%, and if your ROEs are in 15%, then capital gap is around 10 odd %. But that would keep improving. So our need of capital would keep coming down because your accreted profit would go up. But even if more capital would come, we have the distribution capacity and the liability capacity. So our emerging market business, our embedded financing business can be accelerated at any given point of time. We have to calibrate our growth. Right now, we are trying to manage or give a very predictable growth targets. Company wants to grow at 25 to 30 odd %, and our core focus is now to improve our return on asset and return on equity. Return on asset would be first, and return on asset is also a function of our cost of liability. Our cost of liability vis-a-vis our peer set is roughly around 150 basis point higher. It is just because of our size, speed, no single parent on top of us. But with this capital, we think so that would also improve. So we are in a very good cycle. Rate cuts have happened. Along with rates cut, with capital raise and hopefully a rating upgrade, that should lead to a better ROA is our expectation.
Is the rate pass-through going to happen in your case? Or will it accrue to you?
Yeah, it will. Some of that would get passed through, but some would so there are two ways to look at it. I think so. One is what rate benefit that come to us because of the cut. That takes around 12 months. But more so, new borrowings which we'll do would be much lower because when you are at a 30% capital adequacy, you don't pay the lender the same price. You pay much lesser. So incremental borrowing would come at a lower cost.
Point taken. So absolutely any concern with credit quality. As you correctly said, there was some concern, at least within certain pockets in the analyst community, that is this possibly an issue with regard to credit quality? Are you willing to absolutely come out and say this is not a problem with regard to credit quality whatsoever, and that you're absolutely clean in terms of book?
So there are two parts to it. One, maturity of the portfolio. We have designed Ugro for a total credit cost of 2%. And we have designed our different asset line for certain level of GNPA. So our prime business operate at a secured operate at a GNPA of 2%, business loan at say 4.5%, micro enterprises at 3%, embedded financing at 1%, and machinery at 1%. By maturity of the portfolio, definitely, some of this would flow. We are at 1.5% of credit cost. As the portfolio will mature, it will hit 2%. But beside that natural progression, we don't have, and I can tell you with a certain amount of commitment, we don't have ballooned NPA which has not been disclosed. We don't have to take massive write-off. So take my words for it that if somebody thinks that I can raise institutional capital to take a future write-off from set of the same people who are in the company, that's not right. I think so. We will continue and we will make changes. I think so the market continues to change. So for example, business loan segment we felt is under pressure. We have brought down its volume from 225 crore a month to now 75 crore a month. We would make corrective changes to reconstruct our portfolio, but we would be in the range of around 2.5% of gross NPA and around 2% of credit cost and we will try to make sure that we will deliver consistently over a long period of time.
Thank you so much, sir. This has been a good conversation. It's been a tough conversation, but you've been candid, so I appreciate that. Thank you. With that, what we're going to do is we're going to slip into a very short break. More on the other side. Stay tuned.
तू ही तो है जिसकी सच्चाई वाली क्लैरिटी की वजह से मैं आज यहाँ हूँ।
गोल्ड प्लस सिल्वॉक्सी मिरर्स, ऐसी क्लैरिटी कि आपको सिर्फ सच नजर आए, चाहे कितने भी साल बीत जाएं।
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Welcome back. You're watching Ask Profit. As I mentioned at the start of the show, that it's slightly a curtailed session today, but it was very important to have both the management conversations that we had earlier on the show, that is Hindalco as well as Ugrow Capital. Let's start with the first question of the day, and also welcome in Vaishali Parekh, Vice President Technical Research at Prabhudas Leeladhar, joining us. And we'll also be joined by Rajesh Agrawal of Om Capital, joining us soon. The first question is from Rajesh Maheshwari, who's writing in from Indore. His query is on HDFC Life. He's bought 300 odd shares at an average price of 375 and wants a short-term outlook on this particular counter. Whether hold or exit is the view that he wants. Vaishali, I'll come to you on this one. What are the charts indicating?
Very good morning, Mahima, and very good morning, Rajesh. I think the stock is pretty much intact. It could probably give a breakout also, but I would say keep a stop loss of 720 because it could cause a reversal below 720. And if this breakout sustains, it can go towards 800 to 820.
That's the view with regards to where HDFC Life stands. The next question is from Mohan, who's writing in from Dubai. He's holding 3,300 odd shares of Ugrow Capital, bought at 241 a piece, and wants a short-term outlook on this particular counter. Considering the kind of fundraise that the company is doing, and that will lead to dilution in terms of the overall equity, the street is not taking that very well right now. The stock, although has recovered a tad bit, trading around 0.4% lower. But Vaishali, with respect to where charts are concerned, what are the charts indicating? Is there a momentum going forward from here?
Well, currently there is no momentum, but the stock has fallen from 320 levels. We saw it going towards 150. Now it's trying to make an attempt of surging high, and it is sustaining above the 200-day moving average. So I would say keep a near-term support of 170. And if the stock moves above 193, 195, in all likelihood, this can go towards 210 to 250 levels. So that would be my view. Keep a stop loss, and let's see if it gives a continuous bounce.
All right. So, by the way, we just had a conversation with MobiKwik as well this morning. I'd invite you to check that out. We've got Krishna from Mumbai asking about it. Bought at levels of 517 rupees per share. And since it is a recent listing, we're not going to immediately have a view on it. We'll have to circle back to it. In the meanwhile, let me come to you, Vaishali, on Hind Zinc. And this is a question from Jayshekhar, who's asking a question from Chennai. He's got 105 shares at a price of 512 rupees per share. He's planning to hold for a period of 2 years, and he's wondering whether to hold or buy more at this juncture. Good morning to you, and what's the view on Hind Zinc?
Hi, good morning, Alex. So yes, I would agree. The stock has fallen right from 800 levels to now, hovering around between 400 and 440. So technically, I would say that he can add more to average out his cost and wait for the stock to move above 480 levels. And then we can see a good run up coming from this, probably going towards 550, 580. So I think good levels to accumulate from here.
All right, so that's the view with regards to where Hindustan Zinc stands. Next question is from Prashobh, who's writing in and wants a short-term view on LIC Housing Finance and wants to know if the right price to buy is at 600 or not. The stock is currently trading at 590 odd rupees. Vaishali, what's the view like for LIC Housing? What are the resistance and support levels that you see?
So I would say right now the support is at 550 and it's a narrow range. I mean, going above 635, 640. So once we see the stock moving above 640 levels, it could get into a further run.
And we've got several questions that are coming through. The next one is actually an interesting one. Do we have Rajesh yet? Okay, we have Rajesh. Very good morning to you, Rajesh. And thanks so much for joining us this morning. We've got a viewer who says that he's a novice investor. This is Ronak Panda who's writing in. And he's looking at purchasing IDFC First at this point. Given what we've heard recently about this entire conversation about the board seat for Warburg, Pincus, everything that's happened since the fundraise, since the results, the question marks about asset quality going forward, maybe a little pressure on the MFI book, the microfinance is what I mean. Would you deploy at this juncture?
Good morning, Alex. Good morning, Vaishali. Even leaving apart all those controversies which have been there in the recent past, in the last week or so, on the valuation parameters also, I would not deploy my money in IDFC First Bank at this juncture, I would say. Because whatever improvement in results in the last 3-4 quarters which we have witnessed has already been discounted in the prices, and any meaningful upside from here would need a lot of extra workings on the numbers front, I would say. And with the kind of controversies going on, the kind of concerns on the asset quality and NIMs going forward, even the MFI book which we have seen on other banks to going for a problem. So I would rather avoid that at this point of time. In banking space, there are better names to go ahead if somebody was looking for deploying new funds. Maybe in the private sector bank, HDFC Bank or a Kotak is a good bank, or in a public sector bank, you have likes of in the large cap SBI, of course, and mid cap Bank of Maharashtra. These are better banks than IDFC First Bank on valuation parameters, I would say.
So that's the view with regards to where IDFC First stands, and of course the banking sector and the pockets that Rajesh likes in the banking space. All right, the next question is from our first caller for the day. Dheeraj is calling in from Hyderabad. Dheeraj, a very good morning to you. How can we help you?
Good morning, ma'am. My query is regarding Dixon Technologies.
Okay.
So I'm holding 39 shares of Dixon Technologies at 16,000 apiece.
Okay.
So should I continue in the same counter for good returns for another 6 months? Or should I shift to some other counter like L&T or Power Finance is my query, ma'am.
Okay, Dheeraj, I just want to clarify, is that 16,000 or 15,000?
16,000.
16, right?
Yes, I bought it yesterday. I bought 11 shares yesterday and the remaining 28 shares today, sir.
Okay, so your average holding is 16,000. Incidentally, Dheeraj, thanks so much for that question. Is this a long-term perspective that you're seeking?
For the next 6 months or 1 year, sir.
6 months to 1 year.
Depending upon the returns. Like I'm expecting a target of around 19,000.
Understood.
In the next 1 year.
In the next 1 year. Okay. Incidentally, we've got a lot of questions, understandably, on Dixon Tech because it's in focus. By the way, it's recovered from the low point of the day. But we got Srinivas from Hyderabad who's wondering whether it can be bought at this current juncture because of the downtick in the price. We've got Raja who's writing and asking whether it's the right time to enter from a perspective of 1 to 2 years. So let's get a holistic view on Dixon Tech. First, let me come to you, Vaishali, on the charts. Generally, they say not a great idea to deploy when the stock is falling as dramatically as it is, because that's the very definition of trying to catch a falling knife. Would you say that is this case, and would you wait for certain levels?
I would not say that, because if I'm looking at the long-term chart also, I think it's done with its corrective move. But, well, I would say 15,000, 14,800 acts as a very crucial support band to maintain a positive bias and to maintain that the uptrend is intact. So the view gets negated if 14,000, the stock goes below 14,500 and sustains below that. So in my opinion, well, this was the result impact. the way the meeting has taken place today, but it's bouncing back. So I would say keep a stop loss of 14,800 and wait for the stock to surge back, because above 17,000, I do agree that it can go towards 18,000, 19,000.
Okay, understood. All right, so that's a perspective on the technical charts. Let me also get the fundamental view. Rajesh, I think, and this is based on what has occurred so far in the market, the reaction to the numbers, which were fabulous. Even if you remove that exceptional item, 250 crore rupees that they've gained, the revenue increase is quite substantial in the mobile business, and 4.3% EBITDA margin in the quarter gone by. We spoke with the management earlier. I know it was a pretty short conversation, but they're saying that they are able to move levers as required to cover for even a possible eventual loss of that PLI benefit, which contributes about 0.6% to the margin. So from that perspective, based on valuations, would you say that it's still attractive, or do you think it's pricey right now and wait?
See, in fact, Alex, I was surprised by the move which the stock gave today. Because yesterday evening when we looked at the numbers, we thought that it was fabulous numbers, no doubt on that. The numbers are pretty good when you compare quarter to quarter, even year on year. So at least I thought that in the morning it would give a move, but I was wrong. Stock went down. And now coming to valuation, the only concern about this stock is valuation, because at this point of time, it's trading at around 80, 82 times earnings, and that's a concern going forward. Otherwise, I think the company has done well. The numbers have been good, margins are improved, and going forward is a kind of movement in the EMS space as such, and the mobile business also. I think this company can do well in the future. That's somebody trying to hold for maybe 12 to 18 months would be a good thing to hold. But in the short term, I think the valuation concerns would be there. Trading at 80 to 85 times earnings, that would be a concern, because there are a lot of stocks available in the market which are at decent valuation at this point of time.
Right. I think valuations is one big concern. Plus, I think even in the con call, when I was going through the notes, I saw that there was some delay in terms of its backward integration implementation. That is probably not being taken well by the street, and probably that's one of the reasons as to why the stock is down.
They spoke about that actually to us, and they said that those efforts are ongoing. What I found interesting, Mahima, is the fact that the management thinks that there will be improvement in margins, but not on 4.3%.
Correct.
On the 3.9% that they achieved in FY25, they expect a margin improvement. So that kind of gives you an understanding that 4.3% se badhne nahi wala hai.
Correct, got it. All right, let's take the next query then. The next query is from Krishna, who's writing in from Mumbai. We addressed this earlier as well. MobiKwik is the counter. Krishna has bought 150 odd shares at an average price of 517. And he wants to know as to what should be the prospects of this company going forward. He's sitting on a loss of almost 36,000 rupees right now. Rajesh, what's the view like for MobiKwik?
See, we are negative on this stock. We think even after this kind of fall, further fall cannot be ruled out. So it's better to try to exit on any upside which one gets to the market conditions. Fundamentally, whatever has been there in the fundamentals has already been discounted, and even at these levels, we are a little skeptical of the stock. So it's a sell from my side.
Okay, earnings came through, of course, and we did speak with the management. I'd invite you to have a look at the conversation that should be posted on our social media platforms not long from now. Avi is calling us from Kolkata. Very good morning, Avi. How can we help you today?
Hi, good morning to all of you.
Yes.
I'd like to look at a fundamental and technical view of Northern Arc Capital Limited. So I've got 1,000 shares bought at 173. So what could be like 6 months to 1 year target?
Okay, so it might be a little difficult for you to get you a technical view, but let me go across to Rajesh on the fundamentals. Rajesh, Northern Arc posted its numbers not too long back. If I remember correctly, there was certain pressure on asset quality. And so that had a bearing on the numbers. Would you suggest holding for the long term?
What I would suggest is to book at least half of your holdings into this and move your money to maybe a Geo Financial or Poonawalla, which are better into the NBFC space at this point of time. At least if you are having a time horizon of 2 to 3 years, you would be the best buy in the entire space.
Okay, so that's the view with regards to where Northern Arc stands. The next question is on Exide Industries. Rohit from Bengaluru has around 2,000 odd shares at the levels of 534 and wants to know as to what will be the one-year outlook for this particular counter. Vaishali, I'll come to you on this one. In terms of Exide Industries, what are the charts indicating? And for a longish term outlook, what's the kind of support and resistance that you're observing?
I would say the stock is consolidating for a very long time after a recent fall from 540 levels. So I would say, well, the stock can do well. 360 would be the technical support. And the first hurdle comes to 420. Since it's a longer term outlook, I would say buy with these support levels. If you have bought at higher levels, one can average out also at these levels and look for higher targets of 440 to 480 levels.
All right, so that's with regards to Exide. Our next caller, Murli, is calling in from Bengaluru. Murli, a very good morning to you. How can we help you?
Very good morning to you and all other panelists and anchors, co-anchors. I bought Pearl Global Industries,
okay,
500 shares at the rate of 1290.
Okay.
And the results have come, it seems to be good. And compared to peer comparison, and it's the cheapest stock as well as on ROE basis also, second, very good ROE.
Okay.
Can I hold it? Does Bangladesh import, they have factory at Bangladesh and Countermall also, I'm told. Is Bangladesh factory, I don't know how it will affect the curbs import curbs by the Indian government.
Correct.
But generally, if you look at the garment industry is looking back, can I hold it or switch to some other industry like metal industry like Kirloskar Ferrous or Lloyd Metals,
okay,
which also have a good future prospects considering their backward integration of mine.
Okay, got your point, Murli. You've always been, at your A-level game when it comes to research. So we really appreciate that, Murli. I'll take this up with Rajesh. Rajesh, Pearl Global is the company, and as Murli rightly pointed out, right now India has the Bangladesh +1 strategy, plus the UK FTA might also be positive in terms of Pearl Global. What's the outlook like? And if not this counter, then should he shift to something like a metal, something in the metal space? And if yes, what should be the counter?
See, there are two different sectors we are talking about. One is Pearl Global, which is into textiles and garments, I would say, and Bangladesh factor is, yes, it's playing out. FTA, UK FTA is also playing out. But as far as the Pearl Global is concerned, I think the valuations are on the higher side. At 1,300 rupees, much of upside is not seen fundamentally. Due to market condition or news flow, it may go up to 1,400, 1,350, 1,400, but that would be a long call to take. It's better to book out at these levels. If you want to be in textile to take benefit of Bangladesh and UK FTA, the better names in the sector, I would say, Vardhaman Textiles being the best. So you can have a look at Arvind. These are two in the textile space. But if you talk of metals is governed more by China factor, and there are news flows coming in that China might go for a stimulus. I don't know whether that is true or not, but if that comes true, metals would be on fire for a short term. Otherwise, also metals are in good demand. Companies are doing well. Numbers have been decent, I would say, with the exception of one or two companies. And they have done capex with the kind of infrastructure focus of the government. I think metals are going to do well, out of which I would like to recommend either Hindalco or Jindal Steel and Power in the large cap space. In the mid cap, you can have a look at Lloyd Metal.
Okay, all right. And incidentally, that's exactly what Murli was asking about. Lloyd's Metal was one of the counters that he pointed out. Sell is a call based on the way that it's run up. Pearl Global is what I'm talking about, of course. By the way, we spoke with the management immediately after that UK FTA was signed, and they had indicated that they are moving a certain amount of production to India to benefit from the tailwinds that will come through from the UK FTA. The next question is on Orchid Pharma. And Revati from Madanapalle is asking about this. Can it be bought at the current market price? Vaishali, on the charts, what's the view?
I would say, right now there's no clarity. Only thing that I can talk about is it's taken a good fall and it's in deep oversold. So I would say if you have a fundamental backup on this, 680 acts as a support. And I think the clarity comes only about 850, 900 levels. So I would say observe a range of 650 to 900, and that's the way I would look at it. I think Rajesh would be in a better position to answer this. So I have no fundamental knowledge.
Yeah, okay. Rajesh, very quick view on Orchid Pharma. Would you suggest a buy at this price?
It's a avoid. The company went for capital reduction, hands changed. Despite that, numbers have not been improved. It will take at least 2-3 years to show some meaningful return. So it's a avoid at this point of time. Maybe a Cipla, Dr. Reddy's or a Aegis would be a better pick.
Pharma pack looking good, up about 1.7% in trade today. And by the way, we haven't addressed it, but the markets have recovered quite substantially from the low point of the day. Let's see, let's pull up the intraday chart for the Nifty 50. Okay, so it's holding on about 0.9% higher, thereabouts, and very dramatically different from the start. If yesterday the tone and tenor shifted to the downside, today the tone and tenor shifted to the upside. Let's see whether that holds true for the rest of the session as well. We've got our next caller, Nagarjuna, who's calling us from Andhra Pradesh. Very good morning to you, Nagarjuna. How can we help you today?
Sir, very good morning, sir.
Yes, good morning. Please go ahead.
I bought 1,000 shares Paradeep Phosphates at the rate 96.
Okay.
Can you please tell me the view on the stock, sir?
Okay.
Is it hold or sell?
Okay, and do you have a long-term view when you bought it, which is a very attractive level? Did you buy it from the perspective of the long-term of fundamentals?
Long-term fundamental as well as the profit booking somehow.
As well as, sir? As well as what?
Profit booking somehow.
Okay, I'm not able to hear you, unfortunately, Nagarjuna, but I'm going to get a long-term view from Rajesh on this one, Paradeep Phosphates. What is the opinion on this particular stock, Rajesh?
It's a hold from a side. The numbers have been good. The company is doing well. At least a target of 180, 190 is quite possible in the next 6 to 9 months. And by any chance it falls to 140 due to market condition, one can even add to that. At this point, one can continue to hold.
Okay, let's take the next question on Sterling and Wilson Solar. And this is a question from Sulochana, who's writing in from Hyderabad. Hi, Sulochana. The question is from a 2-year time frame, and the renewable energy play is what she's looking to address here by this acquisition. Is a stock that has been under pressure for various reasons, Rajesh. Must remember that there is a significant ownership by Reliance Industries now. Would you suggest a fresh entry at this point?
On the contrary, I will suggest an exit from this counter, because despite the fact that Reliance has a ownership, company has not been doing well, and the renewable energy, as said, there are a lot of players which are doing well, and a better names will be a Tata Power, be a good bet in these levels. So find a switch from Sterling to Tata.
All right, so that's the view with regards to where Sterling and Wilson stands, and in fact the power companies. Our next caller, Gary, is calling in from Agra. Gary, a very good morning to you. How can we help you?
Good morning to you and all the experts over there.
Go ahead with your question.
I'm holding some position in Vodafone Idea.
Okay.
I have equity in Vodafone Idea, about 20,000 shares, bought at different levels.
Okay.
So my average is about 8 rupees. So my question is that as the government holds a large portion of that company, the government actually owns that, which is on almost about 50%. What do the experts feel about the company? Shall I hold the position or shall I just book the losses?
Okay. Just wanted to clarify, is it 30,000 shares or 20,000 shares?
20,000.
20,000 shares. Okay, got your point, Gary. I'll take this up with Rajesh. Rajesh, I hope you've heard his question. Plus, the kind of AGR overdues verdict overhang also on the counter. What's the view like? Should he continue to hold?
See, it's a very difficult thing to suggest, because we all know the fundamentals are in a very bad shape. Quarter on quarter, the numbers have been pretty bad. ARPUs are much lower than the industry ARPUs. 5G, forget about 5G in various regions. 4G is also not working. Management has said they are moving into 5G and all. But the management has also categorically said that if the EGR thing is not solved, the company, they won't be able to run the company for too long a period of time. So there's a lot of negatives going on. At this point of time, I would add a little bit of technicals to this and say that you keep a stop loss of 5 rupees and continue to hold to exit at around maybe on any jumps to 8 rupees.
On any jumps. Let's talk about Ganesh Benzoplast quickly. Let's run through a couple of questions if we can. We've got Yashoda, who's writing in from Bengaluru and bought at levels of 118, wondering whether to add more of the current levels for 1 year. What's a quick view, Vaishali?
Ganesh Benzoplast, just a minute.
Yeah. In the meanwhile, we've also got RVNL, and this is a question from Guru, who's asking whether it can be bought at the current price. It's posting its numbers today. Rajesh, very quick view on RVNL. Add. Okay. Vaishali, the view on Ganesh?
I would say keep today's low as stop loss because the stock has just fallen and it has come to its previous low. So if it breaks the 100 levels, then exit because that could trigger further sell, or else wait for it to bounce at least to 120, 120.
Okay, all right. On that note, thank you so much, Vaishali, as well as Rajesh, for joining us on today's show. Pleasure having you as always. All right, that brings us to the end of this edition of Ask Profit. It's been a curtailed one, and that's understandable considering that we're in the mid of the earnings season, but we've got more lined up for you in just a bit, starting with Know Your Company. Do stay tuned. From Mahima and myself and the team that put this show together, thank you so much for watching, and this is NDTV Profit.
That's huge. That is a biggie. It's out.
Gold Plus Clear Glass. Far ho ya near, sab kuch dikhe clear.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers. Hello and welcome. You're watching KYC. I'm Harsh Saita. Today we're going to focus in on Neogen Chemicals. This is what I want to know about the company, and there's plenty of moving parts, and we'll focus on each one of them. First one is with regard to the existing business. I want to know whether the Dahej facility comes back and comes on stream quickly. How quickly should the drag from the Dahej facility normalize, and how quickly should the top line recover with regard to the existing business. This is of course on the existing business. Now let's talk about FY26 and FY27 numbers therefore. How should the existing business numbers look from FY26 and 27? Because we've seen very low to no growth from FY23 all the way up to FY25. So it's been 3 years where on the existing business we haven't seen growth because of various reasons. How quickly should that normalize? How quickly should that unwind? Really, that's the other core piece I want to understand. Electrolytes business. Now this is the new business. What are the growth expectations here? What are the risks? What are the margins? Is this a commoditized business or not? Really, that's the other piece which I'm worried about. Is pricing eventually, when multiple players come in, is pricing power going to go away, or is it going to be held by the company? Because if you are valued at 94, 95 times, then you want to know whether you will continue to have pricing power over the top line that you are expecting to grow by. Let's also talk about the investment in this business. Around 1500 crore or so to be funded. Around 500 crore of that funding has already happened. Around another fresh 1000 crore to be invested. How will that investment be funded? Because your debt to equity is already quite steep. So are you going to take on more debt is really my question. And last off, can return ratios normalize? Because we've seen return ratios fall quite sharply. And it will require these couple of levers for it to normalize. But what's the confidence that return ratios can go back maybe as high as 20% as they were a few years back, or maybe 4 or 5 years back? That's really the question I want to answer. But that's how it all stacks up in what I want to know about Neogen. Let me also quickly look at what the company does. And Neogen Chemicals currently manufactures bromine and lithium-based organic compounds. This is what it currently manufactures. Specialized to a certain extent, not too many people can do this because it's very specialized, but Neogen in that sense is valued or given a higher multiple because of that specialization. So that's one. Second, compounds, where are they used? They're used in pharma, agri-chemicals, as well as engineering industries. So those are the 3 places where it's used. It manufactures advanced intermediates in pharma, agro, flavors and fragrances. It's the largest importer of lithium carbonate and lithium hydroxide for the last 3 decades. So it's built a bit of a niche with regard to some of these products. Let's talk business segments. The first segment that we'll talk about is organic chemicals, bromine compounds and advanced intermediates. Now, advanced intermediates are if I can describe it in the most layman terms, is between a key starting material and an API, closer to an API, and therefore an active pharmaceutical ingredient, which basically finds the cure to the disease that you're suffering from, whether it's a cough, whether it's a cold. The API is what finds the cure. Advanced intermediaries are also a compound or a component which allows you to build an API. So it's not a key starting material, but it's not an API either. That's how advanced intermediaries is. Bromine compounds, of course, are bromine based. Also into custom synthesis, contract manufacturing, when products are developed for specific customers. This is obviously the low-hanging fruit which everyone is now latching on to, and Neogen is no different. Let's talk about the inorganic chemicals. They are into specialty inorganic, lithium-based chemical products. So all of those, they are also into applications in the organic chemical space. What are the applications like? They are applied in pharma, agrochem, flavors, fragrances, I'm just repeating this, electronic chemicals and semiconductors. We can roll forward to the next slide. That kind of shows where all the applications is for some of the organic chemicals. These are the clientele of Neogen. So if you see the kind of clientele they have, very, very solid, right? In that sense, no concern whatsoever. Let's look at the revenue mix between organic and inorganic, currently sitting at 84% organic to just 16% inorganic. The geographical split, domestic is around 63%, exports is around 37%. This is 9-month FY25. and you're looking at the company exporting to over 29 countries, US, Europe, Japan, China, Korea, and the Middle East, among some of them, along with having all of those clients in India. So definitely the potential is quite large, but you want to see it live up to the potential. So let's look at some of the metrics that we look at in terms of financials. Now that we've got some bit of a grip on the business, let's look at all the factors that we look for with regard to a Neogen. First, we look at the income statement, we look at the balance sheet, we look at the cash flow, we look at return ratios. Thereafter, we look at shareholding, street cred. We'll also look at street coverage, and we look at valuation. So that's how we'll stack up our rating parameters. Let me quickly start with the income statement. When you're looking at the income statement, you're not seeing significant growth on the top line. There you go. No significant growth in the last 3 years on the top line, even though it's done well prior to that, but you're not seeing that significant growth kick in. EBITDA as well, your margins have gotten marginally better in FY25, but those will be impacted by raw material costs, and therefore they will be slightly or rather moving in that band between 16 and 20 is the sense. Look at the profitability also, it's come off from the slightly higher number that we saw in FY23. It's a very, very average looking income statement for the moment, but plenty of levers, the Dahej facility being the key. That's the reason why there's been a revenue drag in FY25 and a profit drag and an EBITDA drag. So you're seeing some of these numbers in that context. Also understand profitability is impacted because of higher debt. Your interest cost has gone up substantially due to the capex that they're doing, and therefore you likely see profitability remain subdued, maybe for another year or so before it starts to really pick up. So that's the other piece you want to look at. The second metric is the balance sheet. Now, when you're looking at equity and reserves, it's largely steady state, but when you look at the borrowing, it's gone up from 400 crore to 600 crore in just about a year. This is what I'm talking about. The borrowing number has gone up, which is leaving the company exposed to a certain extent to higher interest cost, but also servicing or repaying this borrowing at some point. You saw the EBITDA number being just above around 100 crore odd. The cash flow, in fact, was even lower in that sense, and therefore that's something you want to look out for. But overall, what you're seeing here is that the ability to repay is becoming more and more difficult, but you have an expansion in the top line, which is in the pipeline, and a strong expansion, which could well aid the numbers from FY26 and FY27 onwards, which could make this look far better. So we want to wait for that. At least that's what the street seems to be suggesting. Mind you, on the P&L again, top line is expected to expand 5x by FY29 as per average analyst estimates on Bloomberg. So you're expecting a 4 to 5x expansion in the top line. Just try and understand how much that would aid the overall set of numbers. Maybe not a 4 to 5x, I beg your pardon. It's probably 3 to 4x in terms of top line expansion. The bottom line was expanding, the EPS was expanding by nearly 5x, 4 to 5x. So you'll see that very strong expansion come through, which could aid that borrowing number on the balance sheet, which we'll have to wait and watch out for. Can that really happen? Now let's talk about cash flow. Cash flows have gone up in this quarter, in this year. It's because of some adjustments in working capital which have happened. But outside of that, the cash flow remains subdued. It remains in a difficult spot. And that is, again, because of the fact that there's no expansion coming through and there are higher interest costs which are coming through. We'll give this a neutral as well, and we'll wait and watch as to how cash flow evolves. Let's talk about the shareholding pattern at this point. 51% promoter held, definitely a positive because a decent amount of skin in the game. There's a decent amount of FII and DII participation to the tune of nearly 30%. So your capital, your free float is just about, or rather public holding is just about 18 odd %. So we'll give it a thumbs up on this one. Let's look at street cred. Again, The last 1 year, the stock has done just 7%, but the last 6 months and the year-to-date period, it's done far better. We'll again give this a thumbs up as well. I want to look also at return ratios because that's the other key component. And it gives you a lens into how the investments made by the company are playing out. At the moment, we're not seeing that happen. You look at it from 25% in FY20, the return ratios have steadily come off. It's 6%, is probably bottoming in FY25. The guess is that it will start to pick up starting FY26. So your return on equity, return on capital employed, this is the trend which is playing out. We're giving this a definitive thumbs down. You want to wait and watch whether and how quickly do those return ratios go towards 20. The Bloomberg estimates suggest that it will take all the way to FY28 or FY29 for it to hit 20% again. But it's going to be a slow uptrend starting FY26. That's the indication that analysts seem to be suggesting. And I keep coming back to analysts because we also have to take the analyst ratings. Let's take that before we look at valuations. In terms of how analysts are viewing this, there are 8 buy calls and just 1 hold call. The upside is 40% from here. And valuations don't look cheap though. It's a thumbs up because analysts are super positive, but you look at valuations, and when you're looking at valuations, it's trading at 95 times nearly price to earnings, and I'm talking about trailing 12 months. The forward-looking piece is very different. When you're looking at it from a forward-looking perspective, valuations, your profit after tax in FY29 is penciling in 300 crore of PAT. Now, for a 4,000 crore market cap company, that's 13 times. So very strong growth being penciled in. From that 95 times, can it come down to 13 times in the next 3, 4, 5 years is really the question that we will hopefully get an understanding from management from. The valuation picture, therefore, is a neutral because while it's 93 times currently, you could well see a sharp reversal in that number going forward. But let me not try and delay this any further. Let's quickly look at ratings and then move and speak with management. The rating that we're giving this very, very quickly is income statement neutral, balance sheet neutral, cash flow neutral, return ratios neutral. These numbers are, or rather return ratios was thumbs down. Shareholding is a thumbs up, street cred is a thumbs up, street coverage is a thumbs up, valuations is a neutral. So when you stack all of this up, it gives a 5 out of 8 on our KYC ratings. But let's not delay this further. Let's move straight to the management. We spoke to Dr. Hareen Kanani, who's the managing director at Neogen Chemicals earlier today about the company's growth prospects to start off with on the existing business. Let me cut straight across to that question which he answered.
So, this bromine derivatives business, or what we call the base business, has bromine derivatives, advanced intermediate, our CSM business, our recently acquired organolithium, and the non-battery lithium compounds together. So the capacity that we have is something which is for 1,000 crores. And our initial target also for this year was around 950 to 1,000 crore. We had a little bit of a setback because of a fire incident in one of the units in Dahej.
Correct.
So currently this year we are focused on a revenue potential, what we have guided 775 to 850 crores. So it will be about 10% kind of increase over last year's performance. However, the capacity is there, and it's largely because Dahej plant MPP3 is currently being rebuilt. As soon as that is rebuilt for the next year, our guidance for that would be a 1,100 crore plus kind of a revenue. So for this year, approximately around 800, 850 crore. And let's say next year, we are looking at somewhere around 1,000 to 1,100 crore. Of course, this is mainly because, as you can see, that in spite of soft international market, this base business already grew at a 13% kind of a rate last year. And had fire incident not been there, it would have been somewhere close to around 17-18% and a volume growth upwards of 20%. So the demand is really looking good. Unfortunately, we had a little bit setback on the capacity, but I think once the new plant is rebuilt, which we are taking a lot of additional cares, and like, it is again going to be, this was one of our state-of-the-art plants, and the one which is getting built is even better. So once that comes online, next year we are looking for a very great further significant increase to meet several customer demands.
Point taken. So, sir, for clarity of viewers, 800 to 850 crore FY26, and then 1,000 to 1,100 crore FY27. So the base business itself will add 50% in terms of top line over the next couple of years. So I want to therefore talk about margins. What's working at this point? Are these high teen margins sustainable for the base business first?
So for the base business, we have always been like, ever since we acquired our plant in Baroda, which gave us some leverage, like both on the scale as well as in terms of being able to handle bulk bromine. And then subsequently, we got into more complicated CSM business or now organolithium. So we have sustained like 17% to 18% kind of margins, basically 18.5 plus or minus 1.5%. Sometimes it's a little bit lower or sometimes a little bit higher, partly due to lower raw material price, because our per ton margins more or less is kind of what we can achieve. But sometimes when the lithium price is too low, it goes as a percentage, it goes higher. Of the lithium price goes very high, it goes a little bit low. So again, that low range is also between 16 to 20%. If you look at like almost last 8-9 years history. So I think we can sustain that. And once we reach the full utilization, as the organolithium and the CSM business contributes more and more to our business, going forward, the target would be move closer to 20% and beyond. Again, this is only possible through innovation. So we have a lot of innovative products and also technologies which we are developing. So long-term target would be to go there. But for now, this business has already sustained, 18% plus minus 1.5% kind of margins for last 7-8 years, and we look forward to being able to do that.
Point taken, sir. So roughly, if I were to just compute EBITDA, that would be roughly in the range of maybe 130 to 170 odd crore, 180 odd crore over maybe the next year or two. Is that a fair assessment?
Yes, I think this year itself was 130 crore plus. Correct. So I think, you would, as we get higher top line, you would see that. Of course, there will be some additional expenses in this year as we are rebuilding because of fire. So on a quarter, you might not get that. Although we have a loss on profit, but depending on how the accounting treatment takes care of that. So there might be some mismatch on a quarter-to-quarter basis kind of a thing. But let's say if we are talking of next year, when we are thinking of a full utilization of 1,000 crore plus kind of revenue potential, we would basically look at 170, 180 or slightly higher EBITDA coming in from Neogen's base business.
Point taken, sir. So I want to now focus on the electrolytes business because that's where all the interesting things are happening, right? So talk to us first off about what the capex is going to look like. What's the outlook like in terms of how much is this business going to contribute to top line over FY26 and FY27? So the same questions for the base business which I asked you, I'm asking you for the electrolytes business.
Yeah, so before I get into that, I would like to say, at least Neogen's point of view, that for us, the organolithium acquisition or getting opportunity to do something in semiconductor in last 2 years is equally exciting. So inside Neogen, we don't have a partiality only for battery business. Although yes, I agree with you that a lot of investment and efforts are being put there. So here we have planned over 2 years. We had planned around 1,500 crores of capex. This was divided in two parts. That some smaller capacity which can support 3 giga, 5 giga worth of electrolyte and salts, let's say up to around 12 to 15 gigawatt hour. So these capacities were coming in our existing Dahej site. So a part of the Dahej site which was converted to Neogen Ionics, the wholly owned subsidiary, and the major capex was coming into a greenfield site in our Pakhajan. Between two, we are investing around 1,500 crore, of which 550 crores is already already around 450 to 500 crore is already invested by us, and the rest will be invested in the current financial year. We already have a running electrolyte facility which can give 2 gigawatt hour plus. Already the salt facility also, electrolyte salt facility is also partly commissioned and partly in trial production and getting ramped up. So based on the capacities which are coming, and the Pakhajan facility is likely to come online in Q4 of the current financial year. So based on these capacities which are coming online, we have given a revenue guidance of around 300 to 500 crores revenue on the electrolyte and electrolyte salt business in the current financial year. And for the next financial year, when we'll have the Pakhajan facility fully available, we don't have a number yet, but the estimate is it will be something more than 1,000 crore. But how much more is something which we've not given a formal guidance, but that is just the base expectation, because the total capacity on full utilization can give us 2,500 to 3,000 crores kind of revenue, and the full utilization is expected by FY28, FY29. So we expect that by FY27 we will be at least 1,000 crore plus, basically more than kind of 50% kind of utilization of the facility we are installing. But the exact number we have not yet given, so it's not a formal guidance, just kind of an estimate for next year.
Sure, so point taken, soft guidance.
Yeah,
sure.
And this is basically driven by two factors. One is the electrolyte demand and international salt. So international electrolyte demand in India to some extent depends on the battery capacity being set up. So we know around 6 to 7 gigafactories are announced, which are starting in 2025 or 26. So we are discussing with all of them, and little bit to some extent the demand will depend upon how these capacities come online and how their demand comes. On the salt side, we have international customers where we have a tie-up for majority of the salt which we are going to produce. There, of course, it's a very lengthy approval process. So it will be subject to, how the approval process plays out. So these are the two main factors which create the variability. And of course, lithium price is another thing which basically affects the top line. But basically the EBITDA would be driven by like ROCs, depending on investment. So on the full utilization, we are targeting like a 20% ROC. So it will be depending on.
Okay, so super detailed, and I have too many questions on this, but I'll break it up. I'll first talk about pricing here, sir. How much of pricing is in your control? How commoditized is this business in your opinion? Because it's a new business, not too many people doing it. Is it commoditized? And because there are too many players interested in it as well.
So, first of all, so we are basically, so on pricing, right? There are two aspects of the pricing. One aspect is basically the lithium and other input price. So if we think of like, electrolyte. So electrolyte doesn't have just lithium salt, but like, when you make lithium salt, along with lithium, you have fluorine, phosphorus, you have solvents, you have additives. So the electrolyte cost will be, will depend on all the inputs, as well as like, our manufacturing costs, and then of course the operating margins that we are targeting. So what we have seen, that in this business, as you grow scale, so as you go from 10 giga to 100 giga to maybe 500 giga, you cannot expect like same levels of per absolute margin. So what we've seen is, when the volumes grow, so when volume becomes high, your absolute EBITDA per ton will change. But your incremental capex will be required less, and you'll have so many synergies which is coming in. So we've done a similar business, of course, not to this scale, but we were making lithium bromide for absorption chiller. So it's also a chemical company selling to kind of an engineering company, which is a different industry. And here also, we have started by making few lakh sale in 1985, and now, selling tens of crores, and together like getting close to around 100 crore kind of. So we've also seen like 3-4 orders of magnitude there. And I think what basically has worked is that most customers appreciate very transparent pricing. They don't expect you to make money on inputs. Yes, but they want you to control your costs, control your investments. So that is going to be our role, as experts who are doing that. So that's why we have said this is a ROC driven business, that as incremental return on capital will get reduced and the amount of internal capital will get reduced, the return on capital will be lesser required, and therefore your EBITDA might change. So I think EBITDA might not remain constant as we go from let's say right now we are planning 30 giga, but when we are at 30 giga, EBITDA might be slightly different, but the ROC should remain constant. So it's a 20% ROC driven business. And at least so far, whenever we have discussed with our international customers, where we are actually, the international customer has a choice to buy either from China or Japan from India. And, they appreciate this point, and we've been able to kind of get this. So the contracts or the pricing arrangements that we have in place is completely passed through, and which basically ensures that Neogen can earn 20% ROC as long as we can basically control the manufacturing costs that we have. So I think we should not be looking too much on the top line exact number, or the EBITDA percentage also, because they will change and fluctuate in this business. What we have to be that on a fully utilized basis, are we able to get the return on capital?
Okay, so that was a very interesting interview with the management of Neogen Chemicals. Growth expected to play out in a very strong fashion on this one. On the new business itself, 300 crore to 500 crore this year, which will take the top line from 800 crore or 770 odd crore to almost 1300 crore. And thereafter, you will see a scale up on the base business as well by at least 300 to 400 crore. So keep your eye out on it. Let's track progress. But for the moment, that's all that we have with regard to Neogen Chemicals. Interesting but tricky at the same time. Completely out of time on this edition of the show. Stay tuned to NDTV Profit. More action on the other side.
गोल्ड प्लस ऑप्टिमिस्टिक रिफ्लेक्टिव ग्लास लगाओ, धूप की गर्मी को दूर भगाओ और बिजली का बिल भी बचाओ।
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready.
Hello and welcome to NDTV Profit. Fortis Healthcare, that's a stock that is in focus. Overall revenue growth of around 12.5%. Profits have gone up around 2.9%. Now, it's mainly higher interest cost that has impacted profitability this time around as well. To understand more in terms of what do the numbers actually mean and what's the outlook going ahead, joining us on the show are Dr. Ashutosh Raghuvanshi, MD and CEO at Fortis Healthcare. Dr. Raghuvanshi, good morning and welcome to the show, and a pleasure to speak to you at NDTV Profit. Firstly, overall, if I have to look at the street estimates, the profit number has missed what the street was estimating, and there has been an exceptional item that has impacted the profitability this time around. Overall, how has the quarter been? Has it met your internal expectations?
Thank you for having me. You're right that it is the exceptional items which have dented the profitability. However, operationally, if you see that this quarter has been quite decent, we all expect that we keep on improving our performance, and quarter on quarter, we have seen improvement in our EBITDA levels. This quarter was around 21.7%, and that is what we expect to grow further from here. So the numbers on both the hospital side as well as on the diagnostic sides were quite in line with our expectations.
Okay. Let's break this down between hospitals and diagnostics, indicating the diagnostic business first. The revenue also has been absolutely in line with what the street has estimated. Margins also pretty much in line in the diagnostic business. So from here on, how much more capex will you be requiring to expand with regards to the diagnostic business?
Yeah, so the diagnostic business, as you know, is not a capex heavy business, and we have invested quite heavily in specialized labs, especially on genomics side. We have put 2 new labs. We have put a transplant immunology lab in Bangalore recently. So with that, we do not require any major capex this year on the diagnostic side. However, at the same time, we are strengthening our collection network of so that the lab profitability, individual lab profitability improves, and we are looking at other costs as well and growing our top line. We expect that the top line this year should grow in double-digit numbers, and that would certainly flow to the EBITDA as well.
Okay, so when you say the top line will grow in double digits, which will flow into EBITDA, how much of that growth will come in from the diagnostic space and how much of it will come in from the hospital space?
Yeah, I was speaking specifically about diagnostic at that time.
Okay,
as far as
so I will, Dr. Raghuvanshi, I'll interrupt over here. So when you're talking about the diagnostic space, what is the game plan to reach this kind of a double-digit growth? Because, you know, opening a diagnostic company is slightly easier than expanding it, right? Because considering the kind of players and peers that are already into the system, market share is the key from here on. So what's the strategy?
Yeah, yes, you might be aware that, you know, we had certain challenges in terms of changing our brand name. And that did impact our business to a large extent last year. And now we have established the new brand of Aegis quite firmly. And we believe that now from here on, we will see a consolidation on our growth. We are one of the oldest diagnostic companies in this space. And we have a lot of focus on the high-end specialized tests. So that would be the backbone for growth over here. We are not doing, though we do all kinds of tests and we do a lot of wellness testing as well, but we are not doing run-of-the-mill tests, and we are doing the entire spectrum. And that is the strength of this business. So as I was saying earlier, we have expanded the network of collection centers, and that focus will remain. We will also open the company-owned service centers as well, which would further enhance our throughputs and growth. We are putting a lot of emphasis on digital marketing and other areas like that as well.
Okay, so all of this to achieve that double-digit growth in terms of the diagnostic business, which will translate on the EBITDA and the margin front as well. Let's discuss about the hospital business. Taking the aggressive expansion plans that you already have in place, I mean, between FY 26 to 29, you're looking to add around 2,000 beds already. From here on, you know, what is the outlook? What will that take your top line to, considering all of this?
So, the brownfield expansion is a major part of our expansion plan. Other than that, we have had 2 acquisitions. One, we are just in the process of completing the transaction, which is Shriman Hospital in Jalandhar in Punjab. And we have got a hospital called in Manesar in Gurgaon, which we acquired earlier. So along with this, the rest of the beds are all brownfield beds. And we expect the occupancy levels, which are currently at about 69%, to go up to about 72% on an enhanced bed base. So that is going to be one of the major drivers of growth as far as the existing hospitals are concerned. Plus, since these are mainly brownfield expansions, the margin expansion is going to be far higher than the greenfield compared to a greenfield hospital. So that is the objective, and we have had about 14% growth this year, and we expect this 14-15% growth or even higher to continue.
Okay. Apart from this, overall, so what is the kind of capex you're looking at from a hospital business perspective as well, and what will that entail in terms of your borrowings? Because interest costs are seeming slightly higher in this quarter as well.
That's right. We have about 500 crores per year of capex committed for next 3 years, but that is all for this brownfield expansion, replacement capex, and upgradation growth capex. So all that will be taken care of by the internal accruals. However, the reason why our debt levels have gone up is the recent acquisition of the PE stakes in the diagnostic business. 31.8% stake in the diagnostic business we acquired from the three PE companies quite recently. So that has increased our debt ratio, but at the same time, I would say that our balance sheet is still very healthy. Our debt to EBITDA ratio is about 1.1, which is very comfortable. So unless until we have some very large acquisition, we are in a very, very comfortable position at the moment, and we expect the debt levels to come down over the next 2 years.
Okay. Now, taking all of these into consideration, if you have to look at the year-on-year growth, this year, I think around 12 to 13% double-digit growth is what you've already seen for the full year. Previous years have been slightly lower. I think this 2022 was a year where it actually went up to 40-41%, right? From here on, what's the anticipation in terms of growth for your top line and your bottom line, taking into consideration the plans and the strategy that you've already put in place?
Yes, so we expect 14-15% growth to be there in the coming years as well. And that trend will continue. And we are already seeing that our occupancy levels are good, and we will continue to see a similar growth.
Okay. My very 2 quick questions I have is, one is with regards to IHH Healthcare, they have escalated their legal battle against Daiichi Sankyo, and they're demanding a $1.3 billion in compensation regarding Fortis Healthcare acquisition. Any comments on that? Does it impact Fortis in any way? Just a clarification.
No, it doesn't. It is a sub judice matter, so I can't specifically comment on that. But as far as Fortis operationally is concerned, the legal issues are not impeding us in any way operationally. So I would say that, the legal woes are behind us, and we are looking forward to a sustained period of growth.
Right. And Doctor, taking your expertise into consideration, the recent hue and cry with COVID-19 cases increasing, any comments on that as to what is happening, and any conversations that hospitals and doctors are having with the government as well?
Yeah, there have been no specific conversations. However, COVID-19 is now an established disease, and many of the diagnoses which have happened in the country recently are incidental diagnoses. Patients had pre-existing conditions, etc. It is there to stay, and many other countries in Southeast Asia, Singapore, etc., has also seen an increase in the number of COVID positive patients, but the hospitals are now very much geared up to take care of these isolated cases as and when they happen. Most of the illnesses are mild and doesn't require hospitalization. So that is where this disease is going to become like another form of cold or another form of viral infection.
Hello and welcome to NDTV Profit. My name is Varsha. Well, earning seasons is out there, and Gujarat State Fertilizers and Chemicals is in focus today. Now, this is on the back of Q4 numbers that the company has posted. The highlighting factor here was margins. So margins were at 4.2% EBITDA margins versus 1.3% last year, and net profit was also up almost 190%. But to speak about the numbers, how was the quarter and what's the growth outlook ahead, I'm here joined by Mr. S.K. Bajpai, who is Senior Vice President and CFO at the company. Hello, Mr. Bajpai, welcome to the show. And just wanted your view, your sense, according to you, how was the Q4 when it comes to company? What were the highlighting points and what were the misses?
Yeah, during the quarter, this Q4 was the lean season for the fertilizer industry as a whole. So there was a slight reduction in the sales volume, but nevertheless, if you see the yearly result, then we have got revenue from operation at 9,534 crores, having a 4% YoY growth over 9,155 crores in the previous year. PBT also grew by 7% to 757 crore. And PAT also improved by 5% to 591 crore. If you see the quarterly result, then YoY, if you see, then only 2% reduction in the revenue, but PBT surged by 239% to 89 crores, and PAT grew by 194% to 72 crore. So if we,
please go ahead.
Yeah, if you see only Q3 versus Q4, then Q4 being the lean season, there is a slight decline in the revenue as well as in the PBT and PAT also.
Right. Sir, on the, you were speaking about the volume growth as well. So just wanted to have a view for Q4, what was the volume growth and value growth? Did we see good volume growth? Because I understand in last year, in Q4 FY24, you had to give some discounts because of seasonality for the, to attend and volume growth. So was the same reason this time also? This time also, did you give discounts, and what was the volume growth because of that?
I think if you see Q4 YoY, the fertilizer output rose by 5% from 1 lakh metric ton to 3.47 lakh metric ton. And sales volume also grew from 3.62 lakh metric ton to 3.65 lakh metric ton. As I told, because of the lean season, the fertilizers upliftment by the farmers was not that great. But in the coming season, the monsoon is also predicted to be good and over the average. And now the pricing of the subsidy declared by the government with effect from 1st April is also with an increase of 20% subsidy increase. So that accumulating all the factors, it will be a good quarter coming ahead with as Q1 and Q2 in the next financial year is concerned.
On that front, sir, because you said that considering the favorable monsoon and the subsidy rates which have been revised, what is the revenue growth expected when it comes to full year, financial year 2026?
I think 5 to 6% growth we may achieve in the next financial year as a whole. And in the quarter, if you see that also we can expect around 10% growth in the revenue as well as in PVT and fat.
Okay,
But only the problem company is facing is the constant supply of DAP and the elevated raw material prices of the DAP and as well as phosphoric acid, which are the main ingredients for producing of the DAP. But the government is also increasing the subsidy rate, and they are also assured to come out with some sort of loss compensation to be offered to the company. So there will not be any problem of DAP supply in the Indian market. And now the people are importing. We are also importing DAP from the foreign suppliers, as well as we started production in our Sikka DAP plant situated at Jamnagar. So after taking all these actions, I don't think any supply constraint will be there in the quarter one.
got that point. Also, sir, I mean, there was a time when you used to enjoy, 7, 8, even 10, 11% margins. Now, I'm talking about the EBITDA margins. When can you see EBITDA margins in the range of 8 to 10%? Will it be in FY26 or FY27? Because I understand, please correct me if I'm wrong, because of the lower subsidies, there was a pressure in EBITDA margins that we have faced. But for FY26 and 27, what is the margin expectation that you are considering?
So as I told you, from 1st April, the government has increased the subsidy by 20% on the phosphatic fertilizers. So that will improve the top line as well as EBITDA also. And we expect that in the next quarter with a good monsoon, we will be having that number what you are expecting. And we will be having that comfortably EBITDA and PVT as well as PAT in the next quarter and next to next quarter. However, having said that, the government is changing or revising the subsidy biannually. So these rates are applicable only up to the 30th September, means the end of the quarter 2. And government will come out with the new subsidy rates again with effect from 1st October. So that all depends what the subsidy rates are announced by the government and what are the raw material prices prevailing in the international market. Because phosphoric acid is only we are getting from the foreign suppliers. So these rates are fluctuating, and depending upon the subsidy, MRP is fixed, and the raw material prices, it determines our EBITDA.
Okay, and also, sir, on the capex, on the expansion plans that you have, so you have urea 2 ramping project that's coming up, sulfuric acid project, phosphoric acid, and also the sulfuric acid project at Sikka. So what is the capex outlay which is expected in FY26, and how are you going to fund it?
Mainly, we are debt-free company because we are having ample cash. And we are putting up these facilities. Some of the projects have been commissioned very recently. That 15 megawatt solar power project, Tarakna, we have just now commissioned. Urea 2, what you are talking about, the revamping project, that is slated to be commissioned within the end of this month only. So by capitalizing this project, we will be having lesser energy consumption, and whatever the norms decided by the government, we will be able to meet it. One more project, GIPCL 75 megawatt solar power project. We are participating 50% of that 75 megawatt power, 37.5 megawatt we will be getting. And it is also slated to be commissioned within this month only. And regarding sulfuric acid 5 project, we are capitalizing in the Baroda complex, and which will be used as a captive consumption for producing our phosphatic fertilizers like ammonium sulfate phosphate and ammonium sulfate. So that will be commissioned in the September. Overall, we are going to expend around 600 odd crores rupees during next 6 months by capitalizing all this plant and making the final payments to the parties. Regarding PASA project at Sikka, it will take little time because we have already started our basic engineering and detail engineering is in progress. So it will take around 2 years, or in the financial year 2026, we will be capitalizing this PSA project at Sikka, and it will solve the problem of supply of phosphoric acid, which is the main constraint for producing DAP and other NPK grade of fertilizers at Sikka plant.
All right, got that view. So my last question to you is on the urea side. The plant was expected to commission in current quarter. I mean, in the Q4. Has it been commissioned? And if yes, because of this, the revamp project, what sort of improvement you can see when it comes to EBITDA per metric ton?
Actually, this urea 2 plant is very old plant of 1967, so that it requires some overhauling and revamping type new equipments are going to be installed for energy consumption, mainly because the government is tightening the energy consumption norms. So by putting the extra equipments, and we are reviving this project, and the energy consumption will be lesser, so that will be the benefit available to the company. Maybe 50-60 crores lesser energy consumptions per annum we will be getting from this urea 2 plant. The capacity of this plant is also enhanced from 800 to 1123 metric ton per annum per day. So that will also facilitate the higher capacity to be produced in the urea 2 plant. And urea 1 plant we will be closing down, because now we will be producing only the urea from the urea 2 plant.
Got it. And sir, last question before I let you go. You said you're expecting around 5 to 6% of revenue growth in FY26. Just wanted to understand, is this the conservative number that you're giving? I mean, can a company expect a double-digit growth going forward? Because considering the subsidy rates which have been revised, and you're also expecting improvement in EBITDA margin also. So when it comes to top line and bottom line, can you see an overall double-digit number?
That will be too optimistic to see the double-digit number. But yes, certainly 1-2% growth we are just now foreseeing. But it all depends upon the international prices of the raw material, and as well as subsidy fixation after the Q2 by the government of India. So yeah, we are very optimistic, but we cannot say that it will be double-digit number. But yes, 8-9% growth will be there.
All right. Thank you so much, sir, for answering all the questions, and all the best.
Thank you.
Clearly, on all fronts, numbers across parameters have actually beat street estimates. Is this kind of performance expected to continue in the coming quarters as well? Because I ask you this question is because this is a business absolutely related to the kind of cycles that we see on the commodity side.
So I always give, the performance of a company is based on how its operations run, how efficient their cost of production is, how good your product mix is. And in Hindalco, we are adding more and more value-added products. So all I can assure you is that on all of the things that we control, which is our operations, our cost of production, our value additions and quality of products, that is completely sustainable and actually will get better every quarter.
Right. Satish, when you mention about the increase in terms of value-added products that could be coming in terms of Hindalco, if you could help us understand in terms of strategy, what percentage of revenues will come in from value-added products, and how margin accretive is that expected to be, and what are the kind of timelines you're working with?
So, when we did our analyst show in early April, we actually gave a very clear guidance that we are going to make our downstream EBITDA 4x. So roughly from around 1,000 crore, we are going to take it to 4,000 crores. Now, if you look at it this year, 160,000 ton roll plant is coming up and is commissioning in Odisha. An extrusion plant in Silvassa was commissioned last year and is going to ramp up. A copper inner groove tubes for air conditioners is commissioning in Baroda. An AC fin plant is commissioning in Taloja outside of Bombay. So we are adding nearly 250 KT of value-added products into our mix over the coming quarters. So I think this is where the additional benefits and the additional EBITDA is going to accrue to Hindalco over our upstream margins.
Okay. And along with this, in terms of where the copper business is concerned, we did see a marginal decline that did come in terms of the copper EBITDA. And this is despite the kind of higher shipments as well as revenues that we saw. From here on, what's the outlook looking like in terms of FY26?
Yeah, so as you rightfully said, TCRCs, which is the conversion and refining margins that are given to custom smelters like us, has come down quite a lot. So I think that this year we are guiding that the copper business will do about 600 crores a quarter. And what is helping us is that the copper value chain is very diverse. So sulfuric acid prices are good. And we are doing quite a lot of value additions on top of copper cathodes. So copper wires, copper tubes that I just mentioned, copper alloys for the railways. So we have a wide range of downstream products on copper that we are releasing to the market. And hence, even with low TCRCs, we are quite confident that we'll have a 600 crore per quarter EBITDA for the copper business.
Okay. And in regards to Novelis as well, the performance was pretty strong because the shipment volumes have seen a growth on a sequential basis, though remained flat on a year-on-year basis. However, which are the segments that are driving Novelis, and where are you seeing the pressure which could probably be a risk?
So if you look at the tailwinds, what is the tailwinds of for Novelis today is the can demand is extremely strong. We are actually completely sold out. The second thing is the scrap spreads that had tightened in Q2, Q3 have started to ease off. And in fact, we are starting to see scrap spreads improve. So these are two important tailwinds for Novelis. If I look at the headwinds, the auto demand in Europe has been a bit weak, with the economy there being a bit weak, and also because of the tariffs situation with the US. And the other important headwind for us, which we are hoping will get resolved very quickly, is the Canada-US trade agreement, because we have a plant in Canada that supplies to the US, which is a sort of a headwind today because of the 25% tariffs, but which we are hoping will get sorted out when the US MCA 2.0 gets signed.
Okay. And any impact that you're seeing currently with regards to where the tariffs are concerned?
As I said, in the India business, we don't see any impact. The only thing I just mentioned was the US-Canada for Novelis.
Okay. And what will be the quantum? That's what I meant to ask.
So we have already been on record saying the quantum could be in the order of about 40 million.
Okay. Apart from that, overall, if you have to look at the coal mix for 25, even 26 you've mentioned will remain similar to 25, but things will only change post commissioning of Chakla as well as the Bandha mines. What's the timeline for this, and how does this impact in terms of finances?
See, our opening of our coal mines is very important in the sense that it gives you, for the next 20-25 years, a steady cost of production. Because even though coal prices this last year have been very favorable, but we are still exposed to what could happen in the market when we go in for auctions, linkage, or spot.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Hello and welcome. This is Profit Buzzers right here on NDTV Profit. I am Puneet Zaveri. With me is Hiral Daria. We've seen a very interesting day of trade, Hiral. We are kind of off from the day's high, but still very positive. And I think we didn't bake in as many positives going into the trade. We were expecting a narrow band of trading again, but largely, we've seen a very good trading session today.
Absolutely. I mean, if you still see, but there is that profit booking that has come in as we speak right now as well from the day's highs of around 24,946. We are again seeing some bit of pressure, but trading in the positive with gains of around 0.4% coming in terms of Nifty 50. Let's also pull up Bank Nifty on the screens and then the sectoral picture to understand what's happening there. You go a similar trend in terms of Bank Nifty as well, but that's pretty much trading on the borderline right now. Sectoral indices, interesting to watch out for. If you see in terms of sectors, real estate is the top gaining sector, followed by pharma, healthcare, and if you talk about auto and IT, what's losing out is the consumer durable space, which is down almost 0.6%. Private banks are down around 0.2%. Media is continuing to see that correction, but the clear outlier right now is the real estate space. Pharma, a good run up in terms of today's session. No reasons as compared to why Pharma is a buzz overall. Let's also look at individual stocks. So if we can have the Nifty 50 heat map to understand the kind of trends and then the contributors. Bharat Electronics, now it's an interesting run that you're seeing in terms of BEL. Brokerages are positive. Concall order book that they've stated is also pretty interesting. But I think it just does not seem to stop. Cipla, Sun Pharma, Tata Steel, Bajaj Fin and Tech Mahindra, a few of the other gainers. IndusInd Bank ahead of numbers is seeing cuts of almost 2.5% coming in there. Kotak Mahindra Bank is trading under pressure. JSW Steel, Hindalco. In fact, Hindalco was in the positive, and after the interactions with the management, the stock has now turned into the negative. So seeing marginal pressure as we speak. So that's with regards to the benchmarks, but it's an interesting trade, Puneet, in terms of the broader markets as well.
Well, definitely. We actually saw the broader markets largely, outperform the benchmarks. Yesterday, they were largely in line. And today as well, that trend has been continuing. 0.3% up on the mid-cap 150. The small cap as well, up almost flattish, just, very, very minimal moves there. Let's also look at the BSE 500 as well quickly, because we've seen a lot of individual moves on stocks reacting based on earnings. HLE Glasscoat is up for the second day. Yesterday it was up 20% in trade, up almost 8% now. We've also seen some positive moves coming on Kaplan as well as Mass Financials. Data patterns has been continuing based on the defense move that we've been talking about. That is another positive trend. On the losers though, we've seen Dixon Technologies as one of the key ones. Apart from that, some losers on Easy Trip as well. But on Dixon Technology, the results were largely quite in line with estimates, and over 100% growth for the company in terms of revenue as well as profits were up 95%. We also spoke to Saurabh Gupta, the CFO of Dixon Technologies, about the company's quarter gone by and the margin expansion plans for the company over the next couple of years. Listen to that chunk of the conversation.
First of all, quarter four, I think so there are a lot of levers for margin expansion, which is basically a ramp up and stabilization of our refrigerator business, which is doing very well, which is an ODM business and it generates 9.5-10% margins for us. Then there was significant uptake in a telecom business, in a variable hearables business, which are again have decent margins and better margins than our mobile business. And also the mobile business also, as of now, the no backward integration has started getting reflected in these numbers because it will take time, as a display plant will be only operational by end of this calendar year, and it should get into mass production only from Q1 of next financial year. And the other components of camera modules, lithium-ion batteries, and as well as enclosures will only come in from next financial year. So clearly the backward integration numbers are not coming to this category. So when I said margin expansion, I'm not talking about a margin expansion from 4.3% levels, but clearly from a full year levels of 3.9%, there is definitely a scope of margin expansion in next year, and a large part in this year, and a large part will happen in 27-28.
So that's the verdict coming in from the management as well. But what's interesting is as to why the stock has been trading under pressure, and what is it that has not done well, because it's the consumer electronics and appliances business which has seen a downtick of around 23%. In fact, Puneet tracks the sector pretty closely, and he's done a comparative with regards to the other companies as to what's working for them, what's not working for them. Any PLI benefits that will not come through could be acting in as a deterrent as well. Puneet, over to you. Taking into consideration majority of them have reported numbers, what is it telling you in terms of the trend?
Well, we've just taken a comparison of the top 5 EMS companies who already reported the results, and for Dixon specifically, it seems like the mobile margins will expire after this year. So FY27 will be a year first time where there will be no PLI margins, and hence that's the impact. We've just taken the company's revenue growth as well as profit growth, what's been in this particular quarter, and just given the standalone margins for the companies in this particular quarter, and we'll get to that in a bit. In terms of revenue, Dixon, of course, leads the way, 221% essentially that they've grown in this particular time frame. The revenue has been led by the growth in the mobile business, but because of that, the margins are the lowest amongst the peers, but the growth over the last 3 to 4 years in the revenue growth has been the highest, and there is the rewarding, we'll get to the valuations as well, that is given to Dixon in terms of the revenue. In terms of the other players, such as Keynes Technology has been one of the biggest gainers, and that's largely because of industrial as well as the auto business for the company. And for PG Electroplast as well as another gainer, that's also because of the TV business that the company has, as well as the products business that the company has gotten into. I just want to just switch to the PAT growth first. That's largely been very positive as well for something like a PG Electroplast, over 100% growth in terms of profits for the company in this particular quarter. They've also raised their guidance for over 30% growth next year as well. While someone like a Sirma has been lowering their share for the consumer business, and that's helped the profits grow at 87%. The key reasons for giving standalone margins and not the growth has been because of the trajectory where these companies are moving on. Now for Dixon, they are a low margin business because they largely have roughly 85% of revenues coming from the mobile vertical, and that's a low margin business because of lower share of ODM or own design, basically, which is a higher margin pressure. For someone like a Keynes Technologies, they get almost 55% revenue from the industrial vertical, which has smart meters as well as their own designs, where the company can control more margins, and hence we've seen the valuation also getting rewarded for the company. And the last one I want to mention is Amber Enterprises, another consumer-focused company, largely focuses on air conditioner manufacturing. That's roughly 50% of the company's revenues, lower from roughly 75 that it used to be. But again, they're now getting into the electronic business, and this margins will be improving going forward as well. In terms of guidance is the second key part. Before valuations, I want to get into. For Dixon, they've said that the smartphone business will grow more 53% from the FY25 level. They will be selling roughly 4.6 to 4.7 crore smartphones in FY26. That's roughly 1/3 of the market currently of India. When you look at something like Keynes Technologies as well, expecting a 60% revenue growth in FY26. For Amber as well, they're expecting 10 to 12% growth above industry average, and for the industry, for the AC industry, the growth has been 25%. For PG Electroplast as well as Sirma, PG has again guided for 30% revenue growth at a year where the revenue has grown almost 60% in FY25, so building on the growth momentum. And finally for Sirma as well, Management guiding for 30 to 35% revenue growth. They've also mentioned an EBITDA margins of 8%, which will be a key positive because they're currently somewhere around 6.5% now. And finally, in terms of valuation, here is where it gets slightly tricky because, at one end for FY27, we've seen something like a Dixon trade at 80 times price to earnings. Keynes has just taken the baton of being the most expensive EMS stocks, and that's largely because of the industrial vertical for the company. At 52 times, Amber offers a very interesting opportunity for investors where the growth is consistent at 30%. The metrics on returns are also very positive. And finally, very interestingly on Sirma, the cheapest stock in the EMS space, growth consistent at 30 to 35%. And that's going to be one of the most interesting ones to watch out for going forward because they're lowering the consumer share, increasing the EBITDA margins. And hence, these are the 5 key EMS players you should be on a watch out for the next couple of years. Commentary as well as the new PLI component scheme is another key beneficiary on top of that.
Thank you, Puneet, for getting us that number crunch. Specifically, so that's with regards to EMS players, but let's also welcome in Lancelot Dikuna to understand more. Lancelot, good afternoon and welcome to the show, and happy to speak to you at NDTV Profit. My first question coming to you is, we did hear Puneet give us a breakdown in terms of what has happened in the EMS space in the fourth quarter, the growth guidance that they are alluding to as well. What stands out and what would your top pick be?
So, actually, because of the valuations, while growth is actually strong in the EMS space on the revenue side, but valuations are also equally expensive. And if there is any, like speed bump in terms of growth coming in, the stock can re-rate very quickly. So at this point in time, I think the valuations factor in, almost all the positives that can come into the sector going forward. And there is no room left for any negative events that may come up. So at this point in time, I would be a little bit, conservative in terms of saying that, maybe if you're already invested in the sector, it's maybe a chance to just keep holding on to it. And if you haven't invested, probably this is not the right time to invest. But whenever there is a dip in the prices, either due to a negative quarter or some bump in terms of slowdown of revenue, maybe orders or something that happens on the tariff scenario, that would be an opportunity to look to enter the sector at that point in time.
Right, so that's with regards to where the EMS sector goes. Buy on dips should be the strategy. We have Vishu standing by as well with exclusive with regards to where RBI's internal committee goes, and they are likely to decide how much surplus money will it give to government on Thursday. Remember, we had reported earlier as well that RBI is expected to give a bumper bonanza to the government. Let's get in Vishwanath for more. Vishi, thank you for getting us this exclusive information, but what are you picking up from your sources and what is that bumper number expected to look like?
Right. So what we understand from our sources at this point in time is that there's an internal review that has been going on at the Reserve Bank of India about the economic capital framework. Remember that this is the framework that determines what is the level of provisioning that the RBI has to do and thereby determine what exactly is the surplus that it will transfer to the government. Now, since 2019, the contingency risk buffer, or that provision that the RBI does, is set between 5.5% to 6.5% of the size of the balance sheet. In FY24, the RBI went with a 6.5%. It's the upper end of that provision requirement. They have maintained that. Now, the internal committee is actually divided on what exactly the future course should be. One part of the committee believes that the framework has stood the test of time, so don't need to make any amendments at all. While the other believes that there are now global concerns that are emerging. One is geopolitical tensions in different parts of the world. And second, there are trade disruptions that are happening because of the US's stance on global trade at this point in time. And therefore, the Reserve Bank of India might want to actually go out and raise that contingency risk buffer in the way that is there at this point in time. So we need to see what exactly goes on at this meeting and what the RBI finally goes ahead with. The government needs to approve this before anything actually happens.
Absolutely. So the government needs to approve this. And what's interesting is 2.5 to 3.5 lakh crore. That's that big number that Vishy has been talking about as well. But let's quickly just address the aviation data that has come in so far. If you talk about the passengers carried by domestic airlines during Jan to April, that has seen a monthly growth of around 8.5%. CASA Air market share has remained unchanged at around 5%. Let's look at a SpiceJet and Indigo, if you can pull up both these charts on the screens as well. Indigo, the passenger load factor is coming at 84.6% versus a 86.9%. The stock did see a marginal dip. SpiceJet 84.8 versus a 86% on a month-on-month basis. Air India again has seen a dip this time around, and that's with regards to the passenger load factor. The market share is going to be interesting to watch out for. If you could just have a SpiceJet on the screens as well to understand what that stock is doing on the back of the April aviation data. No major reactions on that front. Lancelot, very quickly, your view between a SpiceJet as well as a Indigo.
I think, from a financial perspective, Indigo is better placed than SpiceJet. We have seen in the past that aviation is such a business that those strong companies or companies with strong balance sheets have been able to upgrade their fleet, maintain them better, and also because of which they're able to garner a higher percentage of the traffic that flows. So I think Indigo is definitely a preferred investment option as compared to SpiceJet, because they are much stronger, much larger in size, and any kind of downturn in the economic cycle they will be able to absorb the impact far better. So I would think that Indigo is a better option at this point in time.
View, Lancelot, and we have been seeing. Here is something that we will be discussing going forward in the show, as well as also the defense pack. Defense pack has been the D Street's darling for a while now. In fact, one of the sectoral top gainers in trade today is BL, particularly from that pack, has performed really well over the last 1 month, over 25% now. Now, it came with its Q4 numbers a couple of days ago, and the Street is happy with the numbers. They've also held a conference call, and now we've had the brokerage notes come in for the company. Anushi, what are some of the key aspects that we need to know going forward for BL? Does it still make a case to buy into it?
So thanks for that, Puneet. Firstly, I'll start off with what has excited the street for Bharat Electronics, especially after its con call, which was held yesterday during market hours. Firstly, it's the margin outlook, which was a positive surprise for FY26. Now, the management has guided for a 27% of a margin. Last year, they guided for a 22 to 25% of a margin. So from there onwards, the management has remained pretty steadfast on its approach that they expect this margin improvement trend to continue for the upcoming years as well. If you look at the order pipeline now, this is one aspect that has been talked about. They're expecting a large ticket order for QR SAM, that's quick reaction surface to air missile. This is at the size of 30,000 crore that we're looking at. Possibility of this order coming in the fourth quarter of FY26, but in worst case scenario, this may also spill over to the first quarter of FY27. So that is an important order coming for the business, along with next generation corvettes from the shipbuilding companies. Again, this is at the size of 6,000 to 10,000 crore that we are looking at. So excluding this big ticket order also, the company expects about 27,000 crore of order inflows. Do note that last fiscal, that's FY25, that guided for 25,000 crore of inflows, but it received about 18,000 crore of inflows. So there was a miss by 25-26 odd percent owing to delays of 3 of their orders. Now, apart from that, it's the exports also, which is an interesting picture. In near term, in this year, they plan about 15% growth in exports, but from next year onwards, they're also seeing a 20% of growth in exports coming forward for the business. Other than that, in the long-term project, if we are seeing Project Kusha is one aspect where BL expects about 40,000 crore of an order. The Project Kusha is an indigenous S400 system that we are looking at. So this is another aspect why the street could be excited for Bharat Electronics. Now, a couple of brokerages have come out. Firstly, Macquarie on BL, they've maintained an outperform rating and have hiked the target price to 400. They say that there was a solid end to FY25 that we are looking at, with Q4 beating the consensus on higher than expected EBITDA margins. Pipeline also remains on the robust side. And And FY26 margin guide has surprised the street positively as mentioned earlier. Antique has maintained a buy with a target price of 422, which implies a 16% of an upside, stating strong operational performance continues to surprise the street positive manner. Also the delivery in terms of the margins, 20% plus is the kind of range that we are looking at. It has been consistent. So this would ensure sustainable growth also going forward in terms of where the capex plans are also headed. Lastly, we also have Nuvama, which has maintained a buy call with a target price of 430. Q4 surpassing the street's headline number expectation. Along with that, they believe that the company has positive catalysts rather than the negatives. So they see further scope of re-rating for the business. They've also revised their FY26 EPS by 4% and have assigned a 45 times of a PE multiple based on the FY26 number that we are seeing. So this is the overall picture that we are seeing for Bharat Electronics for its short term and long term, how the order pipeline and the EBITDA margins in particularly are going to be in focus. So that's all on BL.
Thank you, Anushi, for getting us the details. We'll come back to you on Astra Micro later on, but we have the management of Acme Solar that is joining in as well. Let's quickly pull up the stock on the screens and see what the counter is doing in trade, because operationally it has been a strong performance. On the back of a lower other income, I think there has been some bit of a dip that's come in terms of its profit numbers. The stock is up nearly 2% as we speak. Nikhil Dhingra, CEO at Acme Solar Holdings, joins in. Nikhil, good afternoon and welcome to the show. This is Hiral on this side. My first question coming to you is strong performance in terms of operationally. You did see the benefit of the 1.2 gigawatt capacity addition that was done in the third quarter of FY25, where the full benefits have flown into the fourth quarter as well. What's the outlook looking like going ahead? Is this kind of performance expected to continue? And when do you see that recovery coming back in terms of profitability?
Sure. So first let me address the profitability point. So we did not have a reduced other income here. We had a exceptional gain in the last quarter of the last year, where we sold assets and booked income of around 700 crores on the sale of those assets. So our other income is strong, our operational income is strong, and of course we have grown by more than 2x on all the ratios. And that is because of the growth in the capacity from 1300 to 2700 megawatt today. So profitability has improved on let's say a PAT of around 100 crores has gone up to 250 crores if you remove that exceptional item. So profitability is much stronger from last year, and even the EBITDA margins have gone up to 90%. So both operationally and financially, the performance has been very strong because the exceptional profits are for a particular transaction and they are not part of the annual operating financials. In terms of the sustainability of this quarter performance, so of course we gain the benefit of the new capacity expansion, which you rightfully mentioned. Of course, we did not get that benefit throughout the year. So now in this year we will get the benefit of the capacity which got operationalized in the Q3, as you mentioned. Now we are expanding our capacity. So each capacity expansion increases our EBITDA margins also, and of course it increases our EBITDA and PAT purely because of the asset addition. And of course the capital efficiency with which we are building these assets in terms of the mid-teen to high-teen capital employed ratios, that further adds to the profitability and the EBITDA margins. So we have added in this quarter at least till date 162 megawatts. We are supposed to add around 300 megawatt more very shortly in this quarter and next quarter. So that will help improve the quarterly numbers, and of course as we reduce our debt costs, that will further strengthen our balance sheet. This year has been a big move on the balance sheet strengthening with completing our IPO and of course completing multiple refinancings. Of course the IPO fundraise has helped improve the financial strength in terms of the overall equity which is available for the capex which we plan to do in next couple of years. So we expect this performance to continue like you asked.
Right. Hello, Mr. Dhingra. This is Varsha this side. Great to have you here. Just wanted to have your view when it comes to order book, because how much of the order book currently is under PPA backed?
Yes. So around 2.2 gigawatt of our order book is PPA backed, and the rest of around 1.8 gigawatts is LOA. And of course, in all of these, most of them the tariff has been adopted, and we are shortly expecting the PPA to get signed as well.
And also, just wanted to know the timeline when it comes to your large under construction projects, especially 380 megawatt FDRE and 680 megawatt project.
Right. So in terms of the timeline for these projects, the scheduled COD of these projects, 380 megawatts, is June 2026 as per the signing date of the PPA. And for this for the 680 megawatts, it's December of 26, because you get 2 years to build the plant. So those are the target dates, and we are on track to achieve those dates because the execution requires, other than funding, it requires land connectivity, which we are doing in large measures at Rajasthan and Gujarat and various other states where it is required to be done, where we have got the connectivity. And of course, to add, we have closed the capex ordering for the long lead items because the transmission evacuation system takes long time to basically procure as well as establish. So those things we have moved on already on these sites, and of course the financing is in place. So that's how we are targeting to achieve the target of the scheduled COD.
Okay. Nikhil, in terms of the overall capacity, where are you sitting on currently, and how much are you looking to add in the next 3 to 5 years? And from addition perspective, has there been a spillover anywhere where anything that was supposed to happen in FY25 has not happened?
Right. So first, in terms of the next 3 to 5 years, we are supposed to go up to 7 gigawatts of operational contracted capacity. When I say 7 gigawatts of operational contracted capacity, the installed capacity will be far higher, in excess of 10-11 gigawatts, because these FDRE plants require a storage component and you need to install extra renewable capacity to charge the battery. So the installed capacity will be much higher than 7 gigawatt. The installed contracted capacity it will be around 7 gigawatts in next 3 years. In 5 years, of course, we are trying to achieve 10 gigawatt of operational contracted capacity in terms of the overall numbers. And all these capacities are battery backed and hybrid at least, so much higher capacity utilization factors than what we have done in the past, and much higher tariffs as well, because we are providing a more round the clock solution than the intermittent renewables earlier. In terms of the misses, we were of course slated to do the 300 megawatts of solar plant by March. So it stretched on till May. And we have operationalized that capacity 50%, and we are hopeful of operationalizing the rest of the 50% in a month or so. So so that got deferred by you can say 45 to 60 days because of the some commissioning related issues, and also because of the border related issues.
Right. Mr. Dhingra, also on the wind project, just correct me if I'm wrong, because wind has been significantly underperforming. I think in the last 2 years, the performance has been quite weak. So just wanted to get your thoughts on that. Are you trying to how are you trying to deal with the kind of risk attached to that?
Sure. So as we are in a very unique position that we have a very low composition of wind in our portfolio. So currently we have zero wind operational, and we consciously did not enter into the wind sector because we were more confident about the solar generation and the feasibility of providing lower tariff to our customers, and of course in a sustainable manner. And that's where whole of our capacity has been solar, and we have built larger amounts of solar, capturing a very large percentage of the Indian market. So now as we go forward, we are doing a very small amount of wind. Of course, the wind is essential because in a hybrid plant, you have to do both sources of solar and wind. And every RE also some component of wind is required. So that is why we entered into the wind sector. And we are doing our first plant of 150 megawatts in Gujarat. So wind, you are right that there is a high degree of variability. And of course, it has underperformed in a couple of years out of the last 5 years. So we are very mindful of that. And when we design a solution which involves wind, we try and minimize the wind portion. And of course, we try and take the conservative assumptions relating to wind generation. As far as solar is concerned, just to differentiate, the capacity utilization factor for us has been industry leading. In all our Rajasthan plants, we did an annual CFO around 29.4%, which is very high. And of course, this year we have improved our capacity utilization factor by 200 basis points. So our weighted average capacity utilization factor today is 25.6%. And one of the plants in Fatehgarh did again upwards of 30% CUF in the last quarter. So you are right that there is a variability, the source variability, and is more in wind, and we always try and provision that in our bidding as well as in our operational assumptions.
Right. So I think the outlook looks pretty strong from here on. Growth is something that the street should be watching out for as well. But thank you, Nikhil, so much for joining us on the show and sharing the views as well. But let's quickly slip into a short break. Lots more lined up on the other side. Please stay tuned to NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market mover.
Nifty and the Sensex trade off highs. Nifty defense trade as a top sectoral gainer after reversing two-day losing streak. Mid and small caps trade in the positive territory.
JK Tyre gains over 8% despite reporting a disappointing set of earnings in the fourth quarter. Slow demand, higher raw material costs impacts profitability. No reasons known as to why the street is cheering the stock.
Gujarat State Fertilizers loses more than 3% despite reporting a threefold jump in the fourth quarter profit margins. Profit margins have also improved in this particular quarter to 26%, have also improved because of fall in fuel expenses by 26%.
KPR Mill tanks close to 5% after three promoters sell stake worth 1,100 crores or more than 70% of the promoter holding. And this comes in at a floor price of 1,230.3 rupees per share.
India logs 257 active COVID cases. Kerala and Maharashtra lead the rally. Indian authorities say no cause for alarm. Well, welcome back to Profit Buzzers right here on NDTV Profit. Just want to take focus on a couple of stocks which are buzzing both in the auto as well as the tire space. The first one's Gabriel India. Now the company has largely been doing very well in terms of posting a very decent set of numbers for this company. And the street is reacting very well as well. Let's also look at the 6 month to the 1 year chart for the company. It's been outperforming all other auto ancillary players in this particular time frame. For at least this particular quarter on a consolidated basis, the company has reported a 17% growth, and there you go, up 58% in the last 6 months, up 76%. And the street has rewarded the company's consistent performance over the last few, at least in the last few years, and that's visible now in the share price performance as well. On a consolidated basis, they had roughly a 17% growth in terms of revenue. EBITDA was also up 35%. And for the first time, the company has clocked a double-digit margins at 10%. Now, when you look at the net profit, that's up about 31% in this particular quarter, coming in at 64 crores. Now, around roughly 900 crores of revenue comes from the standalone business, and that's the suspension, which is one of the key products. They've also now done a couple of other acquisitions and partnerships, which is helping the company expand its total addressable market. The first one's, of course, a sunroof partnership they've done with Inalfa, which is a European company that will give exposure to the company, which is largely an import substitute play. And the other key aspect for the company is, of course, getting into solar dampeners. That's what they've announced in this particular quarter itself, and that will help the company going forward in increasing the margin profile. Let's also look at JK Tires also very quickly before we get to our guest. Another stock that's in focus. After the company reported actually a weak set of numbers, profits have fallen by 42% in this particular quarter. But the EBITDA is also down by roughly 330 basis points to 9.7%. It's puzzling in terms of how the stock is reacting, and the only thing I could think of, because they've not mentioned much in the conference call as well, but the valuation comfort versus the likes of Polo as well as something like an MRF is something to watch out for, because if you can pull up the 1 year chart of JK Tires, it has been impacted heavily because of the higher raw material cost in this particular quarter that's visible on your screen, 64% versus 59%. But over the last year or so, it's given actually 6%. Stock has fallen by 6% as well. But let's take both these queries to our guest. Brijesh Ale, the head technical and derivatives retail research at IDBI Cap, is joining us. We also have Lancelot. Lancelot, thanks so much for patiently waiting by. Let me come to you first, Lancelot. I'm not sure if you track Gabriel India as a stock. Done very well for its investors over the last year. Any view on the same?
So I think the company has been let's say evolving a little bit on its strategy over the past 1 year, and many of the new initiatives that they've taken have come into play, and we are seeing an improvement in the profitability going forward. However, it trades almost at about 30 times, 32 times forward earnings. And given that you might see some kind of slowdown as far as the sector is concerned, because there have been a lot of data points which indicate that the two-wheeler, four-wheeler sector is looking a little bit weak, especially in the entry level segment. So one has to keep that in mind while looking at a company like Gabriel India. But otherwise, it's very positive from a longer term perspective, because they've entered into new tie-ups, and these are likely to give them higher margins as well as better cash flows going forward. So even from a return on equity, there has improved over this last year, and we expect that it will continue to improve going forward as well. So we are positive on Gabriel India. Maybe need to wait for a little bit of a pullback and then look at accumulating the stock for the long term.
Lancelot, a follow-up I want to take with you is in terms of JK Tire. The numbers have been weak. The anticipation was that it would be a negative reaction with the JK, but the street is rewarding the stock. What is the reason for this? I mean, is it that the outlook going ahead for the tyre industry is expected to be strong, taking into consideration what's happening in the premium segment as well? Because right now, Puneet and I were just discussing that 50-55% of the revenues for a JK Tyre comes in from the bus and truck segment, where the demand is already weak. So what is it that the street is reading that we are missing out right now?
So I think what could be the reason why, despite a poor results, the stock is actually moving up is that there is the raw material prices have sort of stabilized going forward, and you are seeing some stability in terms of raw material prices. Maybe that looking at the future, the margins could improve, given that even if the sales do not increase significantly, but profit margins could improve, given raw materials prices are expected to be a little bit weak for the next 6 months to a year or so.
Okay. Brijesh, your view, what are charts indicating? A good buy at current levels in terms of JK and Gabriel after the strong surge that we are seeing in today's session, or are these candidates for profit booking?
Hi, afternoon. So basically, if you look at the Gabriel, the month-on-month average gains, if you just compare the previous series of gains, the 25 to 30% is what it normally looks like. So for the current month, it's already up by 22%. So we can see some more 3-4% kind of a momentum. But then the trend for this particular stock is quite strong. So on an immediate basis, 600 is the level from where the fresh longs were added. So I think 600 will stay strong, and gradually this should move further higher. So I won't be surprised if we see the stock back to 800, 850 levels. So that would be the projected upside for the Gabriel. So we are positive, and whatever the longs which we are having, I think 600 should be the immediate level where one should keep that as a stop loss. Coming to JK Tyre, so I think this is one stock now which is at the verge of giving some kind of good reversals. Now back to this 380, 400 level, there is a small supply is there. But my understanding is that over a period of time, this 400, if 400 level is taken out, then this will be back to this 480, 500 level on the higher side. So there is definitely opportunity in JK Tyre. It looks quite strong. The recovery is very strong. So corrections, by any chance, if we see in the JK Tyre specifically, I would like to take the long bets for 450, 480 kind of a trading opportunity.
Got the view, Brijesh. Let's also look at another key stock that's in focus, that's Astra Micro. Now the company has raised 174 crore rupees via warrants. Gopikishan Damani has participated in the fundraise and committed close to 50 crore rupees. Let's go across to Anushi of why this is a significant development. Anushi.
Right. So firstly, I'll start off with what the update is for Astra Microwave. Now here the board has approved, as you've mentioned, 174 crore of a fundraise. This is via the convertible warrants route that we are looking at. This warrant subscription price was at rupees 864. So comparing that to the current market price, that's yesterday's close, if we take, we are seeing about a 21% of a discount compared to what the warrant price is. Do note that this warrant tenure is not to exceed 18 months. So if you are seeing now here, the participation is from Damani, Gopikishan Damani, brother of Radhakishan Damani, wherein if his warrants are converted to equity, they hold about 0.6% of stake in the company. Along with that, we have some other notable HNI names as well, which include Suresh Kumar Samani, Atim Kambra, and Ratnabali Equity as well. Now, even the promoter, if you see Renuka Chitrakar, his share would increase to 3.11% as well. Now, do note that Radhakishan Damani did hold a stake in this company, but this was last seen in March 23 levels. It was more than 1% stake that we'd seen, but since then, if it's below 1% or level or so, or he's completely exited the position, is something that is yet to be certain. But what may interest Damani in Astra Microwave, a couple of factors playing into it. Firstly, the company is a key player in radars and subsystems. We've already seen how this has played an important role in Operation Sindoor. Strong growth prospects. Now they're expecting a 15 to 20% of a revenue growth in FY26. Even if you look at the order book, which stood at roughly the size of 2,300 crore, this is as of the December 24 figure that we're looking at. Management expects overall a stronger pipeline, seeing about a 20% of a growth in their order book by FY27 onwards. Along with that, even the margins are expected to increased. This is with higher margin domestic orders as compared to the exports which are there. Now, quickly just walking through the valuation picture, if we see valuations for this stock is not on the cheaper side. Trailing PE, if we look at, that is 76 times. This is as compared to 3-year average PE of 63 times that we are looking at. Even if we see in terms of warrant subscription price, that indicates a multiple of 61 times. This is if we take the 864 warrant price, which is somewhat in line with the average PE of 63 times, but lower than the trailing PE of 76 times that we are looking at. So overall, 174 crore of a fundraise. Now, whether they utilize this for general corporate purposes or for projects is something that we should be keeping our eye out for.
Thanks for that, Anushi. Lancelot, just want to talk to you about both BEL as well as something like Astra Micro. Let's start with Astra Micro first. It's a stock that we don't talk about a lot, but has been gaining strength to strength. We've seen these private defense plays do very well. Someone like Azad Engineering has also been doing well. Solar Industry also came out with strong earnings. Any view that you have on these stocks? And we'll get to BEL also in just a bit.
So, Puneet, the defense plays or the private defense companies, you've seen the stock prices rise significantly in the short term, especially after, the performance of various, missile systems and radar systems in the recent, India-Pakistan conflict. And that has probably been driven more by sentiment than on the basis of valuation. Now, if you look at even the warrant conversion, it's at 843 rupees. It's at probably 20%, 15% discount to the current market price. And, given that the companies, while it receives all this money, the orders and the execution is still going to take time, as well as, we may not see that high margins generated in the business going forward. So even if you look at the current margin systems, the current net operating margins is about 8 to 10%. If you look at on a gross basis, on an EBITDA margin is about, 18 to 20%. So given that kind of financial, let's say, indicators, the price is a little expensive at this point in time. So I think there's a lot of, hope riding on these stocks, but one needs to be a little careful at what time and what price one buys into these stocks.
Got that view, Lancelot. Brijesh, anything on the charts that suggests any of these defense plays, while the last 1 month has been very strong, anything that you like across the public sector as well as the private sector defense plays?
So specifically talking about the Astra Micro, I believe there has been the move what we saw recently, the extended move. The move came from the level of 800 and it almost went up to 1120. So my understanding that it's in the overbought zone and this is an extended move. So somewhat profit booking is expected in the Astra Micro. So somebody who's already holding a position and making a profit, it is advisable to take some profit because sooner or later it's a probability that this may come below 1000, close to 900 level. So profit booking is advisable in the Astra Micro. Coming to Bharat Electronics. So this is one which doesn't look like it is going to stop very soon. So this move which is already there, maybe some small profits can be taken, but this extension of the move towards 420, 430 levels is what we believe can be on chart. So we are riding this trade. So still, but the same scenario, like the move came from the level of 290, 300. It's almost 100 points up. So some profit booking is advisable. And lastly, one of the new trade which I do believe we can have an opportunity in the defense is the Cochin Shipyard. So Cochin Shipyard is one stock which is again, previously it has given a breakout and today there was some corrections in the last 2 trading session and has come back to the demand zone. So I believe from the current level of this 1830, 1800 level, this can go back to 2000, 2100. So this kind of opportunity, I think that would be there in the Cochin Shipyard.
So that's with regards to Cochin Shipyard, but 2 other stocks that are buzzing in trade are Finotex Chemicals. Let's pull up that one on the screens. The revenues have dropped by close to around 22%, 8.5% downtick coming in on that counter. Varsha standing by. Varsha, with regards to Finotex Chemicals, what has not worked this time around? And if you have to look at a GSK Pharma as well, anything that you're picking up, because don't seem to see any news, any volume uptake. What is happening?
Yeah, so coming to Phenotech's chemicals here, so very weak set of numbers that the company has seen. If you see the revenue growth, so basically revenue is down 22%. Now this is due to soft volume, that all the two segments have seen. Now they saw soft volume in FMCG, cleaning and hygiene segment, while the textile chemicals, if you see the other segment of them, remain stable. And the net profit is down 33%. Now there would have been more degrowth in net profit, but the other income helped net profit. Now, if you see the return ratios, so return ratios have been impacted because of the recent fundraise that the company has done, and due to which we are seeing ROE and ROC impacted compared to last year. While if you see the non-textile will be the next growth driver for as per the company in FY26 and 27, and focus on exports is export market will also be the next growth driver, which will actually help revenue when it comes to FY26 and 27. When it comes to GSK Pharma, yes, there's no major news flow, but the stock is buzzing on the back of higher volumes.
Okay, good volumes coming in on that one. Brijesh, Phenotechs as well as GSK, what are charts indicating?
Phenotechs, I'm not very sure how this would span out because the undertone of the particular stock has been bearish. Like this has been trading with a lower top, lower bottom structure. And today there has been a gap down. So the previous low of 207 might be retested or might get broken. So we would be slightly cautious, not too much of gung-ho, maybe close to 200 levels. One need to understand whether the fundamentals do support, but on an immediate basis, this can slip further. So won't be taking any fresh view or maybe fresh buy trade setup or any trade in this. But coming to Glaxo, I am confident that today there has been one day when again very strong breakout has been seen. So the volume breakouts are there. And if I need to speak from the monthly point of view, it's a kind of a bullish flag kind of a formation, which I can see in the monthly chart. So this talks of another 15-20% from the current level on an immediate basis. So I think irrespective of the market, there's an opportunity in this. This can go back to 3,150, 3,200, somewhere close to those points. Definitely some trading opportunities there in GSK.
Got that, Brijesh. The other key aspect and one stock that's in focus is IndusInd Bank. Now, the company is expected to report its earnings today, and we are expecting, of course, the company to report a loss after a multitude of negative news flow that's happened. Now, let's bring in my colleague Harsh now to contextualize this and what are some of the other key aspects to note before the results come in. Harsh.
Well, it's going to be a very tough job for any analyst to really expect or anticipate what to exactly expect in this quarter's Q4 numbers, frankly. And basically, I'll only focus on 3 to 4 factors. One, margins, if they hold up, will be decent. That is the current anticipation that they will hold up. And really, if the provisions number comes in around the 3,000 to 3,500 crore number, the Bloomberg average analyst has penciled in around 3,300 odd crore in terms of provisions. That will be a decent number to go with. Profit after tax will actually be a loss of around 300 crore, but there are a multitude of variables here. And one will of course be how the MFI book does. No negative surprises on the MFI will definitely be a thumbs up. Second is no negative surprises in general on any other front will be a clear thumbs up. Any visibility with regard to what direction is leadership going to take and who the next CEO is going to be, whether private banking, whether from a PSU banking, from the PSU banking space, essentially will also drive how likely analysts react to this one. No growth. So what's the growth prospect like for next year? That will underline some bit of confidence as to how the current book is and what the management sees in terms of outlook going forward. How much of the pain has already been built in. So several of those factors will actually be weighed in, and a mix of that will likely determine the reaction tomorrow.
Thank you, Harsh. Harsh, if you can stay with us, we have PFC numbers which have come in. If we can just get the PFC chart on the screens. Total income is up around 21%. The stock is seeing a good spike as we speak at the day's highest levels. NI has seen a 40% growth at 12,701. And if you see in terms of the profit number as well, I think that itself is a strong number. I'm just waiting for the profit number to come in. There you go, 6,316 crores, uptick of around 12.5%. I know I'm catching you off the guard right now, but any inputs that you could give us on that front? Total income of around 29,085 crores, 40% growth in terms of NI at around 12,700 odd crores, and a good number in terms of the revenue as well. Just at the first look of it, do you think it's a strong set of numbers?
It looks like a very good set of numbers, Hiral. You know, when I had last spoken with PFC management, they had suggested and they had guided for around an annualized profit after tax of approximately 25,000 crore. And this is on a console level, mind you. This also includes REC's numbers to some extent. So I just want to quickly mark that out. I'll be keen to look at the provisions number, and I'm just pulling out those numbers to make sure that I'm getting it right. And you know, there's nothing important that I'm probably missing. In terms of the impairment number, we're seeing a number of around 1,221 crores. So you're starting to see normalization with regard to credit costs start to kick in. So that is something I'll be keen to understand. How much of that is recovery? We'll have to wait for the presentation to come. But how much of that is recovery and how much of the core provisioning has happened this time around? The other piece, of course, is with regard to the overall profit after tax on a console level is sitting very, very strong. So overall, it's looking like a very strong beat on that profit after tax number, despite that provisioning coming in, which is why you're likely seeing the reaction you're seeing on the counter. In fact, on a console basis, the profit after tax number is sitting at 30,000 crore for FY25. The guidance was 25,000 crore. So you'll want to wait and watch as to how much of margin accretion has added to that profitability and how much of this is actually sustainable in the next year, given that recoveries will start to taper for both of these power financiers.
This is going to be absolutely interesting, Harsh. I think we will wait for an analysis in India market close as well today to give us details in terms of what it looks like, but a strong spike coming in on this counter as we speak. But thank you, Brajesh and Lancelot, for joining us on the show and sharing your views as well. So clearly, Puneet, overall, if you go to see, strong move. In fact, you know, even a small positive is helping a stock to see strong strides in terms of today's session.
Well, definitely. I think, and we've spoken much about it, the Q4 earnings is one of the most meaningful across the sectors as well, because apart from the results, the commentary is also something that's to watch out for each results. Now, time for an NDTV Profit exclusive. Sources tell us that SEBI may set new guidelines for approving companies that rate others on environmental, social and governance standards, essentially ESG. This move comes after the whole Gensol fiasco. My colleague Charu joins in and she has the exclusive details of this.
The market regulator, Securities and Exchange Board of India, is set to bring out guidelines governing the assessment providers of the ESG disclosures. Now, companies have to, sort of disclose their ESG related information to the public as well. And the regulator had brought out some sort of assurance criteria to, look into this information that has been disclosed to the public. After that, another provision to bring in the option of assessment was also brought in. Now, the assessment involves a third party to be involved in the disclosure making process of a listed entity, which is slightly stricter than assurances, and that is why the regulator is thinking about bringing guidelines governing who could these assessment providers be. It also involves the process of their accreditation, which could likely be handled by the NBAC, which is the national forum to give some accreditations to these sort of formalized officials or people who will be looking into these things. Now, we must also understand, just for an example, that this is like, for example, the criteria for an auditors of a company. Similarly, some criteria will be laid out for the accreditors of this disclosed ESG related information.
Thank you so much, Charu, for getting us the details in terms of the new ESG norms as well, but completely out of time. From Puneet, the team that put the show together, and myself, thank you. Lots more lineup on the other side, so please stay tuned to NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with.
Hello and welcome to NDTV Profit. You're watching Top Trades. I'm your host Anushi Vakharia and with me is Varsha Chandnani. Right now, the company in focus is Arvind Smart Spaces. They came out with their fourth quarter results. So quickly, if you are just seeing the operational trends, they've reported about an 18% growth in their bookings for the fourth quarter, while collections remained flat at the levels of 215 crore. If you take the FY25 year as a whole, the bookings were up around 15%, while collections saw about a 7% of growth. They acquired new projects with a top line potential of around 4,450 crore and they added projects across Ahmedabad, Bangalore and MMR region. If you just take the fourth quarter headline numbers in consideration, they reported a 39% of a revenue growth. Margins stood at 20.6% as compared to 26.7% and net profits saw about a 23% growth. But to discuss more on the outlook forward and the year gone by, we're joined by Kamal Singhal, the Managing Director and CEO of Arvind Smart Spaces. Hi, welcome to the show, Kamal. First off, let me start off with the fourth quarter. Talk to us about the key operational metrics that we are seeing. Now, on one side, we are seeing bookings growth remained on a decent side, but it's the collections which remained flat. Talk to us about all these key operational trends that we're looking at.
Sure, very good afternoon. This quarter four for the financial year 25 has been absolutely good for us. On financial side, we have grown very significantly, 39% growth in top line at 163 crores. And there's a 56% growth in EBITDA at 44 crores. And PAT has also grown very healthy and it has reached to a 21.8 crore levels. In fact, for the year as a whole, financial numbers have seen a very, very significant uptake. The balance sheet size and the P&L size has grown very significantly. In fact, all the major parameters, including top line, EBITDA, and PAT have grown more than 100%. Now we've recorded overall sales of 713 crores with a growth of 109% in top line, 196 crore of EBITDA, which is 103%, 130% up, and PAT of 119 crores, which is up by 133% for the year as a whole. Operationally, the quarter has seen an 18% increase in fresh sales at 381 crores. And for the year as a whole, we have grown by 15% to 1,271 crore of fresh sales. So all in all, it's a quite satisfactory year for us. On fresh sales, we could have done little better, but for the delay in couple of launches in Bangalore, which have shifted from Q4 into Q1 of this current year, we could have done a little better. And normally we would have liked to grow by 25 to 30% on top line as well, fresh sales as well, which has been to the extent of around 15% this year. But this will get pent up sales coming in the coming year. And for the year, 2 years put together as a block, I think we'll continue to show 25 to 30% growth that we've been showing all through these years.
So Kamal, even in terms of where the collections are concerned, we've reported about a flattish growth in the collections for the fourth quarter. But overall, if you take the last 2-3 years fiscal in consideration, it's about a 30% plus of a growth that we've seen. So just want to understand for FY26, FY27 perspective, where do you see collections heading towards?
So our collection obviously will move in tandem with the fresh sales. So fresh sales have grown moderately at 15% this year, as we just said, because of slipping off a couple of projects into Q1. But obviously, as the sales grows, including the pent up of the last year, I think collection will continue to move and show healthy growth of around 25-30% in the current fiscal.
Okay, so that's the outlook for collection. So can you just reiterate on the point of the pre-sales also? You're seeing more than a 20-25% of growth coming back, or is it a higher number that we are looking at for pre-sales?
So if you were to grow by 25% both years put together, and if you've grown only by 15% last year, obviously this should get added into the current financial. So instead of growing by 25-30% in the current year, we should actually be growing more like 35 to 40% to cover up for the loss of the delay of one project, which was a couple of projects that we saw in the last year. So this year we are actually targeting to grow by 35 to 40% as such.
Okay, so 35 to 40% is what we are looking at. Can you give us an outlook in terms of new project additions that we are expected to see for this year? Now, last year, in line with the guidance, we've seen addition of around 4,500 crore of project additions. What's the kind of potential top line that you're seeing for this year, and also the number of project launches that we can expect?
Sure. Last couple of years, there has been an orbital change in acquisition of new projects. There has been a very, very clear focus on adding to the project pipeline. Last year, we added 4,100 crores of projects. Last year, we added some 4,450 crores worth of project, as you very rightly said. This year, again, we have an investment cycle of around 1,000 crore that we need to invest in next 3 to 4 quarters. And accordingly, we are very hopeful that in excess of around 5,000 crore is something that we should be able to add in terms of new project pipeline in the coming year. Okay. And accordingly, the launches also will go up dramatically. In fact, this is going to be a fat year in terms of fresh launches. And we are very hopeful that for the year as a whole, this year, we should be able to launch projects worth 4,000 crores as new projects.
Okay, so 4,000 crore is the kind of level that we are looking at. In which areas or segments particularly that we are seeing more of these fresh launches coming in? Giving this perspective on the regions also we are targeting these launches?
Sure. So out of fresh launches of around 4,000 crores, around 2,000 crores, or half of it should be coming from Bangalore. And when you say Bangalore, it's a combination of vertical and horizontal projects. By vertical, we mean apartments, and horizontal, we mean plotting and villa kind of development. So pretty much half of what we are targeting to do this year, out of 4,000, 2,000 crores is supposed to be coming from Bangalore. And out of balance 2,000 crores, 1,000 crore each is expected to be coming from Ahmedabad and Mumbai as a market. We were just about to enter Mumbai. We already acquired and announced one project there, a large horizontal project, which is a weekend home project of around 90 odd acres. And we are hoping that at least 1 or 2 more projects will be announced very soon. Put together, we are hoping that 1,000 crores each will come from Mumbai and Bangalore, and Mumbai and Ahmedabad, and 2,000 coming from Bangalore.
50% of it is from Bangalore that we are seeing for this year. Just want to get your sense on the overall market trends across these three key regions. Now you've said that you've marked a entry in the Mumbai region, how that differs from say a Bangalore market. Now in Bangalore, in the 9-month period, in the third quarter we did see some bit of delay. Do you see some of these concerns creeping back in FY26 as well? What's the kind of overall outlook that is there for the real estate right now?
Sure, so there are two sides to it. One is the launches, the other is demand in general. I think on demand side, we are pretty confident that the momentum is still pretty much wide, and it is deep enough, and it should continue. India is in a trajectory where real estate is supposed to continue to grow, and generally there is a healthy appetite. Of course, it will vary from micro market to micro market. Some micro markets are doing better than others, and hence one needs to be smart in identifying the right areas, right micro market, etc. But having said, there is a very healthy momentum which continues in all the three markets that we are talking about here. In terms of launches, that's a function of acquiring the projects and approvals. Last year was a little tight on approvals, especially in the market of Bangalore. I think things have come back to normal and things are starting moving pretty brisk there as well. So this year should see healthier launches as compared to what we saw last year. We also got delayed on a couple of projects in Bangalore, but I think things have come back to pretty much the normal cycle, and hopefully this should be a very healthier in terms of fresh launches, not only in the city of Ahmedabad and Mumbai, but also in Bangalore, as we just said.
Okay, so on one side, while you're saying that, the concerns which are there in terms of approval challenges in FY25, they have somewhat receded in FY26, but also want to get a picture on the realizations that are there. Now, what the industry is indicating that price realizations that we've seen in the last couple of years, especially post-COVID, that kind of momentum in terms of growth may not continue in FY26. Just want to get your sense on what is the kind of growth that we can see for the price realizations in the markets that you operate in.
Yeah, I mean, we've seen some more than normal price increases in the last couple of years, and hence that trend might not be as strong as you would have seen in the last couple of years. But then, generally speaking, from project to project and from developer to developer, it's more about how much value you add into your own project specifically, and it's a function of quite a few things which are internally controlled, including the design, location, specification, the offering, and the brand in general. Brands are commanding much more premium as compared to what they used to be 3-4 years back. Customers are now much more brand conscious, etc. And hence, these are bigger drivers than general increase in pricing that we see. With a lot of consolidation happening in the market, I think the pricing power with the organized sector or the branded players, as we call them, is much higher today. And that will guide the realization for this segment of buyer more than what happens generally to the market. And hence, we are pretty confident that realizations will continue to be healthy, and there'll be a decent and more than decent growth in realizations as well as we go forward from here.
Okay, so that's the outlook in terms of where the key operational trends are. Now coming to the debt positioning of the company, you've had a pretty healthy picture as far as where the net debt is concerned. In the previous 2 quarters, what we have seen at the end of quarters, it's a net cash position of 195 crore or so. In March 25, we've seen the net debt level of around 27 crore. I want to understand, by the end of FY26, where do you see this debt number going upwards towards, since currently you do a debt to equity remains on almost a negligible level. So what's the kind of ratio that you're looking at over here? Do you expect there should be a further uptick in the debt levels that we are seeing?
Sure. And you very rightly said that the company had been a negative debt company for the last several quarters. As on March, we just about came back to a level of negligible debt, 27 crores in total to be very precise on net debt level basis. But as we end this year, financial year 25-26, we are hoping to close the year by having some debt on the books, more in the region of 300 to 400 crores. In fact, as we just discussed, we have got a investment cycle of around 1,000 crores underway, and that will be funded by these 300 odd crores coming from the debt, 300 to 350 odd crores coming from internal accruals, and the balance coming from some sort of equity through a QIP or equivalent kind of instrument. So all these three things put together gives us a fuel of around 1,000 crores, and that gives us a additional top line project of around 5,000 crores. But yeah, at the end of this current financial year, we should be looking at a debt level of around 300 to 400 crores, which will be more or less around 0.5 debt equity, so to say, in terms of ratios.
Okay, so 300 to 400 crore is the level that we are looking towards. Just on that, you've talked about how you've raised funds from the equity platforms that are there. What exactly do you plan to deploy these funds towards? If you can just give us a picture on that, that would be my final question for you.
So we'll remain focused on residential as we have always done. Broadly, pretty much everything is going to be invested in residential project, both vertical and horizontal. From the market standpoint, once again, half of what we are intending to invest will be going to the market of Bangalore. So out of 1,000 odd crores that we intend to invest, 500 will be going to Bangalore. And out of balance 500, maybe 50% goes to Mumbai and 50% in the market of Ahmedabad. So that's pretty much the distribution of investment going. And of course, it will be a flexible combination of horizontal and vertical. We'll bring a little more focus on vertical this time to balance the portfolio between vertical and horizontal. But having said, 50% in Bangalore, 25% each in the city of Ahmedabad and Mumbai is what we plan to invest.
Okay, thank you so much, Mr. Singhal, for joining and sharing that perspective on Arvind Smart Spaces. Really glad to have this conversation with you. But moving on, focus remains on markets, right, Varsha? Where do you see the Nifty and Sensex heading towards? We've seen some bit of recovery, but talk to us about this as well.
Yes, so yes, absolutely. We've seen some bit of recovery. Let's see what Nifty 50 is doing. It's up almost, 0.35%, but let's see who are the contributors when it comes to benchmark. You have on the gainer side, though, you have BEL, good con call, though we'll speak about that also. You have HDFC Bank, Bajaj Finance, Bharti Airtel on the gainer side. But on the loser side, you do have IndusInd Bank expected to announce results today. JSW Steel, Kotak Mahindra Bank and Coal India are some of the counters which are under pressure when it comes to Nifty 50. But let's pull up the sectorial heat map and let's see what sectors are doing. I think barring media, everything is in green. There you go. And Nifty Realty being on the top is up almost 1.5%, followed by Nifty Pharma, which is up almost 1.14%. So barring media, yes, everything is in green. Now, shifting our focus to broader markets, though, you have, let's pull up Nifty Midcap 150 and let's see what that, counter is doing. Nifty Midcap 150 is up almost 0.48%. There you go. Let's see who are the gainers when it comes to Midcap 150. You have Solar Industries, you have GSK Pharma buzzing on the back of volumes. You have Gland Pharma and PB Fintech, on the gainers side. While on the losers side, though, you have Dixon Technology on the, on the back of earnings. You have KPR Mills, you have Max Health. Max Health yesterday reported its Q4 FY25 numbers, and you do have ABRFL on the losers side. On the, let's pull up what Nifty Small Cap 250 is doing. It's almost up 0.05%. So, pretty much kind of recovery that we are seeing when it comes to, broader markets though. But, moving on, we do have defense pack, which is in focus. Defense has been the, the darling of the street for a while now. In fact, one of the sectorial gainers when it comes to in trade today. Now, BEL in particular from that pack has performed really well over last 1 month, over 25%. It came up with the Q4 numbers as well yesterday, and the street is happy with that. But, Anushi, do tell us what our brokerage is saying, when it comes to BEL.
Right, firstly, before I talk about Bharat Electronics, it's the key con call highlights that I want to emphasize on. Now, if you're seeing why investors in particularly are interested with Bharat Electronics, firstly, the kind of margin guidance that we've seen in the management given its con call, they expect FY26 margin at the levels of 27%, which took the street by a surprise last year. That's FY25. The guidance was for a 22 to 25%, which they surpassed to the levels of 28%. So, every year, it's a consistent uptick that we are looking at in terms of where the margins are headed. Along with that, robust order book pipeline remains in focus. This is with large ticket orders with QR SAM in particularly. Excluding QR SAM also, they expect 27,000 crore of additional order inflows, which takes roughly order inflows to the levels of 57,000 crore is what we are seeing. Again, this 57,000 crore is in comparison with the kind of guidance that we saw last year. 25,000 crore was the guidance that they'd given, which BEL failed to achieve. They had received orders worth about 18,000 crores. Due to delay of 3 orders that we had seen, they missed the guidance by 25% or so. Other than that, if you look at the exports, they're seeing about a 20% of a growth in exports as well. And this is from FY27 onwards that we'll see this kind of growth coming for the business. What is also interesting is Project Kusha. Now, Project Kusha, from there, the BEL expects 40,000 crore worth of an order. But again, this is a very long-term kind of a picture that we are looking at. What brokerages have to say? Firstly, Macquarie on BEL, they've maintained an outperform rating on the stock, hiking the target price to 400, seeing that Q4 was clearly a beat. And they've enhanced the base order visibility as well. FY26 margin guidance also was a surprise for the street. And it remains poised with R&D and long-standing defense relationships now bearing fruit for the company. Antique also maintains a buy call on the stock with a target price of 422. They are seeing a strong operational performance continue to surprise the street positively. Company has also seen a 20% plus of a delivery in terms of where the margins are concerned, and with FY26 guidance of 27% is also a positive that we are looking at. Capex plan is another factor that will ensure growth going forward for the business. Nuvama also has maintained a buy call. This is with a target price of 430 that we are looking at. Q4 surpassing street's headline number expectations, and now they believe that the company has more positives than negatives. So there is further side of some re-rating that could be expected for Bharat Electronics. But I also want to address about Astra Microwave, since we are on the topic of defense. Currently, if you are looking at Astra Microwave, that is in focus. While the stock is down about 0.32%, this is in focus after the board has approved a 174 crore of a fundraise. This is via convertible warrants that we are looking at. So they've approved allotment of up to 20.14 lakh convertible warrants, and this is at a subscription price of 864 that we are seeing, which is a 21% of a discount compared to its yesterday's closing. Key allotee here being big HNI investor Damani, that is Gopi Kishan Damani, brother of Radha Kishan Damani. He's displayed interest in the stock with equity holding of around 0.6% of his warrants are converted. Promoter has also increased the stake of the company to the levels of 3.11%. There are other notable HNI investors as well. But what particularly may interest Damani in Astra Microwave? Firstly, the company is a key player in the radars and subsystems. We've seen the importance of these areas in Operation Sindoor as well. Strong growth prospects. They are expecting a 15 to 20% of a revenue growth in FY26. Order book stood at rupees 2,332 crore. This is as of December 24 that we are seeing. And management expects a 20% of a growth in FY27. In terms of valuation also, while valuation is not on the cheaper side, we are looking at a trailing P multiple of 76 times. This is in comparison with a 3-year average P of 63 times. If we take the money share of it in terms of where the valuation is concerned, that indicates a multiple of 61 times, which is more or less in average with what the 3-year multiple is. So this is the overall picture that we are building for these two defense stocks, that's Bharat Electronics and Astra Microwave. But Varsha, a couple of EMS stocks also in focus, right?
Yes, actually. So electronic manufacturing services is the sector that is actually on the rise. Now companies like Keynes Tech, Amber Enterprises and others have reported almost 2 times the growth. We have Puneet joining us with all the details.
Well, thank you for that. So despite reporting strong numbers in Q4, Dixon's, down in trade today. Could be because of valuation concerns, also that the the PLI won't be carrying forward in FY27. But we just put across a comparison for the top 5 EMS players and how they performed in Q4. Let me just start off with the growth in terms of revenue for Q4 on a YOY basis. That's the first column I want to focus on. You can see across the board there has been really strong growth. The highest being for something like a Dixon Tech, over 200%, over 2x growth essentially for the company in Q4. Another notable one is Keynes Tech, where they've increased their exposure to the industrial as well as the auto vertical. They've also just slightly missed the guidance for FY25, which was 2,800 odd crores, but really strong numbers for Q4. Another one is PG Electroplast. They've increased their products revenue from ACs as well as televisions, and that's largely aiding the growth. And for Sirma, I just want to address another one, 18% fall, and that's largely because they're reducing the consumer exposure, but really strong on the revenue basis. I want to secondly highlight the profit growth for the companies. And the most notable one is PG Electroplast. They have been using operating leverage as well as among other aspects to improve profitability. That's visible, up 100% in this particular time frame. The other one's Dixon Tech. If you exclude the fair value for Aditya Vision, it's a really strong growth reported in this particular quarter. And also Syrma SGS, despite reporting 18% fall in revenue, the profits has been really stupendous for the company. Again, reducing consumer share and increasing EBITDA margins from the other key verticals like medical as well as aerospace for the company. Just in the middle, this is not margin growth, this is absolute margins for the company. And the reason for highlighting is the companies have been increasing the margins steadily. For quarter 4, Dixon had 4.3 versus 3.9%. But if you see across the board, the companies have been able to clock in higher margins compared to when they were listed. And that's because they're increasing their own design share. So Keynes is the most notable one in terms of EBITDA margins, helping with the high margin business. I just want to highlight the guidance which the companies have reflected in this for FY26. Keynes, Dixon has specifically mentioned 53% increase in volumes. They are looking to sell 4.3 crore smartphones in the next year. That's roughly about a third of the whole market in India. And that is again a 53% growth from FY25. For the likes of Keynes, they've guided for a 60% growth in terms of revenue. Both Amber as well as PG Electroplast have guided for at least 30%. Amber is going to expect to outpace the industry which is operating, which is air conditioners, where the growth is around 25-30%. So 10-12% above that. For PG Electroplast as well as Syrma, it's a 30% growth guidance that the company has given. For Syrma, they've gone on to say that they will be looking to have 8% EBITDA margins as well. That's higher by 150 basis points. Finally, in terms of valuation, and here is where it gets interesting. While FY26 price to earnings will be very high for the companies, let's look at a longer term view. Let's look at this column, which is FY27. Keynes has actually taken over as the #1 most expensive stock in the EMS space, and that's because of increasing exposure to the industrial space, which has the likes of smart meters as products, as well as the auto vertical. But Dixon Tech is also promising huge growth, and hence the premium vertical. The other interesting one is Syrma SGS, the cheapest stock in the EMS pack. And that's largely because the company is going through, change in its product profile, and hence the market is still not sure of the potential of what it could grow into. So that will be one interesting one. And Amber Enterprises, looking to increase their exposure to the electronic business, and hence it could be one of the key ones to watch out for. For overall, very strong set of numbers for the EMS companies in quarter 4 and in FY25. They're expecting at least a 30% growth amongst these 5. But watch out for the valuations and take your pick wisely.
Right. Thank you so much, Puneet, for all the details. Well, moving on, India's largest third-party tank storage operator is set to hit the T Street. We spoke to Murad Moledina, who is a non-executive director at Aegis Vopak Terminals. Listen into the conversation, where he speaks about company's future plan after getting listed. Listen in.
To begin with, sir, give us a sense of Aegis Vopak. It's a subsidiary of Aegis Logistics, which is already listed in the markets. Give us a sense of how big is it and the business verticals that it caters to.
Yes, thank you for having us, and very great that we are able to come online and speak about the IPO and our company. Aegis Vopak Terminals Limited, like you said, is a joint venture between 2 independent listed companies. One is Aegis Logistics Limited, a 1978 listed company formed in 1956, a pioneer in tank terminal storage business since long, and also a market leader. And Royal Vopak, of course, its joint venture partner in Aegis Vopak Terminal Limited, is a global leader in terminaling business, doing the same business last 400 years and present in 23 countries, a AAA ESG MSCI rated company. So this joint venture was started to do terminaling business in India, and it started its journey in May 2022. Why we chose a separate vehicle was because in the parent we were also doing business other than terminaling, which was basically distribution and sourcing in LPG. So therefore this vehicle was needed because Vopak and Aegis decided to do only terminaling business in this SPV. So like I said, this journey started in May 2022 with a 0.5 million CBM liquid storage space and 5.6 million tons of LPG throughput capacity.
Well, that's the outlook forward from the management of Aegis Vopak terminals that we are seeing. But with that, it's a wrap on this edition of Profit Top Trades with me and Varsha. Stay tuned for India Market Close with more updates coming on the other side.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Hello and welcome to India Market Close. A very good afternoon to all the viewers. I'm Hiral Dadia and with me is, in fact, I am with Harsh Saita. I keep forgetting that. But very quickly, if you see in terms of what markets are doing, after the kind of gains that we've seen, you are seeing some bit of profit booking. We're not at the day's highs, but gains of around 0.4% coming in terms of Nifty 50. You are trying to stay above that 24,750 mark in terms of today's session. Bank Nifty as well. Some bit of underperformance coming in terms of Bank Nifty as compared to Nifty 50 and around 85 to 90 points kind of gains on that front. Let's quickly look at the sectoral indices and see what's happening on that front. Defense continues to be an outlier. 2.5 to 3% is the kind of gains coming in there. Real estate is pretty strong. Pharma. I mean, pharma as a sector right now is seeing some good amount of interest, and it's not only the larger names, even the smaller names are garnering a lot of traction there. Apart from that, you have auto, which is on the front footing, IT trading in the positive as well. What's losing is the consumer durable space, which is down around 0.6%, and I think it's Dixon, which is adding to that pressure as we speak. Private banking space also pretty much on the borderline. Media is also pretty interesting because the last couple of trading sessions have been absolutely weak with regards to where Nifty Media goes. Let's also look at the metal pack here, 0.2%, so pretty in between in terms of where the metal names are concerned. In terms of the broader markets, it's not in line with the benchmarks. Some underperformance coming in from the broader markets as well. It's been a slightly dilly-dally ride, but you have the mid-cap 150, which is up around 0.5%. If we can have the small cap as well, there you go, 0.1% higher in terms of where the small cap index goes. Let's look at individual stocks in terms of Nifty 50 and see what's happening on that front. Bharat Electronics. Smart gains coming in on that one, 4.5% up moves. Cipla, Tata Steel, HDFC Life. Bajaj Twins also in the front footing. IndusInd ahead of numbers, cuts of around 2.5% coming in on that one. Coal India under pressure. You have Adani Enterprises down in trade. ONGC also trading under pressure. In fact, you have ITC, which will be reporting numbers tomorrow. 0.3% of a cut on that one. Sun Pharma, I beg your pardon, will be reporting numbers as well. And that stock is seeing gains of around 1% ahead of numbers. So that's like the broad trend that you're seeing in terms of the Nifty 50 companies. But apart from that, a lot of buzzers, Harsh, that you're seeing specifically with regards to where the broader markets go. And I think that's where the action is. And just to add to that, if we can have the wicks. See, again, a small spike there at 17.8. I think it's taking a lot of resistance at that 16, 17, 18 levels, not wanting to go beyond that 15 mark on the downside. And that is going to be critical. But your broader markets are doing wonders from a stock-specific perspective.
Yes. Plenty of buzzing stocks today, Hiral, you're right. Let's pull up some names. One is an HLE Glasscoat. What a solid set of numbers yesterday. Good move. Follow-up move also very strong. 8% higher in trade today. A Tata Tele is also up around 8.5%. Solar Industries came out with guidance for FY26. Very strong guidance. The stock is perked up 6%. This one is now sitting at life highs, if I'm not wrong. You're also looking at Endurance Tech, some of the auto anch names doing very well in trade. A JK Tyre and Endurance Tech among those names. You're seeing good traction in some of those names. JM Financial is perked up 5% as well. GSK Pharma, Motilal are some of the other names which are up 4+%. With those seeing some bit of pressure, Dixon Tech is down 6% numbers. And maybe some bit of valuations as well at play there. Lakshmi Organics is down 6% again on numbers. Aster DM is down 5%. Radico Khaitan also seeing cuts of around 4.5%. This despite a solid set of numbers by USL, mind you. So despite that, you're seeing a decent a downtick of 4% on a Radico. But let me go across to Akshay Bhagwat, joining us, Senior VP JM Financial, to talk to us about how he's viewing markets. Good afternoon, Akshay. Akshay, I want to first start off with the Nifty. What is your view on the Nifty at this point? Is it going to be range bound for a while now? What are you penciling in and what are you advising your clients?
Good afternoon.
Good afternoon.
So yes, the broader view of the Nifty continues to be positive, but considering the fact that it's been a one-way rally all the way from 22,000, there is a very good chance that we are entering into a phase where Nifty might get into a time correction zone where the prices may be confined in a trading range. So with the remainder part of the May series, with the expiry being on 29th of May, the chances are high that 24,400 can be your lower end of the range for the Nifty spot and 25,200 can be the upper end of the range. So expect choppy directionalist trades within this range. It is going to be within this broader range. Some selling data is emerging from the FIIs in the last session. So that's a slight concern. But overall, the sense is that there might be some choppiness in the next coming week.
Some choppiness, some caution. What about the Nifty Bank, Akshay? Any different?
Similar view, I think, for Bank Nifty, choppy trades. But if I were to choose between the two indices, I think Bank Nifty is better placed because this choppy phase is already at the verge of ending for the Bank Nifty. If you look at the entire, I think the month which has played out from May, Bank Nifty has been in a very tight range, 54,500 lower end of the band and 55,500 roughly has been the upper end of the band. It's time that Bank Nifty now stages a breakout soon. This breakout is mostly going to be on the upside ahead of the RBI event in the first week of June. So in all likelihood, I think Bank Nifty is the index to look forward to. Even if there is a slight dip of 200 or 300 odd points from the current levels, that would be an opportunity to go along with the bank index.
Okay, and what are your picks for this afternoon, Akshay?
So, as I mentioned, I am bullish on the banking and the financial services space. So, I will be looking for stocks in this particular segment. So firstly, from the financial services space, Bajaj Finance is the top pick here. This stock has been noting buying demand at lower end. There is a corporate event of a stock split and a bonus announcement. Ex-date is still not known, but that keeps the demand in the stock. Expecting targets of 9600 to 9632 with a stop loss of 8987. The second pick is in the IT space where the rally has been good lately. It's been a bit offbeat, but I believe the momentum might get back in the IT pack, and TCS is the best bet among the IT names at the current market price. Looking forward to targets of around 3637 with a stop loss of 3482.
Right. So those are the topics coming in there from Akshay. Akshay, let's look at the defense pack. And the BEL has seen some strong strides over the last couple of trading sessions. If you just pull up a 5-day or even a 1-month chart of BEL, you'll see the kind of gains coming in there. Today itself, 4.5% up move, and this is coming in on strong volumes as well. 26-27% is the kind of gains. Do you think this is the time to book profits on a BEL, or are you seeing further upside? Because the kind of strides BEL is making, the others from the pack are not that strong.
Look, BL, as you rightly mentioned, is one of the strongest names in terms of its placement on the charts. It has given a very strong monthly breakout at the levels of 340, and that's the reason you are seeing volumes backing the strong price momentum in the stock. So I believe there is no reason to worry about booking out profits because the long-term targets are probably significantly ahead or higher than where we are right now. It is just from a short-term perspective as to pinpointing where exactly there may be some profit booking. But as I see the charts right now, there is no any signal of a major profit booking around the corner. So 360 is the short-term base which the stock is setting up, and I believe if you are looking to pinpoint levels where there can be some bit of profit booking, probably the estimate initially is 390, 395 might be a probable levels where the stock might see some bit of a resilience. So maintaining a positive view with the support of 360 on BEL.
Okay, the other one which is doing well in trade today on the back of numbers, Akshay, is a PFC. The numbers were strong. Net interest income came in better than expected, and that's led to a little bit of a beat when it comes to the profit after tax number. Credit cost was slightly elevated in comparison to what was penciled in, and that is because of KSK Mahanadi's right back, which was expected to come through. Need more details on how that credit cost number has been arrived at and how that has played out. PCR, which is provisioning coverage ratio, has gone up. You're seeing a 2% uptick on the counter. Akshay, would you trade a PFC?
Yeah, definitely. I think the result numbers which we have seen a few minutes back, the numbers look good on the face, and even the initial reaction of the stock has been positive. If I were to see levels for this stock, I think last few trading sessions clearly suggest that 400 is a very strong support for PFC. So we have a good support in place. Now it's just about the momentum getting back in the stock. In all likelihood, if this momentum gets back, we can look forward for targets of 440 to 450 from a short-term perspective. Place strict stop loss below 400 on this trade, but 440 seems to be in the making very soon for PFC.
With a PFC, Akshay, how are you looking at a REC as well?
Well, honestly, if I were to compare the two, I think REC technical setup is more neutral. It's not weak though, but somewhere 380-85 zone is a small support. Obviously, if PFC has to recover or move from here, REC too will join the party. But I believe the gains should be more in PFC or REC. So if REC does recover, 415 is the upside you can look forward to. But given a choice, I think PFC is better placed, and one should consider PFC or REC in the current price setups on the charts.
The PFC, Harsh, preferred over a REC, and both the charts look exactly like mirror copies right now if you see the screens in terms of the intraday ones.
Yeah, I mean, typically they do go hand in hand, and some bit of concern has been, at least for both of these counters, has been about growth, where REC clocked a lower growth than anticipated, and that's also because of repayments which were elevated in this quarter. PFC, on the other hand, has done 13% odd in terms of growth. Of course, need to wait and watch for exact commentary, and also need to wait and watch as to what that exact growth number is. But my sense is it's in around the 13% range. which doesn't look as bad. The commentary will obviously decide the guidance as well. So we'll have to wait and watch for that con call to come through and thereafter see as to what the outlook seems to be. Let's go across though. Let's switch focus from power financiers to infra. And we have the management of J. Kumar Infra Projects, Nalin Gupta, who's the managing director, joining us. Good morning, good afternoon. Apologies, Mr. Gupta. I want to first start off by asking you, talk to us about the quarter gone by as well as the outlook going forward. You're sitting on a very large order book. How quickly do you expect execution to kick through, and what's the outlook for FY26 in terms of growth?
Well, so I would like to say that we had a fantastic quarter and a year result, I would say, wherein the revenue of Q4 has grown by 15% to 1,633 crores. And on a year-on-year basis, we have been having a growth of around 17% to 5,700 crores for FY25. The EBITDA has grown up by 16% for Q4 to 235 crores and 826 crores for the financial year FY25, which is a growth of upside by 17%. The PAT has grown in the Q4 by 214 crores. Which is a 15% growth on a quarter basis. And for overall year, we have clocked a PAT of 390 crores, which is 19% growth on a year-on-year basis. So, and the order book as of today stands at 22,238 crores. So, I think this was a good set of numbers by J. Kumar. And also it is pertinent to, I think I should make a note of, to inform you that the ROE has also been growing up. And I would say for FY22, where we were at 10.2%, and which has gone up to 13.2% in FY24. And currently this year, we have made a ROE of 13.8%. And similarly for EBITDA, we are in coming 6 to 8 quarters, currently, which we are from 14 to 15% band, we intend to take it to 15 to 16%, looking at the operational and operating benefits.
Right. Nalin, good afternoon. This is Hiral on this side. Now, taking into consideration the kind of growth that you've achieved in terms of FY25, a 17% top line growth, 19% in terms of profitability. Is that the trajectory you're maintaining for FY26 as well? Because I do read that around 14 to 15% is what you're targeting in terms of top line. But how are you seeing it from an operational and a profitability perspective?
Well, so as I mentioned, Hiral, that we expect that we are targeting a top line of around 6,500 to 6,600 crores for FY26. Which will be a growth of 15%. And that's been the style of J. Kumar all these years to surpass the targets given by us. And of course, it is important to note that as the base of the last year keeps increasing, a 15% growth also
Nalin,
is, I think, a good
sorry
number.
to interrupt you. I understand 15%. That's what I said. But how about in terms of profitability and on the EBITDA front?
Yeah, so in EBITDA front, as I mentioned just now, we are at 14.5% as of today, as of FY25. And our endeavor is to keep working on the EBITDA margins, and is coming 6 to 8 quarters. We'll look at taking it from 15 to 16%.
Okay. And to get this kind of number, how are you looking at the order inflow? Because that is down almost 60% on a year-on-year basis. And we do understand it is on a high base of 11,800 crore worth of inflows. Now, firstly, to understand the weakness in terms of order inflows, and secondly, the trajectory in terms of what the pipeline is looking like.
Well, so firstly, I would say that we have bagged an order of around 4,700 crore for FY25, and we are already L1 in projects worth around 4,000 crores. And there are bids in pipeline. We have already bidded for around 3,000 crore odd projects as of now when we speak. And there is around 20 to 25,000 crores of orders that we see in the pipeline, which includes metros, flyovers, and buildings and elevated corridors. So I think the opportunity going forward looks to be really decent. and we intend to bag orders close to like 6 to 8,000 crores, irrespective of the L1 getting materialized or not. But 6 to 8,000 crores is what we will be targeting for this financial year of FY26. So I think that should be and of course, margin is very important for our company. So that's how all the orders that we book, the bottom line has always been an important concern and will remain the concern for the company to be focused on.
The risk on margins like, Mr. Gupta?
I'm sorry?
What's the risk on margins? Is there
I think on the current
risk?
order book that we have already been bagged, that we bagged of around 22,000 crore, I really don't see any risk factor because it comes in from the existing geography and the segment that we have been operating. So I think I don't see any risk. Rather, I see an upside on it due to the operational benefits and the same areas of operation that we have been doing.
Understood. And so this 22,000 crore order book, just give us some perspective. How long is it going to take you to execute the full 22,000 crore? How does it play out in terms of timeline? Just so that we get a slightly more longer term view as to how J. Kumar is going to execute this entire order book.
Well, so firstly, I would like to say that these order books are of different time periods, which is right from 30 months to 60 months. So on an average, we can say that it should ideally have a time period of like 3 to 3.5 years for the existing order of 22,000 crores to be executed. So that's like because 30 months, 48 months, 60 months. So on an average, you can say like this should get executed over a span of 3 to 4 years.
So are you looking at projects outside of Maharashtra? Because currently a large part of your execution as well as your bidding is within Maharashtra. Is that your core geography and you will continue to focus there?
Well, so firstly, I would like to mention that J. Kumar, we have been operating in 7 states. And currently the order book of J. Kumar is around 69%, which is like a matter of chance, which is in Maharashtra. So yes, of course, we being in Maharashtra based company, we always try to bag more and more orders if given an opportunity at our price in Maharashtra. But that does not have any sort of like, a constraint or a compulsion on the company to being focused on Maharashtra. There was a time when 80% of the order book was outside Maharashtra. So this is, I would say, very typically a opportunity based percentage, which keeps changing depending upon the opportunities.
So what's the likelihood of return ratios, which currently sit at around 20%, your ROC, getting better from here or holding up at this level? Are you reasonably confident of that?
Well, I'm very confident it should be seeing some upside and surely not a downside for sure, because all the orders that we have bagged are at a particular margin. So the current margin that we have been making, it should get better off, but not go on the negative side at all.
Nalin, very quickly, in terms of the segments that you operate in as well, come in with regards to the metro elevated side of the business, where it's come back to levels that you did execute in terms of FY22, right? From here on, where will the energies be in terms of...
Hiral, I believe your mic is a bit off, so I'm probably gonna take over. Sir, apologies, I didn't hear Hiral's question, but sir, if I were to ask you,
I guess she was asking about the percentage of metro and flyovers being different. Metros going on the lower side to around 19%, if I'm not wrong.
Yeah.
That's what he meant.
So, sir, how would that impact your numbers? That's what I was going to come to.
Yeah. So, well, let me tell you that metro and flyovers. So, we are talking of metros, elevated metros or elevated corridors, elevated flyovers are similarly complex nature of works that we have been doing, and which J. Kumar has a niche over these areas. So the margin per se in this segment, because let's take Dwarka Expressway, Chennai elevated corridor, or the elevated corridor for the coastal road for Bombay Municipal Corporation, so or coastal road for Navi Mumbai. They are all complex projects. with cable stay, with clover leaves, with double deckers, with long elevated corridor crossing at multi-level. So these projects that we are bagging and which we always J Kumar focuses are of similar margin, and it wouldn't have any negative side, but rather an upside, as I've been mentioning, that we should be seeing in 6 to 8 quarters some further upside, and the EBITDAs crossing from 15 and starting into the bracket of 15 to 16%.
Point taken, sir. Okay. So the other piece that I really want to try and last off understand is, are you seeing a sharper traction post Q3? Because there was some amount of delay in terms of orders coming in. How aggressively are you seeing, and I'm asking you more from an industry perspective than a J Kumar Infra in particular. How aggressive is the traction currently within infra projects? Because there have been delays in terms of assigning projects that we saw at least at the start of FY25.
Well, I would say there is a total focus has been there with the Maharashtra government per se as we speak of, because like 69% of the order book currently comes in from Maharashtra. I think the government is very, very focused, and there has been a 100-day program that has been planned and which has been monitored by the CM office, and where the Honorable Chief Minister is taking a stock of all these projects, where these projects are also being discussed in the war room. And whatever items, permissions or clearances or decision making is involved, I think there is a very fast approach and a solving approach that's been there with the current government. And I think with any government coming, everybody wants to prove the result, because at the end of the day, the result is important for all the citizens in across the country. So I think with my personal view, and as if I talk of like overall picture also in the infra segment, I think there is a positive attitude and there is a good traction on the positive side for completing these projects well in time. And every time, like, in this 2 months time, we have done trial run for Mumbai Metro Line 7A, which the trial run for Mumbai Metro Line 3. It's been open to public. The Mumbai Metro Line 9 has been put on a trial run, and 7A we did the breakthrough. Each time the CM and the commissioners, they come on the side, they give us new targets to complete the other projects well before time, and to be like, there should not be any loopholes. So I think I am finding a very positive approach and support.
Absolutely positive from an execution perspective, and the revenue possibility also then for a J Kumar Infra. But thank you so much, Nalin, for joining us on the show and sharing the views. So that's the management of J Kumar Infra, clearly seeing gains of nearly 2% on the 22,000 crore order book that the company has been sitting on so far. But let's move on. It's an interesting counter that we're going to talk about right now is a JK Tyre. Harsh, I don't know. I mean, I don't think so anyone right now has been able to understand as to what is the reason that the stock is trading at the day's highs with gains of 13% coming in there with a dismal set of numbers, right? Yeah. In fact, first let's get Puneet to get us to know as to what were the key highlights of the quarter, and if anything that he has found which has been positive, which could have led to this kind of a gain.
Well, thank you for that. So definitely, the 4 numbers, not very good. Talk about just the 1% growth in revenue. EBITDA was down 25%. This has dragged the absolute margins by 330 basis points. And subsequently, the profit is also down by 42%. Now, the company in its conference call, mentioned a few things which couldn't possibly, anticipate why the move. But they did mention that the 2 plants that they have in Mexico will now be essentially currently have 0 tariffs. So there has been a pause of 90 days of tariffs between Mexico as well as the US. Both the governments are trying to find a way into, having a more peaceful resolution, essentially, which is a non-tariff based resolution. And that could be one of the key reasons, because that was the biggest risk for someone like a JK Tyre, because it is the only tyre company from India that has a manufacturing facility in Mexico. And with the higher tariffs subsequently on Canada and Mexico at the start of the whole Trump tantrum, I think that was one of the key aspects. The other things that they mentioned was that because the Mexican peso has also depreciated in this particular quarter versus the rupee, so those results were looking slightly better. But in terms of demand perspective, they've not been able to quantify too much of a growth that they are anticipating going forward. They are expecting FY26 to be slightly better in terms of margins versus the previous year, but that would be led by the raw material prices coming down in this year. But largely the valuation comfort is also there for a company. Is the cheapest stock in terms of the tire space. It trades at a 50% discount to the likes of MRF, and maybe those are some of the key things that the street is anticipating. The higher commodity cost to be history, and going into the next couple of years with the capex already done and capacity utilization also at a decent level, there could be anticipation of some gains in the near term once the commodity costs subside, and that could be something that I feel the street is taking positive note on. Stock hasn't done much in the last 1 year. It's actually fallen from its highs of 700 rupees, and I think that's some of the key factors that could be impacting JK Tyres today positively in trade.
Right, so that's with regards to why JK Tyre goes 13.5% up move. I think what's interesting, Harsh, with the tyre stocks is if you even look at a MRF, a Polo or a CEAT, if you can just have today's chart of all these counters, all of them are seeing some bit of positive momentum, and I think it's coming in from the commentary that you're hearing with regards to auto majors as well, right? And that's one of the reasons why that built-in impact that's coming in for a JK. And JK, to be noted, is one of the manufacturers in terms of premium tires. So that is one aspect. Maybe a compelling bet from a valuation perspective is something that we need to check with few of the analysts as well. But this is an interesting one.
Yeah, I mean, the stock has not done anything year to date. And this is despite the 12% move in trade today. So it's likely the fact that we've seen a little bit of an overbuild up in this space with regard to all the negatives that have played out. It's likely that, and hence you're seeing the kind of reaction likely.
And I think the other tire companies have done better or performed better than a JK Tyre in the last 1 year, as you're mentioning. So maybe that's the reason why you're seeing that buying interest, taking the forthcoming commentary into consideration. But the other aspect that's buzzing in trade today, apart from the auto pack, is the pharma sector. I mean, yes, the sector has seen a lot of ups and downs, taking into consideration the commentary that we got from Donald Trump. And the key over here is, in spite of all of this, the pharma sector growth story remains intact, is what Jaykumar, the N. Jaykumar, MD and Group CEO at Prime Security says. Let's quickly learn in an excerpt of that conversation.
From an international sector perspective, I think the pharmaceutical sector, which is the lowest cost producer in the world, other than China, will be hugely in demand as the US consumer seeks out pockets of low-cost production. Even today, Apple has made it very clear that notwithstanding what Trump may like or otherwise, they would like to continue production with India. And I think that goes, unabated. So if individual companies are taking steps which reduce their costs, India cannot be a point on the map which they ignore. We could argue whether they'd be as important as China was 10 years, 15 years ago, but you cannot argue for the fact that the Indian manufacturing setup is here to stay. We'll need to keep tweaking to make sure that things happen. But having said that, the world itself has moved on. The dollar index collapse, the yields going up, clearly indicates which way money is moving and which way international thinking is geared towards.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day.
Welcome back. Thanks for being with us here on India Market Close. Now, that time of the show, when we go across to Samit, who gives us all of the chatter that he's been hearing from dealing rooms. So, with that segment heard on the street, Samit, over to you.
Well, multiple stocks remain in focus. Firstly, on dealer desk, Shriram Finance is one stock that has been in focus. Dealers are indicating that there was a large selling that we had seen from a large global asset management companies of late on Shriram Finance, but most likely this selling is likely to be over soon and the stock could bounce back from current levels is what dealers are indicating. When it comes to NMDC and ONGC, dealers are indicating that there is delivery-based buying seen on DII desk. When it comes to IndusInd Bank, now dealers are indicating that large HNIs have started to accumulate this counter at lower levels ahead of the fourth quarter numbers which will be reported today. Now the general market perception is that most of the negative news related to IndusInd Bank is largely priced in and it's a high risk bet that large HNIs are taking at current levels. When it comes to IOL Chemicals and LN Electronics, dealers are indicating that large influential investors have been buying into this counter in trade today, and that's the reason we have seen such a big move when it comes to IOL Chemicals and LN Electronics. And lastly, when it comes to Sun Pharma, SBI Life and Crompton Consumer, for Sun Pharma dealers are indicating that FIs are buying into this counter, while on the flip side there are sell flows when it comes to SBI Life and Crompton Consumers on the FI desk in trade today.
Okay, so those are some stocks to keep on your radar and what all Samit has been hearing from dealing rooms. But anyway, joining us on this fresh news segment is Chakri Lokpriya, Chief Investment Officer, Equities at LGT Wealth, and we have Kush Bora, founder, kushbora.com. Let me first start with you, Kush. What side are you sitting on in terms of the trade with regard to the Nifty and the Nifty Bank, or are you staying away?
Hi, Harsh. Hi, Chakri. Very good afternoon to you and to all the viewers.
Good afternoon.
I'm on the long side. Let me just start, with that. Yesterday we discussed about the 24,700 support kicking in. Did not do so, towards close. But glad to see that today we are respecting that for the most part. What's happening is that there is a contraction that is happening on the Nifty. If you see the weekly setup, then definitely there is a higher low formation suggesting that the supports are moving up. But if you come closer and look at the last 4 sessions, there is a lower high formation on the daily candle setup, which is suggesting that perhaps on the upside also there are some exits and resistance is building up. So this is exactly what a contraction would look like. So won't be surprised to see that going forward we remain largely in the range of 24,600 thereabouts on the downside and 25,150 on the upside. Spend some time there after a rocking week last week. Some consolidation is par for the course. Also some cool off in the mid and small cap segments, that is also very healthy because a lot of stock had run up too much too fast and approaching over 80 territories. Some a lot of them in fact had crossed over. So some cool off is actually par for the course. I don't think this disturbs the bullish outlook that I have on the Nifty, on the Bank Nifty and markets in general. In fact, it only strengthens that bullish outlook, especially because if you run up too much too fast, then a sharp correction is always around the corner. Now with this meaningful consolidation sideways move, I think we are perhaps on a good footing. So all in all, still bullish on the Nifty. In fact, it would not be a bad idea to consider a long position with a stop loss near the 24,600 mark and come in for targets of 24,950 and 25,150 on the upside.
Right, so that's with regards to Nifty. Clearly, Kush, good afternoon. What would your top picks be, taking into consideration the kind of market moves you're seeing? A lot of action in the broader markets, which is stock specific. Large caps, not too much. Your picks.
Indeed. Hi, Hiral. I think Pharma is the sector of the day. A lot of stocks flying around. So one of my picks is from that is Zydus Wellness. Has been doing well for the last couple of weeks. If you look at the last two sessions, then the volumes, in fact, last three sessions, the volumes are through the roof. Today, the stock has crossed over and sustaining above the 200-day moving average. The momentum is very well intact on this one. So 2030, 2090 are your targets. 1910 is where you place that stop loss. The other pick is from the financial space, which is HDFC AMC. Again, we discussed this stock, I think, about 2 sessions ago. In the market, very volatile and choppy. This one's holding ground. So that's also a sign of relative strength. On the upside, you're looking at targets of 4,900 and 5,025, and the stop loss for this one still remains at 4,600.
Chakri, do you have a view with regard to some of these tire stocks? Do you believe that there's value emerging there? And just talk us through what your take of JK Tyre's numbers is.
Good afternoon to all. Clearly, the tire companies will benefit from lower oil prices and therefore lower input costs. And that margin benefit is kindly likely to flow through for most tire companies for this quarter and the next quarter, assuming next quarter, given some of the inventory management that they have to do. Against this backdrop, the volumes for both two-wheelers, four-wheelers, exports, everything has been kind of subdued all along. But the tire companies have kind of underperformed the auto OEMs, and they are a clear derivative of the OEMs. So from that perspective, if you look at JK Tyres trades at about 14, 15 times. Earnings were a very respectable, cheap value, reasonable valuation. CEAT also for its mix trades at a very good 18, 19 times valuation. And the earnings prospects are likely to accelerate for the tire companies and margin accretion. So therefore, we clearly would be buyers of tire stocks.
Clear buy call coming in terms of tire stocks as well. And I think the commentary from a JK Tyre is also interesting with the kind of uptick they're expecting in Mexico. Margins, they've said, are expected to improve as well going ahead. And probably it's only the commentary to some extent that is alluding to this kind of a positive move as well. But moving on, time to put the spotlight on the stock of the day, and it has surged more than 7%. We are again back to the auto segment. The ancillary pack, Gabriel, 6.5% up move coming in on this front on the back of earnings. Let's understand what are the factors that are favoring this kind of a surge. Puneet puts the spotlight on the stock. Puneet, over to you.
Well, thank you for that. Definitely a very interesting stock in the auto ancillary pack. We don't speak about this much, but over the last year or so, the company has outperformed all other ancillary stocks in terms of business performance as well as stock price. Let's first look at the company's quarterly earnings. Revenue in this particular time frame has grown by 17% on a consolidated basis to 1,173 crores. EBITDA as well has improved meaningfully up 35% to 109 crores, and this has increased the company's margin to over 10%. So 10.2% is what they reported versus 8.8% last year. And finally, on profits, up 31% because of that. Now, we've highlighted three key aspects about the company that will, what's working for the company as well as in the future in FY26 should help continue the business momentum. The first one's, of course, the standalone suspension business, which is continuing its growth momentum. Now, suspension was something that's traditional to, Gabriel India, and they've always had almost 100% of the revenues in this business. Now, currently, it forms 86% of the company's revenues. They've increased the other verticals by acquiring new tech as well as entering, high margin product businesses. That's the second key aspect because, they've expanded their product profile through joint ventures as well as acquisitions. They've entered a joint venture with Inalfa for sunroof business, which is largely an import substitute play. Inalfa is the world's #2 automobile sunroof manufacturing system in the world, and a tech partnership with this company has helped enter into the sunroof market for something like a Gabriel. The third key aspect is that asset purchase. They've signed an asset purchase agreement currently with Marelli Motherson Auto Suspension, and that will increase the company's tech know-how because they now also have a technical agreement with Marelli Motherson as well. Finally, in terms of what are the future products to look at, the company has announced in this particular quarter that they will be entering solar dampers. Now, solar dampers essentially help keep the solar panels in position to have maximum energy and utility. And this market is roughly about $326 million. Apart from that, they also have entered the electric two-wheeler space over the last couple of years and now command 74% market share in this market. Now, they're also in talks with European e-bike companies to provide the suspension products. They've already developed that product. That will be another new vertical. So just apart from the suspension business, there's a whole host of things to talk about for Gabriel. Over the last 1 year, stock is up 76%. And growth valuations are now, of course, pricing in some growth, but not that expensive at 25 times price to earnings. But definitely a very interesting play to watch out for going ahead.
Okay, thank you so much for that, Puneet. I want to quickly highlight Trident, and I'm going to come to Gabriel in just a bit. But look at those numbers posted by Trident. You've got revenue, which is up 11% on a YOY basis. EBITDA is up 23% YOY, with margins coming in at 13.3%. And your profit after tax has zoomed from 57 crore to 133 crore. And look at the reaction on the stock, which is on your screen. I'm also going to quickly highlight maybe the QOQ number as well, because this one obviously looks strong, but QOQ, the profit after tax number was at 80 crore. So that likely is the reason for that reaction on the stock. We're going to try and break this a little bit more, but while we are at it,
margins have also improved. The number has come in at around 13.3% versus 12 if you have to see on a year-on-year basis. Sequentially also there has been a good improvement. Profit number is pretty strong, right? Almost a 2.3, 2.4 times is the kind of growth that's coming in on this one.
Yes. So, and justifiably so, the stock reaction. Kush, anything with regard to technicals with regard to this one? Is there a view that you have?
On Trident, I think it will be a good idea to take some money off the table. I mean, the stock was rising and today it's given a very sharp up move, but it's now gone significantly beyond the upper end of the Bollinger Band. I won't be surprised if the profit booking also kick in. So not a bad idea to book partially, if not fully. And it's also now coming up to the resistance of 35. So yeah, at least partial profit booking is advisable. You could hold the rest with the stop loss around the 32 mark.
Right. Chakri, do you have a view with regard to Trident? Do you hold it?
We don't hold Trident, but as a view, the company has had its own fair share of challenges over the last couple of years. And now, there is more clarity in terms of the external environment is becoming more favorable in terms of exports or what Trident can do in the textiles, etc. space. And, the company in itself is, I think, setting its internal control systems. And therefore, valuation is not an issue, but it's coming together of both fundamentals and the export opportunities key.
Right, so that's with regards to Trident. Chakri, a quick view in terms of BEL as well, taking into consideration the strong strides it's making in terms of today's session. Would you be a buyer of a BEL? And if so, what's the kind of upside that you're looking at? And if you're not a buyer of BEL, what would your top picks be in terms of the defense pack?
Bharat Electronics has done obviously very well over the last 1 month, 3 months, 1 year, etc. And the recent earnings that came about yesterday, day before, were very good. They beat estimates. And now with the India-Pakistan war, there is a huge new order for both Air Force, Navy, and Army on missiles as well as some of the drone technologies. Now, this will add a significant number to the revenue estimates going forward next year. So, and also with Europe now opening up for defense, I think that will open up a new revenue stream access. So I'll continue to hold Bharat Electronics, even though it's done very well.
Okay, continue to hold a BEL. Let's switch focus though. Let's talk about global markets. And we have with us Jonathan Chazelle, Deputy CIO at Westminster Asset Management, to talk to us about exactly that and give us perspective. Good afternoon, Jonathan. Been a while, or good morning. Been a while since we spoke. I want to first start off by understanding your take with regard to this downgrade of US debt by Moody's. What's your sense and what's the likely impact? Because not seeing a large impact, at least on either yields or especially on markets.
Yeah, good afternoon. I think obviously this wasn't a huge shock to markets, as you could clearly see by the price action following the downgrade. Obviously, most of the other rating agencies have already downgraded the US, so I think it is, as mentioned, it wasn't a huge shock. So for us, we didn't really focus too much on it. I think it was inevitable. It was coming. It's happened. Now we move on. Clearly, though, what we have seen a push higher in much longer US rates, the 30-year rates, than some of those which US mortgages are based off. Some of those, movement ups are quite concerning, over the longer term. And certainly we do think inflation is an issue going forward, less in the short term, but certainly in the medium to longer term, and that rates probably do move higher.
What about the refinance, Jonathan? There's going to be a large refinancing which is going to play through all the way through 2025 calendar year. That is going to happen at a higher rate, of course. How would you reckon would US play this?
Yeah, I think you're correct. I think, there's a lot of people had been very bearish, particularly on the US macro over the last few years on rising interest rates. But I think, as we all know, a lot of CEOs of US businesses had locked in lower rates. And as you quite rightly say, the refinancing is coming due now, and that's picking up in the period ahead. I think it is going to be difficult, particularly in an environment where there is some uncertainty about global trade, about capital investment. So I think it is going to be a tough period ahead, probably for the CEOs of a lot of business, and decisions on capex, on repaying debt, etc., are going to be extremely important going forward. And we do expect to probably see a pickup in stress in certainly some of the more high-yielding sectors of the market.
Okay. How do you expect, Jonathan, markets to therefore react? Do you believe that they've reacted irrationally, or do you believe that a lot of this is already built in? And if so, how should one rationalize between a risk-free rate of 4.5% that the US 10-year Treasury currently trades at, and the Dow not taking a significant knock?
Yeah, you're quite right. I think, at the end of the day, investors have an alternative with a risk-free rate of over 4%. So it is an alternative. We're actually, on the whole, still remain and have remained reasonably positive on global equities, or equities as an asset class. I think the reality is we are probably past, if you like the phrase, peak tariff. and that hopefully some rationality will come back into this whole space. So I think some of that risk is behind us, and clearly markets have rebounded extremely strongly in a very short period of time on the basis that that risk has diminished. Where we are today, though, I think with most of the data that we're currently seeing being backward looking, there probably are some risks in the short term that markets probably either just go to sleep for a bit or even come off a little bit, because they have moved in a very fast in a very short period of time. And of course, we've got seasonality about to kick in some of the Northern European markets where returns tend to be suboptimal for the next few months.
Right. Jonathan, picking up from what Harsh was talking about in terms of the bond yields as well, he mentioned about the US 10-year Treasury. We've crossed 4.5%, 30-year is approximately 5%. Japan's 40-year is also at a multi-year high right now. And this surge follows Moody's downgrade of US long-term ratings from AAA to A1, AA1. With this, if you have to look at India's 10-year GSEC yields, that has fallen to around 6.22 at a 3-year low. What would this actually mean from an India perspective and from a markets perspective?
Yeah, look, it's fascinating. I think when we look at some traditionally higher yielding government bonds, and you now put those against some of the US ones, the US yield is now what I think probably higher than what you can get at the equivalent bond in China. So, and it is extraordinary, as you rightly say, that the Indian rate is now very close to the US longer term rates. I think there's lots of things at play here for that. There's obviously the domestic factors that are important, but I think one of the things which is noticeable, particularly for the likes of India and other Asian in particular economies, is this whole idea that we're seeing a shift away from US holdings of treasuries from Asian central banks, global central banks. And we've seen some early signs of certainly when we look at Asian currency strength. And that could be a reflection of repatriation flows beginning. We do think there is something in this trend, and therefore that will have huge ramifications globally as well over the next few years. We think it's a trend which will be slow to play out, but we think it is important. And ultimately, we think US rates probably do have to go higher to attract global flows.
Okay, Jonathan, how do you view oil and how do you view emerging markets? Do you think oil has bottomed, and are you positive, negative on EMs?
So I think for oil from a demand perspective and what's going on with OPEC and Saudi Arabia, in the short term, it remains quite difficult. I think probably the risks are to the downside for the oil price in the short term. But we remain quite positive on the energy complex sort of on a medium to longer term basis. We still think it's quite attractive. And sorry, your second question was emerging markets. Sorry,
even more so on India, if you have a view.
Yeah, so we like India's had a decent correction, and obviously, like some of the other markets, it has had a sharp move higher. We continue to like India. And yes, I know a lot of other overseas investors look at India and just cannot get their head around the valuation premium you pay for it. But obviously, it's a market that I've been involved with for a very long time. You do get extraordinarily good companies in India. So we still do like India. We're happy to be longer term investors in the market. But overall, we think a weak dollar, which we do think the dollar will weaken off, is going to be positive for the broader complex as well. So we like India and we like EM in general.
Absolutely. I mean, positive commentary coming in on India and emerging markets. Thank you, Jonathan, so much for joining us on the show and sharing your views. And apart from Jonathan, we have, a couple of brokerages that have come up with their commentary, which clearly is indicating that India is in a sweet spot. We have 4 brokerages today. We're talking about Goldman Sachs, JP Morgan, as well as you have Nomura and a Morgan Stanley. Let's start with the Goldman Sachs. What they are saying is amongst the countries that they look at, India is among world's 5 largest economies by 2025. That's their target that they have. And in terms of the top 3 by 2075, and they are saying that they will overtake US in the next 50 years. That's a Goldman Sachs view coming in terms of India. When you talk about JP Morgan as well, they're expecting India's 2025 GDP growth to be the highest, and this is amongst JP Morgan's global universe. And they're saying that India, in a way, is trade insulated and cyclically very well positioned as compared to the other countries as well. Overall, a safe haven amongst the trade war, which is 2.0, and they're seeing the economic momentum that is picking up as well. In fact, the factors that will aid growth in terms of where India goes is the stance shift to accommodative. Secondly, the 2 consecutive rate cuts that the RBI has undertaken. And thirdly, the liquidity infusion measures that the central bank is looking at as well. Overall, if you have to talk from an earnings perspective for FY26, the ongoing recovery that they are seeing in the rural demand is something what JP Morgan is betting big on. The reduced taxes that have actually come into effect from the end of April, your declining inflation, normal monsoons, in fact monsoon is hitting slightly earlier, and soft commodity prices. Moving on, you have a Nomura as well, where they are saying that the GDP growth is likely to rise in the first quarter, and this will lead to indices still pointing lower. They're expecting 100 basis point of further cuts this year versus a 50 basis point consensus that was taken into consideration. When you talk about Morgan Stanley, what they are indicating is that the defensive market is what India is looking at, and there is a further upside that is on the cards. Now, India's low beta means it will underperform a global bull market, though the drawdown from September high is an opportunity to buy the long-term story, that is India's growth story. They've raised their EPS estimates as well by 1% to reflect the GDP growth forecast, and their June 2026 Sensex target is 89,000, which is a 8% upside. So Harsh, overall, India is in a sweet spot from all the 4 brokerages that we're talking about from markets perspective, and if you see from an economy perspective as well so far.
So India in a sweet spot. Thanks so much for that, Hiral. Broken down extremely well. Let's go across to Chakri. Chakri, if India is in a sweet spot, what are you betting on? What is your top bet? Sector, company, however one looks at it.
Okay, here are 2 or 3 things. One is in terms of catalyst that is needed to take the market up is one, we have an RBI surplus that's likely to be distributed. That's about 2.5 lakh crores. That can be used by the government of India in defense spending, in capex, and also given the recent Pakistan-India war, you're likely to see higher defense spending, higher railroad spending, higher infrastructure spending. So which means that is a sector, industrials, financials, and thirdly, consumer discretionary. In that order is what we would like.
Okay, so thanks so much for that. Stay with us, both of you, Chakri and Kush. What we're going to do is we're going to slip into a very short break. On the other side, we'll have top buy today, sell tomorrow picks, and we'll have a very interesting bull versus bear for you because Dixon Tech is down 5% despite a very strong result. Stay tuned. Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Well, as promised, let's go across, Puneet, waiting buy on Dixon Tech. Bull versus bear. Very strong numbers, beaten every single estimate. Stock down though. Puneet.
Well, thank you for that. That's definitely the first bull case. Really strong numbers, are over 120% growth in the company's revenue in Q4. For the whole year, the revenue is doubled from the previous year. Profit is also up roughly 95%, excluding the one-offs, of course. So 95% for the business, really strong numbers, as you rightly said. But there is also a lingering concern of PLI impact. Now, the company was eligible for mobile PLI, and that's roughly 85% of the company's revenues between 2021 and 2026. That will be the last year. So FY26 is essentially the last year for the PLI benefit for the company. The company quantified that it's 0.6% of the revenues of the mobile vertical. And just to give context, for FY25, the mobile revenues were 33,000 crores. So 0.6% of that has been straight benefit to the profits for the company. That will be missing in FY27. When you look at the second key vertical, they're estimating that the revenue will keep on growing, and that's because they're estimating to sell roughly 44 million or roughly 4.4 crore smartphones in the next year. That's a growth from roughly about 28 million or 2.8 crore smartphones that they sold in FY25. Just to give some context, that's 1/3 of the volumes in India for smartphones. So 1 in every 3 smartphone is built by Dixon and manufactured in India, and that's the scale of the company. But one of the other growth verticals essentially was expected to be the JV with the company Vivo. You're all very familiar with that. It was largely announced 6 months ago, and the company is anticipating another 5 to 6 months to get those approvals. So that effect will only come in FY27. And now finally, in terms of both valuations as well as growth prospects, now they are anticipating that the company's new components foray will aid margins going forward. From this year itself, they are building a facility for display manufacturing. So effectively, the screen on your phone will now also be built by Dixon, but that will only get commissioned in FY27. So watch out for that. That is expected to have a 90 to 100 basis point positive margin impact. But again, valuations at 80 times price to earnings for FY27 was pricing in a perfect result. And while they've delivered that, I think the margin profile as well as, some more aspects of, the semiconductor venture of the company, they're still waiting for the government subsidy. Those are some of the key things that need to be nailed down before going forward. So peer comparisons as well with Keynes and Amber while trading at similar valuations. Amber is actually at 52 times price to earnings. Something like Sirma is at 29 times FY27 price to earnings. So definitely there is some valuation comfort in a couple of peers, but for now, Dixon getting impacted because of potentially the mobile PLI, but a stellar result nonetheless.
Okay, so that's on Dixon Tech. Thanks so much for breaking that down for us, Puneet, in what was a very comprehensive bull versus bear. Chakri, let me come to you. What side of the fence do you sit on when it comes to a Dixon?
Clearly we would buy the stock longer term. It has run up, but that's all right. Given the revenue is doubled and profits have more or less done the same, and that's likely to continue for quite some time now. And as and when the new verticals come down, go on stream, that's likely to add, again, to overcome the effects of the PLI, loss of PLI margins. This as a business is a high volume, low margin business. And that's what will come to the company's rescue. It's shown that it can execute.
Also a very low entry barrier business, Chakri.
It is, but you can't get to be such a large player overnight. So it takes another competitor a few years of build out. By then, semiconductors is another area that Dixon is looking at. So low barriers to entry is not size, is a barrier to entry.
Sure. Take your argument there.
But I think a technical perspective on this one is also interesting. Kush, anything with regards to Dixon? Because there have been some news that are indicating that probably any buy, any dip should be used as a buying opportunity. And if that is the scenario, if you have to look at a Dixon, Keynes, for that matter, even a PG Electroplast, Sirma, where are you seeing strength?
I'll make life easy for everyone, including the viewers. And there's a consensus now. Technically, also this doesn't look so bad. If you look at the kind of run it's had over the last couple of months, I think the last 2-3 weeks of move has at best what you can call a consolidation. So multiple support zones for it. First up, the 1500 to 15,100 to 14,800. That's the zone that it might act as a very strong immediate support zone. If this dip continues tomorrow as well, and if I get it anywhere closer to those levels with a stop loss near the 14,300 mark, this might turn out to be a good buying opportunity. Even now, what happened, at least from a technical standpoint, as I said, the numbers were right, but if or rather, better than expected. From a technical standpoint, there was an RSI divergence building up, and hence we saw that correction coming in. So for me, this still looks like a good buy. 15,100, 14,800, that's the support zone. Anywhere closer to that, the risk reward ratio becomes extremely favorable.
I want to talk a little bit about PFC, Hiral, because stock in focus, you have renewables distribution sector aiding profit growth is what the management tells us. Resolution of one asset worth around 1,200 crore has aided profitability. FY26 loan growth at just 10 to 11%. So they've substantially cut down on that guidance. They're cautious about taking exposure in infra. They have 1 lakh crore worth of loans sanctioned in the pipeline, yet to be fully disbursed. And they have provided 100% for Gensol, around a 266 odd crore exposure. They're also saying that they expect to maintain their spreads and they will raise about 15-20% of total borrowing via overseas markets in FY26. I want to understand from Chakri whether at all he is bullish on any of these power financiers, REC, PFC. Chakri.
REC PFC will continue to do well, I believe, for the simple reason that there is now a huge emphasis not just on renewables, but also thermal. Adani has just announced a huge plans for expansion in thermal. Second is in terms of, the companies are both Navratna status, so this enables their cost of funds is much lower versus competition. Third, even if they don't do infra, the renewable space and thermal space is huge enough for these guys to grow at a very high growth rate over the next until 2030. So by that time, the company which is now trading at one-time book value can do very well over the longer term.
Right. Strong commentary from Chakri as well in terms of REC and PFC. But very quickly, let's just pull up NTPC Green on the screens. A very strong set of numbers that are being reported. A net profit of 233 odd crores versus 81 crore. I'm assuming there should be some one-off that is coming in on that front. Because overall, if you see 230, the growth, the spike also coming in with 5% gains. EBITDA seeing a growth of around 28% at 560 odd crores versus a 437. Margins have seen a strong improvement as well at 90% versus a 86%. So operationally, good strength. Profitability also a massive improvement. If we can just see the top line number, what that is looking like, I think that the revenue from operations have come in at 622 odd crores versus a 508. And if I have to look at the total income, 751 versus a 553, where the other income component on a year-on-year basis has more than doubled. So that is something which has aided the numbers this time around as well. Apart from that, let's see if there is any exceptional in terms of the numbers. Does not seem to be here. But overall, a strong set of numbers so far. Very quickly, any views coming in on the set of numbers that have been reported, Chakri? Because the stock is seeing a strong spike right now.
I think they're a good set of numbers. And if I think it's trading kind of, close to or below its IPO price, Kush can help us there. And the valuation at that time was very reasonable at IPO time, so it should be reasonable now then.
Okay, Kush, what are charts indicating? As Chakri is saying, I think you are going to come to help us understand from the IPO to now. Good levels to buy because 102 is what the stock is trading at. On a 1 year or a YTD basis as well, the stock has been a downer.
You're right. It's seen quite a bit of a dip, but let's not forget that, that came in line with market correction, a sharp one at that. I'll take it as a silver lining, the move that the stock has made in the last about 2.5-3 months, where the stock is steadily gaining ground, and there have been good days of high delivery markup, volume backed up moves. So for me, I think this is a good setup. The risk reward ratio becomes very favorable in the sense that on the upside you're looking at a target of 117, and once that is taken out, perhaps even a 125, and on the downside a good support zone comes in at 98. So the stock now seems to be on a good footing. It's not a tear away or a breakaway rally which just makes the stock very overheated. So while the momentum is missing, I think that's the kind of stock that you should be in, which has a gradual steady up move, even in a market which is now a little volatile. But I think NTPC, after the kind of recovery that it's seen over the last 2.5, 3 months, makes a good bet.
Okay, the other one in focus is Max Health. The company posted its Q4 numbers, revenue of the company up 29%. We spoke with Abhay, who's the chairman and managing director at Max Healthcare, about the company's expansion plans going forward. Listening.
Going forward, having said this, we're expecting perhaps the strongest, very, very strong sort of capacity expansion happening in the current year. Strongest, if I may say so, because it's almost going to be 30% capacity growth in not only the financial year, but in the calendar year, of which in the next 90 days, we'll be adding close to 1,000 beds on a capacity of about 4,000 beds that we have at present. So, there's a significant capacity expansion. These are all the ones which are being added in the next 3 months are entirely brownfields. That's 268 beds in our Mumbai hospital at Nanavati, about 200 beds in Mohali, in our Punjab hospital, as well as 400 plus beds at Max Saket. So that's the extensive increase that we're expecting, and then followed by December, January, when we should be coming up with another 550 beds in Max Gurgaon.
While we are at it, we also have Varsha who's standing by with a review on Finiotech. Stock is under terrible amounts of pressure since the morning. You also have Aster DM and Torrent Pharma on your list, Varsha. What can you tell us about the numbers of all of those, all three buzzing?
Yeah, so let me start with Finiotech Chemicals, wherein the revenue degrowth that you're seeing, so revenue is down 22%. Now this is due to soft volume across the sectors that the company has seen. Now the soft volume was seen in the FMCG, cleaning and hygiene segment, and the textile segment, if you see, textile chemical segment remains stable for the company, and the other income, so technically net profit was down 33%, but because of other income, if there won't be any other income, then there would be more decline towards net profit. So other income actually helped net profit. Next on the list is Lakshmi Organics, wherein again kind of weak set of numbers. The EBITDA impact that you're seeing is due to one-time expenses and the base effect that the company has seen, and the interest expense have actually impacted net profit for the company. Revenue was down 10%, EBITDA was down 35%, and margins were 8% versus 11% last year. Net profit was down 51%. On the FY28 outlook, though company is very bullish. They plan to achieve ROC of 20% to double the revenues by FY28, and they want to triple the EBITDA by FY28. Next on the list is Aster DM. If you see, overall net profit did miss estimates. The EBITDA margin growth that you are seeing, because margins were 19% versus 16% last year. This was driven by operational excellence and better operating leverage. And the ARPOB, there is one of the important factor in hospital that to track in, that is average revenue per occupied bed, grew 13% year on year. A company had an exceptional item of rupees 26 crore, which actually impacted a net profit for them, and the other income grew 7.7x. But the overall net profit you're seeing, because there was a net profit of 790 crore versus loss of 24 crore, which was also the growth in the net profit. It was also led by the lower tax.
Thanks, Varsha, for getting us the details. Chakri, let's talk about the hospital space. Fortis, Max Healthcare, and if you have to look at Aster DM, all the three, the key common aspect is the kind of bed additions that they are looking at. So capex is something that hospitals have been focusing on. Do you think that is something what investors should also bet on and take a buy call?
Yeah, absolutely, yes. Hospitals in India are hugely, number of hospital beds per patients is very low compared to, let's say, Taiwan, Malaysia, and all the other countries. So there is a huge runway for growth ahead for all hospitals. And, now then it comes down to execution. Those guys Apollo is doing an excellent job. To an extent, Max is doing all right. So it all comes down to that execution. and in terms of improving up the complexity, right, so that they can charge more per patient. So I think hospitals as space in general looks good. Apollo we like.
Okay. And Kush, if I have to come to you, not with the hospital pack, but let's look at a Gland Pharma, Torrent Pharma, the Pharma pack, which has reported numbers. Anything that you like, because the kind of surge that's coming in terms of the sector itself today, it seems there is some bit of buying interest, at least on the street right now. What would your pick be from there?
So one stock we've already discussed, which is Zydus Wellness. That stock seems to be doing well. So that is one stock that I am focusing on. I think as far as the other two that you've mentioned, Gland and Torrent, Torrent actually has gone into a sideways consolidation, broad range being 3350 on the upside and about 3200 on the downside. Not much in terms of volume, also neither in terms of momentum. I think the one that you should focus on, if at all, between the two, then it is Gland Pharma. It had a good base formation around 1400, started inching up. Today you're seeing a big move, even now far away from overheated territory. So I think this move could well extend to 1610 and about 1650 odd levels. So if you do have a position, continue to hold. If not, then you could add it for the given levels, and the stop loss will be close to the 1540 mark.
Okay, what we're going to do is we're going to slip into a very short break. On the other side, buy today, sell tomorrow recommendations, along with what to expect in terms of numbers. We'll have a Sun Pharma's numbers, for example, coming in tomorrow. What can you expect? IndusInd as well later today. Stay tuned. Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers. Welcome back. Thanks for staying with us. Kush, let me come straight to you with regard to your BTST, STBT trade for today.
Well, it's a buy today, sell today, or more of a positional trade, even if someone wants to consider, and that's on 63 moons. After a while, this stock has popped up on the radars. It was witnessing accumulation, at significantly lower levels, but in the last two sessions, it's had a good move on the back of good volumes. In fact, if you see the last 2 weeks, there has been, a good solid up move on this one, agnostic of what the market is doing. So I think this momentum could well continue for levels of 912, 942 with a stop loss around the 850, 852 zone. 63 moons is something that can be considered on the long side.
And then you'll of course have certain numbers expected today, and IndusInd Bank is one of those. Chakri, what is it that in terms of commentary that you look out for to determine as to whether IndusInd could be a good buy at this point? What is it that you'll be looking out for?
IndusInd Bank has both internal and external issues, and cleaning up their house internally, as well as, when I say external, is the overall loan environment against which how they take the provisions. That's the easier part. Fixing the in-house thing, while they might have done a cleanup, I guess you need some more time for the new bunch to start getting their act together. That's why I'll still stay away.
Okay, and the other one is going to be ITC, the FMCG giant, expected to come out with Q4 numbers tomorrow. Mahima here with what to expect. Mahima.
Right, so it's going to be a mixed quarter for ITC overall. FMCG is expected to do fairly well, but paper and agribusiness are not expected to do very well. Cigarette might see a volume uptake. In terms of overall revenue, might see an uptake of around 4%. EBITDA likely to fall around 2.3%. Margins also to slide a tad bit. And in terms of profit, it's expected to fall around 1.5%. Cigarette volume growth is likely on the cards because there has been no tax hikes even this particular budget. So that might see an uptake, but overall, the kind of inflation that tobacco leaf is seeing, that might put pressure on margins. So gross margin contraction on account of commodity inflation both in cigarettes as well as in the FMCG business might be seen. FMCG business likely to see a high single digit growth in terms of the volume versus value growth. Likely it will deliver a price led growth because price hikes have been taken in biscuits as well as snacks by ITC. In terms of agribusiness, it might see a double digit growth, but overall, the street is expecting that the growth will not be as good as compared to how it was in the past few quarters. Paper business likely to see a low single digit growth, another quarter of pressure in terms of paper business. In terms of key things to watch out for, developments of recent acquisitions and commentary on the same, plus how much of a margin pressure will take place, and price hikes taken given the kind of inflationary environment that Q4 has seen. What will be the volume versus value growth? And lastly, in terms of demerger unlocking, value unlocking, how much of that has taken place and to what extent is something that will be one of the key things to watch out for. So this is the overall view as to what you can expect from ITC's Q4 earnings.
Right. Thanks for getting us the details. Ahead of the numbers, Kush, what are charts indicating?
Not a very healthy setup, I'd say, because multiple legs of negative divergences, volumes, a little thin yesterday and today. So I'd be a little cautious on this one. Anyway, the resistance on the upside very close to the 435 to about 438 kind of zones. So the risk reward ratio anyway not favorable going in long. On the downside, I'd look for a level of 425 and about 418. If that is protected, perhaps this mild rally that has started, might just continue. If not, you could perhaps be looking at lower levels. So no, I wouldn't go in long, on ITC ahead of the results, given the technical setup.
Don't go long on ITC ahead of the numbers. But moving on, you have Pharma giant Sun Pharma that will be reporting its numbers tomorrow as well. In fact, analysts are expecting the cancer drug to lead the company's organic growth. Varsha joins in with a detailed breakdown. Varsha, what are you expecting and what's on the cards?
Yes, thank you for that. So yes, a company gonna post its result tomorrow, and revenue is expected to grow almost 12%, and net profit is expected to grow almost 6%. Now, EBITDA margin is expected at 27.5 versus 26% last year. Now, organic growth is to be led by Revlimid sales, that is a cancer drug, and domestic formulation business, that is India business, is expected to grow at 13% year on year, but the US sales is expected to grow at around 12%, which will be led by continued traction when it comes to their specialty portfolio. Now, specialty portfolio is the next leg of growth when it comes to Sun Pharma, and everyone is betting on their specialty portfolio only. But the continued traction in specialty portfolio will be offset by price erosion that the company has been seeing into the generics. On the key areas to watch, one should watch the sales growth and the R&D guidance, which will be given by the company for FY26. Further development on the Lexelvi, which is the drug which is used to treat hair loss. An update on the specialty drug pipeline these are some of the key things which investors should watch out.
Okay, so that's coming in on Sun Pharma. Chakri, views with regard to Sun Pharma and ITC, would you go long on, or rather would you buy any of these?
ITC does not have any fundamental catalysts per se that can take the stock significantly higher. So we would stay away. As far as Sun Pharma is concerned, clearly the tariffs on pharma sector, what was announced was only for the branded drugs and not for the generic drugs, which is still some time away. And so with that as a backdrop, I think the revenue growth and the valuations are fairly reasonable enough for the company to hopefully beat tomorrow, and therefore offers a good probably 15-20% upside.
Okay, Kush, let me come to you with regard to a few stocks which are buzzing, and Edelweiss and NBFCs, all of them, and a Mass Financial actually. I have already asked you for a view on PFC, but But yeah, these two in particular, both of them buzzing in trade.
Yeah, right. Actually, there's a lot of traction in some of the capital markets names, NBFCs also. So, yeah, I mean, not surprised with the kind of moves that some of these are making. Edelweiss typically hasn't really been a big money spinner for traders or investors. So I think this is a momentum play. If you have a position from lower levels, continue to hold, keep a trailing stop loss near the 92 mark. On the upside, you could well see targets of 105, the 200-day moving average, and 112. But I wouldn't stay for too long in something like an Edelweiss Financial, unless major trends change, which they haven't right now. Mass Financial, on the other hand, is a different creature. Good moves on the upside, volume back. I think now it's coming up at a minor resistance of the 300 mark. But I think, with the kind of momentum, if that is taken out, you could well be looking at 315, 330 kind of levels on the upside. So this is one stock that you want to continue to hold. Stop loss or trailing stop loss, depending on the kind of position that you have, 275. That's a good support zone. You could continue to hold Mass Financial with 275 as a stop loss for higher levels.
Right. So that's with regards to Mass Financial. Ugro Capital, that's an interesting one to watch out for. Chakri, how are you looking at this one? Because overall, the latest update has been with regards to where the fundraise goes. What's interesting is in terms of the dilution that they're looking at. Raising 915 crores with a current market cap of around 1,779, a 34% dilution. But if you have to look at the overall picture as well, in terms of the fresh raise as well as the earlier raise, the dilution to current market cap comes to around 42 to 42.5%. What would your view be on this one?
Sorry, I don't cover this company. I don't invest. So unfortunately, not much view on it.
Okay. All right, gentlemen, we'll let you go on that note, just a minute away from close. So thanks so much for coming in, giving us those views. Let's quickly look at where the Nifty 50 is settling in at. It's been that kind of a day where we've done okay after a couple of days where we've seen pressure. 0.5% higher on the Nifty, 24,800. Let's look at the intraday as well. We've done decently okay, to close the day off. We're not closing at the day's low or the day's high. It's a fairly decent day of trade. We've been range bound for a predominant part of it, at least in the latter half, after that little bit of spike that we saw early on in the day. Let's look at the heat map as well on the Nifty, and at least the breadth strongly in favor of the bulls. BEL is one of those which have done very well. Tata Steel again in the green. Mind you, yesterday on a day of weakness as well, Tata Steel was sitting in the green. So that one has done fairly well for itself. Sun Pharma will be in focus on the back of its numbers, which will come out, and so will IndusInd Bank, which is languishing at the bottom of the screen, 2% lower. No big major movers otherwise. Auto stocks in general have done well. Tata Motors up 1%, Bajaj Auto also up 1%. So those couple of stocks buzzing in trade. Life insurance and financials have also done well, and HDFC Life and Bajaj Finance among those top gainers within the Nifty. Let's look at sectors now, and within the sectoral basket, let's focus in on the only solo loser, which is Nifty Consumer Discretionary. Outside of that, you're seeing a sea of green. Nifty India Defence back in the green, 3.5% higher. The Nifty Realty Index also up nearly 2%, and the Nifty Pharma is up 1+% in trade. Let's look at the advanced decline on the Nifty. There you go. We've seen a bit of a reversal midway through the day, but that also corrected gradually, and we're sitting well in the green when it comes to the advanced decline. Just 800 declines to the 1400 odd advances, and therefore the Nifty mid cap and small cap indices largely in line with how the large cap index has performed. 0.8% higher on the Nifty mid cap, the Nifty small cap slightly underperforming, around 0.4% higher, but broadly all of those indices in the green. That's how we're closing in at. Let's also last off look at the BSE 500 top gainers, top losers. Some of those obviously on the back of numbers. Tata Tele, for example, up 20% at close now. Trident was the other one, very, very strong numbers. But outside of that, there were some big buzzers. Mass Financial on the back of very strong volumes was up 6.5% to 7%. And HLE Glasscoat, after the solid numbers that we saw day before, was up nearly 6% in trade. GMM Pfaudler also up around 5%, and so was BEL. Dixon Tech was the one big casualty despite a very strong set of numbers. Aster DM, Radico among alcohol stocks was down, but Lakshmi Organics was the other one on the back of numbers. But let's look at what to watch out for. US crude oil inventory is the one big piece now. I want to talk about that for just a minute. US crude oil inventory will also determine oil prices. Now, really have oil prices bottomed or not is the question, and we might get some bit of cue coming from this metric, and hence it's lying on the screen there. Let's look at AB Fashion and Retail. That's the one where demerger date is effective the 22nd of May. So you might want to look at that. You have corporate action across the board, and Ashok Leyland, GM Breweries and Emami, all three to declare their respective interim dividend. And last off with regard to earnings. That's all the earnings that we'll need to look out for. Astra Micro, interestingly, with a family member of RK Damani picking up a stake there. So that's why it was a part of the buzz today morning. But an ITC, Sun Pharma, we did speak about both of those. Good Luck India is the other one. You will also see Ramco Cements come out with its numbers and an HFCL. So some of those names may well be on the list for you for earnings tomorrow. But with that, Strides Pharma as well. But with that, completely out of time on this edition of India Market Close. From Hiral, myself, everyone who puts the show together, thanks so much for watching. Stay tuned to NDTV Profit. More action on the other side. Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims?
welcome to Market Express, your fast-track source for the latest updates from the markets along with national and international news. I'm your host, Himakshi Bahugna, bringing you the key stories and breaking developments to keep you informed and ahead. So let's dive right in. Now, viewers, benchmark indices, the Nifty 50 and the 30-pack Sensex ended off their day's high but concluded the session about 0.5% higher. While Kotak Mahindra Bank, ITC, JSW Steel and IndusInd Bank weighed most on the Nifty 50, HDFC Bank, BL, ICICI Bank, Bharti Airtel and Bajaj Finance uplifted the basket. Now the Nifty Mid-Cap 150 outperformed the benchmarks. All sectors ended in the green, with Nifty Defence continuing to lead the sectoral bulls. Nifty FMCG, Bank and Media gained the least. The market breadth ended highly skewed in favor of the bulls. Rupee closes flat against US dollar, settles at 85.64 against the US dollar. Solar Industries project significant growth in its defense segment, aiming for 8,000 crore rupees in revenue over the next 4 to 5 years. For FY26, the company expects 3,000 crore rupees in defense sales, nearly doubling in FY25 defense revenue of 1,355 crore rupees, driven by a strong order book exceeding 17,000 crore rupees, including a landmark of 6,084 crore rupees contract for Pinaka rockets. Now, Solar anticipates an uptick in domestic sales volume in FY26, bolstered by India's growing defense budget of $78.4 billion US dollars. The Competition Commission of India has greenlit Bajaj Holdings an investments acquisition of a 20% stake each in Bajaj Alliance's life insurance company and Bajaj Alliance General Insurance Company. Now, this is a part of a broader deal where Bajaj Group acquires Alliance SE's 26% stakes for 24,180 crore rupees. This increases Bajaj's ownership to 100% from 74%, now ending a 24-year joint venture. Dixon Technology saw its shares plummet nearly 8%, hitting a low of 15,270. Now, the lowest since May 9, 2025. Now, this fall came in despite strong Q4 earnings with a 20% year-on-year PAT increase and stable margins. The decline was driven by investor concerns over lofty valuations and the impending expiry of the production-linked incentive scheme in FY27, which contributes 76% to mobile margins. Hindalco Industries is poised for robust profitability over the next 2 to 3 years, driven by ramped-up downstream projects and the start of captive coal mining. Analysts say that the company reported a stellar 41% year-on-year net profit surge to 3,174 crore rupees in Q4 of FY25, exceeding estimates. Now, this is fueled by strong aluminium copper segment performance and lower input costs. JP Morgan maintains overweight on Hindalco and hiked target price to 720 rupees from 680 rupees. Now, it expects the company to finish the year on a strong note. It also reckons that better than expected product mix in aluminium downstream and lagged impact of higher alumina prices aided this Q4. Now, it further added that EBITDA expansion will most likely continue over the next 2 to 3 years as downstream projects ramp up and captive coal mining commences. Citi Research maintains a buy rating on Hindalco Industries, raising its target price to 800 rupees from 725 rupees. Now, this follows a robust Q4 of FY25 with a 41% year-on-year net profit surge to 3,174 crore rupees, driven by stronger aluminium performance. Now, Citi highlights stable India aluminium cost in Q1 of FY26, with downstream EBITDA per ton set to improve steadily due to lower input costs. Gland Pharma's share price experienced notable volatility following the release of its Q4 earnings report. Initially, the stock declined by 2.81% at market open, but later recovered to trade at 3.78% higher. Now, the company's revenue fell by 7.3% to 1,425 crore rupees compared to 1,537 crore rupees in the same period last year. This was below Bloomberg's estimate of 1,552 crore rupees. Tejas Network share price was in focus today as the Tata Group-backed company saw its shares surge 5% in Wednesday's trading session. The upliftment was noted right after the company bagged a significant order worth 1,525 crore rupees for supply of services for the BSNL 4G project. Power Finance Corporation reported robust Q4 of FY25 results with consolidated revenue surging over 20%. Now, this was driven by strong loan book growth. Net profit rose 12% to over 6,300 crore rupees amid, AMD. This was actually supported by improved asset quality. Now, net interest income also soared above 40%, reflecting healthy margins. Bharat Electronics is gaining investor confidence due to its strong financial outlook and order pipeline. The company's FY26 margin guidance of 27% has surprised positively, while robust order book including 27,000 crore inflows and a potential 40,000 crore from Project Kusha ensures revenue visibility. Additionally, BEL plans to boost exports by 20% from next fiscal year, further strengthening its growth prospects. Acme Solar's Q4 revenue rises 65% to 487 crore rupees, driven by a 1,200 megawatt capacity addition. EBITDA jumps 116% to 436 crore rupees with an 89.5% margin. But the net profit drops 76.8% to 123 crore rupees due to a high base effect and lower other income. Now, the company records an exceptional gain from asset sales. JK Tyre's Q4 of net profit falls 42.7% to 97 crore rupees, with revenue up 1.6% to 3,759 crore rupees. EBITDA drops 24.5% and margins shrink to 9.7%, hit by high commodity cost, with material costs rising to 64.4% from 59.03%. Natural rubber prices drive up raw material costs. Gabriel India's Q4 shines with robust top-line growth. Revenue rises 17% while EBITDA surges 35.6%. Margins expand to 10% and net profit jumps to 31.2%, reflecting strong operational performance across the board, and that also makes it the stock of the day. Astra Microwave grabs attention with a 174 crore rupees fundraise via 20.14 lakh warrants at 864 per share with an 18-month tenure. Now, Gopi Kishan Damani invests 49.99 crore while Radha Kishan Damani, who was, who last held over 1% in March 2023, re-enters. Max Healthcare's Q4 earnings showed strong growth with a 29% year-on-year increase in revenue to over 2,400 crore rupees, driven by a 30% rise in occupied bed days. Now, the share of revenue from new units jumped to 15% from 2%. Bed occupancy remains steady at 75%. GSFC's Q4 revenue declined by a 2.2% to 1,922 crore rupees compared to last year. Margins also improved to 4.2% from 1.3%, driven by a 26.2% drop in fuel expenses. EBITDA rose to 80 crore rupees from 26 crore rupees and net profit soared 190% to 71.7 crore rupees. Employee benefit expenses fell by 15.7%, boosting the efficiency. Fortis Healthcare's Q4 revenue rises 12.4% to 2,007 crore rupees, slightly below the 2,020 crore rupees estimate. EBITDA grows 14.3% to 435 crore rupees, beating the 424 crore forecast, with margins improving to 21.7% from 21.3%. Net profit also increases 2.9% to 184 crore rupees, missing the 218 crore estimate impacted by the exceptional items and higher interest costs. Now, PBT before exceptional items rises 8.4%. The company plans to add 2,000 beds from FY26 to FY29 with 4,024 operational beds in FY24. Lakshmi Organics Q4 revenue dropped by 10.4% to 710 crore rupees and EBITDA fell by over 34% to 58.9 crore rupees. Margins shrunk to 8.3% from 11.4% impacted by one-time expenses and a high base effect. Net profit also declined 51% to 21.7 crore rupees dragged by higher interest expenses. Quarter 4 is seen to be a challenging quarter for IndusInd Bank. Net interest income is expected to decline 6% year-on-year to 5,030 crore rupees and operating profit is projected to fall 15% to 3,470 crore rupees. Provisions are anticipated to rise significantly to 3,371 crore rupees, leading to an expected net loss of 318 crore rupees, driven by a 1,600 crore hit to profit after tax from understated derivative losses. ITC is set for a mixed quarter 4, with revenue rising 3.5% to 16,900 crore rupees, but EBITDA and profit dipping due to margin pressure. Cigarette volumes may grow, FMCG could see price-led gains, and the agri-business is expected to post double-digit growth. Margins may shrink to 29.1% amid commodity inflation. Key areas to watch include acquisitions, price hikes, and demerger progress. Interglobe Aviation may see revenue rise 23% to 21,887 crore rupees in quarter 4 of FY25, driven by strong air traffic, better fares and lower crude prices. The Mahakumbh could actually boost demand, while a stronger rupee may limit forex losses. Lower fuel cost might offset rising airport charges and lease expenses. Let's now take you through how the top brokerages view India. First up is Goldman Sachs. It projects India to be among the world's 5 largest economies by 2050. It expects India to rank in the top 3 by 2075. The firm predicts India will surpass the US economy within the next 50 years. Now, this outlook highlights India's strong growth potential over the coming decades. JP Morgan projects India to lead this global universe with a 6.5% GDP growth in 2025. Now, this is largely driven by its trade-insulated cyclically, while positioned economy acting as a safe haven amid escalating global trade tensions. Economic momentum is gaining, supported by the Reserve Bank of India's shift to an accommodative stance with 2 consecutive rate cuts and liquidity infusion measures. Goldman Sachs view India as a defensive market. The brokerage has set Sensex target of 89,000 by June 2026 with an 8% upside. The brokerage believes that despite low beta suggesting underperformance in a global bull market, the recent drag down from the September highs presents a buying opportunity for India's long-term growth story. Nomura forecasts India's GDP growth to rise in quarter 1 of FY26, projecting a 6.2% growth. Recovering rural demand, easing inflation, and normal monsoons will most likely boost the country's GDP. Despite leading economic indices signaling caution, Nomura expects the Reserve Bank of India to implement 100 basis points in rate cuts by end of 2025. The RBI's internal committee is set to meet on Thursday to finalize the economic capital framework and also decide surplus transfer to the government, expected between 2.5 to 3.5 lakh crore rupees for FY25. The committee will also review the framework before Friday's board meeting. While one faction sees no need for changes, others cite ongoing geopolitical tensions and trade disruptions as a matter of concern. Time for an NDTV Profit exclusive. Sources tell us that SEBI plans new guidelines to accredit ESG rating providers, aiming to boost compliance with environmental, social, and governance disclosure norms. Now, this follows violations by companies like Gensol. The National Accreditation Board for Certification Bodies is likely to handle accreditation tightening oversight in the ESG space. An Indian delegation is expected to arrive in Brussels later on Wednesday as India and the European Union look to expedite talks and close the first tranche of the India-EU free trade agreement by the end of this year. Now the Indian team, led by Special Secretary and Chief Negotiator L. Satya Srinivas, is visiting Brussels almost directly after the 11th round of talks were completed in New Delhi between May 12 to 16. Larsen & Toubro has approached the Supreme Court to challenge the Bombay High Court's refusal to stay the opening of financial bids for the 6,000 crore rupees Mumbai Tunnel and Elevated Road project. Now, the project is managed by the Mumbai Metropolitan Region Development Authority. India's airline passenger growth in April was the slowest in 2025 so far as bad weather disrupted operations. Passengers carried by domestic airlines in April stood at 1.43 crore, marking a growth of 8.45% over last year. During January to April 2025, over 5.75 crore passengers were ferried, registering an annual growth of 9.87%. Bad weather was a significant factor in flight disruptions during April, accounting for 38.8% of all cancellations. At Build 2025, Microsoft unveils a sweeping AI strategy centered on autonomous agents. Now, these enhanced AI bots operate across apps via the open agentic web. Now, key innovations include an advanced GitHub Copilot, tuning secure IDs through Entra and compliance features integrated with Microsoft Purview. India logs 257 active COVID cases. Kerala and Maharashtra lead the tally. Maharashtra records an uptick in active cases with a spike from 12 to 56 in 1 week, but Indian authorities say that no cause of alarm. Severe weather led to 38.8% of flight cancellations, impacting 20,840 passengers last month. Airlines paid 41.69 lakh in compensation, marking a 117% increase month on month. Now, delays also surged, affecting 96,350 travelers, with 70% caused by reactionary delays. Late arrivals from previous flights with disruptions mounting, passengers may continue facing travel uncertainties. The Supreme Court has granted interim bail to Ashoka University Professor Ali Khan Mahmoodabad, who was arrested on May 18 over his social media post on Operation Sindoor. However, the court refused to stay the investigation into the matter. Security forces have reportedly killed 27 Maoists in ongoing 50-hour encounter along the Narayanpur-Bijapur border in Chhattisgarh. Among those slain in Nambala, Keshav Rao alias Basav Raju, the General Secretary of CPI Maoist, who carried a 1.5 crore rupee bounty. The Supreme Court has junked a plea to file a police case against Justice Yashwant Verma, the ex-Delhi High Court judge from whose home burnt bundles of cash were allegedly found in March when a blaze at an outhouse on the grounds of his bungalow was being extinguished. In yet another flashpoint in language tussle between the centre and Tamil Nadu, the MK Stalin government has approached the Supreme Court, accusing the centre of blocking funds worth 2,151 crore rupees because the southern state did not implement the national education policy. The DMK government has opposed the national education policy, which recommends a 3-language formula under which students learn a third language besides English and a regional language. Delhi recorded the highest minimum temperature of the season so far at 30.2 degrees Celsius, 3.5 degrees above normal. The India Met Department forecasted thunderstorms with rain. The air quality was recorded in the poor category. Around 280 Bangladeshi migrant workers are demanding hundreds of thousands of dollars in back wages. Their employer, Kawaguchi Manufacturing, has shut down, which has left the workers stranded. A Hawaiian Airlines flight bound for Honolulu was evacuated after reports of a possible bomb threat. The Airbus A330 had just pushed back from the gate when the flight attendant alerted the captain to a passenger's concerning statement. Agriculture Minister resigned on Wednesday after facing backlash for saying that he never had to buy rice because supporters give him plenty. The comment made amid rising rice prices drew criticism from both lawmakers and the public. Eto admitted that remark was extremely inappropriate after stepping down. Trump unveils $175 billion Golden Dome missile defense system. President Donald Trump announced a $175 billion missile defense system called the Golden Dome. According to Trump, the system will be capable of intercepting missile threats from anywhere in the world, even from the space. He called it crucial for the country's security and survival. World #1 chess player Magnus Carlsen was held to a draw in a vote-based match on chess.com, where 1.43 lakh participants collectively played against him. Now, the freestyle game, which started on April 4, concluded on Monday with a perpetual check on Carlsen's king. Overall, I'd say the world played very solid chess, Carlsen told chess.com a few days ago. Grammy-winning composer and singer Shankar Mahadevan has contributed to the development of Google's Music AI Sandbox, a tool designated for music professionals to explore generative music through the Lyria model. Now, Google also showcased a track Mahadevan created using the Sandbox platform. And with that, it's a wrap on this edition of Market Express, viewers. Up next, my colleague Sanjana takes over with Profit 360, bringing you sharp insights on markets, national and international news. So stay tuned with us here on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
The Nifty and Sensex stage a smart rebound on course to snap a three-day losing streak as auto, IT and pharma stocks led the recovery. Broader markets also ended higher, though they underperformed the frontline indices in the second half of the session. IndusInd Bank, which is currently entangled in an accounting irregularities case, is all set to announce its earnings for the fourth quarter. The Reserve Bank of India's internal review on its economic capital framework has revealed divided opinions on its future direction. Sources say the internal committee are currently of two views when it comes to the framework which determines the quantum of RBI's surplus transfer to the government. India's negotiating team, led by Special Secretary L. Satya Srinivas, arrives in Brussels for the next phase of discussions on the India-EU Free Trade Agreement. In a major move aimed at regulating app-based taxi services like Ola and Uber, the Maharashtra government says drivers who cancel a trip after accepting it on the app will face a penalty of 10%, while passengers who cancel without a valid reason will be charged 5%, which will be credited to the driver. The Met Department issues an orange alert for Karnataka and a red alert for multiple regions, including coasts of India. Warning of heavy to extremely heavy rainfall is issued over the next 2 days. More than 26 Naxals have been killed in an encounter with security forces along the Narayanpur-Bijapur border in Chhattisgarh. Good evening, you're watching Profit 360 on NDTV Profit and I'm Sanjana. Along the next half an hour, we're going to bring you the latest on markets as well as national and international news. So let's take a look at how the markets fared today. Benchmark indices held their ground despite global uncertainties. The indices closed in the green with Sensex up by 410 points and Nifty up by 129 points. All sectors except for consumer durables ended in the green with Pharma and Realty leading the pack. Nifty and Sensex also saw a rebound from the 3-day slump. My colleague Harsh now joining in with a detailed market roundup of the day.
Well, a decent day of trade, frankly, after what's been a couple of tough days of trade. We saw a 100-point increase on the Nifty 50. We've closed above 24,800 today, which is the key positive. When you're looking at stocks within the Nifty, and if you look at the larger breadth, even within the Nifty 50 pack, it was skewed in favor of the advances, which is again a positive. BEL and defense again came to the rescue. BEL up another 5% in trade today. That was the one big mover. Outside of that, financials, auto, there was some support from those pockets of the market as well. The top loser was IndusInd Bank, whose numbers likely determine, and we'll have to wait and watch as to what the reaction to that will come in tomorrow in trade. So maybe eye out on that one as well. When you're looking at the overall market breadth, 1,400 advances to just about 800 declines. So that's how it played out, at least in trade today, and therefore indicates that the Nifty mid-cap and small-cap were not too far away from how the Nifty 50 played out. In fact, the Nifty mid-cap was up around 0.8% and the Nifty small-cap up around 0.4%. So that's how those two played out. In terms of certain sectors which did well, defense I did mention. In fact, the Nifty defense was up another 3.5% in trade today. So we saw good traction in the entire pocket of defense. But outside of that, all the sectors closed in the green. The realty was one of the big outperformers in trade, up nearly 2% as well. What didn't do well was just the consumer durables index, which was down a wee bit, but outside of that, we saw good traction across sectors. Last off, I want to cover some stocks which were in focus on the back of numbers. Tata Tele, for example, was up 20%. HLE Glasscoat, despite numbers coming 2 days ago, was again up 6%. So you saw some sharp moves on some of those, and a Trident also saw a good move in trade today. Immediately post the numbers. On the other hand, there were some which didn't do as well on the back of numbers. A Dixon Tech, despite a strong set, was down roughly 6% or thereabouts. Yeah, that's how it played out.
Thanks, Harsh, for that. And despite global trade tensions and economic uncertainties, Moody's has reaffirmed India's strong economic position, citing robust domestic growth and a vast internal market as key stabilizing factors. Now, the agency notes that India's limited reliance on exports and government-led initiatives, including private consumption boosts, manufacturing, expansion and infrastructure investments, all of this help shield the economy from external shocks. Let's listen in to Nikki Dang, SVP Moody's ratings on India's stance amid these uncertainties.
I think that's definitely an upside for India's growth, and especially for planting India's economy more into the global supply chain, right? So we saw early May, India and UK secured the free trade agreement. And the trade deal really suggests the trade liberalization is becoming a pillar to the broader policy response to the U.S. Tariff shocks in here. And this is in contrast to India's historical moves where more protectionist the trade policy is in place. And with the continued negotiation with EU and the US, latest news has Commerce Minister just finished the 4-day of a trip visit to the White House, and with a now 3-phase timeline, with an initial pact signed with the US expected before July, and the comprehensive agreement concluded by the next year. So this is all going in favor of plugging India more so in the global supply chain. And this is a kind of in conjunction with government's manufacturing push, which has stalled, in recent years, where you see manufacturing contribution to GDP kind of is half of where the government would like to see, like 25%, but we're staying at 13%. At the same time, employment for industrial employment only accounts for a quarter of the total employment compared to a high 40% for agriculture. So I think this is definitely in India's favor.
Absolutely in India's favor. And on to an NDTV Profit exclusive now. The Reserve Bank of India's internal committee is expected to finalize the surplus transfer amount to the government on Thursday. Reports, however, suggest that the RBI may announce a record dividend, with estimates ranging from 2.5 lakh crore rupees to 4 lakh crore following its 100 billion liquidity infusion since December. What could this mean for policy and market liquidity? Vishwanath Nair now joins us with exclusive insights.
What we understand from our sources at this point in time is that there's an internal review that has been going on at the Reserve Bank of India about the economic capital framework. Remember that this is the framework that determines what is the level of provisioning that the RBI has to do and thereby determine what exactly is the surplus that it will transfer to the government. Since 2019, the contingency risk buffer, or that provision that the RBI does, is set between 5.5% to 6.5% of the size of the balance sheet. In FY24, the RBI went with a 6.5%, it's the upper end of that provisional requirement. They have maintained that. Now, the internal committee is actually divided on what exactly the future course should be. One part of the committee believes that the framework has stood the test of time, so don't need to make any amendments at all. While the other believes that there are now global concerns that are emerging. One is geopolitical tensions in different parts of the world. And second, there are trade disruptions that are happening because of the US's stance on global trade at this point in time. And therefore, the Reserve Bank of India might want to actually go out and raise that contingency risk buffer in the way that is there at this point in time. So we need to see what exactly goes on at this meeting and what the RBI finally goes ahead with. The government needs to approve this before anything actually happens.
Absolutely, the RBI awaiting the government nod. Moving on, sources indicate that the SEBI is considering new guidelines for approving ESG rating providers, aiming to enhance transparency and accountability in the sector. Now, this move comes in the wake of the Gensol engineering scandal, which raised concerns about financial irregularities and governance lapses in companies championing sustainability. SEBI's Master Circular for ESG rating providers, issued in May 2024, already outlines compliance measures for rating agencies.
The market regulator, Securities and Exchange Board of India, is set to bring out guidelines governing the assessment providers of the ESG disclosures. Now, companies have to, sort of disclose their ESG related information to the public as well. And the regulator had brought out some sort of assurance criteria to, look into this information that has been disclosed to the public. After that, another provision to bring in the option of assessment was also brought in. Now, the assessment involves a third party to be involved in the disclosure making process of a listed entity, which is slightly stricter than assurances, and that is why the regulator is thinking about bringing guidelines governing who could these assessment providers be. It also involves the process of their accreditation, which could likely be handled by the NBAC, which is the national forum to give some accreditations to these sort of formalized officials or people who will be looking into these things. Now, we must also understand, just for an example, that this is like, for example, the criterias for an auditors of a company. Similarly, some criterias will be laid out for the accreditors of this disclosed ESG related information.
Thanks, Charu, for that. And India's largest third-party tank storage operator, Aegis Vopak Terminals, is preparing for its IPO, setting a price band of 223 to 235 per share. The fresh equity issue, initially planned at 3,500 crore, has been revised now to 2,800 crore. The funds raised will be used for debt repayment and capital investments, including the acquisition of cryogenic LPG terminal in Mangalore. The IPO will be open for subscription from 26th to 28th of May, with the listing expected on June the 2nd. Murad Molidina, non-executive director at Aegis Vopak Terminals, shares insights on the company's post-listing roadmap.
To begin with, sir, give us a sense of Aegis Vopak. It's a subsidiary of Aegis Logistics, which is already listed in the markets. Give us a sense of how big is it and the business verticals that it caters to.
Yes, thank you for having us, and very great that we are able to come online and speak about the IPO and our company. Aegis Vopak Terminals Limited, like you said, is a joint venture between two independent listed companies. One is Aegis Logistics Limited, a 1978 listed company formed in 1956, a pioneer in tank terminal storage business since long, and also a market leader. And Royal Vopak, of course, its joint venture partner in Aegis Vopak Terminal Limited, is a global leader in terminaling business, doing the same business last 400 years and present in 23 countries, a AAA ESG MSCI rated company. So this joint venture was started to do terminaling business in India, and it started its journey in May 2022. Why we chose a separate vehicle was because in the parent we were also doing business other than terminaling, which was basically distribution and sourcing in LPG. So therefore this vehicle was needed because Vopak and Aegis decided to do only terminaling business in this SPV. So like I said, this journey started in May 2022 with a 0.5 million CBM liquid storage space and 5.6 million tons of LPG throughput capacity in May 22, and currently we are already triple in liquid, 1.7 million CBM storage space, and in LPG in H1 of the current year we would triple to a 15.6 million tons of LPG throughput capacity. We are currently operating 22 working sites. We have developed 225 acres of port lease land. In this JV, we are present in 6 ports. So basically, we handle liquid and LPG in storage tanks for our client at a fee. The infrastructure is simply a jetty pipeline which unloads the product. In the middle there is storage tank, and then you evacuate the product for the clients, either by filling it in road tankers or filling up rail wagons or hooking into a pipeline grid which the customers want the product to be delivered.
And a quick update coming in now. IRIDA has filed an application for a default amount of 510 CR and 219 CR against Gensol Engineering. They have filed the application in the Debt Recovery Tribunal against Gensol Engineering. This is the information that we're getting in right now. Now, this is not to be confused, and this is not to be confused with IRIDA's already existing insolvency filing under the NCLT and its Debt Recovery Tribunal application against Gensol Engineering, but this is essentially something different. With IRIDA has already initiated insolvency proceedings against Gensol Engineering over a 510 crore default, filing an application under the Insolvency and Bankruptcy Code before the National Company Law Tribunal. But what we're talking about right now is the Debt Recovery Tribunal. This filing is separate from insolvency proceedings. While NCLT handles the corporate insolvency resolution, DRT will allow direct enforcement of secured assets without the benefits of the NCLT. Now, let's remember, this is as multiple investigations, insolvency proceedings and leadership exits, Gensol facing some really uncertain prospects with the company's ability to navigate regulatory scrutiny and financial recovery will determine its future stability. Let me quickly bring in my colleague Agni now, who's joining me on the phone line, who's been tracking the story. Agni, can you explain the difference between IRDA's insolvency filing under NCLT and this debt recovery tribunal application against Gensol Engineering? How do these processes impact the company's financial position and potential resolution?
Right, so a potential resolution is a long way along the line, because currently the lenders are just going through all the processes, figuring out which process to go ahead and resolve their impending amounts for. So as of now, we know that IRDA has gone ahead and filed an application in the Debt Recovery Tribunal against Gensol. Now the recovery amount that they have been claiming is for a default of 500 crore and another 220 crores separately. So it's a total of around 720 crore. So of all the steps that IRDA is taking, this is the latest development. So do stay tuned as we bring you more.
Right, Agni, thanks so much for that update. Now, trouble deepening for Gensol with this new application being filed by IRDA. Let's move on to some news coming in from Maharashtra now, where the aggregator cabs policy 2025 has been introduced that introduces strict penalties for ride cancellations, aiming to improve reliability for commuters. Now, drivers cancelling without a valid reason in the state will be fined 100 rupees or 10% of the fare, whichever is lower. Passengers cancelling without a valid reason will be fined 50 rupees or 5% of the fare. There will also be mandatory GPS tracking, emergency contacts and driver background checks to enhance safety. My colleague Tushar now joining us with more insights. Tushar, over to you.
The Maharashtra government has implemented a new policy for cab-based aggregators, which actually accounts for cancellation of rides. Now, if a driver cancels a ride, the driver actually has to pay 10% of the fare, or rupees 100, whichever is higher. If a passenger cancels a particular ride, then in that case, the passenger has to pay 5% of the fare, or 50 rupees, whichever is higher. This has been taken into consideration given the amount of cancellations that happen in the cities of, especially in the cities of like Mumbai or Pune during peak hour traffics in the morning as well as evening. This is aimed at reducing the troubles that both passengers as well as drivers face at these particular points of time. Apart from this, the new cab policy also looks at women's safety, introducing a new policy for female drivers as well as carpooling. Remember, Uber has something like Uber Share. That may also become more prevalent going ahead. It also makes features like GPS, emergency contacts, insurance and driver training as mandatory for all drivers possible. We have to remember this that this cab policy is in addition to the bike taxis that the state government plans to introduce in the near future.
Thanks, Tushar, for that update. It remains to be seen how the rollout in the state actually makes a difference to both the passengers and the drivers. Moving on, the Employees Provident Fund Organization, also known as the EPFO, has rolled out major changes aimed at enhancing digital access, reducing paperwork and improving transparency for its 7 crore subscribers. Let's take a look for more details on this.
There's quite a few options that have emerged, changes that have taken place starting 2025. The first of which has to do with fast PF transfers when you're changing jobs. From the 15th of January this year, the EPFO, which is the organization, has simplified the process of transferring your PF balances. This has been, of course, a long-standing concern for a lot of contributors to the EPF. Transfers are now handled through a digital joint declaration system, which makes the process faster. So this is a positive update. The second positive update is that if you've updated your unique identification number, or rather universal account number, UAN, with your Aadhaar, you can now edit the information on the portal very simply. In most cases, things like your name, your date of birth,
your gender, your marital status, as well as your nationality and your parents' names. All of that can be adjusted by you fairly simply. Of course, if your UAN was generated before the 1st of October 2017, it might require a sign-off from an employer. So bear that in mind. Finally, a very quick update. As of the 1st of Jan 2025, the pension disbursements are now handled through a centralized system. Essentially, what this means is that it makes it easier for those that are receiving pensions to have their digital life certificates submitted. This is another measure that is aimed at improving the experience of people that have contributed to the EPF and are now getting pensions.
And a quick update coming in. We have budget airline Interglobe Aviation Limited, also known as Indigo, that has released its financial results for the January-March quarter today. Now, these results of the fourth quarter are providing a complete picture of its performance for the financial year. We're seeing net profit at 3,067 crore versus our estimate of 2,575 crore. These are the earnings that's coming in. Interglobe Aviation's net profit has grown by 62%. This airline is also, as we had predicted, expected to report robust revenue growth, and we're seeing that right now with a 62% growth, with revenue up by 24.3%. Let's remember that the airline will also be holding a key board meeting to discuss and approve the results. And this is as the results now have been made public, and later there will be a conference call for analysts and investors. We'll bring you all of the details on that, in which FY25 and the FY26 outlook will also be discussed. Now, just a little bit about Interglobe Aviation. They had actually informed the stock exchange that a board meeting will be held today to consider and approve these audited financial results. And this is what we're seeing at the moment, with Indigo actually coming out strong, beating estimates on all fronts. And a look at the weather right now. The Indian Met Department has issued an orange warning for Karnataka and a red alert for multiple regions within the state, including North Interior, South Interior and coastal Karnataka, forecasting heavy to extremely heavy rainfall over the next 2 days. Goa, Madhya Pradesh, Maharashtra and the Konkan region are also likely to witness very heavy to extremely heavy rainfall between May 20th and 22nd, while Mumbai is expected to receive moderate to heavy showers from today. The IMD's alert comes even as Bengaluru struggled with the aftermath of a downpour that flooded homes, submerged vehicles and left parts of the city in disarray. And moving on now, top Maoist leader Basava Raju was among at least 27 members of the banned Communist Party of India, Maoist, killed in a fierce encounter with security forces in Abujamad region of Chhattisgarh's Narayanpur district. Security forces remain engaged in an intense operation, recovering multiple weapons and Naxal bodies as they push forward. Acting on intelligence inputs, DRG teams from several districts were deployed to take on senior Maoist cadre. NDTV's Anurag Dwari joins us now with the latest updates.
Security forces have achieved a huge success in the bordering areas of Narayanpur, Bijapur and Dantewada near the Indravati reserve. So far, the bodies of 27 Naxals and huge weapons have been recovered from the encounter site. And based on intelligence inputs about the Central Committee and Politburo members, as well as the senior MAR division cadres and PLGA cadres, DRG teams from Narayanpur, Dantewada, Bijapur and Kondagaon were dispatched to Abujamad for the operation. And after reviewing all the facts and information for this crucial operation, when the DRG teams reached there, the Naxals opened fire and the firing continued for almost 50 hours. And once the search operation started, they have recovered the bodies of 27 Naxals, and despite the difficult geographical conditions and multiple challenges, the security forces have advanced to this decisive campaign against the Naxals there in Bastar, and one DRG team member was also martyred in this operation, and few other personnel also were injured, and they were airlifted, and right now they are out of danger. The search operation is still underway, but the massive success lies in the fact that the General Secretary Basav Raju has been killed in this encounter, carrying a bounty of more than 1 crore 36 lakhs. He was also from the central military operations of the Naxals, and was involved in all the major offensive against the security forces there in Bastar. And apart from Basav Raju, a native of Telangana, other Naxal leaders, including Madhu, was also killed in this operation. So a huge success for the security forces there in Bastar after Karegutta, this operation in the bordering areas of Narayanpur, Bijapur and Dantewada.
Now, India has logged 257 active COVID-19 cases, with Kerala at 95 cases and Maharashtra at 56 cases, reporting the highest numbers. Maharashtra has seen a sharp rise from 12 to 56 cases in just 1 week. Despite the uptick, health authorities maintain that the situation is under control, with most cases being mild and not requiring hospitalization. Officials continue to monitor trends, especially as COVID cases surge in parts of Asia, including Singapore and Hong Kong. The Supreme Court has granted interim bail to Ashoka University Professor Ali Khan Mahmoodabad, who was arrested on May 18th over his social media posts on Operation Sindoor. However, the court refused to stay the investigation into the matter. Additionally, the court has directed the Haryana DGP to constitute a special investigation team within 24 hours to examine the true meaning of the post. The SIT will be led by an IG rank officer with 2 SP rank officers, including 1 woman officer, ensuring an impartial probe. The Supreme Court has junked a plea to file a police case against Justice Yashwant Verma, the ex-Delhi High Court judge from whose home burnt bundles of cash were allegedly found in March when a blaze at an outhouse on the grounds of his bungalow was being extinguished. A bench of Justices Abhay S. Oka and Justice Ujjal Bhuyan pointed out a report that has been submitted to the Prime Minister and the President, and since the petitioner had filed no representation before those two, the court could not hear their plea. In yet another flashpoint in the language tussle between the centre and Tamil Nadu, the MK Stalin government has approached the Supreme Court, accusing the centre of blocking funds worth 2,151 crores because the southern state did not implement the national education policy. The DMK government has opposed the national education policy, which recommends a 3-language formula under which students learn a 3rd language basis English and a regional language. The Tamil Nadu government has alleged that the 3-language formula attempts to push Hindi in southern states and has batted for a 2-language policy. The centre has rejected these allegations and said that the 3-language formula aims to revive Indian languages. And that's all the time we had on this edition of Profit 360. Stay tuned to NDTV Profit for more news and updates.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day.
Hello and welcome. You're watching KYC. I'm Harsh Saita. Today we're going to focus in on Neogen Chemicals. This is what I want to know about the company, and there's plenty of moving parts, and we'll focus on each one of them. First one is with regard to the existing business. I want to know whether the Dahej facility comes back and comes on stream quickly. How quickly should the drag from the Dahej facility normalize, and how quickly should the top line recover with regard to the existing business? This is of course on the existing business. Now let's talk about FY26 and FY27 numbers therefore. How should the existing business numbers look from FY26 and 27? Because we've seen very low to no growth from FY23 all the way up to FY25. So it's been 3 years where on the existing business we haven't seen growth because of various reasons. How quickly should that normalize? How quickly should that unwind? Really, that's the other core piece I want to understand. Electrolytes business. Now this is a new business. What are the growth expectations here? What are the risks? What are the margins? Is this a commoditized business or not? Really, that's the other piece which I'm worried about. Is pricing eventually, when multiple players come in, is pricing power going to go away, or is it going to be held by the company? Because if you are valued at 94, 95 times, then you want to know whether you will continue to have pricing power over the top line that you are expecting to grow by. Let's also talk about the investment in this business. Around 1500 crore or so to be funded. Around 500 crore of that funding has already happened. Around another fresh 1000 crore to be invested. How will that investment be funded? Because your debt to equity is already quite steep. So are you going to take on more debt is really my question. And last off, can return ratios normalize? Because we've seen return ratios fall quite sharply. And it will require these couple of levers for it to normalize. But what's the confidence that return ratios can go back maybe as high as 20% as they were a few years back, or maybe 4 or 5 years back? That's really the question I want to answer. But that's how it all stacks up in what I want to know about Neogen. Let me also quickly look at what the company does. And Neogen Chemicals currently manufactures bromine and lithium-based organic compounds. This is what it currently manufactures. Specialized to a certain extent, not too many people can do this because it's very specialized, but Neogen in that sense is valued or given a higher multiple because of that specialization. So that's one. Second, compounds, where are they used? They're used in pharma, agri-chemicals, as well as engineering industries. So those are the 3 places where it's used. It manufactures advanced intermediates in pharma, agro, flavors and fragrances. It's the largest importer of lithium carbonate and lithium hydroxide for the last 3 decades. So it's built a bit of a niche with regard to some of these products. Let's talk business segments. The first segment that we'll talk about is organic chemicals, bromine compounds and advanced intermediates. Now, advanced intermediates are if I can describe it in the most layman terms, is between a key starting material and an API, closer to an API, and therefore an active pharmaceutical ingredient, which basically finds the cure to the disease that you're suffering from, whether it's a cough, whether it's a cold. The API is what finds the cure. Advanced intermediaries are also a compound or a component which allows you to build an API. So it's not a key starting material, but it's not an API either. That's how advanced intermediaries is. Bromine compounds, of course, are bromine based. Also into custom synthesis, contract manufacturing, when products are developed for specific customers. This is obviously the low-hanging fruit which everyone is now latching on to, and Neogen is no different. Let's talk about the inorganic chemicals. They are into specialty inorganic, lithium-based chemical products. So all of those, they are also into applications in the organic chemical space. What are the applications like? They are applied in pharma, agrochem, flavors, fragrances, I'm just repeating this, electronic chemicals and semiconductors. We can roll forward to the next slide. That kind of shows where all the applications is for some of the organic chemicals. These are the clientele of Neogen. So if you see the kind of clientele they have, very, very solid, right? In that sense, no concern whatsoever. Let's look at the revenue mix between organic and inorganic, currently sitting at 84% organic to just 16% inorganic. The geographical split, domestic is around 63%, exports is around 37%. This is 9-month FY25. And you're looking at the company exporting to over 29 countries, US, Europe, Japan, China, Korea, and the Middle East, among some of them, along with having all of those clients in India. So definitely the potential is quite large, but you want to see it live up to the potential. So let's look at some of the metrics that we look at in terms of financials. Now that we've got some bit of a grip on the business, let's look at all the factors that we look for with regard to a Neogen. First, we look at the income statement, we look at the balance sheet, we look at the cash flow, we look at return ratios. Thereafter, we look at shareholding, street cred. We'll also look at street coverage, and we look at valuation. So that's how we'll stack up our rating parameters. Let me quickly start with the income statement. When you're looking at the income statement, you're not seeing significant growth on the top line. There you go. No significant growth in the last 3 years on the top line, even though it's done well prior to that, but you're not seeing that significant growth kick in. EBITDA as well, your margins have gotten marginally better in FY25, but those will be impacted by raw material costs, and therefore they will be slightly or rather moving in that band between 16 and 20 is the sense. Look at the profitability also, it's come off from the slightly higher number that we saw in FY23. It's a very, very average looking income statement for the moment, but plenty of levers, the Dahej facility being the key. That's the reason why there's been a revenue drag in FY25 and a profit drag and an EBITDA drag. So you're seeing some of these numbers in that context. Also understand profitability is impacted because of higher debt. Your interest cost has gone up substantially due to the capex that they're doing, and therefore you likely see profitability remain subdued, maybe for another year or so before it starts to really pick up. So that's the other piece you want to look at. The second metric is the balance sheet. Now, when you're looking at equity and reserves, it's largely steady state, but when you look at the borrowing, it's gone up from 400 crore to 600 crore in just about a year. This is what I'm talking about. The borrowing number has gone up, which is leaving the company exposed to a certain extent to higher interest cost, but also servicing or repaying this borrowing at some point. You saw the EBITDA number being just above around 100 crore odd. The cash flow, in fact, was even lower in that sense, and therefore that's something you want to look out for. But overall, what you're seeing here is that the ability to repay is becoming more and more difficult, but you have an expansion in the top line, which is in the pipeline, and a strong expansion, which could well aid the numbers from FY26 and FY27 onwards, which could make this look far better. So we want to wait for that. At least that's what the street seems to be suggesting. Mind you, on the P&L again, top line is expected to expand 5x by FY29 as per average analyst estimates on Bloomberg. So you're expecting a 4 to 5x expansion in the top line. Just try and understand how much that would aid the overall set of numbers. Maybe not a 4 to 5x, I beg your pardon. It's probably 3 to 4x in terms of top line expansion. The bottom line was expanding, the EPS was expanding by nearly 5x, 4 to 5x. So you'll see that very strong expansion come through, which could aid that borrowing number on the balance sheet, which we'll have to wait and watch out for. Can that really happen? Now let's talk about cash flow. Cash flows have gone up in this quarter, in this year. It's because of some adjustments in working capital which have happened. But outside of that, the cash flow remains subdued. It remains in a difficult spot. And that is again because of the fact that there's no expansion coming through and there are higher interest costs which are coming through. We'll give this a neutral as well, and we'll wait and watch as to how cash flow evolves. Let's talk about the shareholding pattern at this point. 51% promoter held, definitely a positive, because a decent amount of skin in the game. There's a decent amount of FII and DII participation to the tune of nearly 30%. So your capital, your free float is just about, or rather public holding is just about 18 odd %. So we'll give it a thumbs up on this one. Let's look at street cred. Again, the last 1 year, the stock has done just 7%, but the last 6 months and the year-to-date period, it's done far better. We'll again give this a thumbs up as well. I want to look also at return ratios because that's the other key component. And it gives you a lens into how the investments made by the company are playing out. At the moment, we're not seeing that happen. You look at it from 25% in FY20, the return ratios have steadily come off. It's 6% is probably bottoming in FY25. The guess is that it will start to pick up starting FY26. So your return on equity, return on capital employed, this is the trend which is playing out. We're giving this a definitive thumbs down. You want to wait and watch whether and how quickly do those return ratios go towards 20. The Bloomberg estimates suggest that it will take all the way to FY28 or FY29 for it to hit 20% again. But it's going to be a slow uptrend starting FY26. That's the indication that analysts seem to be suggesting. And I keep coming back to analysts because we also have to take the analyst ratings. Let's take that before we look at valuations. In terms of how analysts are viewing this, there are 8 buy calls and just 1 hold call. The upside is 40% from here. And valuations don't look cheap though. It's a thumbs up because analysts are super positive, but you look at valuations, and when you're looking at valuations, it's trading at 95 times nearly price to earnings, and I'm talking about trailing 12 months. The forward-looking piece is very different. When you're looking at it from a forward-looking perspective, valuations, your profit after tax in FY29 is penciling in 300 crore of PAT. Now, for a 4,000 crore market cap company, that's 13 times. So very strong growth being penciled in. From that 95 times, can it come down to 13 times in the next 3, 4, 5 years is really the question that we will hopefully get an understanding from management from. The valuation picture, therefore, is a neutral because while it's 93 times currently, you could well see a sharp reversal in that number going forward. Let's not delay this further. Let's move straight to the management. We spoke to Dr. Hareen Kanani, who is the Managing Director at Neogen Chemicals earlier today about the company's growth prospects to start off with on the existing business. Let me cut straight across to that question which he answered.
So, this bromine derivatives business, or what we call the base business, has bromine derivatives, advanced intermediate, our CSM business, our recently acquired organolithium, and the non-battery lithium compounds together. So the capacity that we have is something which is for 1,000 crores. And our initial target also for this year was around 950 to 1,000 crore. We had a little bit of a setback because of a fire incident in one of the units in Dahej.
Correct.
So currently this year we are focused on a revenue potential, what we have guided 775 to 850 crores. So it will be about 10% kind of increase over last year's performance. However, the capacity is there, and it's largely because Dahej plant MPP3 is currently being rebuilt. As soon as that is rebuilt for the next year, our guidance for that would be a 1,100 crore plus kind of a revenue. So for this year, approximately around 800, 850 crore. And let's say next year, we are looking at somewhere around 1,000 to 1,100 crore. Of course, this is mainly because, as you can see, that in spite of soft international market, this base business already grew at a 13% kind of a rate last year. And had fire incident not been there, it would have been somewhere close to around 17-18% and a volume growth upwards of 20%. So the demand is really looking good. Unfortunately, we had a little bit setback on the capacity. But I think once the new plant is rebuilt, which we are taking a lot of additional cares, and it is again going to be, this was one of our state-of-the-art plants, and the one which is getting built is even better. So once that comes online, next year, we are looking for a very great further significant increase to meet several customer demands.
Point taken. So, sir, for clarity of viewers, 800 to 850 crore FY26 and then 1,000 to 1,100 crore FY27. So the base business itself will add 50% in terms of top line over the next couple of years. So I want to therefore talk about margins. What's working at this point? Are these high teen margins sustainable for the base business first?
So for the base business, we have always been like, ever since we acquired our plant in Baroda, which gave us some leverage, like both on the scale as well as in terms of being able to handle bulk bromine. And then subsequently, we got into more complicated CSM business or now organolithium. So we have sustained like 17% to 18% kind of margins, 18.5 plus or minus 1.5%. Sometimes it's a little bit lower or sometimes a little bit higher, partly due to lower raw material price, because our per ton margins more or less is kind of what we can achieve. But sometimes when the lithium price is too low, it goes as a percentage, it goes higher. Of the lithium price goes very high, it goes a little bit low. So again, that low range is also between 16 to 20%. If you look at almost last 8-9 years history. So I think we can sustain that. And once we reach the full utilization, as the organolithium and the CSM business contributes more and more to our business, going forward, the target would be move closer to 20% and beyond. Again, this is only possible through innovation. So we have a lot of innovative products and also technologies which we are developing. So long-term target would be to go there. But for now, this business has already sustained, 18% plus minus 1.5% kind of margins for last 7-8 years, and we look forward to being able to do that.
Point taken, sir. So roughly, if I were to just compute EBITDA, that would be roughly in the range of maybe 130 to 170 odd crore, 180 odd crore over maybe the next year or two. Is that a fair assessment?
Yes, I think this year itself was 130 crore plus. Correct. So I think, you would, as we get higher top line, you would see that. Of course, there will be some additional expenses in this year as we are rebuilding because of fire. So on a quarter, you might not get that. Although we have a loss on profit, but depending on how the accounting treatment takes care of that. So there might be some mismatch on a quarter-to-quarter basis kind of a thing. But let's say if we are talking of next year, when we are thinking of a full utilization of 1,000 crore plus kind of revenue potential, we would basically look at 170, 180 or slightly higher EBITDA coming in from Neogen's base business.
Point taken, sir. So I want to now focus on the electrolytes business because that's where all the interesting things are happening, right? So talk to us first off about what the capex is going to look like. What's the outlook like in terms of how much is this business going to contribute to top line over FY26 and FY27? So the same questions for the base business which I asked you, I'm asking you for the electrolytes business.
Yeah, so before I get into that, I would like to say it is Neogen's point of view that for us, the organolithium acquisition or getting opportunity to do something in semiconductor in last 2 years is equally exciting. So inside Neogen, we don't have a partiality only for battery business. Although yes, I agree with you that a lot of investment and efforts are being put there. So here we have planned over 2 years. We had planned around 1,500 crores of capex. This was divided in two parts. That some smaller capacity which can support 3 giga, 5 giga worth of electrolyte and salts, let's say up to around 12 to 15 gigawatt hour. So these capacities were coming in our existing Dahej site. So a part of the Dahej site which was converted to Neogen Ionics, the wholly owned subsidiary, and the major capex was coming into a greenfield site in our Pakhajan. Between two, we are investing around 1,500 crore, of which 550 crores is already already around 450 to 500 crore is already invested by us, and the rest will be invested in the current financial year. We already have a running electrolyte facility which can give 2 gigawatt hour plus. Already the salt facility also, electrolyte salt facility is also partly commissioned and partly in trial production and getting ramped up. So based on the capacities which are coming and the Pakhajan facility is likely to come online in Q4 of the current financial year. So based on these capacities which are coming online, we have given a revenue guidance of around 300 to 500 crores revenue on the electrolyte and electrolyte salt business in the current financial year. And for the next financial year, when we'll have the Pakhajan facility fully available, we don't have a number yet, but the estimate is it will be something more than 1,000 crore. But how much more is something which we've not given a formal guidance, but that is just the base expectation, because the total capacity on full utilization can give us 2,500 to 3,000 crores kind of revenue, and the full utilization is expected by FY28, FY29. So we expect that by FY27 we will be at least 1,000 crore plus, basically more than kind of 50% kind of utilization of the facility we are installing. But the exact number we have not yet given, so it's not a formal guidance, just kind of an estimate for next year.
Sure, so point taken, soft guidance.
Yeah,
sure.
And this is basically driven by two factors. One is the electrolyte demand and international salt. So international electrolyte demand in India to some extent depends on the battery capacity being set up. So we know around 6 to 7 gigafactories are announced, which are starting in 2025 or 26. So we are discussing with all of them, and little bit to some extent the demand will depend upon how these capacities come online and how their demand comes. On the salt side, we have international customers where we have a tie-up for majority of the salt which we are going to produce. There, of course, it's a very lengthy approval process. So it will be subject to, how the approval process plays out. So these are the two main factors which create the variability. And of course, lithium price is another thing which basically affects the top line. But basically the EBITDA would be driven by like ROCs, depending on investment. So on the full utilization, we are targeting like a 20% ROC. So it will be depending on.
Okay, so super detailed, and I have too many questions on this, but I'll break it up. I'll first talk about pricing here, sir. How much of pricing is in your control? How commoditized is this business in your opinion? Because it's a new business, not too many people doing it. Is it commoditized? And because there are too many players interested in it as well.
So, first of all, so we are basically, so on pricing, right? There are two aspects of the pricing. One aspect is basically the lithium and other input price. So if we think of like, electrolyte. So electrolyte doesn't have just lithium salt, but like, when you make lithium salt, along with lithium, you have fluorine, phosphorus, you have solvents, you have additives. So the electrolyte cost will will depend on all the inputs, as well as like, our manufacturing costs, and then of course the operating margins that we are targeting. So what we have seen, that in this business, as you grow scale, so as you go from 10 giga to 100 giga to maybe 500 giga, you cannot expect like same levels of per absolute margin. So what we've seen is, when the volumes grow, so when volume becomes high, your absolute EBITDA per ton will change. But your incremental capex will be required less, and you'll have so many synergies which is coming in. So we've done a similar business, of course, not to this scale, but we were making lithium bromide for absorption chiller. So it's also a chemical company selling to kind of an engineering company, which is a different industry. And here also, we have started by making few lakh sale in 1985, and now, selling tens of crores, and together like getting close to around 100 crore kind of. So we've also seen like 3-4 orders of magnitude there. And I think what basically has worked is that most customers appreciate very transparent pricing. They don't expect you to make money on inputs. Yes, but they want you to control your costs, control your investments. So that is going to be our role, as experts who are doing that. So that's why we have said this is a ROC driven business, that as incremental return on capital will get reduced and the amount of internal capital will get reduced, the return on capital will be lesser required, and therefore your EBITDA might change. So I think EBITDA might not remain constant as we go from, let's say right now we are planning 30 giga, but when we are at 30 giga, EBITDA might be slightly different, but the ROC should remain constant. So it's a 20% ROC driven business. And at least so far, whenever we have discussed with our international customers, where we are actually, the international customer has a choice to buy either from China or Japan from India. And they appreciate this point, and we've been able to kind of get this. So the contracts or the pricing arrangements that we have in place is completely passed through, and which basically ensures that Neogen can earn 20% ROC as long as we can basically control the manufacturing costs that we have. So I think we should not be looking too much on the top line exact number, or the EBITDA percentage also, because they will change and fluctuate in this business. What we have to be that on a fully utilized basis, are we able to get the return on capital?
Okay, so that was a very interesting interview with the management of Neogen Chemicals. Growth expected to play out in a very strong fashion on this one. On the new business itself, 300 crore to 500 crore this year, which will take the top line from 800 crore or 770 odd crore to almost 1300 crore. And thereafter, you will see a scale up on the base business as well by at least 300 to 400 crore. So keep your eye out on it. Let's track progress. But for the moment, that's all that we have with regard to Neogen Chemicals. Interesting but tricky at the same time. Completely out of time on this edition of the show. Stay tuned to NDTV Profit. More action on the other side. Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims?
Hi, we're talking about Your Money Matters on NDTV Profit, and my name is Alex Matthew. Let me lay out a few scenarios for you. One, you walk into a bank branch, not something that you do every day, but let's assume that you have. And the bank manager says, hey, you know what? I have a colleague in the investment wing that wants to have a conversation with you about this great product that we've got.
That guy comes to you and starts talking about an investment product that will give you a certain amount of money, say a few lakhs. You invest this much money and you'll get a few lakhs in 10-15 years time. Now it sounds very interesting, and then you find out that it's actually an insurance product. But wait, is it an investment product along with an insurance product, or it's an insurance product first along with an investment option that is tied to that? These are essentially traditional products that are sold to you. Another scenario, of course, is the cold calls that you get from banks saying, sir, you're a customer of our bank and we've got this great new product that we want to offer to you. You're getting an internal rate of return of 10+%. Even that sounds too good to be true, because that's an equity-like return, and when you ask, it's actually a traditional product that they're talking about. I've gotten calls like this, which is why I want to talk about this with Aditya Shah, who is the founder of Hercules Advisors. Aditya, thanks so much for taking the time. And I'm sure there are so many similar situations that people have found themselves in, and ultimately we're talking about traditional products. So let's define the term traditional products or money-back policies. How do they work?
So Alex, good afternoon to you. What we see in the markets are a couple of products. One is the investment plus insurance product, where the insurance companies say you pay us X amount of premium for the next 10 years, and after certain maturity, we will pay you X amount of money for 15 to 20 years. So that guaranteed return to some extent is something that people really want. They want guarantee of returns. Even when, for example, people are investing money in fixed deposit, it is a guaranteed product. So the guaranteed product is where the weakness of people really lies, and that's where people get swayed away. Let me give you an example. For the next 10 years, Alex, you pay me 1 lakh rupees of premium, and starting 2040, for the next 15 years, I will pay you about 60 to 70,000 rupees of guaranteed income. And that's where most people get swayed out. These are called whole life insurance policies or endowment policies. These provide very low insurance cover per se, but these provide guaranteed returns, and that's where people get swayed. If you look at the rate of return of these policies, the rate of return would be around 5 to 7% on a post-tax basis. A lot of these policies do get tax exemption, and that's where the real mis-selling happens and people get swayed towards this guaranteed thing.
But having said that, what you've described right now is an endowment policy which allows me a certain amount of income on a monthly basis, right, Aditya? On a monthly basis.
Yes. So what they will do is they will say that I will give you an yearly X amount, and that you can split out on a monthly basis, depending on your preference, an yearly income or a monthly income, whatever you like. But people are really fond of this monthly income or a yearly income, which is guaranteed, and that's where insurance companies are really playing with people's mind.
Okay, so this is endowment, but there's also a traditional policy or money back policy, as they call it, where people look at insurance as an investment rather than an expense. And this is, we'll talk about this in over the course of this conversation, but they want their money back. They want the amount that they're spending in the form of premium, they want it back. And so insurance products are geared towards that, and they say you'll get a certain corpus back at the end of the policy maturity. How do you define this, and how does it work?
What happens is, as I said, let's say over the next 10 years, Alex, you pay about 1 lakh rupees of premium. Then what happens is the company will keep that premium for the next 25 years. And when you start to get old, the company will start to give you your money back in terms of any monthly income or an yearly income per se. So that is what an endowment or a whole life policy really means. In a whole life policy, you have a life cover as well, but that life cover is really very low when you compare it to a term plan.
Okay.
So that gap, yeah.
So and just to clarify, there is no one-time payment. It's always an equated monthly payment or a yearly payment over a period of time, right?
So that depends. That depends on what kind of a policy you choose. Sometimes it is one-time payment. Sometimes it is yearly payment. So it really depends on what the policy is offering, what the insurer is offering, and what your agent wants you to buy. Here, the agent misleads the customers to buy such policies per se. But a whole host of products with starting from monthly income to yearly income to one-time income, all of those products are available in the market.
Okay, all right. So we've talked about what these whole life or traditional products or money back policies, all of them, we've got different words for it, but ultimately it's the same thing. And you pointed out one thing, which is that the insurance component of what you're paying as a premium is very small. Is this usually about 10 times of the annual premium that you get?
Yes, Alex. So here the insurance cover varies from about 5 to 10 times of the annual premium that you end up paying. So let's say, for example, you end up paying 1 lakh rupees of premium, then you get a life cover of about 1 CR only. Compare this to a term plan where for a 30-year-old, you easily on a 20 to 30,000 rupee, you get a 2 CR, 3 CR cover provided he is healthy. So the cover is really very different. A term plan, as we will decipher during the show, is a pure risk cover. A whole life policy or an endowment policy is not pure risk cover. It is insurance plus investment product. So obviously the company will provide you with a lower life insurance cover because it is also providing you the benefit of investment there.
Okay, so when you and of course you study these policies on an ongoing basis because you advise people on what insurance to buy and not to buy. Aditya, when you look at some of these endowment policies, what is normal in terms of the split of the premium? How much of it goes towards investment and how much of it goes towards that life cover?
So let me first tell you how these policies really work and how do insurance companies make money on this.
Yeah.
So what the insurance company will do is it will invest this money in the stock market. It will generate about 10 to 12% return and it will give you 5 to 6% return. So net, you are not better off than an FD return in these policies, the first point. The second point is how much life cover and how much money that the insurance company is spending on your life. 90%, 80 to 90% of it is towards the investment side of it. Only about 5 to 15% of it is in providing you life cover. Mind you, insurance company will play with the probability. What is the probability of a claim coming in under the life insurance part of this whole life policy per se. So as the insurance company's probability is really low, only 5 to 15% of it goes towards the premium for securing your life. Other is invested in the stock market or debt products where the sole aim is to generate about 10 to 12% return.
Okay, so then to drive home this point, if we were to split these two products, Aditya, then ultimately you are getting not a very good return on, say, suppose let's talk about a 1 lakh per year kind of a contribution to a product like this. And if you were to split and say that you're paying about 10,000 rupees for the pure life component of this, if you were to do this in a separate policy, a term policy, would the amount of cover that you get differ from what you're getting here?
Yes. So rather than asking the insurance company to take care of your investment plus life insurance, there's an easier way and far simpler way to do this. The far simpler way is you just say to the insurance company that only cover my risk, where the insurance company will cover your risk for the for 20 or 30,000 for a 30-year-old and give you a much higher cover. It will give you a 2 CR or 3 CR cover for a 30-year-old in 20 to 30,000, and the rest 70,000. If you invest in a mutual fund, let's say an index fund, if somebody does not know what mutual fund really is, just go ahead and invest in a Nifty 50 index fund. You will find that from 2003, the Nifty 50 index fund has given you a return of about 10 to 11%. And on a post-tax basis, that boils down to about 9 to 10%. So net, what we are saying, if you split this down into term plan, which is a pure risk cover, and a mutual fund, you are destined to have a higher return. The only thing missing there is no guarantee of return, but we have seen from anecdotal evidence as well as the future of India that 9 to 11% return on a index fund is really very possible. And mind you, how is the insurance company also guaranteeing you this return? Because it also sees that it can generate about 9 to 11% return.
Okay.
So net splitting this up into a term plan plus mutual fund makes much more sense.
Okay, so we'll come back to that. We'll circle back to that, because I also want to ask you about par and non-par. And now here's where, so I find that in the finance space, when we're talking about money-related products, there's a tendency to make things very complicated. And it becomes easier, I guess, to sell somebody a product if they don't entirely understand what they're buying. So when you're talking about participatory products and non-participatory products, there is also a product called the ULIP, which is the unit-linked insurance product, which allows an insurance company to invest on your behalf in the stock market, and it's supposed to give you equity-like returns along with an insurance angle or a cover, a life cover. Can you explain how ULIP works?
Yeah. So what is a ULIP? Let's first understand this. You give money to the insurance company, and according to the asset allocation you decide, the insurance company will invest in the stock market or it will invest in the debt market as per your directions, just as in mutual fund. So a mutual fund has its own set of regulations, which is regulated by SEBI. A ULIP has its own regulation, which is regulated by IRDAI. So what happens is the expense ratio that you end up paying to the insurance company is really very high. And because of the rules that ULIP has to follow, it cannot match the returns of a mutual fund per se. So net, what is a ULIP really doing? A ULIP is investing on your behalf in the stock market. It is also at the same time giving you a very nominal life cover. And on top of it, it can be a participating ULIP or a non-participating ULIP. What is a participating ULIP? A participating ULIP is when the ULIP invests in the stock market on your behalf, it is participating. The returns are not guaranteed there because the return will vary as per the stock market. A non-participating ULIP is where the ULIP is not investing in the market, and what it is saying is that I will guarantee some sort of a return which is not linked to the stock market per se. Generally, ULIPs come with a 5-year lock-in, and the taxability of ULIP, now that the government has really changed the taxability, above 2.5 lakh rupees of premium, it will be taxed according to what a mutual fund is really taxed per se. So that taxation benefit is really gone. The returns are not equivalent to what a mutual fund, a pure play simple mutual fund can get, and you end up paying a very high expense ratio, at the same time a very low life cover as well. So from my perspective, ULIPs no longer do make sense in the markets right now.
A lot of people went and bought ULIPs when the tax treatment on mutual funds changed and equity, long-term capital gains on equity came through. Because there was a bit of a loophole, there was a benefit that was provided to ULIPs, and the government has closed that. So, and they've done it with retrospective effect effectively. Yes. So any policies that were bought to take advantage of that, and these are longer term policies, everybody who's got in excess of 2.5 lakhs of premium is going to have to pay the piper, so to speak, right?
Correct. So the mutual fund industry was not very happy with the disproportionate treatment given to ULIPs. Mind you, who does pay a 2.5 lakh rupee of premium on a ULIP? People who are HNI and people who are not trying to pay tax on a mutual fund per se. So now, if your annual premium on a ULIP is higher than 2.5 lakhs, the government will then tax you according to what a mutual fund is really taxed. There will be long-term capital gains tax that will be involved. Mind you, a ULIP matures in 5 years. You can continue with a ULIP as long as you want, but long-term capital gains tax is the only tax that is applicable on that, and there's no tax arbitrage anymore on a ULIP as well. So net, it has shifted the game towards mutual funds now. Because of the drawbacks of ULIPs, mutual funds make much more sense than a ULIP does.
Okay, just to drive home that point, if we're looking at participatory ULIPs, which is equity related or equity linked, and we're looking at traditional policies, or as you pointed out, whole life policies, endowment policies, what is the return range that you can expect from these policies?
See, non-participating policies or a whole life policy or an endowment policy, the post-tax returns, because many of these have tax exemptions available, many LIC policies do have that, the returns will vary from about 5 to about 6-7%. A ULIP will vary with respect to the market. In the years that the market does really well, the returns on ULIPs could be really very high. Participating products depends on the markets per se. Generally, they tend to be very close to the index returns per se, but they will be obviously lower than active funds because of whole host of restrictions per se. But on a non-participating products or a guaranteed product that your life insurance agent is going to sell you, there the returns will be about 5 to 7%. And let's understand this. If the insurance company is making 12% on your investment, there's no way it is going to give you 10% because the insurance company also has some expenses to really bear. So the insurance company will give you close to 5 to 7%, where 3 to 4% is its expense as well as the profit that it will make out of the investment that you really make.
Okay, so assuming that these policies, in certain cases, people will go back and look at the policies that they're paying insurance premium on, and they realize that they're better off, as you've described, splitting those two functions, insurance and investment. Is there an option for them to pre-close or foreclose those policies, or is that too expensive to consider?
So there are two options that you can choose. One is to surrender this policy. What does this mean? It means that you just give away the policy, and whatever money that the insurer is providing, you take that. So what happens is, here the insurer pays you about 30 to 50% of the premiums that you have paid. Forget about any appreciation. Surrender is a very big loss to the customer because the customer ends up losing a lot of upside of the money that you have got. Surrender should be used only when you are in immediate need of money. Then let's come to option number 2. Option number 2 is paid up capital, making the policy paid up. So what does that really mean? That means that, let's say, suppose you have 10 premiums that you have to pay. After the 5th premium, you say that make the policy paid up. It means you are not going to pay any future premiums. Once you don't pay any future premiums, what is going to happen is, your maturity value that the insurer had defined, he will pay only 5 by 10 of the maturity value, which is about 50% of the maturity value, because you have not paid up the entire premium that you are supposed to pay. So proportionately, the insurer is going to pay you the maturity amount. Anybody who is in the process of paying the premium and does not want to pay the future premium must go for paid up policy. It will give you the future benefit in proportion to what the premium that you have really paid. Anybody who has paid up the premiums already must continue with the policy, because if you surrender the policy, the insurer is going to cut away a lot of your maturity per se. You don't have any option. Surrendering the policy is the last resort. I urge investors to not choose that. Making the policy paid up is a very good option, but if you have made the wrong option, then you don't have any option.
What qualifies you to go for the second option? As you pointed out, if I'm not mistaken, you have to complete a certain number of years, yes?
Yeah, so to make the policy paid up, you need to pay 3 premiums. 3 premiums out of any amount of premiums. So if there are 15 premiums, you need to pay 3 premiums. If you paid the 3 premiums, you qualify to make your policy paid up.
Okay. The last point, which is term insurance. Now, we've spoken about it on today's show, and we often speak about it. When it comes to insurance, this is what you need. You need a life cover. This is a pure life cover. Is there a checklist that you follow, Aditya, when you're going for a term life cover?
Yeah. So not everybody needs life insurance. The number one checklist that you need to do is 2 checklists. One, if you have somebody dependent on you, if you are a sole earner of the family, for example, if you are a husband and your wife and children depend on you, then to that extent you need a term plan. Point number 2, if you have a large liability per se, for example, if you've taken a home loan or any other type of a loan, which in case you expire and your family needs to service, then you require a term plan. right? That's the first checklist that you have to go through. The second checklist is buy it as young as possible. Unlike health insurance, term insurance premiums get locked in. So suppose if you buy a 2 CR cover at the age of 30, the premium comes to 22,000. That will remain 22,000 for the rest of your life. So if you buy as young as possible, it is much more beneficial. As a broad thumb rule, what is the sum insured that you should take? Nearly about 25 to 30 times of your income as your broad thumb rule. More advisor can decipher with respect to your income and expenses, but as a broad thumb rule, please buy 25 to 30 times of your income. Don't go for any add-ons. Just a waiver of premium in times of critical illness and a critical illness rider. These are the two riders you need to buy. You don't need to buy fancy riders such as return of premium or any other feature that provides return of premium. These are the 3-4 things that you need to provide. And lastly, you don't need a term plan up till 85 or 90. You require only until the time that you are earning, because basically what you are saying is the risk of me expiring and my income going away, I only want to cover that risk. You don't need to pay the term plan premium when you are retired. It will be a drag on your expenses when you retire. So buy a term plan up till 60, 65. See if dependents are there. Buy 25 to 30 times of your income per se, and don't go for return of premium concept that insurers have introduced.
Fantastic. Okay, that wraps up our conversation. Aditya, thanks as always for taking the time. Pleasure speaking with you.
Thank you. Thanks, Alex, for having me.
All right, so there you go. It's a very simple explanation as to how you should go about taking insurance. Sometimes you might not even need it. So first, that's the first question that you have to answer. Now, as we normally do on this program, we try to make concepts in the personal finance space and the mutual fund space easy for you to understand. And one of these concepts is, if you are going to invest in a mutual fund scheme, you will probably have seen two options. One is growth and one is IDCW. And IDCW essentially stands for income distribution come wealth capital withdrawal. Okay, so income distribution come capital withdrawal. Let's go through what these two means. The growth option, when you consider investing, essentially reinvests anything that emerges from the underlying. So for example, if you're investing in a mutual fund scheme that invests in State Bank of India, and State Bank of India gives a dividend in any given year, that dividend gets reinvested into whatever scheme the mutual fund fund manager is choosing to invest in. The IDCW, on the other hand, will distribute income to you on an ongoing basis. Now, do bear in mind that there is no guarantee that this will take place on the 1st of April or any other date that is predefined. It could be if a fund manager decides at the end of the year that there is a substantial amount of gain, they could decide to give you a dividend. Now, because it's not predictable, that is something that you have to bear in mind. You're not going to be able to judge your cash flows based on what you get from the IDCW option. And the second aspect is, for a lot of people, this is not going to be tax efficient. Now, understand this. When dividends are given to you from the IDCW option, it is going to be treated as dividend in your hands, and so it's going to be taxable in your hands, but it's going to be taxable at the slab rate. Irrespective of whether you invest in equity or fixed income, it's going to be taxed at slab rate. So take an example, you invest in an equity mutual fund scheme, you choose the IDCW option. Ordinarily, long-term capital gains tax would have come to 12.5%. In this case, if you get a dividend distribution through IDCW, it would be taxed at slab rate. If you're in the top tax bracket, you would be taxed at 30%. Now, it is beneficial to you if you get a dividend and you are within 12 lakhs and opting for the new tax regime, but that's not a lot of cases, and remember that it's not predictable. If you're looking for regular payouts or regular income from your mutual fund investments, a better option to consider and a more tax efficient option to consider is the systematic withdrawal plan. And if you're wondering what this is about, we'll talk about it tomorrow.
Now, there's one more quick update that I want to bring you, and that has to do with the Employee Provident Fund. And there's quite a few options that have emerged, changes that have taken place starting 2025. The first of which has to do with fast PF transfers when you're changing jobs. From the 15th of January this year, the EPFO, which is the organization, has simplified the process of transferring your PF balances. This has been, of course, a long-standing concern for a lot of contributors to the EPF. Transfers are now handled through a digital joint declaration system, which makes the process faster. So this is a positive update. The second positive update is that if you've updated your unique identification number, or rather universal account number, UAN, with your Aadhaar, you can now edit the information on the portal very simply. In most cases, things like your name, your date of birth, your gender, your marital status, as well as your nationality and your parents' names, all of that can be adjusted by you fairly simply. Of course, if your UAN was generated before the 1st of October 2017, it might require a sign-off from an employer, so bear that in mind. Finally, a very quick update. As of the 1st of Jan 2025, the pension disbursements are now handled through a centralized system. Essentially, what this means is that it makes it easier for those that are receiving pensions to have their digital life certificates submitted. This is another measure that is aimed at improving the experience of people that have contributed to the EPF and are now getting pensions. So all of these things have been done from the perspective of making life easier for you. Now, we've covered quite a few aspects on this particular program, but there's so much to talk about in the realm of personal finance. If you'd like to hear about a specific topic, about a mutual fund or about a mutual fund category or anything else in the realm of personal finance, write to us in the comment section and we'll pick it up. Thanks so much for watching. This is NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
For an exclusive conversation now. A strong vote of confidence for India has come in from Moody's as they've underlined the country's economic resilience, saying it's driven by robust domestic growth and a vast internal market despite global uncertainties and US trade tensions. India's low reliance on exports and a thriving service sector act as an effective buffer against external shocks, says this Moody report. It also highlights significant government investments in power, transport and digital infrastructure, poised to sustain GDP growth over the next 5 to 7 years. To talk on this, I'm joined now by Nikki Dang, SVP at Moody's Ratings, for this exclusive conversation. Nikki, thank you so much for speaking with us. Very good morning to you from where we're sitting. Take us through what the key view is coming in on India in relative terms.
Yeah, thank you for having me today. Yes, indeed, as I highlighted, the report highlights India's unique position among this global trade turmoil because of the few factors you mentioned. That is, smaller exposure to the U.S. Goods exports, and plus the strong domestic growth drivers, including large domestic market and very robust domestic assumptions and recovered domestic consumptions. And just to put things in perspective, India's goods exports to the U.S. only accounts for less than 3% of GDP. That really compares to the high single digits or even over 20% of some of the emerging peers India's got there. So it's much smaller exposure here. And another thing adjacent to export, that is, India has a growing share of service exports, and it's growing to almost half, accounts for half of the total exports of the country. And just keep in mind, service exports is not really subject to this current tariff play. And one last thing I want to mention is the large domestic market and domestic consumption. It's the nature of India's growth drivers, and this is further bolstered by the government supports fiscal policies such as the personal tax cut announced in the budget.
Nikki, so to put all of that into a number that everybody looks at, what is your assumption of economic growth for India in the context of concerns, worries about global growth, even though you have a few pockets of strength here and there?
Well, yes, indeed. After the observation of the turmoil coming through the market, after the so-called Liberation Day with high reciprocal tariff announced by the U.S. administration, in our early May release of our new forecast, we did cut across the G20 growth forecast collectively to 1.9% from 2.5%. For the emerging market in particular, it's down to 3.6% for this year from 4%. India, on the other hand, it did suffer a smaller cut. Our view now is for the calendar year 2025, our forecast is now down to 6.3%, and compared to our 6.7%, the number released in February of this year. And just keep that in mind, India remains the fastest growing economy among the G20. So there is definitely the downside play by what's going on in the rest of the world with the trade disruptions whatsoever, and also the balancing it off with the strong momentum domestic growth drivers is putting in, and together with favorable credit conditions domestically.
Nikki, I'm wondering, in terms of GDP outlook for India, one key factor which is yet to play out is whatever the bilateral trade agreement is between India and the United States. How do you see that impacting? One thing is for sure from all, from everything we're hearing so far, we're going to definitely end up at a lower rate than 27, where we are right now. Do you think that would be a clear enough indicator to boost GDP outlook for this year, or we're not really seeing any impact one way or the other of the current tariffs?
I think that's definitely an upside for India's growth, and especially for planting India's economy more into the global supply chain, right? So we saw early May, India and UK secured the free trade agreement, and the trade deal really suggests the trade liberalization is becoming a pillar to the broader policy response to the U.S. Tariff shocks in here. And this is in contrast to India's historical moves where more protectionist the trade policy is in place. And, with the continued negotiation with, EU and the US, latest news has, Commerce Minister just finished the 4-day of a trip visit to the White House, and with a now 3-phase timeline with an initial pact signed with the US expected before July, and the comprehensive agreement concluded by the next year. So this is all going in favor of plugging India more so in the global supply chain. And this is a kind of in conjunction with government's manufacturing push, which has stalled, in recent years, where you see manufacturing contribution to GDP kind of is half of where the government would like to see, like 25%, but we're staying at 13%. At the same time, employment for industrial employment only accounts for a quarter of the total employment compared to high 40% for agriculture. So I think this is definitely in India's favor.
Nikki, I do realize that you don't specifically comment on sovereign rating. So I'm not asking a pointed question. I'm asking directionally, right? So given what we've spoken about India, and also the fact that there is an element of fiscal prudence from the perspective of the government and the way that it has approached its budget, the way that it's spending, corporate balance sheets have improved. Directionally, do you think that all factors are moving in the right direction for a better rating for India?
Well, there are, I take everything you just said, positive momentums on economic strength, right, for India. But, in terms of again, this is not my subject, I'm not a subject matter expert for sovereign rating. But one thing we do focus on, in addition to the economic strength, is really the physical strength, right? So we did see physical consolidation gradually coming in for the government. But I mean, the pace has slowed down in the recent, I think, the fiscal year, as reflected in the budget. And I think in order to compare with the peers, right, similar rated peers within the global portfolio that we have for sovereigns, I think the physical metrics are not boding too well or positioning India too well for next rating level.
Okay, Nikki, thanks so much. And for answering that last question in particular, I think a lot of people here in India are looking at this very closely. But the outlook that you pointed out to will also bring a smile to a lot of faces today. Thanks so much.
N. Jaykumar, MTN Group CEO at Prime Securities, joins us as well to discuss what's in store from here on. Jaykumar, good morning and welcome to NDTV Profit. This is Hiral on this side. With the kind of uptick that you're seeing in terms of markets, and you had FIs which actually came out and had a big sell number in terms of yesterday's session, what is the feeler that you're getting from here on? Is it going to be a DII-driven market? And if the FIs are exiting and booking profits, what would this mean?
I think a one-day sale figure can hardly be classified as a trend. And I personally don't think that a single day sale figure is enough to conclude that the FIs are selling and booking profits. I think there have been sellers in the past, but over the last couple of weeks, I think there's been a decided shift with the dollar index coming off and the money moving out from the US markets. I definitely see an increasing trend of money coming through. There could be odd days when the FIs are sellers, much the same way the DIs could be sellers on a few days. But I think the trend that every dip will be bought into is something that I buy as of now.
I agree with that point, Tamanna here, and great to speak with you again. I'm just wondering if bond yields inching upwards is something which can be a bit of a pain point from an emerging markets perspective at all. And in terms of global turmoil and turbulence on the trade war front, do you think that ship has now sailed, or could this as a factor come back and bite us?
With Trump, nothing has ever sailed. I think these things have a habit of popping up, and especially when you have a social media-driven policy formation process, where everything is announced on Twitter and then we wait for clarifications later. Or for that matter, everything is done through executive orders with hardly any referral to Congress. I think it's a new world and it's a new way of doing things. But the way I see this is that at least as far as the trust factor in the US markets or the US government, more importantly, is concerned, that's certainly something that is a big overhang. I think people have started losing faith, and money flows have in a sense presaged that and preambled that. And the money coming out of the US markets, coming out of the bonds, equity markets are holding up despite the fact that there will be earnings downgrades as inflation catches up. We've not had a single full quarter with the tariffs in place. And the tariffs are inflationary at the very least. I mean, 30% China may be a sort of a cotton wool kind of deal. But the reality is that at 30%, it's still a lot of pain point and pressure on the average US consumer. I believe that the Indian trade deal will get done over the next few weeks. We aren't used to these knee-jerk kind of have a cup of coffee in Switzerland and do a deal kind of process, which China seems to have taken up more, I would say, almost as if needing a deal to be done. I think the US needed it probably even more. But now that China has been set, and I think there'll be a reasonably fair deal done, I believe, with India. Keeping that in mind, but also the backdrop being that Trump's whimsicalities are legendary now, we will have uncertainties going along the way. But the reality is that the US consumer is now going to be hit and slam dunk to the whole bunch of cost escalation, which is already happening. The likes of Walmart and Home Depot, etc., have already talked about it. My own sense is that that will be the pressure point that will make them relent. The downgrade in the US bond, the treasuries, is a matter of severe concern for them, as $36 to $37 trillion of debt is the outstanding, and interest rates are moving up. The long bond, the 30-year has gone or inching close to 5%. The 10-year has gone past 4.5% and kind of straddles that area. And these are levels that have not been seen, especially in what is seen as a recessionary and almost stagnation kind of environment domestically. So the US consumer is hurt. The US manufacturer has never made money. In fact, people have been moving out of the country to set up manufacturing facilities. So I'm not even sure what the current administration is in the US is smoking. I mean, these are completely alien to conventional thinking, and certainly makes no sense whatsoever. But be that as it may, we are in this maverick-led world, if you will, and certainly as far as the US is concerned.
This is what I love. Jakes doesn't pull his punches. But the fact is that we have to live with the outcome of whatever the US administration is smoking, as you put it. And in that sense, if there is an economic hit to the United States, IT and the resurgence we saw in IT then goes on the back burner. How do domestic investors who've kept the faith steady in Indian equity right now unpack all of these possibilities?
IT is an issue not necessarily because of US policies. I think it's a bigger issue because of AI. And that impact is playing out every quarter. Number two, the ability of the Indian IT sector to adapt to more products and more AI-driven solutions is probably the need of the hour. And that's easier said than done because these are all large service organizations. And most importantly, if you look at the domestic sector, India still being the oasis in terms of a growth in a desert of, in a global desert, if you will. My own assessment is that the Indian growth story continues. Liquidity has never been as plentiful as it is right now. The RBI and the other, should I say, regulatory authorities are doing what it takes to improve, ease of doing business. SEBI's come out with a lot of steps which I think will allow for greater access to foreign capital. But more importantly, RBI is very, very pro banks, and therefore banking and financial services will lead, to my mind, the next rally. But from an international sector perspective, I think the pharmaceutical sector, which is the lowest cost producer in the world, other than China, will be hugely in demand as the US consumer seeks out pockets of low cost production. Even today, Apple has made it very clear that notwithstanding what Trump may like or otherwise, they would like to continue production with India. And I think that goes, unabated. So if individual companies are taking steps which reduce their costs, India cannot be a point on the map which they ignore. We could argue whether they'd be as important as China was 10 years, 15 years ago, but you cannot argue for the fact that the Indian manufacturing setup is here to stay. We need to keep tweaking to make sure that things happen. But having said that, the world itself has moved on. The dollar index collapse, the yields going up, clearly indicates which way money is moving and which way international thinking is, geared towards.
Right. Jakes, one question I have when you mentioned about BFSI that will lead the rally. You have an IndusInd Bank that is going to report numbers today. And with everything that's happening across, the disclosures that they've made in terms of the discrepancies in the derivatives trading portfolio, the RBI coming in, and the latest that's come in where an additional accounting issue where the bank has found almost 674 odd crores worth incorrect interest income. And you have the earnings. How would you actually describe the entire episode? Do you think this is going to be a cleansing act from here on and a good investment opportunity, or do you think this is something one should be avoiding?
I would not like to talk individual stocks, but in general, just a one-liner which may be trite in some senses, which is banking at the end of the day is in a sense, a trust business. And any bank which faces this kind of a sort of barrage of events, clearly the trust factor starts weakening. So for me, it's an avoid, especially when the banking sector is replete with small and big players, all of whom are focused and doing the right stuff, especially with the tailwinds of liquidity, etc. The BFSI is a large space. We don't necessarily need to, hunt out gems from, in some sense, near-term fallen angels.
Okay. Now, the hunting out gems is the interesting bit. Are there gems in the market right now? Because the companies that are doing well, and we're seeing it from the corporate numbers, companies are doing well that have reported good numbers, and the question comes in of valuations. That balance is getting more and more difficult to strike. What are you making of the kind of numbers that we've seen so far?
I think markets will pay up for growth. And as I said, there are multiple companies that have reported very good numbers. And in 7,000 or 8,000 listed stocks, I'll be the first to say that there are more gems than you and I can count. The idea is that what will you pay for growth? And as growth becomes a huge challenge in most parts of the world, I think there are several small and mid-cap players who are giving the growth at, arguably not the cheapest of valuations, but then as companies become bigger, valuation multiples start becoming a part and parcel of what people have to pay up. But in the BFSI space specifically, I do believe there are a number of good candidates in the private sector space that I would be buying. But as I said, I don't want to talk specific stocks, but our interest in the space is very, very high.
That's all right. What about defense? What you're seeing, of course, there's the recency bias with defense, but there seems to be much more to it than just, okay, there was a conflict and then people brought into defense stocks. What we saw with Operation Sindoor was the coming of age of Indian or indigenous defense technology. Are you buying into that defense story right now?
I think, defense very quickly has sort of moved up and become, on the face of it, quite expensive at this point in time. But is there a play with defense being potentially an export theme, where a number of smaller countries come to us to actually source equipment? Because I think if this war taught us anything, it is that indigenously made armaments actually did extremely well and helped us big time. So I think from that point of view, is there a space, and is it a longer term story than just being used in some conflict, and therefore the proof of concept being tested out to our satisfaction? So taking away the fact that there is jingoism associated with some of this, but the reality is that most of these companies are priced to perfection as of today. Can this be a longer term story with a lower return than what they promised several years ago? Probably that's the way it's playing out. So wait for any sharp dip where these stocks come off 10-15%, and then that could be an entry point, because a lot of the returns have got front loaded in defense stocks.
Right. So, Jakes, with all of this said and done, BFSI that will lead the space. We've spoken about how pharma will do. Defense is what we've spoken about as well. From a market perspective, where are you looking at the new base from here on, taking into consideration the gyrations that we've already seen so far? What could be the new normal for Nifty 50?
Well, difficult to say new normal over what period of time, but let's say if we took the next 6 months. Clearly, the double testing of 21,000, 22,000 has become a very, very solid base. Even through the war and everything else, we did see those levels holding out. And then when the dust settled and money started coming in from, especially from, overseas markets in, and we saw the foreigners actually buying through this difficult period as well. To my mind, 23,000 to 23,500 perhaps will become some kind of a pretty solid base. And quite suddenly, we are now close to 25,000. But I would dare say that if you want a really solid, sustainable sort of thing, I think 21,900, 22,000 is that level. Intermediate wise, I think maybe 23.5 would be the level. So we probably will, we should look at buying into this market on any dips, but avoid the sort of blowout days, the days when Nifty goes up 1%, 1.5%. Those are probably not days to buy, because a reversion to mean, while it may not happen, but reversion to 2-day and 5-day-old levels could happen, because so many, as I said, policy statements are coming out through social media and in a sort of a whimsical kind of manner. And those will remain opportunities for us to grab, especially, for instance, things like pharmaceuticals. Whenever they put out policies which actually makes no sense whatsoever, they talk about price cuts and so on and so forth. And markets tend to react maybe irrationally at times, or market men react irrationally. So those opportunities can be taken. And I would say that, watch out for sharp dips to buy into. Markets may not be that forthcoming, but if you have to look at two things to figure out if the trend has changed, I think it's the US yield and the dollar index. The dollar index tested 98, came back to about 101.5, 102. Now it's gone below 900 again, it's probably close to 99.5 and may retest 98. The dollar yield, the index, the market moves are clearly linked to weakness in the dollar and positively correlated to a dollar weakness. And the bigger problem from a US perspective are yields. And I'm hoping that some solution, because any country that has 37 trillion in debt and the long bonds trading at 5%, give or take, is in deep trouble. But that also happens to be the country that can print notes and be the standard currency. And that paradox somewhere along the line is getting sort of unwound as money moves into gold, money moves into the Swiss franc, the euro, and safe haven like that.
No, okay, you talked about pharma. Jakes, and I'm interested in that, because I think that turnaround has been seen, that understanding has sort of come in, that perhaps investors were quick to jump the gun, thinking that one day Trump will say most favored nation policy for pharma, our prices will mirror the cheapest in the world, and then everything will sort of blow apart. Do you think that there is a distinction to be made here between companies which are selling largely generics, CDMOs, and how do you sort of navigate as an investor the pharma space?
I think the real problem from a Trump perspective, of the US consumer perspective, is the pricing of some of the patented drugs and the sort of unholy alliance that exists between the middlemen, 2 or 3 large groups distributing the bulk of pharma in the US, especially generics. So typically, if a generics lands in the US on US shores at $1, it gets retailed at $5, where the patented equivalent could be between $10 and $15. Now, because the patented equivalent is $10 to $15, it could be maybe $10 or $12 in Europe, but 12 to $15 in the US. The middlemen actually make a huge spread between that by marking up the $1 to $5. And I think if that system were to be eliminated, the demand for generics would dramatically move up. And more importantly, the patented folks would actually bring down their prices. So prices have to come down with competition, not with diktat. Prices have to come down with more, getting lowest cost producers a chance to get their products across to consumers in the cheapest possible way, not by talking down prices. And that the exponent of free markets, the US, needs to probably understand, and I think they do, but a certain few who make policies, I don't think quite get it, that they believe they can bluster their way through by actually talking prices down, which is not going to happen.
That's not going to happen, and I think that agreement is something that is absolutely crucial.
And the last point here, Will, the last point, if you will, is that the US actually needs more, not less generics. And Indian pharma is more generics than anywhere else in the world. And I think that is therein lies the rub, that you need Indian pharma, and yet you're sort of peeved about the fact that Indian tariffs have been high, and you're mixing issues here. So this needs to be sector specific. This can't be a one tariff fits all kind of strategy, which is attempted to be put in place right now.
Absolutely, and the doctor of medicines is what India is called for the US as well, taking into consideration the kind of generic exports that happen from here on. But thank you, Jake, so much for joining us on the show and sharing the views.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. what matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind?
Welcome, you're watching The Big Question. I'm Tamanna Inamdar. Did you know that the smartphone you're currently holding as you watch this show perhaps, whether it's the latest iPhone, Google Pixel or Samsung, there is a pretty high chance that it may have been made in India. That's right, made right here locally, as opposed to a situation a few years ago when phones were predominantly assembled in China or Vietnam. Why am I saying that? Well, because according to recent government data, 99.2% of all mobile phones which are sold in India today also happen to be made in India. That's a steep rise from 10 years ago when only 26% of phones which were being sold to us were manufactured locally. In fact, we're not just supporting local demand, we're also making for the world. Indian manufactured smartphones have now become the country's top exported item, surpassing traditional export staples like petroleum products and diamonds for the first time ever. In fact, smartphone exports have soared by 55% to $24.14 billion in 2024-25 when compared to the previous years. Big brands like Apple and Samsung are leading the charge, accounting for around 94% of India's smartphone exports, according to Counterpoint Research. Both are further ramping manufacturing in India, something which has gotten a further fillip with Donald Trump's recent tariff tsunami. In response to these tensions, Apple has said that the company will produce a majority of iPhones sold in the United States in India in the June quarter. Apple also wants to move 25% of all iPhone production to India in the next few years. In fact, Apple's shift has drawn the wrath of Mr. Trump, who said last week that he will ask Tim Cook to stop building plants in India. Despite that, Apple seems to continue its expansion plans, with its main manufacturing partner, Foxconn, investing $1.5 billion into its India unit. Similarly, Samsung too is evaluating a shift of some of its smartphone manufacturing from Vietnam to India owing to tariff-related trade disruptions, as is Google Pixel. So far, it has been an advantage thanks to China Plus One strategy, Trump tariff disruptions, and the government's PLI schemes. But uncertainty remains. With this deadline of the PLI scheme set to end in FY26, it remains to be seen whether the government will give an extension, and if they don't, will global players be willing to sustain the momentum in the absence of subsidies? Furthermore, the recent US-China deal, which saw Trump reducing tariffs on China by 115%, may also tip the scales back in China's favor and dash India's hopes of becoming the world's phone factory. India still relies heavily on China for raw materials and components used in phones, limiting Delhi's ability to fully capitalize on supply chain shifts. So this is why we're asking the big question today. Can India become the next global smartphone hub instead of China? And how do we make it happen? To speak on this, our first set of guests are Sunil Vachani, Executive Chairman at Dixon Technologies, and Pankaj Mohindru, Chairman, India Cellular and Electronics Association. I'm going to start the conversation with Mr. Vachani with the context that Dixon Technologies is, in a sense, the poster child of what success of the PLI scheme can look like. And a lot of what we see in terms of made in India and electronics is something that Dixon has been at the forefront of. With that said, Mr. Vachani, can we first start by contextualizing the sea change in manufacturing of these products in India?
Yeah, Tamanna, thank you for having me on the show. I think, you rightly said the context, and you very rightly pointed out that we have come a very, very long way as an industry, as a country. And I think if you recall the times, I'm talking about maybe about 20 years back, we were importing almost all the phones that were sold in the country. And to come to this stage, where now, as you rightly said, that mobile phone exports as a category is probably the top category for exports in the country. And almost in all the phones that are now sold in the country are made in India. So I think we have come a very, very long way as an industry, as a country. But I think the positive news is that this is just the beginning of the journey. So if you see our share of the overall electronics trade, the global trade, the total market, global market is roughly about $3 trillion. And we are roughly at just about 3% of this market. So this journey has just begun. And I think all of us have to strive together, come together, the industry associations, and make sure, that the vision the Honorable Prime Minister has set for us of $500 billion turnover in the next few years definitely comes true. And I, for one, am extremely positive that we are on the right track. I think these numbers are definitely achievable.
Yes.
We should be looking at an exports of mobile phones alone of roughly about $100 billion. I think few things need to come together, and I'll probably talk about it later in terms of a creation of a component ecosystem, creation of a design ecosystem, and now Indian manufacturers and Indian champions further investing in creating very large scale in building mega factories, and the whole focus now has to be looking at exports. I think we have kind of really addressed the domestic market, the issue of the import substitution, to ensure that anything that is consumed in India is made in India. And now is the time to look at global markets and be emerging as global champions and making sure that India emerges as the next hub for manufacturing for the world.
Surely, it's a big sea change. But Mr. Vachani, I just want to get your view very quickly on those who say that, are we really making in India or are we assembling in India? How much of what we're putting together is Indian components? Is that a fair question, or is that a fair point?
No, absolutely. It's a fair question. And I'm sure this question also might have been asked at the time, let's say, Maruti Suzuki was entering the automobile market, right? I'm sure people must have asked that, this is only assembly happening. Where is the component ecosystem? And I think fast forward to now, you see our auto component sector is exporting to the most competitive global markets, and they're world leaders, right? So I think what is important is that you need to give time to the industry. And I think if you were to talk about the mobile industry specifically, so right now value addition is roughly around, let's say, less than 20%. And we see our neighboring countries at about 45 to 50%, right? And I feel that now with the new PLI scheme having been launched, especially for components, and industry really putting in large capacities of display assembly, camera module assembly, mechanicals, we should be reaching this figure very, very quickly. And I think we as a country would have done this, the fastest as compared to anyone in the world. So I think the point that I'm trying to make is that give time to the industry. We are on the right track, and we will reach the desired levels of value addition that is required, and also create millions of jobs, right? Because I think the first focus for any country has to be to create very large scale. Because wherever you have scale, the component industry follows there. And we've seen that example happening in Vietnam and other neighboring countries.
Okay.
So I think it's very important first we focus on scale, which is happening now. And now the component industry is going to follow.
No, absolutely. We are at that nascent stage. And, Pankaj Mohindra, so great to have you on the show. You've been a champion of this space, and we've been speaking for several years. And there was a time when this seemed unimaginable, that you're largely you're largely solving for domestic consumption within the country itself. I'm going to start with the question that I just asked Mr. Vachani. Are we truly making in India right now?
You see this, the global smartphone ecosystem and the electronic ecosystem these are based on GVCs. So with a lot of specialization, for example, Taiwan is a very specialized semiconductor country. What we are achieving is a very big scale. We have crossed $60 billion now in smartphone assembly, and some of the sub-assemblies are also being produced here, like charger, battery pack, USB cable, mechanics. A large portion of mechanics is being done here. And also now, as Sunil said, display assembly, camera module, all of that is started happening here. So the scale has given us, it's lifted the industry up, and it is also giving motivation to the other verticals that this is possible. But now you see what has happened in the past, let's put it aside, because the Honorable Prime Minister has given a target of $500 billion. And this is a 400% increase over what we are doing now, in spite of the 450% growth which has happened in the last 7-8 years.
Right.
So we have no time to think of what has happened in the past. We are relentlessly going after this 500 billion, and 500 billion is only possible by firing on all cylinders, right? This is a big scale. Smartphones will be approximately, in the ecosystem, will touch about 200 billion out of it, 130, 140 billion of output, and the rest of the sub-assemblies, etc., that will come into play. So we are very busy because, you see, as that Tom Cruise song, "You've Taken My Breath Away." So we are in that state of mind now. We are, with total relentless passion going after 500 billion.
Wow.
So, this patting ourselves on the back by what we've achieved in the past is not going to help now. Let's
No, I agree with you. I mean, I don't have to be breathless while doing it. I like that. I like that reference. But coming down to the point of what those cylinders are, and Mr. Vachani, let me come to you on this. And this is something because we track your company's stock also closely. Though we're not talking about it today. The PLI scheme is the oxygen, right, of this entire success story. The PLI scheme is supposed to end in FY26. Now, suppose there's an extension or there's not an extension or whatever happens next. For how long do you think this ecosystem will have to have that boost? And is this ecosystem now at a stage where it doesn't need that boost, that subsidy from the government? Of course, initially you need it because otherwise how are you going to kickstart the whole process? But where are we right now?
Tamanna, it's not a subsidy, it's an investment.
It's a production-linked incentive scheme.
It is an investment from the government, from the taxpayers' money. It's public money which has been invested for the good of the country. It's not a subsidy.
I agree, sir. But, call it what you may. It is an incentive scheme. My question is now, you don't call it a subsidy, don't call it a subsidy. Some may not. The question remains the same. Are we at a stage where we can do without it, or how long will we need it, or does it need to continue? Your thoughts, Mr. Vachani.
Yeah, absolutely. So I think, when we are answering that question, I think it's very important to look at and go into the background that why was this scheme really launched, right? And I think if we go back to the time, you would remember that we hardly had any scale in the country. There were very few manufacturers in the country. There were no GVCs which were operating out of the country. Exports obviously was negligible or even zero. And what was really the objective? So the way the scheme was structured, and I think, ICA played a very, very crucial role in that. And I think the scheme was designed beautifully. And really the objective was to create very large scale in the country so that we can be globally competitive. And that's why if you read the document of the scheme, the whole scheme is based on the premise on incremental sales. That means there was a base year, which was financial year 1920. And whatever the companies achieved beyond that, you would get that incentives or whatever you want to call it, only beyond what you were doing from the base year, right? So the whole concept was to create very large scale. The idea was to generate large employment in this industry because it is very labor intensive in spite of all the automation. The idea was to build Indian champions and eventually make sure that India as a country is a world leader as far as this product is concerned. So now fast forward to now and let's see, has it checked all the boxes?
Yes.
I would say we have created very large scale, right? As Pankaj ji pointed out, that now we are producing, mobile phones with almost about, let's say about $45 to $50 billion, right? We have created very, very large employment. Almost 1 million people have been directly employed in this sector. Indian champions have been born and now are doing phenomenally well, and now they'll become global champions in times to come. So I would say that the scheme has done exceedingly well, but I think a lot of work still needs to be done, right? As I mentioned, that India still needs to emerge as the largest hub, manufacturing hub for the world. There are a few disabilities that continue in terms of, let's say, logistics cost and some other disabilities that we know of. So I feel that now the new PLI scheme that has come for components and working along with this PLI for mobile phones, maybe for a few more years, will really do the trick and will really help us achieve the objectives that we have of, as I mentioned, of making India the next hub for manufacturing for the world.
Can we compete with China at some point, Mr. Vachani?
Well, the point is, I think, when you ask that question, you need to see that what sort of scale they have created, right? For how long they've been doing this, right? We really started this whole journey maybe about, let's say, 10 to 12 years back, right? So there's no doubt we have a lot of catching up to do, but I think you've got to see the positive signs, right? The kind of scale that we've achieved, the kind of productivity our Indian champions and global champions are achieving in the country, which shows that given the right kind of inputs to our manpower, to our workers, to our operators, they can be the best in the world. So I'm very confident that, we can be the best in the world and compete with anybody in the world. But I think you've got to be patient and you've got to give us time.
Definitely. No, it's maybe we are getting ahead of ourselves. The fact is, there's no question about diminishing what we have achieved. The fact that we're making for India is huge. The fact that Apple wants to come in here is huge. The fact that Trump doesn't like it is also indicative of where that is going. I mean, if you're going to compare Make in America and Make in India, it's a no-brainer. Let me come to you on the question of now the US-China trade pact. And I know things like manufacturing and that kind of capital intensive investments don't happen because of one thing or the other. But nevertheless, with US and China in a trade pact, do you think it diminishes in any way what India could have done in that China plus one advantage?
Well, I think, first of all, the US-China is not really a trade pact that they've signed. It's not like a free trade agreement that has been signed. And second, the point that I wanted to make was, the kind of opportunity that exists in terms of the forthcoming, or at least the agreement that we look forward to between India and US, right? So as a country, we know that the US is a very large importer of products like mobile phones, even IT products. We believe almost $80 billion worth of IT products are imported into US every year. Almost $50 billion worth of mobile phones are imported to US every year. Even same numbers are with telecom. So there's no doubt it is a very, very large market. And I think in case India and US are able to come to an agreement on the free trade talks, I think it's going to be a huge opportunity because if India is a natural alternative, and if India were to able to capture even a small part of that, we're talking about absolutely huge numbers. So I think we are very excited about this possibility. I think I'll talk about this opportunity when it came, during Mr. Trump's first presidency when he came to power. And I think from that time, people started looking at an alternative to our neighbor, right? But unfortunately, that advantage went to Vietnam, right? And I think we saw a surge in exports in Vietnam of ICT products. But I've said this before, and I say it again, that I feel, and I'm very confident that this time around when this opportunity has come, the Indian industry is definitely better prepared. And I already mentioned it earlier that now we have a larger scale than what we used to have. We are now getting into components. We are now planning to get into the design ecosystem. And I feel if we put all these three together, our strengths together, definitely, this could be a very, very large opportunity for the country.
Oh, undoubtedly. And this is one which we cannot afford not to be in this space right now and continuously be an importer. I'm going to introduce to the conversation Prachir Singh. He's senior analyst at Counterpoint Research who tracks the space very closely as well. Prachir, hi. We've had a fascinating conversation on what has been working for the space. And the core question, of course, can India be the next smartphone hub? Can we beat China? I'm going to take that in two parts. Can we be the next global smartphone hub? What, in your view, do we need to do to ensure that we don't lose this opportunity?
Tamanna, we are already in a hub. So, so as per our data, if you see last year in 2024, India contributed to almost 18% of smartphone manufacturing. And this year, we can almost go to 25%. So if we talk about, is it a hub? Yes, it is a hub. Can we beat China? See, China has had a hard, a head start. So beating China at this point of time, is a long path. The government's policies and the industry's intent is in the right path, and with the component scheme that the government has launched, the intent looks correct. So I believe we are on the right path, but beating China at this point of time, it's a tough task.
At this point of time, right? And as Mr. Vachani just said, they've had several decades ahead of us in building this. The question is, how do we make sure we get there, and what do we need to do? What is the strategy? Pankaj Mohindru, should we get obsessed about making every component ourselves? We are living in and I think this is an important point to understand. There is one school of thought, and we're seeing a bit of that in America right now, that let's also make the chips. Let's also do the innovation. Let's also have the manufacturing. Let's do everything here, here, here. Is that the way we should look at it? Pankaj Mohindru, I'd like your view on this.
Tamanna, we have one single objective, 500 billion, right?
We'll get
That's
there.
a single objective.
We'll get there.
That's
At
a
this
single
pace, we're getting there.
अर्जुन की आंख सिर्फ उस चीज पे है 500 billion. Second, two Hindi idioms I'll tell you कि अगर हाथी रखने होते दरवाजे बहुत बड़े करने पड़ते हैं, right? So 500 billion is a big boys target where GVCs and Indian champions have to get created. So you need policies and regulations and ease of doing business, everything. All ducks have to be lined up.
No, you have to explain GVCs for my viewers. We use these terms, but let's simplify this, because this is something everyone's very interested in. How do we create GVCs? What are GVCs?
We don't create GVCs. GVCs have to participate here. A GVC is like Dell or like Apple, which is a lead firm, and a whole supply chain follows them. So when they participate in your economy, the economy shines, because 92% of the global electronic trade is in the hand of GVCs, and 70 to 75% of complete international trade is in the hand of GVCs. India has very little participation from GVCs across sectors. Like Colgate Palmolive is a GVC, P&G is a GVC. These are GVCs. Gillette is a GVC. The whole ecosystem. They are the lead firms and the GVCs. Now the GVC, the lead firm is the mother hen, and everything else operates under that. China did that, and they produced their champion companies also. Second important thing, Tamanna, the second Hindi idiom is, दूसरे के चिता पे हाथ नहीं सेकते, right? Today we are confident about smartphones because whatever geopolitical crossfire is going on, because we have a fundamental strength, which we created over 7-8 years. Today, the same thing is happening in hair bands, right? Same opportunity, but we are not able to produce hair bands. So every industry has to work deeply and create a base for the nation in that, whether it is Christmas trees or it is electronic toys, or it is, innocuous products, which are run-of-the-mill, which China produces probably 25, 30 million SKUs. We have to become an alternative base for that.
Sure.
Every sector has to participate
I want
in this
to get the practitioner's
revolution.
view. I want to get the practitioner's view. When we started our conversation, Mr. Vachani, you talked about some of the challenges, or I would say not even challenges, but things that we need to work on, what we need in the ecosystem to make it happen. First of all, do we need to stop obsessing about having every component in India and focus on what matters? Maybe innovation, design?
So I think, Pankaj has inspired me to, use another couplet and idiom. And I think that this by the famous poet Victor Hugo, who said that no power on earth can stop an idea whose time has come. So there is no doubt that this is our time, India's time has come, right? To your point, that what do we really need to do to make sure that this comes faster? I think there is no doubt that we need to strengthen our component ecosystem. Because the value addition that we have in mobile phones is extremely low right now. Of course, in other product categories, of course, right now we talk about mobile phones, but if you look at other product categories like home appliances, like products like air conditioners and refrigerators, viewers will be very happy to know that the value addition is as high as 75%, right? So I think we need to bring that kind of similar value addition across product categories. So focus on the component value addition, component ecosystem, focus on the reducing the logistics cost disability, focus on ease of doing business. And finally, as I said, let's continue that focus on building very, very large scale, because according to me, that is the most important element for global competitiveness.
That's really well said. We have to focus on the scale. We need to focus on what next for global competitiveness. What is the one thing, Mr. Vachani, that you would want to see in terms of ecosystem support?
So I think, as far as the government and industry alignment is concerned, thanks to ICN, there is, I think, excellent alignment. The government is really listening to the voice of the industry. So whatever feedback one has shared in the past, I think you see that most of the boxes are getting checked, right? But I think one thing that I would particularly like, and I think there is perfect alignment between me and Pankaj also on this, that if now we need to focus on creation of a design ecosystem. So just the way, there was a call given by our Honorable Prime Minister, this is maybe about 10 years back, that let's make India the hub for manufacturing for the world. I think a similar call needs to come on let's design in India besides making in India, right? Because I feel that India has huge strength in design capabilities. And if we combine our strength of large pool of manpower, skilled manpower, our cost structures and the design capabilities, I think this combination will be unbeatable. Yeah. So I think that call really needs to come now on let's design in India, and that call needs to follow, with some actions and some policies and how we can help our startups, our MSMEs, to invest money into designing of products.
Yep, that's the next bit. And of course, a Kickstarter will come in the form of a PLI scheme here and there, but it has to be an overview, a vision that this is where we need to go. We saw that innovation in our defense industry, for example. If there is a clear-minded view on keeping tech and innovation first. But a fantastic conversation. Thank you, gentlemen, for joining us on this edition of The Big Question. It's truly been a special one. We've asked the question today on whether India can be the next global smartphone hub. The resounding answer is why not? So that's all we have on this episode. Thank you so much for watching. And we're keen to hear your feedback, what you'd like to see on the show. We're listening.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Thanks for staying with NDTV. You're watching the Wednesday edition of the World Report. I'm Arjun Samar Mahendran. Let's take a look at what's making headlines around the globe. India's Operation Sindoor global outreach has officially kicked off with the first of 7 all-party delegations, in fact, led by Shiv Sena MP Shrikant Shinde heading to the UAE. The 59-member delegation, cutting across party lines, mind you, will travel to 32 countries and the European Union to present, in fact, India's firm stance against terrorism. Now, this diplomatic mission follows the Indian Armed Forces cross-border strike, or Operation Sindoor, after the dastardly Pahalgam terror attack last month on the 22nd of April. In fact, now each group is armed with dossiers, in fact, detailing Pakistan's role in global terror networks, and it aims to rally international support against cross-border terrorism. Meanwhile, my colleague Shiv Arur joins us to unpack and also underline the very importance of this unprecedented diplomatic reach out. Shiv, if you can hear me, now as leaders across party lines speak in one voice, we've seen, how is this effort, in fact, going to hit the nail in the head, when it comes to exposing, in fact, Pakistan's double game internationally?
Well, these MP delegations fanning out to different parts of the world are very much part of Operation Sindoor. What was visible so far was the military action, the kinetic action where India had imposed its will on Pakistan, pinning it down and dragging it virtually to the ceasefire table. But work isn't over yet. And as Prime Minister Modi said, Operation Sindoor has only paused. It's obviously tempting to look at Sindoor as only a military operation. But these MPs, are part of a national mission by themselves, parallel to the Indian military. They're going out into the world to emphasize India's, role and its commitment to its allies, to its friends, to its partners in the international community, to brief them about how things have really changed, to fill in the gaps of some of the questions that many of these countries may have. Because remember, as far as diplomatic support is concerned, even though India had overwhelming solidarity from all of its friends and every major country, of course, apart from Pakistan and China and Turkey, there were some misgivings in terms of certain countries trying to hyphenate India and Pakistan, to equidistance from India and Pakistan in an effort to de-escalate things. So these MPs have an important mission. It's not going to be an easy one. There will be many countries that will have some tricky questions as far as Operation Sindoor is concerned, but they've been briefed and they're ready.
So thank you so much for getting us the latest there, Shiv. Now, continuing with the same story, External Affairs Minister S. Jaishankar, in fact, met Danish Prime Minister Mette Frederiksen in Copenhagen on Tuesday, reaffirming India's commitment to its unique green strategic partnership with Denmark. Now, Dr. Jaishankar also conveyed PM Modi's personal greetings and thanked Denmark for its support in combating terrorism. Now, the two leaders also discussed regional and global security challenges. The meeting comes ahead of India-Nordic Summit in Norway later this year, in fact, where the External Affairs Minister will represent New Delhi in place of PM Modi. Meanwhile, a multi-pronged boycott of Turkey as well as Azerbaijan, along with Pakistan, driven by sheer public sentiment in India and strengthened by social media campaigns, has had an economic and diplomatic impact already on these two countries. In fact, reports also state that the clamor to ban the import of even apples from Turkey, which supports Pakistan in its nefarious fight against, which supports Pakistan in India's fight against terrorism, continues to grow louder. Trade, travel and brands are being phased out. Shifting focus to India and Asia, the larger Asian continent, the recent surge in COVID-19 cases in some of the Asian countries. Now, these...
As you know, we have seen multiple material developments since March. At the outset, we acknowledge that these developments are unfortunate for any organization, and it's painful to see these taking place, particularly in your own. However, the board is determined to address all identified issues so that we can move and resolve to move appropriately forward. I want to first spend a few minutes on the approach taken by the board to address the issues at hand. The irregularities disclosed indicate an inadequate emphasis on accounting analysis and rigor, as well as lapses in and violations of governance norms, internal controls, disclosure, and reporting mechanisms to the board. The board was not informed of the discrepancies, including at the time of approval of the financial results for the relevant accounting periods. Upon being made aware of the irregularities since March 2025, the board has swiftly taken active steps in understanding and addressing all areas of concern holistically and disclosing progress transparently at all appropriate stages. The board and the management set forth its desire of maintaining trust in the institution by aspiring for and implementing higher standards of transparency and compliance. The board is closely working with management and all relevant stakeholders so that the bank can be forthcoming in highlighting any irregularities which need to be addressed. The board, along with the management, has spent considerable time and effort in assessing in a timely manner all the irregularities brought to our attention. Wherever required, we sought assistance of reputed external professional firms in addition to detailed internal review. The bank is announcing this year's financial results slightly later than what it has done so in the past. Given the events which have transpired, the statutory auditors have done substantive checks with wider sample sizes to analyze any anomalies in financial reporting so that all the identified issues can be adequately and fairly accounted while finalizing Q4 results for financial year 24-25. The board and its committees are working with the management and external advisors to identify and address the root causes, rectifying any lapses in systems or processes, and imbibing learnings to tighten internal controls. These shall be reviewed and implemented under the board's oversight. We strongly believe these extra steps should help in avoiding such incidents happening in the future. While we address these immediate issues, we are also cognizant of the need to reinforce the governance culture and long-term sustainability of the organization. We are institutionalizing ethical best practices, robust systems and processes while rebuilding the talent desirous of delivery on such a framework. The board is also in the process of taking necessary steps to assess roles and responsibilities and fixing staff accountability as per the extant laws and internal code of conduct. We are approaching these aspects with utmost seriousness, without fear or favor to anyone involved in precipitation of these issues. The board is also continuously engaged with the regulators. The board would like to express its gratitude to the regulators and particularly the RBI for its support and guidance in helping navigate these challenging times. Whilst we have shared updates through stock exchange intimations and also as part of the financial statements for quarter 4 24-25, financial year 24-25, which have been disclosed, I will summarize the recent events and financial performance as follows. Number 1, the derivative accounting issue. The bank has received final reports from both external firms, and the financial impact is broadly similar to the earlier initial internal assessment. The bank has already discontinued internal accounting trades since 1st April 2024 and is in the process of taking further measures to improve internal controls and processes to prevent such lapses occurring again. The board has also taken a very serious view with respect of staff accountability across levels to reinforce the governance and compliance culture and is in the process of taking actions for staff accountability. Number 2, additional rigorous review. In addition, in light of the derivative accounting issue, the board has also worked with the management and the statutory auditors to undertake an enhanced and much more rigorous review as part of finalizing the financials, including thorough reviews by the internal audit department of the bank. As part of this exercise, the bank has identified the following significant matters which have been appropriately accounted for in the financials for quarter 4 24 financial year 24-25. Number 1, microfinance portfolio. The reviews identified that over the first 3 quarters of financial year 24-25, there was incorrect recording interest income and fee income. The review has also identified the misclassification of certain microfinance loans which have resulted in under-provisioning and non-recognition of NPAs aggregating rupees 1,885 crores. The bank has addressed the underlying cause and is in the process of taking actions for staff accountability. Other matters. As part of the review, it was also noted that there was certain unsubstantiated balance in other assets and other liabilities accounts of the bank, and that an amount approximately of rupees 760 crore has been incorrectly classified as interest income instead of other income. Based on review of all these matters and reports received by the board suspects the occurrence of fraud against the bank and the involvement therein of certain employees having a significant role in the accounting and financial reporting of the bank. Accordingly, the bank has directed necessary steps to be taken under applicable law, including reporting to regulatory authorities and investigative agencies, and to also fix accountability of all persons responsible for these lapses. The financial impact absorbed in quarter 4 financials in FY 24-25. The financial impact of all the above has been fully taken in the audited financial statements of the bank for the financial year 2024-25. The bank's approach towards financials has been to start FY 25-26 on a clean slate without carrying forward any of the past issues. The bank has thoroughly reviewed all the lines of accounting and has taken a conservative view in some of the accounting treatments. This has reflected in a few one-offs versus the business as usual run rate, which we shall delve deeper in subsequent sections. The bank's balance sheet remains healthy after absorbing all these changes with a capital adequacy ratio of 16.24%. I repeat, capital adequacy ratio of 16.24%, a provision coverage ratio of 70%, and an average liquidity coverage ratio of 118% with an excess liquidity of rupees 39,600 crores. The liquidity remains comfortable in current quarter as well, with an average LCR of 139% in the first half of this quarter. I would now refer to the leadership transition. Following the findings of external review announced on 27th of April 2025, the bank's CEO and Deputy CEO had resigned from their respective roles thereafter. The RBI has advised the bank to submit proposals for appointment of the new CEO for RBI's approval by 30th June 2025. The board is at an advanced stage in the selection process and is confident that the recommendations will be submitted to the RBI in advance of the timeline prescribed. This will provide strong leadership and management stability at the bank. The board is determined to identify and expeditiously induct strong leadership with right competencies, strong ethics, and the ability to build and scale a robust franchise. In the interim, and as approved by the RBI, the Committee of Executives, which is Anil Rao and Soumitra Sen, is entrusted to oversee the operations of the bank. The Committee of Executives is guided by an oversight committee of the board comprising of the chairpersons of the board, the Risk Management Committee, the Compensation and Nomination Committee, and the Audit Committee of the board. The Board of Directors and the management team is committed to ensure a smooth transition. I would now like to reinforce the ethos of governance while executing the growth strategy from here on. The board is working with the management to bring in a cultural shift towards achieving high standards of ethics and governance. We want to build an environment of open and honest communication with all the stakeholders, prioritizing long-term sustainability over short-term achievements. Compliance with extant regulations in form as well as spirit is non-negotiable. A one bank vision, breaking the silos by laying a strong foundation would ensure avoiding repetition of such episodes, providing uninterrupted execution on the bank's strategic growth objectives. I will now hand over to Soumitra Sen to take you through the highlights on individual businesses. Soumitra, over to you.
Yeah. Thank you, Chairman. Let me start with the vehicle finance, one of the business pillars of the bank. Our vehicle loan book at rupees 95,595 crores grew at 8% YOY and 2% quarter-on-quarter. The disbursements for Q4 was 12,273 crores, which was 3% YOY growth. Full year disbursements were at a whopping 47,600 crores. The industry volumes across categories have grown by single digit during the year. We have maintained stable market share across categories of commercial vehicle, construction equipment, and passenger cars. We also consolidated our position in tractors as we reinforced our processes and credit underwriting. The asset quality trends have been improving since Q3. After the first half, which was slightly weak, the sequential improvement in gross slippages continued in Q4 as well. It was 0.74 last quarter and it's 0.70 in Q4. All the vehicle segments except tractors saw a sequentially stable and improved gross slippages. We are refrained from selling NPAs to ARC during this quarter, and we focused on our own collection drives. This, however, optically increases the GNPA ratios. The restructured book in the vehicle finance continues to show a reduction. We started the year with 547 and now it's 119 here at the end of financial year 25. And majority of this reduction has come from upgrades and recoveries. Looking ahead, improving fiscal spends, benign oil prices, falling interest rates, monsoon being absolutely fine, I think we should be supporting the recovery in the industry volumes. Let me now get into Bharat Financial. The outstanding loan book is now 38,169 crores. it's down 2% quarter-on-quarter, but 15% and YOY. The microfinance business showed signs of stabilization in quarter 4. The disbursements were up 1.4% quarter-on-quarter. We followed a very cautious approach for disbursements with 94% of disbursements in quarter 4 with the branches with low flows from the current areas and to customers and centers with high vintage with us. We have implemented the MFIN guardrails effective from April 1, 2025. This restricts disbursements to customers with not more than 3 lenders. With large customer base unique to us and our conservative ceiling on clients' overall exposure, the impact of the business has been limited so far. We have disclosed early trends in the delinquency buckets, and they have improved in both stock as well as fresh flows of delinquencies. Now let me give you a brief of the Karnataka situation. It's improving, and the current book net of the collection efficiency in Karnataka has improved from 96.4% in February 25 to 98.2% in March 25. As a result, the 31 to 90 days past due reduced to 2.3 in March 25, down from 4.1% in December 24. We have also disclosed trend in all standard overdue customers, that's 0 DPD to GNPA, which is heading back to normalcy. The slippages were elevated during the quarter due to the accumulated stress in the earlier quarters and misclassification of certain loan accounts, which was corrected in quarter 4. Now, Bharat Superstore, that's the merchant acquiring business under the BIFL banner. We have now 664,000 merchants under this program. The book is 7,260 crores, growing at 30% year-on-year. The share of non-MFI book has improved to 19% from 12% year-on-year. The total liabilities through BIFL now stands at 2,680 crores, up 3% quarter-on-quarter, and it has 19 million accounts. Overall, the portfolio stress witnessed last year is winning. As we see the portfolio quality improving in most states, we are cautiously focusing on disbursements in select geographies amongst clients with higher vintage. With the implementation of MFIN guidelines, further strengthening of controls, the Karnataka operations steadily getting back to normalcy, our focus is to ensure disbursement quality, dedicated efforts on collection and recovery, and continued diversification of the loan book. Now let me brief you about the corporate bank. During the quarter, we let go some of the corporate loans for balance sheet management and liquidity management. Consequently, our corporate loan book has come down by 16% quarter-on-quarter and 6% YOY. This was only a tactical decision, keeping in mind the short-term objectives of the bank. The overall strategy of scaling up granular and small corporates with selective exposure to large corporate continues to be implemented. The proportion of A plus and above rated customers at 77% has been steady YOY. Slight decline quarter-on-quarter versus 79% of last quarter. But as we go in for some high-rated loans, the weighted average rating was 2.57 versus 2.51 year-on-year. Now let me brief you about the diamond business. It continues to show healthy growth, the asset quality with no SMA1 and SMA2. While growth is subdued due to weak industry demand, industry, we are liaising with the stakeholders for suitable terms in bilateral trade discussions. We are closely monitoring the developments and are comfortable with the exposures as of now. The gross slippages in the corporate book, which were at 204 crores, mainly contributed by one restructured real estate amount accounting to 140 crores. The full gross slippages for corporate book improved from 44% to 0.44% to versus 0.54% year-on-year. The corporate restructured book also has now reduced to 147 crores from the 583 crores at the start of the year. Our SMA1 and SMA2 book collectively stands at 24 bips versus 20 bips quarter-on-quarter. Overall, while we have consolidated our corporate book during the quarter, we have resumed our disbursements selectively in focus areas, and growth in corporate bank should start reflecting in the coming quarters. Now, let's talk about the other retail assets. Our other retail assets maintained growth momentum with 17% YOY and 6% quarter-on-quarter. The MSME book under business banking is at 18,232 crores, grew 9% YOY and 3% quarter-on-quarter. The LAP book maintains steady traction with 15% YOY and 3% quarter-on-quarter growth. We continue to focus on home loan scale up with outstanding now at 4,491 crores, growing at 151 year-on-year and 43% quarter-on-quarter. It's a small book, so look, the percentage growth looks very attractive. The credit card spends at 27,666 crores were broadly steady. Our market share in credit card spends was at 5.31 based on the latest available data. Overall, we should continue to scale our other assets and at the fastest pace with focus on improving diversification of loan book while increasing the retail secured mix with home loans and MSME. Now coming to liabilities. Total deposits was at 4,10,862 crores. It grew 7% YOY while remaining steady at quarter-on-quarter. Our deposit franchise had shown resilience during the turbulent last couple of months. We have proactively engaged with our customers, rebuilding the trust in the institution. These initiatives helped stabilize our deposit base after a temporary blip post the disclosure on March 10th. The retail deposits as per LCR grew 9% YOY, contributing to 45.1% of overall deposits versus 44.1 year-on-year. That's a 100 bips increase in 1 year. We have carried healthy liquidity during the quarter with the average LCR at 118% and an average surplus liquidity at 39,600. The period end LCR as of 31st of March 25 was at 136%, along with surplus liquidity of 62,000 crores. The liquidity position continues to be healthy during the current quarter as well, with the average LCR at the first half of the quarter being at 139%. Apart from the short-term disruptions in March, our new initiatives of affluent banking and NRI banking continue to scale up at the healthy and sustained pace. Affluent segment deposits at 58,300 crores grew at 9% YOY. Affluent AUM at 102,000 crores has now crossed 1 lakh crores mark, growing at 24% YOY. Our NRI segment deposits at 58,300 crores grew by 28% YOY. Share of the top 20 depositors is now reduced to 14.8% in March 25 versus 17.4% YOY. It shows the debulking which we are doing. The share of certificates of deposits at 8.2% of overall deposits and borrowings at 9.7% of total liabilities. Overall, our deposit franchise showed resilience during the turbulent time. Looking ahead, we remain confident on resuming our journey towards building granular retail deposit franchise while keeping our cost of deposits in check. The developments around easing liquidity also goes well for our deposit franchise.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of
Hello and welcome to NDTV Profit. You're watching Earnings Edge. Of course, we are fresh out of IndusInd Bank's bombshell disclosures talking about what this quarter meant for the bank. And of course, the bank has reported over 2,400 crores in losses, but that's actually not the key story. The key story is the multiple governance issues that the bank has talked about. In fact, this is the first time that the bank has come out with a disclosure saying that it is suspecting if fraud was committed against the bank and that the board and the auditors are now swinging into action. They're reaching out to appropriate authorities and are going to file cases, and of course the situation is going to take off from there. This is a tough time for IndusInd Bank. You know, already on the 10th of March, the bank disclosed derivatives accounting issues where about the impact was about 1,960 crore. There were multiple investigations and then internal investigations as well, which found further issues in the bank's balance sheet. One was with respect to the microfinance book, where the bank had incorrectly recorded interest income. And then again on the other assets and other liabilities account, where again the bank saw unsubstantiated balances in the bank. Now, of course, with today's disclosure, which is coming in significantly later than what the bank actually originally wanted to put out, but what they are disclosing is that there's more than these issues. In fact, one of the points in the notes to accounts states that in the microfinance business, IndusInd Bank found that certain accounts, certain microfinance accounts were incorrectly being classified as standard accounts, and they have now been transferred into the NPA category, and the bank has taken a 95% provision against them. This is adding up to a financial impact of over 1,900 crore for the bank just in this one piece of the balance sheet. I have with me Aditya Shah of Hercules Advisors. Aditya, welcome to this conversation. I want to start with the multiple sort of governance issues that are coming out. How are you seeing these disclosures?
So, hi, good evening, Vishy. So we've seen, wow, what is happening at IndusInd is clearly unacceptable. On one hand, the derivatives accounting was a problem. Now the bank is coming out and saying that we reported extra income on the microfinance side of it, unaccounted income, and we did not provision for accounts that went into NPA. So the entire corporate governance at IndusInd Bank is really at question. There's no doubt about it that this is a fraud. The bank will need to take action on this. If the trust on IndusInd Bank is really now broken, the bank, as the chairman said, that the RBI has moved swiftly and asked them to submit a new leader by 30th of June. So that is one positive out of it. We can expect over the period of next 2 to 3 months a new leader will come in. But trust on IndusInd Bank is really broken at this stage. The stock market will not take this very kindly.
Aditya, but relevant question here is who exactly is going to come in? When the Reserve Bank of India had asked them to bring in, as of 29th of April, when the then existing CEO Sumant Kathpalia stepped down from the bank's management, a lot has changed. A lot of new information has come to the fore. I'm just thinking that anybody who is interviewing for the CEO role at this point in time is probably looking at these disclosures and saying, do I even want to risk my career getting into this bank?
Obviously, it's a risky job. We've come out of Island FS crisis, Uday Kotak led it. We've come out of a Yes Bank crisis as well, where RBI chose somebody to lead the bank, and the bank is doing fairly okay now. It's a crisis time, and many people will not want to come in. But good leaders, this is a defining moment for good leaders. The bank will undergo a cleanup over the next 1.5, 2 years. Post which there will be some growth for equity investors per se. But next 1 or 2 years look really very tough from a bank's perspective as cleanups happen, systems and processes are put back in place. And this is a dramatic change from what Ramesh Hapti really was. Sumant Kathpalia needs to be asked what was happening at the bank. He needs to be held accountable for this.
You know, in the auditor's note, of course, they mentioned that they suspect that people in the senior management as well as former KMPs, and I'm referring to the former CEO and deputy CEO who both stepped down now, they were involved in concealment of fact and that accounting gaps were not being disclosed properly to the board and the statutory auditors. They have said that they also suspect that there is likely a fraud that is going on and that they have made appropriate complaints. Do you think that maybe this can have an impact even after Mr. Sumant Katpalia and Arun Khurana have stepped down?
So there needs to be thorough investigation so that RBI can stop this from happening in the future. What really happened here? How was the senior management involved? And even the auditors, how did the auditors not look at accounts which were NPA, classified them as standard accounts, and the bank did not take provision? See, in the stock market, management tend to do this, that they don't want to show NPAs so that the market views them very kindly. That's a normal phenomenon, but what were the auditors really doing needs to be questioned here. What were the senior management really doing needs to be questioned here. So from my perspective, the entire management, the entire board and the entire auditor, all of them need to be reviewed, and most likely all of them need to get changed if IndusInd Bank needs to come out of this mess.
You gave the examples of Ireland FS and Yes Bank in this scenario, but in both those cases, you know, in Ireland FS, the government took charge and the committee that was being led by Uday Kotak was actually appointed by the government. That was not done through an independent board. Similarly, at Yes Bank, the RBI appointed Prashant Kumar as an interim CEO, and then, of course, later on he was confirmed as a full-time CEO. Do you think that something like that is probably essential here?
Here, essentially, what is going to really happen is RBI is going to say who they want to really choose. The board is just now a sitting mimic board. I think the RBI will take control, and the RBI will say that, boss, I want this person on board, so that over a period of next 2 to 3 years, systems and processes are re-established. The major concern is systems and processes in IndusInd Bank have taken a beating, and